Plan. So this is the kind of response we might see from other automakers as they try to get a handle on what's happening to their businesses. On the pharmaceutical sector then, Guy, watch Novartis. This could be a story in the different direction, raising their forecast after profit beats estimate, and AstraZeneca getting a profit boost from their diabetes and cancer drugs. So that sector could move differently to some others, Guy.
And a little bit of help from the tax situation as well for Astra. Okay, let's talk a little bit about the final story going into this market open. A lot of corporates to digest. It's going to be interesting to see how the kind of the macro top-down interacts this morning with the bottom-up story. FTSE 100, BP is going to be a story in that market. You've got ABF out with numbers too. You've actually got some inflation data I think is worth paying attention to as well, which is the top-down picture there. But the FTSE 100 is up by 0.3%. The Stoxx 600 flat as a pancake this morning. No clear sense of direction. This is a market that's got a lot to think about right now and is struggling to find a sense of direction as a result of that. The IBEX, obviously, the focus there is what is happening with the national crisis surrounding the electricity grid. That market, interestingly enough, up by 0.2%, pretty much in line with what we're seeing around Europe this morning. You do wonder what the longer-term fallout from that story is going to be economically. The CAC 40, we wait to see what happens there. This morning, the DAX has a little bit of news to digest, as a result of which we're back to normal form. It takes a few minutes to get open. So let's figure out what is happening with the sector story. Kruti, over to you.
Well, we're seeing some broad gains, even though, of course, there are marginal gains. They are still largely in the green, Guy. And I think this is interesting because when you look at the downside, it's two major earnings stories, Anna, that we're looking at. AstraZeneca and BP, from an index contribution perspective, both taking a beating. AstraZeneca down a whopping 4%. I think that's what's dragging down the healthcare index because Novo Nordisk is also trading lower right alongside it. But then BP as well, down about 2.6% this morning. So, of course, commodities are very much in focus. But BP, perhaps the underperformer of that broader sector.
Yeah, interesting to see that energy and basic resources move in very different directions. So as you say, the energy story has the BP numbers in it. We heard from them today, and that stock down by 2.9%. So there's sort of stock specifics, and the oil price is weaker. So we're down by 1% at 65.20 on Brent. Basic resources, though, that sector is going higher. Perhaps it, if we're looking for a tiny bit of risk on in markets, I mean, that's a stretch, isn't it? But there maybe is that element to it. We are a little bit firmer on basic resources this morning. Banks, the best performing sector, though, as it stands right now. And of course, we've heard from HSBC, we've heard from Deutsche Bank. Deutsche Bank, their shares opening up by 3.9%, HSBC up by 1.4%.
Yep, just keeping an eye on the defence shares as well. It's interesting, Rheinmetall up very strongly. Preliminary results out this morning. Love a German company. Surprisingly upbeat. Well, not surprisingly, but upbeat, and that's a surprise. The market likes what it is hearing out of that company. Astra is interesting. Weakness there, despite the fact actually in theory this looks like actually a decent story. There's a lot of tax in the mix as well in terms of what is helping out here, but it's interesting to see that Astra not having a particularly strong start to the day, in fact showing some considerable signs of weakness, which is weighing on the FTSE 100. That stock down by 3.5% this morning. I just wonder if this is about the quality of the beat in terms of what they've delivered this morning.
Maybe, I mean, and in terms of the tariff narrative, he was pretty positive, wasn't he? Downplaying the extent to which this was going to be something that hurts their business.
Downplaying the effect, but also doubling down on the investment, which is, as several of our guests this morning have said, there are pros and cons to kind of building that kind of exposure. Also talk about some broad beats. When you look at the banking sector, Deutsche Bank, HSBC, BBVA, BNP Paribas, all moving the index higher when it comes to some of those earnings stories as well. Let's go straight to our markets desk here. Rory McPherson, CIO at Ren Sterling, joins us around the table. Rory, pleasure to have you on the program. We've seen a lot of volatility in the last month or 2 months, to say the least. Is it over? Is the worst behind us?
I don't know if it's over yet. I think the worst probably is behind us. I think we've seen the bond market serve to put a bit of a lid on some of the more extreme policies from the Trump administration. We saw the rollback last week as bond yields spiked up to sort of 4.4%. Straight after Liberation Day, as bond yields spike, we saw President Trump come out and dial down some of the rhetoric that he'd been speaking about and was a bit more positive on markets. So I think with the debt levels they've got, that $36 trillion of debt and the funding costs around that, I think they will respond to the bond market. So I think as yields tick higher, you will see those policies start to come down. I think that's what we've seen, and it seems the narrative is a little more calm in markets at the moment.
So is the bond market driving the stock market, or is the stock market driving the bond market?
I think, as always, for me, it's the bond market that drives things, and I think economic policy from the Trump administration has clearly spooked the bond market a little bit, particularly US yields at the longer end. And I think that's driven some of the softening in tone from the US administration, which is feeding through to markets. Also, we've had some, as you've spoken about, some really strong earnings that have come through, which kind of got forgotten about. At the start of the earnings season, we had US banks with some good numbers, and we started to see that a little bit more last week in the US with Alphabet, and some numbers this week as well with the UK banks.
Yes, the banking sector seems to show some resilience, Rory, and that's maybe they're a step removed, aren't they, from the tariff question. But some of their clients, some of their customers in specific industries will start over time to be affected, won't they? And I'm thinking now about the auto sector. We've got Volvo Cars down 10%. We've got Porsche under pressure this morning. The theme for that sector, it faces a number of challenges. Even if you get a slight rollback in some of the tariff regime, this is still a sector under pressure.
For sure. For sure, it's a challenge sector. It has been for some time. It's one that's in the eyes of trade policy as well. And I think the consumer is under pressure. We know that. We've seen a little bit of roll forward on spend on some of the autos, but I think the guidance has tended to be a little bit on the weak side, because it's very hard to forecast high spending of a consumer that's under pressure.
How is FX playing into this? Obviously, the strong dollar the weakness in the dollar over recent weeks has been the key theme in markets. I was reading some research by Deutsche Bank yesterday that talked about that continuing. So continued weakness in the dollar, the euro up to 130, they say, the yen up to 114, the pound up to 145. Is this having an impact on your thinking? Are you watching this dollar move intensely, and is that impacting on your strategy?
Well, look, it's a really interesting dynamic when you have the dollar selling off, bonds selling off, US equity markets selling off. It's highly unusual. It speaks to the policy that's in place. I mean, I think ultimately, the dollar is still a strong currency. The US is world's biggest economy, and it's got really good growth. So, we're not throwing the towel in on the dollar or US markets at this point.
Yeah, interesting to see the HSBC CEO making that point, saying it's important the dollar stays the reserve currency. The Barclays CEO was saying it. Even European Eurozone central bankers have been saying it's important that the dollar stays the reserve currency.
Absolutely.
Nobody wants to
But if you're a European investor, the dollar is a real problem right now.
Yeah.
So if you put money to work in the United States, I'm really drawn at the moment by the difference between US investors and European investors. European investors' view on the States is much more pessimistic than US investors is right now. And data kind of speaks to that. So if you're a US investor, the S&P is only down by 6%. Okay, great. No problem at all. 6%, that's a nice little drawdown by the dip. Happy days. If you're a European investor, year to date, the S&P is down by 15%. Okay? The Nasdaq is down by nearly 20%. And that's the dollar effect coming through. And that kind of explains maybe the difference we're seeing. In terms of being a foreigner wanting to invest in the United States, the currency seems absolutely critical at the moment, because you need to adjust for it. If the euro goes to 130, those numbers are going to look even worse. Does that tell me, as a European investor, to be very wary of parking money in the States right now? Because I'm going to continue to be hurt by that currency story.
Our view is it's too late to hedge that now, because obviously the dollar sold off a lot this year. I mean, in the very long term, currency tends to be a wash in equity markets. Yep. So we would look at it and say, actually, now it's a good time to be nudging back into the US equity market. As you say, you're adding on 7% to a downfall of 6 to 7% already.
That number could get worse. Well, we could go much higher on the euro. Presumably, the currency effect could get greater, not less. It could undermine any gains that potentially I could make in the US market. Potentially, but I suppose at some point when the trade issue calms down, we get back to interest rate differentials, and then you're back to the dollar. Okay, we'll watch that moment. Rory, nice to see you. Thank you very much indeed for coming to see us. Rory McPherson, CIO of rand sterling. Core 6 looks like this morning. Some key names do certainly stand out from this story. The auto sector is under pressure, but Ferrari is not. It's interesting, Francine is going to be speaking to the Ferrari CEO a little bit later on. Staying in luxury, though, we are seeing some weakness in LVMH. The pharma sector is definitely back under pressure. A little bit of safety. Look at that bid into Nestlé this morning.
Coming up on the programme, we speak to the CEO of the world's largest sovereign wealth fund as investors navigate market turmoil from Trump's tariffs. That interview is coming up next. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Minutes into the session, I have to say, I don't think the indices really do justice to what is happening out there. There are some fairly chunky single stock moves that we are watching. Thul's down by 11%, Electrolux 9%, ABF nearly 9%, Porsche's down by 7.4%, Schneider is down by 6.22% this morning. There are some really big drops on single stock names as they reveal earnings. The earnings story is interesting. Rheinmetall on the other side, Capgemini, both doing very well this morning. Let's put some of this into perspective. I want to take you to Oslo now. The Norwegian Sovereign Wealth Fund Investment Summit is taking place. Francine is there, and she's with probably the most famous Norwegian when it comes to the world of finance. Fran.
Yeah, the most famous Norwegian. I mean, there are many famous Norwegians, but he's certainly the most famous in the markets. I'm delighted, Guy, to be here in Oslo and to be joined by Nicolai Tangen, the Chief Executive Officer of the Norwegian Wealth Fund. Nicolai, as always, thank you so much for joining us. The markets are all over the place. One minute they're happy, 1 minute they're worried. I know inflation underpins everything. Are the markets too optimistic about what we'll live through in the next 6 to 8 months?
Well, it's a very interesting question. You know, in a way, the world is splitting into two.
And that means that we probably will see lower growth, and there is a risk that we will see higher inflation. And so the market is very resilient given that backdrop, I think.
So, which means that you're expecting maybe a correction, and are there parts of the markets that seem too sanguine at the moment?
Well, we've been saying for quite some time that we think it will be more difficult to make money going forward. And so I suspect with all the uncertainty that we are seeing just now, that we could continue to see, tough times.
So what's it like being in the markets? Do you worry? Is this an opportunity? What does it mean for how you position your portfolio for a long-term investment?
Well, I think the way to behave in the market now is just to be broadly diversified and very, very long-term. You really need to put your long-term hat on. And I think to do, tactical reallocations and movements is very, very difficult because they move so fast. When we last met in Davos, it looked like the US was going to be fantastic from a stock market point of view, and Europe, all the leaders we met from Europe were really, really depressed. Well, you fast forward a couple of months, and the whole thing is just turned upside down. So it's very, very difficult to get these turns right.
But, Nikolai, what does it mean longer term? Because actually it's unclear where the trade barriers exist, whether market pressure will make the Trump administration do a U-turn. So even 3-4 years of visibility is extremely difficult.
Yeah, no, absolutely. We really don't know how this is going to pan out. I think what is certain is that the long-term trend of globalization, growth, these kind of things, that will look very, very different going forward. So the easy money is not there anymore.
You have over, I think, 50% allocation into U.S. assets. Does that change?
No, we are very happy with our U.S. allocation. We have, big holdings in Treasury, and we have, big holdings in the large companies in America. They are great companies, and we love owning them.
But, treasuries, are they a safe haven? What are they? Because
yes,
we think quite differently.
We think it's the safest place you can be.
Still now, despite the market move and some of the uncertainty?
Yeah.
That means dollar stays a reserve currency?
Well, so there are other people who are better when it comes to currencies than me. We, for instance, did a podcast with Ken Rogoff last week, so tune into that one and find out.
I love that I'm speaking to podcaster to podcaster, but Nikolai, overall, so 15%, for example, Europe. Yeah. Are you allocating more to Europe, as opposed to other emerging markets?
No. So what we have a very clear mandate from the Ministry of Finance, which in broad terms tell us where we should be invested. And what we do is we are very, very long term. We stick to the mandate and make just small allocation relative to that. And I actually think to have a long-term plan and a long-term mandate in these turbulent times is a very, very good idea.
But it's hard. When you look at, for example, the Magnificent Seven, some of the tech stocks, you were slammed because of the market volatility in those. Yeah. So staying in takes quite a lot of courage.
Yeah, on the one hand, on the other hand, we are, after having been down, the market is now pretty much back to where it was when you look at the global index. And, the fund is pretty much where we were at the beginning of the year. So you just have to sit through some of this volatility. I think it's interesting, when you look at our first quarter results, we were down some $40 billion. Now, that's giving back only 10% of the combined gains of the 2 prior years. And markets don't go up in a straight line. You have to assume some volatility here.
They also don't go down in a straight line.
That's also correct.
Where do they go down first? Is there any indicator that you see for a bigger market correction?
Well, I think it's all depending on what's going on with the trade tariffs and whether you manage to solve the the relationship between the superpowers, right? We are seeing impact now in terms of incoming container traffic into the US and so on. So starts to have some real economic effects.
Nikolai, when you say, we started the conversation by saying actually there's a split, right? There's a fragmentation around the world. What does that mean for tech stocks? Why are you so still invested in them? Do you think they're immune to it?
Well, so I think if you have this fragmentation, it will have more negative implications for markets. We publish our stress tests every year, and we put them on our website so that people know what we think in the various types of outcome scenarios. We think if you have a proper fragmentation of the world, could be like 35-40% downside in markets.
Did you actually, change your portfolio to maybe add some stocks or certain positions when there was a market rout?
So we have a very delegated mandates within the fund. So some people would have done that, and some people wouldn't. It depends. It's a very high level of accountability in this fund.
Out of the Magnificent Seven, is there one that you think will come up better than others?
It's difficult to say, but it is, what is clear is that AI has really real implications for efficiency. So last year, we think we increased efficiency and productivity in the fund by 15% by using the new tools. I think this year will be even higher, you know. And so we are working really, really hard with it and applying it to the whole tech stack that we have. And it's has got huge results.
What's Tesla? So is it a Trump play? Is it a renewables play? Is it what do you do with the stock?
Well, I don't have a firm or specific view on that one particular company. So I think you can perceive that in many different ways. You know what it is actually.
So when you look at China, how does China play into all of this? I mean, the biggest fight on earth is probably between the U.S. and China.
Yeah.
How does that change again your position on where you make money and how?
Yeah. So again, we look at China as a collection of companies. We think they have some great companies, and we are invested in those companies. We don't really do, allocation just based on geography. When you look at the U.S. tech stocks, they would have exposures around the world, and just because they are listed in America doesn't mean they are U.S.-only stocks, right? Same in Europe. You look at the big European companies; they are global companies, global leaders in. You know, the Swedish companies are global industrial leaders. In Denmark, you have pharma companies. In France, you have, luxury goods companies. These are global leaders, incredible companies.
But because of the tariffs, are you expecting the tariffs to come back down? Again, you don't know whether a tariff is put in place now.
I don't know. I think there is one guy who knows, and it's not me.
So you just stay firm. Nikolai, talk to me about renewables.
Yeah.
I mean, it's clear that it's not part of the Trump administration focus right now.
Yeah.
What does that mean for how expensive they'll be and actually transition?
Yeah, we got it into our mandate some 3-4 years ago that we could actually start to invest in renewable infrastructure. And at that stage, these stocks were investments were just very expensive, low yield, a lot of competition to get in because everybody was trying to make their portfolio a bit greener. So we did very little. Now it's very different, right? They are not particularly in favor. The potential returns are coming up. There is less competition, and so we can make real investments here at good returns, and that's what we're doing.
Where? Europe?
In Europe and also potentially in the US.
US, so it hasn't. Do you think it slowed down actually the adoption of renewables in the US?
Well, I mean, it depends whether you are talking about wind or solar. We think they are potentially attractive investments.
What about the less liquid real estate? I know you're tipping your toe into this to because of mandates.
Yeah, well, we're tipping our toe. It's a pretty big toe because we have close to 1,000 properties. We own 25% of Regent Street in London. We own big holdings in Manhattan and so on. I think relative to the stock market, these things start to be pretty attractive. You had kind of a perfect storm with everything from COVID, working from home, regional bank uncertainty and so on in the US. Now, just relative to other alternative investments, I think some of them are pretty attractive.
So less liquid, but actually more attractive in terms of returns. Will you be buying more?
If we find the right ones, yes.
So right ones is what? Prime real estate in big capitals?
Yeah, prime has generally done better than less good real estate.
Nikolai, I can't tell whether you're bullish or not on the U.S. because you say invested in the U.S. you have 50%. But do you think some of this is an opportunity for Europe to either attract talent, attract companies, and attract capital?
Well, in the long term, U.S. has got a terrific, spirit, innovation, ability, great companies, great management, business models, and so on. What we're seeing now, we are seeing that Europe potentially is getting its act together, taking away some bureaucracy, starting to try to cooperate, merge businesses to make kind of stronger champions. And I think we're seeing the start of that, and I think there is a sense of urgency kind of creeping in there. So it will be really, really interesting to follow. Now, I think you can look at this world in many different ways. You can put on your, you can be worried or depressed and so on, or you can put on your student hat, which is what I'm doing. Your student hat, because we are at a time where things are changing so fast, at the same time as technology development is incredibly fast. And so just to live, at these times and see what's going on here is just so fascinating.
I love your podcast, and you have someone from Formula One. Did you learn anything about leadership, or what's the best piece of advice you've gotten for leaders?
So the Formula One episode is out in a few weeks, and I think what is really fun there is to talk about speed. Of course, they really live in the fast lane. But that's not only about the race, but it's also how they think about speed in the organization, speed in decision making, all these kind of things. It's just really, really fascinating. And he's a very, very charming and professional CEO,
I mean, speed, it's like the bond traders, March 22nd. Nikolai, thank you so much. Nikolai Tangen there, the Chief Executive Officer of the Norwegian Wealth Fund. Back to you, Anna, and we'll have plenty more, of course, from the conference here in Oslo throughout the day.
Absolutely. Francine, thank you very much for that. Francine Lacroix, anchor of the Pulse, of course, at the Norway Wealth Fund Investment Summit. As she says, lots more still to come. And stay tuned for our exclusive interview with the Goldman Sachs CEO, David Solomon. That is at 10:30 a.m. UK time. Let's take a check on some of the individual stocks that are on the move. There are so many. How on earth has Charlie Wells chosen, narrowed down the list? Charlie?
Anna, so we're seeing so much movement in the market on the back of these earnings reports, this spate of earnings reports that have dropped this morning. We got to start with some significant beats. I'm thinking about the banking sector here. HSBC reporting a profit beat. They're up 2.2% this morning, and they were able to announce a $3 billion buyback. That's got to be pleasing shareholders right now. Another banking beat, Deutsche Bank. Their CEO said they had the best quarterly profit in 14 years, up 3.5%. So significant beats in the banking sector there. I want to talk a little bit more about the automotive sector, however. We've got Porsche and Volvo also out with reports. We've got a kind of different picture here, a lot of red on that screen. Porsche, they have no capacity to manufacture in North America. That leaves them vulnerable, and they had a significant miss, down 0.79%. And Volvo Cars had to withdraw their guidance, not just for this year, but for the year after that, down 8.5%. So pressure in that auto space we're seeing today. More reports on autos coming this week. We should also talk about Schneider Electric. So this is, we've got that AstraZeneca screen up. They're down 4%. And I think, look, we've got a solid pipeline from this company. We've got, solid earnings coming on the back of diabetes drugs, on cancer drugs, but also this looming threat of sectoral tariffs that are coming, that there's a lot of uncertainty about that. And let's end on this kind of energy theme. We've got BP and Schneider we need to talk about. BP, again, the question had been about the buyback, and they announced a buyback on the lower end of that guidance. We're seeing down 3.7%. That's some disappointment there. Schneider, they make a lot of the electric things in your house, plugs, chargers, etc., down 6.3% on the back of a disappointing earnings report.
Bloomberg's Charlie Wells walking us through some of those early movers. As Guy said, there are some really significant ones that perhaps aren't showing up when it comes to the surface. We thank you so much for walking us through some of those early movers. I can't quite tell what the narrative is today. Is there even a narrative when we're talking about this market, or is it just everyone stay put until the month turns?
Everyone for yourself with your earnings report. It feels a bit like that.
Yeah, are there themes that unite them? My takeaway this morning is weak consumer. I get a number of CEOs have talked about that. Clearly, tariffs is a big theme at the moment. It's interesting to hear Nikolai talking about the fact that Europe may be getting its act together. Does it feel like that this morning in terms of the narrative that we're seeing coming through? I'm not entirely sure. Europe's just had a major power outage across the Iberian Peninsula. It doesn't feel like we've got our act together very much this morning.
Well, the sentiment when it comes to how a lot of these companies are approaching the States, very, very varied. We're going to talk about the bank sector next. Deutsche Bank, HSBC, and BBVA. That next. This is Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit. and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome back. This is the opening trades. We are 30 minutes into our European session, and we have modest gains coming through across European equity markets. So overall, and that's not really where the story is, but overall the indices are moving a little bit higher, making these modest gains, waiting for data points to kick in later on in the week. We've been told, look for the ISM data. We get inventories out of that. That's all in focus. In the meantime, then, US futures edging a little bit higher. But let's dive into some of the specifics around certain sectors, shall we?
So Astra's down quite hard, which I think is interesting. And I'm wondering whether this is because this is a tax beat rather than a kind of underlying business beat. The picture's quite solid coming out of this company, but actually, why have they delivered what they've delivered this morning? And to what extent is this kind of an accounting story rather than a kind of science story? So I'm wondering, I think that's quite interesting. BP is down. This is an issue of debt and the buyback and the vulnerability, but the whole sector I think is really interesting at the moment, given what is happening with oil prices and just how low they are right now. The first of the majors to report numbers.
Yeah.
Is it a useful indicator for the rest of the sector, or is this idiosyncratic?
And ahead of the numbers, I was reading that they were talking about assuming an average price of $70 over in their new strategy. And so then you start to, when you see, the oil prices at 61 on WTI and 65 on Brent, it makes you wonder how intact some of these plans are. And that, for a lot of businesses, is going to be a key difficulty, isn't it, of 2025, getting any certainty on any of the key inputs into their forward planning.
Absolutely. There's one more mover I want to bring to everyone's attention. That is Schneider Electric taking a beating as part of Guy's Core 6 as well. Their first quarter revenue numbers did come in softer than expected. They're still talking about some pretty solid data center investment. As we're talking about the issues over in Spain and Portugal, Schneider Electric perhaps also getting a little bit of a sentiment weight or dampener, if you will. Those shares down a whopping 5.7% this morning.
Rheinmetall's up really strongly. The numbers, according to one analyst this morning, well ahead of expectations. So that stock absolutely surging after a decent run this year. Obviously, the story's faded a little bit, but these are strong numbers, apparently. JP Morgan talking about a very positive view. I think you've got another analyst, I say, talking about well ahead of expectations. These are solid numbers, it seems.
Yeah, so somewhere between that AI theme and the tariff theme, there was the defense theme, wasn't there? And we haven't forgotten about that, so let's remind ourselves. Let's talk about the banking sector then, because some of these stocks are really on the move and making some decent gains today. Deutsche Bank's trading unit hit a record in the first quarter as the lender benefited from market volatility. We spoke to the German lender's CFO, James van Moltke, a short time ago.
The crystal ball is cloudy. As we think about it, though, first of all, our company is well equipped to navigate an environment like this, whether it's risk management or the great client franchise we have, as well as the very strong balance sheet. We're equipped to navigate ourselves and, more importantly, help clients through what is an unsettled environment.
Joining us now is Bloomberg's Jenny Serrain. So interesting that the CFO, yes, acknowledging the sort of cloudy outlook, and that's there were some references to tariffs and HSBC doing that as well. But thinking about Deutsche Bank, it said it's seen a dramatic slowdown in deals post the trade war. How does that fit with what we're hearing from other banks?
I think it's exactly what we've heard from a lot of the banks this quarter. So, a lot of them are reporting really strong results for the first 3 months of the year, especially in those trading divisions, which really benefited from all the market volatility. You saw clients kind of rushing in, looking to kind of take their positions and stake out their claims. So now you have the sort of after and knock-on effects. And with deal making slowing down, underwriting slowing down, those are the sorts of things that investors really get queasy about, because those are the sorts of things that can kind of stick around for much longer than just 1 quarter in, 1 quarter out. So definitely, certainly something that we've seen from across the industry and what we expect to hear more later this week as more and more banks report.
Can I just stick with Deutsche Bank before we go on to HSBC? They've raised credit provisions as a result of tariffs. Can you just explain kind of what's happening there? This is US focused. Something's talked about it in the letter this morning.
Yeah, so I think it's something that we're seeing a lot of different banks kind of take different stances on. So I think for the most part, they haven't actually seen any signs of stress yet.
Yeah.
But the fear is that if you do really see this pullback in trade, this slowdown in GDP, if consumer spending starts to falter, if the U.S. plunges into a recession, that's when things could really get hairy. And so you see different banks kind of taking different stances on, we want to be ready for if, the rain comes in. And so that's, I think, what you saw from Deutsche Bank this morning.
How is HSBC dealing with that problem?
So HSBC, it's interesting because they're really known as this trade bank. They're known as this conduit between East and West. And so you saw them talking about, we have different scenarios, and in our worst downside scenario, it's that trade pulls back and GDP slows. And you saw them talking about, I think it was $200 million of direct revenue impact from that. But again, it was the first 3 months of the year still looking really solid. And I think one thing we've heard from a lot of these banks is it can be in different ways. So if trade goes from U.S. to China, they're good at that. But if trade goes from China to Vietnam to India, then to the U.S., if it becomes more bifurcated, that's actually still okay for these banks too. They can make that happen too. So you see them trying to kind of pick their marks and play to their strengths, and that's more of what we saw from HSBC.
So what else are we watching for when it comes to the banking sector then? We're nearly through, are we, Jenny? Is that it? We're done with the first quarter bank earnings?
No, not quite. So we have Barclays tomorrow. We've got Standard Chartered later in the week, another big emerging market bank that we expect to hear a lot from on the tariffs and trade front. So I think we're still in the middle of the earnings season, as it were. And I think the main thing really is, how are you navigating these tariffs? Are you seeing clients start to draw down? Are you seeing any signs of stress? How big of a risk do you really think a U.S. recession is? So these are all questions we're still asking the rest of this week.
Not done yet. Jenny, great stuff. Thank you very much indeed to you and the rest of the team. Some fantastic coverage coming through of the bank reporting season. Pretty as ever, slightly obsessed, not just with banks, but with Spanish banks.
Absolutely. Well, I think it's a lot of what Jenny was just talking about how do banks around the world, regardless of region, deal with the likes of tariffs, deal with the likes of banking consolidation. I think BBVA is a really great example of a bank that is dealing with both the tariff threat in the United States, not just in terms of Europe, but how they're reacting to the likes of Mexico. BBVA is a Spanish bank, the largest financial institution in Mexico, so directly exposed to things like the auto lending, some of the manufacturing, some of the reshoring themes. But then they're also in the midst of a big kind of Sabadell takeover, or attempted takeover, I should say. We're awaiting a result on that. I spoke to BBVA CEO owner Yank about that very concept.
In Europe, different than US, 75% of corporate borrowing comes from the banking system. In the US, it's 25%. The rest comes from capital markets. In Europe, unfortunately, capital markets is too small, so the banks provide the funding. Banks provide the ammunition to invest, to companies to grow. So you need banks, you need strong banks, you need profitable banks. And in the context of the fixed costs becoming larger in banking, you need to be large. In Europe, unless we solve this issue of scale, we cannot really compete as Europe, and we cannot really grow as Europe.
That, of course, owner Gench, the CEO of BBVA. You can catch more of that interview with the CEO and my profile on the CFO as well. Luisa Gomez Bravo is all part of Bloomberg's Chief Future Officer. It's now currently out on YouTube. It was a really fascinating conversation because these are two folks who have spent time around the world, not just in Madrid, have brought that skill set back. And they're talking about doing kind of the opposite of what everyone else is talking about. If you're worried about deal flow activity, about pulling back, BBVA is leaning forward. If you're concerned about tariff exposure, BBVA is actually investing more towards the likes of Mexico or even the likes of Turkey and not pulling back. So everywhere, they're kind of taking the contrarian approach, and we'll see if it works.
Yes, although you wonder if anyone was doing anything yesterday.
Yeah,
at BBVA or any of the Spanish or Portuguese banks.
Well, the irony of this whole thing is that we were actually expected to have a CNMC decision. So that's the Spanish regulatory authority looking to potentially sign off on the Sabadell takeover, which we know has been deemed a hostile takeover. That has now been delayed because, as you say, they couldn't get through and they couldn't actually make that decision making. So we are on deal watch when it comes to that. You are, of course, seeing live pictures of some of the chaos in Spain at the moment. This is the Atocha train station you're seeing live on your screen at this moment. Let's go to that story next, if we can. Spain and Portugal returning to some semblance of normality after suffering one of Europe's worst blackout in years. Many questions remaining about what caused the power outage. For more on this, we're joined by Laura Millen in Madrid. Laura, walk us through the latest there. Is the power now back?
Yes, the power is now back in most of Spain and Portugal, and things in the streets seem pretty much back to normal. Phone connection is still on and off at times, but yes, things are pretty much back to normal.
Do we know what happened? Why did this happen? This is obviously a huge crisis for the country.
No, that's the big question this morning in everyone's minds, including, I guess, the governments. We still don't know what caused the outage. What we know is that 15 gigawatts of power disappeared from the Spanish grid in just 5 seconds. That's about 2/3 of the supply that normally runs through the grid in any given day. It disappeared almost instantly. What the grid operator has said is that there were oscillations of supply of power in the grid. We don't know what caused these oscillations, these variations in voltage, and this is the big question on everyone's minds right now. Prime Minister Pedro Sánchez appeared yesterday night and said that the technicians that are working on this, looking into this, still have no answers. And he's speaking later today. He's holding a cabinet meeting, I think right now as we speak, and he will, someone from the government will then address the press. We hope to hear more, but so far there are no answers on what caused the massive blackout yesterday in Spain and Portugal.
Laura, thank you very much indeed for the update. We greatly appreciate it. Nice to see the lights on in the Bureau. Laura Millen joining us in Madrid. What are we going to be talking about next? President Donald Trump about to hit his 100-day milestone this week amid unprecedented tariffs, unprecedented everything, actually. We're going to look at the impact on European earnings, what is happening in terms of the corporate story this morning. This is Bloomberg.
What would it mean for India to host the Olympics?
Yes, Linda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage And 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The tariffs, which is of course disturbing a global company massively with our production in the US and in China.
Global trade uncertainties we're seeing at the moment, we would expect that the subdued consumer to continue for a while.
We believe that tariffs are not the best way to manage this, to manage pharmaceuticals.
Are you expecting the tariffs to come back down? Again, you don't know whether a tariff is put in place now.
I don't know. I think there is one guy who knows, and it's not me.
That one guy, 100 days in office. Some of the business leaders we've been talking to this morning commenting on the impact the tariffs are having. President Trump hitting a 100-day milestone this week. We've got a big event in Detroit tonight. During his time, he's launched an unprecedented global tariff war, and he's left countries scrambling to respond. This all comes, of course, during a busy week of corporate earnings, which we've just been hearing some of the leaders talking about. Josh Gallo, Bloomberg Global Business Editor for Europe, joining us now to discuss all this. Josh, we're hearing from CEOs, clearly everybody's being asked about tariffs. What are we learning? What are European corporates thinking about in terms of the tariff narrative thus far and where it takes them next?
Well, part of what we're hearing is that they don't know. All we know now is that they are there. They're far more than people expected, and there's a great deal of uncertainty about how they're going to be resolved going forward, or what final rates are going to be reached in the discussions. You know, the earnings we're seeing now from the first quarter, of course, they take into account the first couple months of Trump's administration, but the real impact of, you know, the Liberation Day tariffs, the reciprocal tariffs were announced on April 2nd. So we're not really seeing an impact on numbers per se, but we have seen a number of companies change their outlook for sales and earnings this year. Porsche, you know, the car industry is one that's being hit very hard, and we saw that with Porsche today, with Volvo, both of whom cited the tariffs. Volvo said it's going to cut costs and some jobs. Porsche lowered its outlook for the year. They, of course, all the cars they sell in the U.S., its biggest market, are imports. They build them in Europe. So they're obviously going to, they face a major challenge with this. Going forward, we really don't know. It just is it's a question out there for everyone where these rates are going to end up.
Well, Joshua, when you start talking about some of how these corporates will react to this, how much of the answer is ultimately in pricing power and price hikes and the amount that they're charging their customers, not just in the States, but right here in Europe?
Well, you know, the consumption in Europe has been lagging, so the capacity for companies to raise prices here isn't necessarily great, right? Especially when you think about cars. That was most evident when the European Union decided to slap tariffs on Chinese EVs, which would have come in much lower than European car manufacturers were able to compete with. As for the U.S., you know, that remains to be seen. Today the administration, I suppose yesterday, the administration said it would give a little bit of a reprieve on some of the auto parts tariffs. parts that are imported for cars that are made in the U.S. That will give a little bit of relief to makers like Volkswagen, makers like BMW. That will help them. But the capacity to raise prices, especially given the rest of the economic weakness that we're seeing in the U.S. and elsewhere, I don't think that's what we're hearing from corporates, that they're going to, that they feel confident in that regard.
Joshua, thank you very much. Joshua Gallu, Bloomberg's global business editor for Europe, joining us there to talk about the corporate landscape, how it's being affected by tariffs, 100 days this week, of course, into the Trump administration. Joining us now with more of an eco take on where we are across the European economy, Anna Titareva, European economist at UBS Investment Bank. Anna, nice to have you with us. So our focus is often on inflation. We're talking about tariffs a lot and talking to company CEOs about what that's going to do to inflation in the United States. Here in Europe, the conversation is a little different, though, because the inflation dynamic, how this plays out, will be quite different. We're looking ahead to inflation data due out on Friday. What's your overarching expectation on the inflation front?
Yeah, when we focus more short-term and looking ahead for the inflation print on Friday, we expect headline inflation to remain stable at 2.2%. But looking beyond Friday inflation print, we do think that we are firmly on track for inflation to get back to the ECB's 2% inflation target. There are two factors at play. First, we of course benefited from a big drop in energy prices after the announcement of the US tariffs, and as a result, we have adjusted down our inflation projections. On top of that, we also got a bit of a surprise in terms of currency reaction, very significant strengthening in euro, which is also disinflationary. So against this backdrop, we've adjusted down our inflation projections, and in fact, we expect inflation to dip below 2% in May, and then essentially to hover around 2% for the rest of the year, which is a bit lower compared to what we expected about a month ago.
Okay, and whenever we hear from European officials on this front, they talk, if we're talking about tariffs, they talk about not wanting to see tariffs, and then they talk about the importance of not allowing China to dump product into Europe. Where are you seeing any signs that cheaper product from China is getting in, or where do we look to see any evidence of dumping into the European market? When is that on your radar?
So that's certainly a concern. That's one of the disinflationary forces that we have flagged in the context of US tariffs. At this stage, it's a bit too early to judge based on the incoming data whether we're seeing signs of that. But I think it's important to flag that it's something that is of a concern for policymakers as well. You know, we've seen some statements even from the European Commission that they will try to prevent it, that they will try to put some mechanisms in play. So we think that there is awareness around this issue. One channel of transmission, of course, would be to monitor, goods prices. But of course, at this stage, it's a bit too early to firmly say whether there are any signs of this taking place.
Anna, are you seeing evidence of almost bracing or preparing for the tariff impact? So much of the data we focus on in the States and in China, as Anna mentioned, has been kind of front-running the tariff impact in terms of warehousing. Are we seeing evidence of that in Europe when it comes to consumers, but also businesses?
So I would say that when we look at the latest PMI release, we've seen some tentative evidence of that. In particular, when we look at the commentary from German corporates and in the manufacturing sector in particular, we've seen that in general, manufacturing PMI held up a bit better than was expected. And based on the comments from the companies, there was a bit of sort of front-running in terms of orders and in terms of stockpiling, given the risk from tariffs. So that's sort of soft evidence that we have so far from the company's perspective. From the consumer perspective, a bit less so, especially because what would be a concern for European consumer would be Europe retaliating and increasing import tariffs, which would be the inflationary element. And so far, that hasn't happened.
You come to us from the UBS Investment Bank specifically, and I know you're an economist, so bear with me here. So much of the narrative around the deal-making space and the investment banking space is really ultimately tied to confidence when it comes to how Europe can actually weather these tariffs, as you point out. Is there a change in sentiment from the vantage that you have when it comes to some of this deal-making, especially given in just the last, I believe, hour or so, we heard the likes of Google and Alphabet, for example, accessing the European debt market?
I mean, from a macro perspective, it would be difficult to comment on the deal-making sentiment, but I would, in general, comment that there is an improvement in terms of sentiment towards Europe, and we've seen that gradually building up since the start of the year and getting even stronger after the announcement of a big fiscal stimulus in Germany. So definitely we see more interest from the client perspective, not just from Europeans, but also outside of Europe to talk about Europe. And we've also seen that in terms of, performance of the currency and also equity market to some extent.
Does the UK still have an inflation problem?
It's got more of a problem compared to the Eurozone. Of course, in the UK, what we are seeing is that on the one hand, the impact from US tariffs is likely to be somewhat disinflationary. So again, story of falling energy prices, strengthening of sterling. But when we look at more domestically driven inflation, in particular services inflation, that part still remains quite sticky. And of course, we have to remember that April is going to be a very important month because that's when we get increase in various taxes, also some regulated items. So we are likely to see a jump in services inflation, in core inflation more broadly in the UK. But overall, looking beyond April jump, we do expect that we are likely to see a gradual decline in...
So the bank should look through this? The Bank of England should look through these numbers?
Yes, that's our view. So we think that this jump in inflation in April is going to be, to some extent, a one-off price level adjustment. So we don't expect significant second-round effects. So against this backdrop, we do expect sort of gradual decline in underlying inflation that should allow the bank to continue to ease.
Anna, we're going to leave it there. Thank you very much indeed. Great to see you. Thanks for setting us up for all the data we're going to be getting throughout the week. Nati Tereva, European economist at the UBS Investment Bank. A few stocks really stand out this morning. Rheinmetall is definitely one of them. The numbers that's delivered this morning are super strong. We're dealing with, obviously, a series of kind of idiosyncratic stories, but actually they fit into the broad buckets and themes that we've been talking about. What is happening with defence? What is happening with the consumer story in Europe? What's happening in terms of the tech story? It's interesting to see what is happening there, and we're looking forward to the big tech earnings coming through. But the Google news this morning, I think, is interesting in terms of what it tells us about funding as well. So there's a number of kind of really interesting themes running through this market today.
Absolutely, and you were the key one to point out some of the moves that you saw on the defence names. Rheinmetall, I think, was the one that you mentioned, so higher by almost 7% this morning. You're seeing a lot of the optimism, at least in Germany, show up in some of the banking sector as well. Deutsche Bank was what caught my eye, specifically because pre-tax profit not only exceeded expectations, but Christian Saving talking about its best quarterly profit in 14 years, that being reflected in the market, higher by 4.4%. But all the banks having a good day, frankly.
Yeah, the bank's having a good day. So despite the fact they are citing tariff concerns, they're sort of proving to be, at least in the very short term, a little insulated. Let's have a look at the pharmaceutical space, because we spoke to the CEO of AstraZeneca a little earlier on, Pascal Soriot. He was pretty bullish. He was cautioning against tariffs, but saying that it wouldn't impact the business too much. Analysts then, in retrospect, or having seen the numbers, noting that margins and earnings per share have held up better than feared, but saying that they think that the business has missed on oncology and rare disease sales, and that seems to be where some of the negativity has come from when it comes to AstraZeneca, because that stock down a little more than... It's also
been helped by the tax story as well, so the numbers have benefited certainly from the tax read onto the business, so that's another factor that probably is worth bearing in mind. Porsche's having a very bad morning. Very bad morning indeed, and it's a second warning effectively that we've had from this business in as many months. It's very difficult at the moment to sell a high-end car in the United States, unless of course you're Ferrari.
Yeah, and the Ferrari CEO will be joining The Pulse exclusively from the Norges Bank Summit. So Francine Lacroix has been out there all morning. She continues her conversations from there. That starts at 9:45 a.m. UK time. US futures pointing a little bit higher, bouncing a little bit as we've been going through the programme. Not stunningly so, but Nasdaq futures now up 0.5%, waiting for key earnings out of the United States. Any further news flow surrounding tariffs, of course, could be influential, and waiting for key data points as we get towards the end of the week. That is it for the opening trade. The Pulse is up next. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here at the Norges Bank Investment Conference in Oslo, Norway, and these are your top stories. Mark Carney wins the Canadian election, promising to build a stronger Canada and fight Donald Trump's trade war.
President Trump is trying to break us so that America can own us. That will never, ever happen.
The U.S. president said to ease some tariffs on automakers as he marks 100 days in office. China urges other countries not to give in to what it calls a bully. Plus, a big beat for HSBC and record trading revenues at Deutsche Bank as traders cash in on market volatility. Now, we have some interviews, great interviews, with the chief executives of Ferrari and Norsk Hydro at this hour. Later in the morning, we'll also be joined by the Goldman Sachs Chief Executive Officer, David Solomon. Now, first thing is first, as always, let's check on the markets, especially on these big markets day. Not only do we watch the election, of course, in Canada, but we watch what Donald Trump will do next. Now, again, quite a lot of economic data coming up. A stock, actually, for the moment, stocks in Europe posting some pretty modest gains. You can see futures also gaining some 0.3%. Look, traders await two things. First of all, progress in trade negotiations, but also a series of updates in the U.S. economy. When you look at European earnings, let's get to the European markets map. There's a lot of focus on Deutsche Bank, HSBC, those shares rising, BP actually slumping after cutting its buybacks as profit missed estimates. Again, investors really tracking a big stream of data for clues on the health of the American economy, but also on the prospects for Fed interest rate cuts. For the moment, there's relative calm returning to the markets after some pretty extreme volatility that we saw on Liberation Day, April 2nd. So on to Canada, and Mark Carney is promising to work for all Canadians after narrowly winning an election dominated by trade tensions with the U.S. Now, the Prime Minister's Liberal Party is on track to win enough seats to form at least a minority government. Carney, a former central banker, is promising to stand up to the U.S.
When I sit down with President Trump,
It will be to discuss the future economic and security relationship between two sovereign nations. And it will be with our full knowledge that we have many, many other options than the United States to build prosperity for all Canadians.
Now, for more on Canada and Mark Carney, let's bring in Rosalind Matheson, our EMEA News Director. Ros, thank you as always for joining us. So what are Carney's main priorities when it comes to trade discussions with the Trump administration?
Well, for a start, we need to know exactly what kind of government we're going to be having in Canada, because whether it's a minority government or a majority government may give us a sense of Mark Carney's wiggle room at home, whether he has to liaise with other parties on all of his policy making. But certainly he's setting out his stall pretty much straight away when it comes to the relationship with the US and the need, as he said, to renegotiate as well from the Canada end on the trade side, not just be responding to whatever is coming from Donald Trump in the minute when it comes to tariffs and trade with Canada as a whole. I mean, Canada's in an interesting position because on the one hand, they have leverage with the US because the US relies on Canada for a bunch of key materials, including raw materials. On the other hand, you know, there aren't that many other markets for Canada for some of these goods, so they also are at risk there in terms of their diversification. So what we're going to see is, can Carney develop the kind of relationship with Donald Trump that we've seen some other leaders do, where Trump respects the space a bit, where he's willing to negotiate and listen? And, you know, does that involve Carney standing up to Donald Trump? Of course, we saw Justin Trudeau, the previous Prime Minister, repeatedly attempt to stand up to Donald Trump, and that really not being a successful strategy. But will Carney have better luck? Certainly we're going to see an effort very early on in this administration to try and reset that relationship.
Ross, meanwhile, Donald Trump is also looking at softening some auto tariffs. What do we know about that?
Well, that's right. And of course, we're marking 100 days of the Trump administration, and Donald Trump is giving a big rally today in Michigan. This is the heartland of the U.S. auto sector, and certainly one where he's had a lot of big companies, auto companies, coming to him and saying, what you're doing is going to be risky for us and risky also, you know, for our staffing levels in the US. And he's very attuned to not having an environment where US auto workers are worried about their jobs as he's going to talk to the auto sector about his 100 days in office. And this is one area where he's very much seemingly listening to what the companies are saying. So what we're hearing is he's going to offer some tariff relief to the auto sector, which means they can get some money back for tariffs paid on foreign parts they bring in, and on a tapered basis. Eventually it will run out, but also they're going to try and avoid stacking tariffs when it comes to the auto sector. This is one area where all of his things collide. You know, the US voter, how Americans are feeling about the economy, and a key part of the US economy.
Thank you so much, as always, Bloomberg's EMEA News Director, Rosalind Matheson. Now, China's foreign minister is also warning countries against caving into U.S. tariff threats, saying it'll only embolden what it calls a bully. Wang Yi's comments at a BRICS meeting in Brazil underscored China's attempt to portray itself as a bastion of free trade. Well, Alan Wong, our China economy and government editor, now joins us now. So, Alan, when you look at Wang Yi's comments, does it mean that, you know, China is now wants to be the leader of the free world?
That's certainly what China wants the world to see it as. But the truth is that the comments are coming after the U.S. claimed that Chinese President Xi Jinping called Trump, and China having denied having any trade talks whatsoever with the U.S. So Wang Yi's comments could be seen as a way for China to say that they're not rushing into any negotiation. In fact, just an hour ago, the Foreign Ministry, the department that Wang runs, gave a regular press conference saying that it welcomes dialogue only on the basis of equality and mutual respect. So that means that China's public position has been quite consistent in that China doesn't like the U.S. pressures and threats, and while it's happy to engage in talks, there are some conditions attached to it.
Alan, Trump's threats also seem to have given Xi Jinping a boost. Tell us more about today's big take.
So we have talked a lot about the economic aftermath of and the ramifications of all the Trump tariffs. But one thing that's rather unexpected is how politically the tariffs are actually handling China something that money can't buy. It's giving President Xi Jinping more time to fix his economy by basically giving President Xi Jinping a tool to rally the entire Chinese population around. So the U.S. has framed its trade war as a way to right what it sees as unfairness in its trade with China. But China has framed it as a full-on economic attack on the country. And this is coming just, a couple of years after China's rising discontent with the COVID lockdown, as well as the general weakness in its economy. This new idea of a foreign enemy is allowing the Chinese government to blame everything basically on external pressure. So another key element in this is that by having Trump as a common enemy, this also solidifies Xi Jinping's control over the population and even its long-term rule. And this is important also because, unlike the U.S., China doesn't have the kind of democratic elections that we have every once in a while. And maybe China will see this as an opportunity to just weigh out the threats and use this time to reform its economy, to put it on a better footing, and to meet any external challenges.
Alan, thank you so much. Alan Wong there, Bloomberg's China Economy and Government Editor, and I urge everyone to go and check out today's Big Take. Now, we're also joined by Johanna Kirkland, Chief Investment Officer at Schroders. Johanna, thank you so much for doing it. I'm sorry I can't be with you in London. A lot of the talk here at the Norges Investment Conference is, of course, on inflation, what the Fed does next, some of the concerns out there, and what it means for portfolio managers. Johanna, what do you see as the biggest risk, actually, for portfolios that they could get wrong in the next couple of months?
Well, right now, the biggest thing we need to focus on is the risk of recession in the United States. So before Liberation Day, we saw pretty much no probability of a US recession because the labor market was so strong and because corporate balance sheets were solid. Clearly now, with the uncertainty created by the tariffs, we need to start pricing at least a probability of a US recession. So I think for now, the biggest focus we have as we look at data and analyze each company, we have to look at it stock by stock. We're really looking for that risk to growth is the first concern. And of course, thinking about the US versus other countries, the challenge of the US specifically is they could also be dealing with a bit of an inflationary shock at the same time. So that is the most imminent concern right now. Further out, what's the other thing that can cause bear markets is a rate shock. And right now, the US 10 is behaving itself. Trump typically has stepped back whenever he has worried the Treasury market, but that's probably the medium-term concern as we go into 2026. But for now, it's growth that I'm focused on.
So, Johanna, how many cuts, if any, are you expecting from the Fed? And we're getting a lot of data out of the U.S. Are we going to see, is this a turning point? Do you position your portfolio slightly different as we get onto Thursday and Friday?
Well, for now, we think the Fed is right to sit on its hands because the data isn't there yet to support a rate cut. Typically we have faded aggressive rate cuts. We've had a few times where we've had aggressive pivots priced in the recent years. And ultimately, we are dealing with a worse trade-off between growth and inflation that does muddy the water for the Federal Reserve. But as the year progresses, we do expect a bit of a slowdown at this point. And then, yes, we could see some rate cuts. But generally, I'd say we're still a bit above the market in terms of our rate cut expectations.
Johanna, what are you seeing in earnings overall? When you look at some of the things, for example, in tech that's coming up, banks, do they give you confidence that a lot of the companies can weather this, or do they need to do a little bit more for shareholders to get them back on side?
Well, I think the good news is we've moved from the first phase, when Trump first announced his tariffs, you had that sort of air pocket and that's typical of the market. When you're confronted with a new risk, you're trying to work out how to price it. We're now moving to a much more constructive phase where we're starting to understand the different reaction functions of the players involved in this tariff war. And that allows us to then think about the impact on companies stock by stock. Big picture, in terms of what the companies are telling us so far, they're not giving us much guidance beyond the next 90 days. So I think the reality we have to face is we're still dealing with a lot of uncertainty at stock level.
Do you think the aggressive move, I have to say, out of U.S. assets has been overblown?
No, I mean, generally, we have also been favouring European assets over US assets. This is something we started doing actually in December, to some extent unrelated to Trump. It was just a recognition that we were now very heavily, if you're exposed to MSCI World, the exposure to the US was just incredibly high, and we felt that there was a need to start diversifying our exposure. And I think that first the DeepSeek news in January highlighted that innovation does exist outside the United States, but then more recently the actions of Trump have sort of undermined the credibility of the US as a partner, and I think that again highlights the need to diversify portfolios. So generally we're still playing that theme predominantly via Europe, so we're long European equity versus US equity, and we're favouring the euro over the dollar. Generally, and this is for the first time in years, because we've been bullish the dollar for many years, we always saw it as a positive carry hedge in our portfolios. We actually short dollars now, and that's literally, we haven't done that for years.
Joanna, in Europe, how do you play equities? Is it sector-wide? Is it tech stock versus luxury stocks, or any exposure to China, or do you just do it geographically?
No, from the top down, we're really making that geographical allocation. And what really got us more interested in Europe, really at the turn of the year, was this idea that the debt brake might be released. The fact that actually the return to positive yields is hugely positive for Europe. Negative yields was a terrible environment for the European banks. That was really the main reason why we invested in Europe, because we saw the potential. We felt it was such an unloved market, and we saw the potential. We felt the environment had shifted quite a way in Europe. Typically, Europe acts when its back is against the wall. But now I think, so as I said, initially conviction was on the European side, but I think now also we see reason to diversify out of the US.
What do you do with China?
China's a bit harder because, of course, it's at the epicenter of the tariff war, and we need to recognize that there's still that's really the axis where we have the most uncertainty. We're neutral in China. We're not taking a view either way. Obviously, one thing we've seen since the beginning of the year has been a turn in the government's reaction to the market. It's been much more supportive of the equity market in a way that it hadn't been in previous years. So again, the interesting thing is that Trump's policies, in some sense, are leading to more stimulative policies elsewhere outside the United States. So that means that for now we stay neutral in China. I think the fact that the government's more supportive would certainly mean that we wouldn't want to be underweight, but we need to recognize that this is probably the absolute epicenter of tariff uncertainty.
Yeah, Joanna, for me that seems the hardest, right, is figuring out exactly how stimulative some of these policies are from the Trump administration for the rest of the world, combined with the fact that maybe markets are not fully pricing in a trade war that could last for years. There seems to be an assumption, despite market volatility, that it will be okay, and I don't know whether you need to push back against that.
Yeah, I think that look, I mean, the market, it has attention deficit disorder. It can't focus on anything for too long without fresh news. I think that, as I said, for now there's potential for stability just because we had that air pocket, and now we're getting to a point where we can start to price the risks. Bigger picture in the medium term, the thing that I'm probably watching the most, where I still don't have enough information, is the reaction of the European authorities to all of this. How are they going to interact with the US, and might the US try and force them to sort of freeze out China as well? I think that is still to come and something we need to watch out for.
Joanna, thank you so much for joining us. Joanna Kirkland, their Chief Investment Officer at Schroders. Now, coming up, we'll have plenty more from Oslo, Norway. We'll be looking back on the U.S. president's first 100 days in office and discussing the effect of Donald Trump's policy so far. I'm delighted to be joined by Hugh Van Steenis from Oliver Wyman. That's next, and this is Bloomberg.
bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Welcome back, everyone. Now, President Trump promised a market boom like no other if he was elected president. Instead, his first 100 days in office have fueled the worst stock slump since 1974. Now, the S&P 500 down about 8% since his inauguration. The dollar has slumped. Treasuries have lost their haven status as the Sell America trade gripped markets and recession fears grow. Well, we're now joined by Hugh Van Steenis, partner and vice chair, and Oliver Wyman. Hugh, as always, thank you so much for joining us. Look, the market actually also quite sanguine. I mean, you have these ups and downs, but you know, they're quite level-headed, maybe too level-headed, some investors say, about what we've lived through with the Trump trade policies. What do you think history will look back on this period in history and tell us?
Well, thanks for having me on again, Francine. Look, I think this, as all investors know, this has been an incredibly challenging period. I think in some ways, this is the biggest shock to world trade since 1971, when Nixon also put in import tariffs. And I think the market is really trying to weigh up, you know, how much of this first opening salvo will actually follow through. And I think that's the challenging thing that markets are trying to work through. We've already seen the administration pivot, probably 4 or 5 times. And so there's an assumption we'll get through this. But I still think the underlying change to supply chains could be very radical.
Yeah, and I guess you have like second round effects when you look at, for example, some of the small companies, how they fund themselves, some of the loans. What's not being talked about that chief executives are worried about?
Well, look, so from our conversation with finance, it's the cash flow crunch to small businesses, which isn't really getting on the front pages. Yeah. Obviously, large businesses can navigate, you know, through bumps and drops so well. There was a Pulse survey that I came across 2 weeks ago that 1/3 of small businesses have cancelled all their orders from international because they simply can't pay the tariffs. Because if you're let's say you're a small toy provider, you know, buying from China, you've got to pay 2.4 times the working capital, and you simply don't have that. So I think the squeeze on small businesses is really the big story, which hasn't really fully got out there. But you're starting to see through some of this dirty data, like the shipping to Seattle and to LA, some of those cancelled orders are starting to come through.
I mean, Hugh, I guess there's a working assumption that a lot of chief executives will also just stop spending for the moment until they have clarity on the situation. But there's also an assumption that when you look at the trade and tariffs, that it'll work itself out. Yeah. I mean, do the two balance each other?
Yeah, I mean, look, it's very clear from our conversations that CEOs have gone into defense mode. They're thinking more about trimming costs, but, you know, they're not wanting they want to keep a cool head because they don't, you know, this is a very fast evolving situation. And day by day or every 3 days, there's a sort of a new announcement. But no, they're very much in defense mode. They're very cautious, therefore, about costs. They won't be hiring as much, maybe pushing some plans to the right. And that's one where, you know, obviously the vast majority of bosses are trying to just look through to the longer term, as Nicola and you were talking about this morning.
I mean, it does probably have some, policy implication from both governments and central banks in terms of what they do to support their economy. Is that how much of that is a benefit to, for example, small companies?
Well, so I think this is where the interesting thing about the changes in the States and what it's actually catalysing internationally, whether it's Canada, the UK, Europe, you're starting to see plans where where governments are looking that they're going to have to deploy capital domestically. And obviously in Europe, we've also got a defence move. I mean, that $1 trillion from Germany has been a profound impact to the European yield curve. And, I think, you were talking with Nikolai about the long term. Remember, we had 8 years of negative rates in Europe. If we can now say that is behind us, I was very struck with Deutsche Bank's results this morning. Best quarter for 14 years. And I think that speaks to the fact that in the longer run, a steeper curve is incredibly helpful to the financial system, even if the growth shock is not.
So it depends, I guess, on on where you sit in the financial spectrum. Because if you do a lot of M&A, then this is probably, or IPOs, this is not your time. If you're an equity trader, you're probably having a great time.
Oh, look, I think this is everything, everywhere, all at once, as you're commenting everyone every day. I think, no, obviously, for the transactional businesses, pens were put down probably actually about 6 or 7 weeks ago, to be honest. And obviously, any pens which hadn't been put down got completely put down 4 weeks ago. And so I think, yeah, for issuance for IPOs, for M&A deals, the bid-ask is just too broad, and therefore deals are being pushed to the right. But it's interesting. Some of our conversations are people are hoping that they might pick up in the autumn, but there's some who are a bit more cautious. They're now saying, you know what? Actually, we may not get this picking up till the second half of 26 or even the first half of 27.
Hugh, what about private equity? Because it's difficult to price things at the moment, so it's difficult to sell and buy, but there could be longer-term opportunities.
Yes, so I mean, again, big sector to call, but there's a lot of indigestion in the system. I think, so many private equity firms had hoped for an exit this year, which has obviously been pushed to the right. Where I think there are some opportunities is around the private credit side, where you have seen some dislocation, not huge, but a little bit. And that's therefore thinking about opportunities to deploy that capital. But it's the fundraising environment, I suspect, will become a little bit tougher from here.
So you've worked very closely with Mark Carney through the Bank of England. You know him for many years. What kind of Prime Minister do you think he'll be?
Oh, look, I'm thrilled for Mark. Look, I think he's got a remarkable combination of strategic nous, economic savvy, and a very cool head in a crisis. And I was honoured to serve him for 18 months. And it's very clear that I think he's a great candidate for a great prime minister for this environment. Look, as we discussed, if this is the biggest shock to world trade in 50 years, having someone with that understanding of economic history and that network, I think will be Canada's very fortunate to have him.
I mean, could you see a rapprochement between Europe and Canada, or because of the retrenching of the U.S., or does the U.S. come back?
I think there's only one person who knows that, and it's in the White House. Look, I think the lesson from the 70s, interestingly, was that Canada did put their elbows up back then too, and actually within 4 months, the tariffs will pretty much drop to zero. And so I think there's a hard negotiation to be had. As you know, the big proportion of the deficit with the US is actually energy, which supplies the electricity for the eastern seaboard and other parts of the western seaboard. So the only other source of oil is Venezuela, which I think is even more persona non grata. So I think there's a good negotiation. I think Mark's a great person for that.
Hugh, I know you also have your pulse on UK business and UK companies. How's it going at the moment? Again, the UK was hit by 10% tariffs. Some say, look, it's so much better than others, but it has quite a lot of other shocks or concerns that it has to deal with.
So I think the UK is less impacted by the tariffs than many countries because we're a more service-based economy. Oh. In fact, if you had actually done the regression, we should probably only had 3 or 4% export tariffs. No, I think the agenda there is much more about the current government and the financial situation. I think it's unfortunate that a series of steps have put more friction in the system, and certainly the businesses we talk to are worried about the new labour laws, the new taxes, the capital flight of some of the wealthier people. So I think there's some headwinds, but look, it's still a great place to invest, and so like anything, it's finding the right companies.
Hugh, thank you so much. Hugh Van Steen is their partner and vice chair of Oliver Wyman. Now, coming up, look, we have some great interviews. Later this morning, we'll be speaking to the Goldman Sachs chief executive. He is David Solomon. That's at 10:30 a.m. London time. We'll talk to him about markets, trade, Europe. Also coming up, the chief executive of Norsk Hydro joins us here as the aluminium supplier cuts its outlook. We'll get more on the impact of U.S. tariffs next. And also, I'm looking forward to speaking to Benedetto Vigna from Ferrari. The chief executive also joins me from Oslo, Norway. This is Bloomberg.
let's cut right to it. This is Bloomberg's new show, Primer. Technology is $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on.
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francie Lacqua here at the Norges Bank Investment Conference in Oslo, Norway, and these are your top stories. Mark Carney wins the Canadian election, promising to build a stronger Canada and fight Donald Trump's trade war. The U.S. president set to ease some tariffs on automakers as he marks 100 days in office. China urges other countries not to give in to what it calls a bully. Plus, a big beat for HSBC and record trading revenues at Deutsche Bank as traders cash in on market volatility. Now, later this hour, we'll be speaking exclusively to the Ferrari chief executive, Benedetto Vigna. Also coming up, more, of course, on the Spanish power supplies. They're back to near 100% capacity as the country slowly returns to normal following a massive electricity outage across the country and in neighboring Portugal. Well, Bloomberg's Laura Milan joins us now from Madrid. So, Laura, what's the situation right now, and what do we know about the cause of what happened?
Most of the power is back in Spain and Portugal after the massive blackout that impacted most of both countries yesterday, but we still don't know what caused almost 2/3 of the Spanish power supply to go offline almost immediately in just 5 seconds. We still don't know what caused what the grid operator is calling oscillations in frequency or in voltage. It's not clear right now. Prime Minister Pedro Sánchez appeared last night, said that the technicians were working on finding the cause of the outage, and we expect the government, which is meeting at the moment, to come out later this morning and to speak to the press. We hope that we will have some more answers then, but right now we just don't know what caused the outage yesterday.
I mean, it's quite extraordinary. Laura, thanks so much, Laura Milan there in Madrid. Now, on to some corporate news. Norsk Hydro has reported adjusted EBITDA for the first quarter, missing estimates. It's lowered also its 2025 outlook for the extrusion divisions. Well, we're now joined by Eyvind Kallevik, Norsk Hydro Chief Executive. Mr. Kallevik, thank you so much for joining us. Look, there's a lot of trying to figure out what kind of impact the tariffs have, what kind of impact it means in terms of demand. I know there's a lot of uncertainty on the tariffs, but what impact concretely have you seen this quarter?
So far this quarter, impacts have been very minute. When we look at the order intake for the first quarter and into April, they actually look quite good. So I think the jury is still out, and we'll see later on in the second and the third quarter what the impact is going to be.
Yeah. I mean, when you look, I think, at North American demand for extruded aluminium, it was down by 4%. Again, is that tariffs?
No, we don't think it's tariff-driven yet. Again, the bookings that we see into Q1 and into April are still quite good. And then, interestingly, we can shift around production from both our Canadian plants as well as the Mexican plants into the US plants. And we see the fact that we have a unique production system also means that we can replace some of our competitors' volumes potentially coming in as imports.
When you look at some of the domestic order books in the U.S., does that improve?
So when we look year over year, so compared to 2024, we have a somewhat better order intake at the tail end of Q1 and also the numbers that we see so far in April.
Where are you seeing a likely drop-off in imports? Again, if you just walk us through what you're expecting in the next couple of months and then maybe in the next 6 to 8 months, that will give us an indication of how you're thinking of things.
So clearly with at least what we know as of today, there will be tariffs on imported parts from globally, so to speak. So the more you can manufacture domestically in the US, is good for companies like us who actually have a large manufacturing presence in the United States to avoid paying those tariffs.
If demand for some of the aluminium actually continues at 4% downwards, what kind of implication does that have for your future earnings?
So clearly in a recession case, that would mean lower sales, which again will be translated into lower earnings. And then we will adjust our production capacity accordingly to that. That's something that we can do when we have more than 20 sites across the North American region to adjust it to produce where it's most optimal at any point in time.
Mr. Kalvik, when you look at some of the alumina pricing, again, does it mean that you could shift, for example, towards the recycling or other things? When you look at where we are now, and again, there's so much uncertainties, but does it change on where you want to be stronger?
Yeah, so we have the flexibility. We're one of the largest recyclers of aluminium. We're also one of the largest primary producers of aluminium. So we have the flexibility to shift between recycling versus the primary part portfolio that we have. We do that partly in Europe. In the US, we're mostly based on recycling. That scrap we buy domestically in the US for domestic sales in the US. So in many ways, we're insulated from the tariffs on aluminium input in the United States.
When you look at scenarios and where the world economy is going through and inflation in general, what do you think your base assumption should be?
I think these days it's incredibly hard to make very clear predictions for the rest of 2025. We see tariffs are changing pretty often, leading to uncertainty. So again, what it requires from a company like ours is the agility and ability to adapt to the situations that we see, while at the same time staying true to the strategy we have towards 2030. Obviously, increased tariffs will at some point also lead to increased inflation, and then we can all estimate or guesstimate, if you like, what that will do to inflation and inflation levels in the United States or other places around the world over time.
Eivind, thank you so much. Eivind Kalvik, the chief executive there of Norsk Hydro. Now, coming up, we'll have plenty more, of course, on some of the earnings, on some of the banks, HSBC, also Deutsche Bank. In a quarter marked by intense volatility, Deutsche Bank reported record revenue from its trading desk. Now, fixed income and currency trading surged 17% as the Trump administration's policies continued to add uncertainty into markets. Now, for more, Oliver Crook is in Frankfurt, fresh from a conversation with the Deutsche Bank CFO. Ollie, what do these results actually tell us?
Yeah, Francine, I mean, it's what we saw across a lot of the trading desks across the United States and the rest of Europe is that basically the intense volatility in the first half of the year was really a boon for all of these traders that were operating in the first quarter. We saw it, as you said, about 3 billion euros worth of revenue for Deutsche Bank from the trading desk. That is a record number for them, up 17%. But what's interesting, Francine, is that an investment bank is not just the trading desk, right? There's another side of it. There's the M&A, there's the deal side of things. Intense volatility is not good for that side of the business. That is what we also saw in the first quarter. quarter, and we saw the same thing illustrated in the first 2 weeks of the second quarter as well. But Francine, what I thought was really interesting in talking to James von Moltke is that this intense volatility isn't actually always good for the trading desk. In the first 2 weeks, the 2 weeks after Liberation Day, we saw these massive breakdowns across the market. That was not a good week for a Deutsche Bank trading desk. They were really focused on getting prices, the correct prices to their clients, getting liquidity out to their clients, and making sure things didn't break when correlations were breaking down left, right, and center. And that is just the implication within the market. I also talked to James von Moltke about the longer-term assessment about whether or not the U.S. is still the safe haven that it once was, and how much of the damage that the Trump administration has done, how much of that is permanent. Here's what he had to say.
Our analysts are calling for a relatively significant structural change. I do think that will take time. It's had a pretty dramatic impact on the euro-dollar exchange rate already, and a further drift, up from here would be impactful overall. I think the difference you're seeing is that the policy changes are making the rest of the world interesting to investors, and changing the relative position a little bit of the United States and Europe.
So there, the message from James von Moltke that really seeing a rebalancing away from those U.S. assets. Really a beneficiary for that would be the German Bund, of course, and the euro, but really sort of spreading across the rest of the world, to say nothing of the fact, Francine, that for Deutsche Bank, when you think about all the bad news that has been priced into the German economy over the last couple of years, the tariffs, of course, adding to that, there's actually €1 trillion of spending that is coming down the pipeline. Maybe that is not quite priced in, and something that Deutsche Bank could really benefit from over the coming years.
Ollie, thanks so much. Oliver Crook there with the very latest, of course, on Deutsche Bank. It was a great conversation. I think we're going to put the whole thing online. HSBC has also announced a $3 billion share buyback after first quarter profit came in well above estimates. So let's get more on that and today's other earnings from Charlie Wells. Hey, Charlie, HSBC, what you got?
Hi, Francine. So we've got so many earnings dropping, and we really do need to start with HSBC because they had that profit beat and that significant $3 billion buyback, $1 billion more than people had been expecting. And this is just a vote of confidence, not just in this bank, but in the banking sector, in Europe in particular. You can see in the Euro Stoxx 600, this is the best performing group, and year to date, they are outperforming a number of their United States peers. So again, a vote of confidence, and you're picking up on that in that buyback. I'm talking about buybacks, and I've got to talk about other earnings. Buybacks in focus with BP. They reported a disappointing set of earnings today and a disappointing buyback figure. I got to bring this up here. $750 million. The hope from investors, from analysts, had been that it would be in the billions rather than the millions. This is the lower end of that guidance, but we just know that BP has been under pressure because of that oil price. I'm talking about oil. I'm also going to talk about oil pipelines. That makes you think that. You think about pipelines, think about the drug pipeline. AstraZeneca's drug pipeline had been giving it a lot of optimism this year, a lot of optimism going into this earnings report, but that's not being met in the market. They were able to beat on a number of fronts, but the market just does not like the sales figures that they posted, at least at this point this morning. We've also got the threat of pharma tariffs looming over this industry, looming over this country. And if we're talking tariffs, we've also got to talk autos. A lot of auto companies reporting this week. Porsche reporting this morning, and a disappointing set of earnings there. They issued a profit warning. They said that their profit margin is likely to slip this year. And this is a company that is so exposed to tariffs because they have no production capabilities in North America. Now, saying you've got an imported European luxury vehicle is great on that luxury shop front in the United States. It's not so great in the middle of a trade war.
Yeah, it's not. We'll see what Ferrari does. I'm looking forward to our conversation, actually, with the Ferrari chief executive, Charlie. That's coming up shortly. Coming up, our exclusive conversation, of course, with David Solomon of Goldman Sachs, and exclusive with the chief executive of Ferrari, Benedetto Vigna. We'll talk tariffs and the outlook as the company prepares to roll out its first fully electric model. That's next, and this is Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Welcome back, everyone. Now, the head of Norway's $1.8 trillion sovereign wealth fund says real estate and renewables are becoming more attractive in the face of stock market volatility. Well, I spoke to Nikolai Tangen, the chief executive officer of Norges Bank.
In a way, the world is splitting into two. And that means that we probably will see lower growth, and there is a risk that we will see higher inflation. And so the market is very resilient given that backdrop, I think.
So, which means that you're expecting maybe a correction? And are there parts of the markets that seem too sanguine at the moment?
Well, we've been saying for quite some time that we think it will be more difficult to make money going forward. And so I suspect with all the uncertainty that we are seeing just now, that we could continue to see, tough times. So
what's it like being in the markets? Do you worry? Is this an opportunity? What does it mean for how you position your portfolio for a long-term investment?
Well, I think the way to behave in the market now is just to be broadly diversified and very, very long-term. You really need to put your long-term hat on. And I think to do, tactical reallocations and movements is very, very difficult because they move so fast. When we last met in Davos, it looked like the US was going to be fantastic from a stock market point of view, and Europe, all the leaders we met from Europe were really, really depressed. Well, you fast forward a couple of months, and the whole thing is just turned upside down. So it's very, very difficult to get these turns right.
But, Nikolai, what does it mean longer term? Because actually it's unclear where the trade barriers exist, whether market pressure will make the Trump administration do a U-turn. So even 3-4 years of visibility is extremely difficult.
Yeah, no, absolutely. We really don't know how this is going to pan out. I think what is certain is that the long-term trend of globalization, growth, these kind of things, that will look very, very different going forward. So the easy money is not there anymore.
You have over, I think, 50% allocation into U.S. assets. Does that change?
No, we are very happy with our U.S. allocation. We have, big holdings in Treasury, and we have, big holdings in the large companies in America. They are great companies, and we love owning them.
Well, that was Nikolai Tangen, the chief executive of Norges Bank Investment Management, speaking to me a little bit earlier. Now, on to a great exclusive, because President Trump is on track to ease the impact of his auto tariffs. That's what we found out today. Now, changes include lifting some levies on foreign parts for cars and trucks made inside the U.S. Now, while imported cars would also be given a reprieve from separate tariffs on aluminium and steel. Well, Europe's car industry is looking at ways to respond to the auto tariffs, with Ferrari announcing plans to raise prices for some of its cars in the U.S. by as much as 10%. Well, we're now joined exclusively by Benedetto Vigna, Ferrari's chief executive. Benedetto, this is the interview that everybody wants to know about, because they want to know about the new cars, the great things that you'll put in place. But first to tariffs. Yeah. How much of the cost can you pass on? I also need to say you're in a quiet period because your earnings will be on May 6th, so I know investors will have to wait a little bit more for any concrete update. But how's it feeling?
Look, I think that we as a company are used to manage situations that are changing. We are having this situation change with the tariff. I think we've been pretty quick. Already 27 March last year, we said 3 things. 1, all the cars that are important before April 2nd, no price increase. 2, some cars like 296 SF90 and Roma Spider, no price increase also if you place an order after 2nd of April. And 3, yes, there are some cars that will have an increase up to 10%.
But is Ferrari immune? Because I mean, I know the waiting list is long.
The waiting list is covered well into 2026. But apart from immunity of Ferrari, I think there is one important message that I would like always to remember to myself, to all the team. The customer is the client is at the center of what we do. We have to respect the client, because if he places an order, well, we have to consider the condition and we have to respect him.
Maybe you also said, which I found fascinating, you know, Ferrari is not a midlife crisis car.
No.
Because you're selling much more to the younger generation.
Indeed.
Does that look differently in terms of what they want, how fast they want it?
You said it. You framed it much better than I did. But it's true. There are many. We have a lot of new clients. I was chatting with a client, 32 years old, just last week. He was very pleased because he placed an order for the 296 GTS. So we keep having, and we see more and more youngsters, he and she. I mean, men and women. Yeah. It's especially in new countries, but it's not only there. We see also that the traction of Formula One is attracting more and more people in our world. So that's good news.
Yeah, and we could have a whole conversation about Lewis Hamilton, but maybe for another time. When you look at everything that's happening between the US and China, does it change, again, the demographics on where the cars are sold and bought?
We don't see this. We don't see this change, honestly. We see China today. We are selling double the number of cars we were selling pre-COVID. We see, I mean, US, as we announced in the last quarter, 1 over 4 cars is going to US. So we don't see. What I can see instead is the new countries popping up. Eastern Europe, take Czech Republic, take Poland, but also Korea, Taiwan. So these are countries where we see a growing interest in our car.
And this is what for the hybrid, because I know there's also an exciting update today in a couple of hours for the 296. I don't know whether it's fully new or different.
That's the reason why you pick up this date.
Yes.
No, in a few hours you will see the latest born of our new Ferrari. We said that this year is a special year for us because we will have 6 new cars on the road.
Big year.
Big year, yes. In line with our plan of Capital Market Day, by the way. So nothing different. We keep the things under control. And this will be the first 2 cars of this 6-year deployment. This will be, you will see.
Okay, I'll see.
Wait a few more hours and you will see everything
I know,
about those cars.
everyone will tune in, Benedetto, but is the market share of that, I mean, that's really increasing, right, this hybrid car. Is that what you're expected to just go from strength to strength in terms of market share or in terms of the amount of cars that you sell within the group?
Look, the number of cars we sell more or less are in the range of 13,000, 14,000 cars. That's what we have been selling. We see 50-50 between ICE and hybrid. I think it's important in line with our strategy that we offer the client the opportunity, the freedom to choose. So far, they can choose among hybrid and ICE. In the future, they can also decide if they want to pick up an electric car.
I know. I keep on trying to get you to give us a little bit of news on the electric car. Can you give me something?
What I can tell you is that we will announce this car in October. And as we like to do innovation in the product, we like also to do innovation in the way we launch the car. So I will tell a little bit more about this car in a few days during our quarterly call. But we are on track with our plan. And we're looking forward to have a richer product portfolio to offer our client.
What are you most excited about? You've had so far a very good year. Is the tariffs?
Very good, yes.
You know, is the tariff something that you just need to work around, or
look, the tariff is a change of the condition around us. In the past, since I am in Ferrari, we had many changes. Now we had the chip shortage, then we have the Ukraine war, then we had also the Middle East war, and considered some of our suppliers were over there. So we had to manage also the situation. Nobody thought about that. This year, the challenge is called a tariff. I mean, we are managers. We have to manage what is under our control, and we have to adapt. I think that's the beauty of life. That's the beauty of business, no? That keeps you busy.
If you like a challenge. If you don't like a challenge, not so much. But it seems
I took this challenge.
and you seem ready, I have to say, to, you know,
I think that, we have been, this company had always this clear in mind. You have to be ready for the challenge. It's like when you drive a car. You don't know when things happen. When you are, I was in Imola last weekend, at the hypercar, okay? When you see there is an accident, there is a situation that you have to face, you have to be agile enough to face that situation.
I mean, there's a bit of a softening, actually, from the Trump administration on tariffs today for cars.
It seems so today. I mean, we like to wait when things are official, because look, we stick to what we said in March 27. when we invoice the car, that was a great idea I think we had in the company, we isolate on the invoice this part. If things change, we'll revert back. I mean, it's simple.
From a business perspective, could this be a new golden era for Europe if they get through it? That actually there's a proposition that Europe can go head-to-head with the US in certain places?
I think that when things change, people have to change. I think that what I see, I'm talking about the European supplier that we have. I see that recently, I see more and more European suppliers that are becoming aware of the need to increase the pace and to offer something unique. So if, let's say 2-3 quarters ago, I was them more in a wait and see, now I see more reactive. And I'm very proud about that because we can have more innovation also stemming from them.
Benedetto, I know there's a lot of speculation about what kind of, not tie-up, but what kind of conversations there are between Leapmotor and Ferrari. What can you tell us?
This is interesting because I read it on the internet. I got a lot of message. Well, I would like to remind 3 things that are important for our brand. 1, in Ferrari, we don't use platform. 2, we don't buy platform from outside. 3, we always keep in-house strategic components. In electric car, the component that the blog was referring to were strategic, so this will be always under our control.
Is there something there? Is there something else that you can work on?
I think that we have some Chinese supplier, yes. Are they making strategic component? Not. I think that there is nothing more than that. You know, sometimes also because of my past experience in semiconductor business, I have also a relation with people that were my previous client. So the people start to make stories that are not true.
When you look at China, how do you see the China demand? I mean, we're expecting a lot more help from the government. How do you see China going forward, especially when it comes to EVs?
First of all, when you go to China, and I've been pretty often in the last years, you don't hear the car when they're getting close to you, so you have to pay attention when you cross the street. But I see that the new technologies, let's say the approach of the Chinese people toward new technologies is different from what I see in other countries, in other continents. So this is good. I see also a lot of the pace of development of innovation over there in these new technologies is higher. And this can become a boost also for the Western world, I think. So that is good. In terms of demand, as I said, the number of cars we sell now is double the number we were selling before the COVID. And, you know, we also need the Chinese people to get more acquainted with our brand. The number of Ferrari we have in China is 10,000 cars since the beginning of history. If you go in other countries, it's 80,000, 90,000. So.
Benedetto, I mean, the only really important question is Ferrari. Does it have to be a red car? I know you sell, yellow, green, all kinds of colors, but what's the Benedetto color?
The Benedetto color I'm driving now is red.
Of course.
But in future, I may take something more on the bluish side.
And blue, we're keeping our options open.
Yeah, this is like my
viewers are thinking like a blue. What kind of blue?
It's blue like this. I like a lot this kind of blue.
Navy blue.
Yeah.
There you go. It's a bit like Batman vibes. Benedetto.
No, not Batman.
Not Batman. Someone else. Benedetto, thank you so much for joining us. Benedetto Vigna there, the Ferrari chief executive. Now, coming up, we'll have plenty more, of course, from the Norges Bank. We'll also be speaking exclusively to the Goldman Sachs chief executive officer, David Solomon. We won't talk about the color of Ferraris with him, but we will ask him about inflation and what the Fed does next. That's at 10:30 a.m. London time. Up next, Bloomberg Brief, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit. Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, The world of which you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Easing the pain, President Trump plans measures to soften the blow of auto tariffs. Carney wins Canada. Anti-Trump sentiment secures a win and a dramatic turnaround for the Liberal Party. And coming up this hour, an exclusive interview with Goldman Sachs CEO David Solomon at the Norwegian Sovereign Wealth Fund's annual investment conference. Well, it's been 5 consecutive gains for the S&P 500. We attempt to make it 6 this morning. Tech has been lagging ahead of their earnings tomorrow, but now it matches the S&P 500, up about 0.2%. We'll get Meta and Microsoft tomorrow. We also have that White House story earlier confirming the Wall Street Journal story on relief for auto tariffs, that helping to lift futures this morning. 10-year treasuries, those have also gained for 5 consecutive sessions. Do we end that today? Yields are moving higher, 2.8 basis points for your 10-year yield. That stands at 4.23. We do have Scott Bessent talking about more deals to come and a tax proposal for the U.S. Let's look underneath the surface here with your stocks to watch is Bloomberg's Valerie Teitel. Good morning, Valerie.
Danny, good morning. Let's start off with the U.S. auto sector. Really enjoying these headlines around the softening of stance on the auto tariffs from President Donald Trump. We're seeing shares of Ford rise 1.2% in pre-market trade. Also shares like GM and Stellantis doing well pre-market. Let's head over to Germany, though. The story is a different picture for a German luxury automaker, Porsche, issuing yet another profit warning, Danny. It's third this year. Shares are falling around 5%. One of the biggest losers in the stock 600 today. They also warned that price hikes might be coming as they look to battle these U.S. tariffs. Lastly, Danny, let's end on the stocks that are reporting before the bell because we continue to get more news on the auto sector. We also have GM reporting in just over an hour's time, also followed up by Pfizer and Coca-Cola for perhaps a read on the U.S. consumer. All three of these, the big ones, reporting before the bell this morning.
Yeah, in the deluge of earnings season. Val, thank you so much. Bloomberg's Valerie Teitel. Now, as market volatility persists, Ed Cole, head of multi-strategy equities at Man Group, writes, quote, "The lessons I have taken from 20 years suffering in EM investing is that once you unleash disruptive and policy volatility, it's very hard to put it back in the box and restore confidence with the same government in place." I'm pleased to say that Ed joins us now. Ed, I always love this perspective that you bring to the conversation. But look, I could argue things have settled down. You don't have that toxic brew anymore of yields higher, stocks down, and dollar weaker, and things are back to normal. But you say the damage is done. Why?
Look, I think that businesses, economic agents require transparency generally. We seem to be in a situation today where the US government's kind of rolling back a little bit from some of its most aggressive policy announcements, and just overnight with the auto tariffs, more of the same on that. And so markets like that. But ultimately, if you're planning investment, which is what makes economies tick, you need to understand that you have a predictable landscape that you can understand is going to be in place for a long period of time. And I don't think that's really what we've got. I think the flip-flopping is problematic, and I think we're going to see that. I mean, we already are starting to see that come through in earnings revisions. So analysts who are looking at corporate earnings in the US have revised their expectations down materially in terms of the volume of downgrades. So we're now at a point where pretty much earnings revisions for US equities are as negative as they've been at any point outside of a recession in the last 25, 27 years. Earnings expectations themselves have not come down very much, really only about 1% down from the top of the 1-year forward earnings expectation integer. And there's probably a lot more to come. I think, businesses are not likely to be particularly confident in this environment because they just don't understand the lay of the land, and they don't understand how they're expected to allocate capital.
How long does that need to persist, Ed, before we see businesses not just pulling back on CapEx, but revisiting their hiring plans, things that might get us more worried for a more protracted economic downturn?
I mean, that's the big worry. I was part of the kind of inevitable recession in 2022, 2023 brigade, which was wrong. But my worry then was that, as inflation rose, the lever that corporates would be left with was managing their cost base, which is a kind of euphemism for the sadness of letting people go. That time around, it didn't happen because end demand was so robust from all of that post-pandemic saving. And this time around, we're in a probably slightly stickier inflation environment. I think, the Fed is trying to work out the extent to which it can look through that. But, inflation expectations are moving a bit higher. And at the same time, expectations of real growth are moving lower. The statement of economic projections for March that came out is showing that the Fed has got less confidence in growth. So from a business perspective, if your end demand's falling and your cost base is rising, sadly, that normally does mean that you need to retrench. That would likely be, if we're going to see a recession, that would likely be the cause of a recession in the US.
Ed, you don't sound like someone who's particularly keen on American equities, just given everything you've said. What are you doing with your allocation when it comes to geographic makeup?
Yeah, I mean, Man Group has this sort of credo that we don't have a house view, and we really don't. We're a place where we want everyone to, think creatively about investing problems. The closest thing we have to a house view is embracing diversification. So, we've kind of, as many people have done, we've looked at this growing concentration in equity markets, both within the US and the US as a part of the world, for a long time, and thought that's problematic because it leaves, in equities at least, it leaves the investment decisions that big plans need to make to outperform in equities. It comes down to, a few decisions on a few stocks, which is not particularly, I think not a comfortable place for big allocators to be. Ultimately, we believe in, diversifying risk, which in equity allocation means perhaps thinking about ways to be exposed to equities that don't force you into concentration. We like risk premia, like low vol, max diversification. So basically, building a portfolio of cash equities, which is massively diversified rather than following an index. And you can do some pretty clever things with leverage to make sure you get the right amount of beta to continue to outperform. Ultimately, though, over the long run, I think if we take that back to what we think allocators are doing and are talking about, we've had an over-concentration of capital in US assets, and that's been driven by superior earnings performance and innovation. But those things are now being questioned, and I think what we're going to see, not necessarily in the short term, but over multiple years now, is that capital has to reallocate away from the US to the rest of the world. And there are lots of interesting things going on in the rest of the world. I mean, just yesterday, there was a huge announcement of corporate consolidation in Japan in the industrial space, unlocking some of those inefficiencies you've got there through the kind of balance sheet and cross-holding between Japanese industrial groups. There's lots of idiosyncratic stories in the world. There's still, I think, an interesting story in the medium term in China. Obviously, there's European fixed capital investment, and all of these things are happening at a time where we think, at least, allocators are going to need to start thinking on a multi-year time horizon about bringing capital, to different geographies.
Ed, what I'm hearing from you, though, is what you're looking at in just that decision alone is some of the innovation, not necessarily waning in the U.S., but coming from elsewhere, valuations and concentration too high. Does that mean that you would be really rotating away from the U.S. or diversifying, looking elsewhere, regardless of what's happening in the White House?
Yeah, I think so. I think that's a really good way to put it. I think this is a catalyst. The kind of excess concentration has happened. It hasn't happened because of the White House. It's happened for good reasons. I mean, that's always the reason that things become over-concentrated. There's always a good story. The catalyst now is the White House, but we've been preaching diversification long before the White House made life more difficult for allocators. I think it's just a reminder, right, that if you end up overly concentrated in either a geography or a group of stocks, because these kind of mega cap stocks are all in the same groups in consumer discretionary or technology, that when the tide goes out on that, when what turns from a tailwind to a headwind, life becomes more difficult. So yeah, we preach, irrespective of the White House, we preach diversification, and now is a good reminder of why you get paid for it.
Ed, a masterclass. Thank you so much for joining us this morning. Please come back again soon. Ed Cole of Man Group. By the way, we heard similar noise coming from George Salaveros of Deutsche Bank saying that buyers remain on strike of U.S. assets. Okay, some other top stories trending on the terminal this morning. Deutsche Bank's trading unit notched a record first quarter, getting a boost from market volatility. Revenue for fixed income and currencies jumped 17%. Deutsche Bank CEO said the results put the bank on track to deliver its targets this year. Elsewhere, China says that it's willing to cooperate with the U.S. after the spat over Boeing. The country's Ministry of Commerce said it's willing to support normal ties with U.S. companies. Earlier this month, officials told Chinese airlines to reject deliveries of new jets from Boeing. And talks are progressing between the U.S. and Iran. For the first time in decades, Iran is pitching its sanctioned economy to President Trump as an investment opportunity worth trillions of dollars. Top Iranian officials are overtly angling for a better nuclear deal with Washington than the one Trump had canceled in 2018. Coming up, autos on the rise pre-market. President Trump offers the sector another reprieve. We're going to bring you the latest on Bloomberg Brief.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
I think it could be as early as this week or next week. Vice President Vance was in India last week, and negotiations are coming along quite well with them. As I've mentioned, some of our Asian trading partners have come with very, very good deals. We're evaluating those.
Treasury Secretary Scott Bessent there speaking outside the White House yesterday. And shares in U.S. automakers are gaining in the pre-market session by as much as 3% for Stellantis. President Trump offered the sector a reprieve from tariffs. Commerce Secretary Howard Lutnick called it a major victory for the president's trade policy. For more, we're joined by Bloomberg Global Business Editor Josh Galoo. Josh, just how much of a reprieve exactly is the Trump administration giving the auto sector?
Well, it's definitely welcome news. And, you know, you already see comments from Ford and GM confirming that they get parts that are manufactured abroad. They have, there are others like Volkswagen and BMW that make cars in the United States, but their supply chains go outside of the boundary. So, you know, these supply chains that they've set up over decades are now in deep trouble. So the extent to which the reprieve the Trump administration is giving now is going to affect their businesses there. It's certainly welcome, but it's also a tiered approach. So they're kind of avoiding the worst case scenario. Basically, what the Trump administration is poised to do is to avoid this stacking of tariffs, where imported cars would not only be taxed from the import, but also suffer the steel and aluminum tax that they have. And at the same time, cars manufactured in the U.S. are going to get a bit of an easier deal on foreign parts that they bring in, and that's going to be tiered over time. The administration says to give them time to relocate their production to the United States. So it's not a full reprieve, but it is something that's very welcome to car manufacturers that are on the edge right now.
And something I'm sure a lot of other corporates would like. I got to say, Josh, it does seem like Secretary Bessent is the one who's setting the agenda. He also talked about this goal of a July 4th deadline to pass Trump's multi-trillion-dollar tax cut package. Let's just take a listen to the Treasury Secretary.
We're going to be having a tax meeting today, but what you can see is that as we go into the tax negotiations or the final stages of the tax bill, we're going to see the president's campaign promises: no tax on tips, no tax on Social Security, no tax on overtime.
Josh, there does seem to be a real concerted effort from the administration to shift the focus back on tax policy.
Absolutely. President Trump's polling numbers have just cratered during this tariff war. Fewer than 40% of respondents in many polls are saying they approve of his handling of the economy. That puts him in a tough position. It's the lowest approval rating on the economy he's had in both terms. So, you know, on the one hand, it's important that he, for his own popularity and for political expediency, returns to some of those campaign promises that are really popular with Republicans, like his tax cuts. And at the same time, you know, the government's coming up on a deadline this summer, August or September, where it's going to need to extend its debt. So it's important that they're moving their tax cuts through Congress in a way that's completely tied to lifting the debt. So that they're trying to move that forward. They have to in some ways, but the administration wants to go even faster than Congress has signaled that they wanted to go. The House aims to pass its version of it by Memorial Day, so the end of next month. And then, of course, there are things to be decided with the Senate to make it move forward. And the administration wants that to happen before they go on their August recess. But there are a lot of details about what cuts to make to be able to afford the tax cuts, the extension of Trump's 2017 tax cuts, but also additional cuts that he wants to layer in. The no taxes on overtime, no taxes on tips, deductions for auto loans, That is going to cost, and up to now, it's unclear how they're going to pay for it, other than massive tax to social programs.
Yeah, I mean, look, a lot of things to figure out in a short time. That is Bloomberg's Josh Galou. By the way, just a headline coming from Punchbowl, pointed out by a great production team. Amazon to show the cost of Trump tariffs on each product. What will that mean for the American consumer as they look line by line of the added cost of tariffs? We already know some of the fast fashion companies like Shein, the e-commerce companies like Temu from China, also adding in the price of tariffs. Okay, coming up, a victory for Carney, what the win means for Canada and its relationship with the U.S. That's coming up next on Bloomberg.
You missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power, live every weekday.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Let's take a look at the front pages this morning and what's making headlines in various outlets. First up, we have this on the Bloomberg. Full power is being restored, or has been restored rather, to Spain after a huge blackout. Just moments ago, the country's operator said the power system is back to normal. Portugal's power has been restored for all users as well. Because of that blackout, it is still unknown. The government said it's not ruling out any possibilities. Next up, the FT has this, that HSBC is increasing provisions for bad loans. It's also forecasting muted lending for this year. It cited uncertainty, market turmoil, and a deteriorating economic outlook from higher tariffs and geopolitical tensions. They also announced a $3 billion buyback for shareholders. And the top story, I should say, on basically every front page, that includes the New York Times, the Wall Street Journal, Mark Carney winning a narrow victory in Canada's election. Carney's party won about 43% of the national vote, but may fall short of a majority in the House of Commons. He spoke to supporters shortly after the victory.
I have a question. Who's ready? Who's ready?
Who's ready to stand up for Canada with me?
Joining us now for more on this is Bloomberg's Roz Matheson. Roz, just how massive of a turnaround was this for the Liberals to come back and secure the prime ministership?
Well, as you say, it was quite a turnaround because only months ago we had the Liberals under Justin Trudeau really lagging in the polls, you know, struggling with an economy that's been in difficulty in a sense that this was the Conservatives' election in a way to lose. But we saw under Mark Carney the change in leadership, helped possibly a bit by the environment with the US and tensions there, that Canadians really moved back towards the Liberal Party. And of course, Mark Carney now winning the election. But it wasn't quite the victory perhaps he was looking for. As you were noting, it could be that he's facing a minority government, yet another minority government in Canada, which will make life harder for him, obviously, as Prime Minister. And the Conservatives performing relatively well in all of that, taking some ground in Ontario, Toronto as a whole. And also, we're just hearing with projections that the Conservative leader, despite the performance of the Conservatives, he may lose his own seat. So again, there could be changes coming for the Conservative Party in all of this as well.
There was a sense, Roz, that this election was just as much about who is in Ottawa and versus who is in the White House. Mark Carney yesterday saying our old relationship with the U.S., one based on steady integration, is over. What does it mean in terms of his victory in saying those things and getting the boost from Trump's anti-Trump sentiment about how Canada and really the rest of the West is going to be treating Donald Trump and the pushback against him?
Well, certainly Carney lent into that in the campaign, saying he would stand up to Donald Trump on trade. He would diversify Canada's trade with the rest of the world, including Europe and in Asia, because, of course, the Canada trade relationship is very intertwined with the US. So he lent on that very much in the campaign. And for a lot of Canadians, these tensions with the US are very visceral. They're very personal. This sense that Trump keeps saying, I can just make Canada another state of America. And so that may have been a rallying cry for voters. But equally, you know, some voters will be concerned. We can see that in some of the voting patterns, that the tensions with the US and by standing up to the US might hurt the Canadian economy further, an economy that's already, again, in those difficulties. So those are twin factors at play. And beyond the US and all of this, there were those long-term concerns in Canada for voters around housing, access for you know, and also about migration, cost of living, and those were still bubbling there alongside the US issue. So possibly did give Carney an extra push in their campaign, but there are big challenges ahead when it comes to the economy.
Roz, thank you so much for that update. That is Bloomberg's Roz Matheson. Now, futures continue to move higher this morning, getting some help from some easing of auto tariffs. Futures up just 0.1%. Coming up on the show, our exclusive interview with the Goldman Sachs CEO, David Solomon. Francine Lacqua sits down with the chief executive from the Norway Wealth Fund Investment Summit. Stay with us for that. This is Bloomberg.
Asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg. From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Easing the pain, President Trump plans measures to soften the blow of auto tariffs. Carney wins Canada, anti-Trump sentiment secures a win, and a dramatic turnaround for the Liberal Party. And coming up in just a few moments, an exclusive sit-down with Goldman Sachs CEO David Solomon at the Norwegian Sovereign Wealth Fund Annual Investment Conference. 5 consecutive gains for the S&P 500. We attempt to make it 6 this morning, getting a boost from the White House, confirming an earlier Wall Street Journal story on relief for auto tariffs. Tech, that had been lagging ahead of their earnings tomorrow. We're going to get Meta and Microsoft. They're dead even with the S&P. When it comes to this bond market, U.S. Treasuries have also gained for 5 consecutive sessions, but we look to snap that this morning with yields moving higher. By the way, yields closed yesterday at their lowest in 3 weeks. We're higher by 1 basis point for your 2-year. For your 10-year, it's just over 2 at 4.23%. Let's look underneath the surface here with some stocks to watch is Bloomberg's Valerie Teitel. Hi, Valerie.
Hey, Danny, good morning. Let's start in Germany. We've had one of the German lenders reporting this morning, Deutsche Bank, showing record profit for their trading desks. Again, this theme that trading desks across the street have done very well with the market volatility in the first quarter. There was a little bit of a warning under the hood, though, the CFO telling Bloomberg that their deal pipeline slowed dramatically in April. So that stock did temper some of its rally. Still in the green, up 1.6%. Let's stay in Germany, move on to defense, because the darling of the defense stock rally in Europe reporting a blowout first quarter earnings release. Those stock is rising near 6.5%. Danny, want to end on what's ahead. We've got 3 big companies reporting before the bell, starting with the auto sector, General Motors in just an hour's time, moving to the pharmaceuticals with Pfizer, and lastly, Coca-Cola. Focus will be on their organic U.S. sales guidance, and what could that possibly tell us about the health of the U.S. consumer?
Valerie, thank you so much. That is Bloomberg's Valerie Teitel. Now let's head to the conversation of the morning to Oslo for the Norway Wealth Fund Investment Summit. Bloomberg's Francine Lacqua is standing by, one of the top voices in the banking industry. Francine.
Thank you so much, Danny. I'm delighted to speak to the Goldman Sachs Chief Executive, David Solomon. David, thanks so much for joining us. First of all, welcome to Oslo, Norway. I know we'll talk about Europe, but we have to start with Trump policies. It's been 100 days since the inauguration. Like, where are we? We've seen a lot of volatility. How would you describe this moment in time?
Well, first of all, thank you for having me, and it's good to be with you, here in Oslo. We're 100 days in, and I would say there are a handful of policy initiatives that are being put forward. Some of them certainly are very, very interesting and intriguing to the market. But what's been put forward on trade so far has raised the level of uncertainty very significantly. And so I'd say 100 days in, we need another 100 days to kind of see where the policy directives are going and to try to have a better understanding of how what's talked about so far, particularly with respect to trade, is ultimately going to be put in place, how it's going to play out. But the policy actions to date have raised the level of uncertainty. to a degree that I don't think is healthy for investment and growth. And I think it's going to be important that we get more clarity on the direction of travel from here.
What, for the markets? So if you look at markets, there's been a sell-off, a pretty dramatic sell-off in U.S. assets. It's somewhat come back, but has it been too drastic?
Well, it's not just for the markets. You know, first and foremost, it's for businesses, it's for individuals. When there's a high level of uncertainty, people tighten their belt, they invest less, they spend less, and all those things slow down growth. And so, you know, one of the things that has happened over the course of the first 100 days is that the perspective on forward growth has been decreased. And so when you decrease, you know, that perspective on forward growth, that changes investors' perspective of equity values. So what we've seen is a relatively orderly kind of repricing of equity assets. And what's unusual in the context of this repricing is generally when you have that kind of equity market stress, people run to treasuries or safe haven, but here we're seeing a slightly different rotation because of the nature of the policy. We've seen a weakening of the dollar, you know, at the margin, and so that's been different than I think what people expected.
Well, are treasuries still a safe haven?
I think U.S. Treasuries absolutely are a safe haven, but you can reprice a safe haven asset as people's preferences shift slightly. You know, I think at the margin, we've had for a long period of time a trend of capital flows into U.S. assets. And, you know, at the margin, people are looking at their portfolio constructions and saying, given the uncertainty that's been raised in the U.S., do we want to rebalance that a little bit? And I'd say the rebalancing so far has been at the margin. Investors can rebalance their portfolio in two different ways. If you're over here in Europe and you have a European investor, they can sell U.S. assets, but also if the relationship between the dollar and the euro changes, that rebalances their portfolio weighting too. And so we've seen that over the course of the last few weeks.
But David, so investors are asking a risk premium, a pretty hefty risk premium to own U.S. assets at the moment, even if there's a reversal in terms of tariffs. Does it come back to what it was like, or is there a permanent change?
Well, I'm not sure that they're asking a pretty hefty risk premium. They're certainly asking a different premium than where we were 3 months ago. But I think everything's got to be looked at, you know, in a broader perspective. You know, the moves have been real in terms of the repricing of equities, particularly some of the growth stuff, the Magnificent Seven, some of these stocks, you know, that really led the last rally. But I'd also, you know, step back and just say, you know, when you look at where stocks were a year ago, when you look at where stocks were 6 months ago, you know, we had a big move up in the early part of the year, and we've kind of reset to kind of where we were, you know, 6 to 12 months ago. What's really important is people need to understand the policy set going forward and the prospects for growth going forward. And at the moment, as I said to you a few minutes ago, the level of uncertainty is just too high. And so until we have more certainty about the policy directive, it's hard for you to see, you know, more capital allocation, more investment.
Does the dollar remain a reserve currency?
Absolutely.
In 10 years, 20 years?
I absolutely think the dollar is going to be the reserve currency, but the value of the dollar relative to other alternatives can shift. And I do think over time, the U.S. needs to be very focused on our levels of debt, our deficit spending, et cetera. And I think to the degree that we don't handle that appropriately, it can put more pressure on the dollar. But I don't see a scenario in the near term where I think it's likely that the dollar is not the reserve currency for the world.
So I know you're basically saying, look, keep a cool head until we have a better understanding, right, of some of the policies put in place. But what does it do to the U.S. economy going forward? Does it mean, you know, does the Fed need to cut rates because of uncertainty on growth?
Well, I think it depends. You know, Goldman Sachs has lowered its growth forecast from 2% to 0.5%. You know, it's not clear how this will all play out in the coming months. No one really knows. But to the degree that the economy slows, you know, ultimately the Fed will try to act to buffet, you know, some of that slowdown in the economy. To the degree that we go into recession, you know, that will lead to a different reaction. So again, the Fed will look at the data, will look at the information, they'll look at labor, they'll look at growth, and they'll make decisions based on that. Everyone wants to project forward and know the answer. We're at a moment in time where it's more uncertain than makes everybody comfortable, and I just say it's a moment in time. Let's, you know, step back. Let's see how some of these trade deals are cut. Let's see what policy actually does go into place, and that will help us better understand the forward growth trajectory. But it's clearly been slowed by these actions, and as I'm talking to CEOs, as I'm talking to our clients, they are holding back on investment. and they're certainly tightening their belt. You're going to see some companies laying off, employees and running their businesses tighter because of this level of uncertainty.
But were you surprised, and are your clients surprised that it's hit growth maybe more than inflation?
I think you're going to have pressures on both fronts. But again, it depends. It's one thing to talk about reciprocal tariffs, but from an inflationary perspective, it actually depends on what tariffs go into place. With respect to growth, there's no question the uncertainty slows down growth. And so everyone's growth forecasts have come down. By the way, not just in the U.S., this affects global growth everywhere. And so the forward trajectory of growth, given the current policy initiatives, has slowed. And now we're going to have to wait and see how this all moves forward to have a clearer sense of how much, how long, et cetera.
Where's China in all of this?
Well, China's a hugely important trading partner, to the West, to the U.S., to Europe. At the moment, we're in the early stages of what I think is an obvious negotiation between the U.S. and China, and we need more clarity. But the current state of affairs is not sustainable, and so that's why I think there will be some change. You're starting to hear the administration, talking about the fact that there needs to be change and what's in place is not sustainable. But no one knows exactly how this would play out at the moment, and that's increasing the level of uncertainty.
David, when you look at a lot of investors, and I think also Goldman Sachs did quite a lot in the Middle East, is this one of your main points of focus? And is that in case things dry up in the U.S., or is it just business sense to go for the Middle East right now?
Well, the Middle East is a very, very interesting business opportunity for a firm like Goldman Sachs. They have enormous capital resources that they export around the world and they invest. We run a big asset and wealth management business, and there are, many of these Middle Eastern nations and their pensions and their funds are partners of ours and other asset management firms all over the world. I think that continues. It's not a function of the U.S. drying. The U.S. is 35% of consumption in the world. That's not changing. Okay, that's not changing. The U.S. is a very, very attractive market. I think Middle Eastern investors appreciate that opportunity as they appreciate opportunities in Europe and other parts of the world. I think one of the most interesting things about what's going on is it would be really good for global growth and good for the global economy if Europe can make more progress on capital markets reform, European champions really bringing together and harnessing the power of the European Union. And one of the things I'm encouraged by as I'm over here visiting in Europe right now is I definitely take away a sense of resolve, of excitement about actually moving forward, breaking down some of the regulatory barriers that have been an inhibition to growth here. And I think that would be quite constructive. And more stimulative fiscal action here in Europe also would be quite constructive for growth. So, there are gives and gets, but it would be really terrific to see some progress on the economic trajectory of Europe holistically here. And I'm encouraged by some of the things I'm hearing from our clients over here.
Where do you see opportunities in Europe? And again, is there like a 6-month window where if Europe doesn't get its act together, it's just too late?
No, I think, there's never just a 6-month window. Okay, here or in the U.S., it's a great soundbite, but these are big, important economies. I do think that European growth has been hampered by a very complex regulatory environment, particularly in Brussels, and by a sense that many of the nations have acted, more nationalistically than holistically. I think given what's going on with the U.S., there's really a push to break down some of that regulatory bureaucracy, to really think about how European champions can be bolstered and there can be more investment. And I think that's a big opportunity. There's more tech innovation going on here. It doesn't quite match up or compare to what's going on in the U.S., but there's more opportunity here. And so, I'm hopeful that this is a moment in time where we can see greater investment and a greater sense of the opportunity of Europe holistically. And that would be quite constructive for global growth if we could see some progress on that.
Talking about regulation, what are you expecting regulation for banks to look like in the U.S.? Does DOGE rip up some of the regulators?
Well, I think we saw an enormous pendulum swing in the last 4 years toward a much tougher financial regulatory environment in the U.S. I don't think it was constructive. And I do think, from a positive perspective, this administration would like to reset that. I'm hearing some very constructive things along 3 fronts. One, obviously, is the leverage ratio, which is very, very important for the Treasury market. 2 is on the capital regime and CCAR and GSIB and the construct of how bank capital is calculated. And 3rd is just on the supervisory process. Supervisory process should be focused on ensuring that we have a safe and sound banking system, and it shouldn't get distracted into other areas. And so I'm encouraged by what I hear out of Treasury. I'm encouraged by what I hear more broadly. And so I do think there's an opportunity to take that pendulum, which really was an inhibitor to growth, free up some capital, get that capital recycled into the system, increase lending activity. And so I'm quite constructive that we're going to see some positive change on the front of financial regulation in the U.S.
How quickly could that come?
I think we'll see the beginnings of that in the coming months. And, certainly if you and I were sitting here a year from now, I would hope I could point to a handful of very specific things that have swung that pendulum back to a more constructive place.
I mean, do you think Europe then follows suit in deregulating at the margins, or otherwise it puts the European banks in a very difficult position?
Well, I think one of the issues for Europe is that the banking system in Europe has not come along over the last 15 years the same way as the U.S. banking system has. When you look at Europe, whether you're looking at, BNP is probably the largest European bank with probably a $75 billion market cap, today. UBS would be larger than that, but just over 100 billion. There are obviously lots of institutions in the United States that are bigger, broader, much larger market cap banks. And so in the context of that, consolidation and growth in Europe and a capital markets union in Europe would be a very constructive thing for the capital markets more broadly. But Europe's been slow to make progress in that. I'm hopeful that we'll see more progress in the coming 12 to 24 months.
Dave, there's a lot of talk about credits and, of course, private equity and some of the alternative investments that also Goldman's trying to take advantage of. How much does that grow in these uncertain times?
Well, when there's a higher level of uncertainty, the growth of private capital slows, just like the growth of, asset management business and public capital slows too when there's uncertainty. But I think the long-term secular growth trends around private capital formation are solidly intact. And if you step back and you step out of this moment in time, I think with a 5 or 10-year view, we still have very good secular growth in private capital formation. With respect to private credit, we haven't had a credit cycle in quite some time. If we have a real economic slowdown or ultimately a recession, you will have a credit cycle. We'll have to manage through that. But with a 5-10-year view, I still think growth in private capital formation is a long-term trend that's firmly in place. And a firm like Goldman Sachs and what we do in our asset and wealth management business is very well positioned to benefit from that.
We often talk about a canary in the coal mine, or is there anything in either private credit or anything that you're watching out for an indication of a significant souring, I guess, of the economy or
well,
markets?
what has happened that we're all watching is the level of uncertainty has changed the prospects for growth in the short term. And as a result of that, companies slow down capital plans. People, because they have less confidence, spend less. I think there was evidence in late January, early February, that when you looked at certain consumer discretionary businesses, we were starting to see a little bit of slowdown. Obviously, with the level of uncertainty we have now, that's been accelerated. And so, there's no canary in the coal mine. Fine. The prospects for growth are slower. And as a result of that, investment will be slower. And until there's more confidence in the policy path forward, we're going to have to manage through a slower growth environment.
And so M&A and IPOs will take a backseat?
Too strong a statement again.
Are you telling me I'm too punchy as a journalist?
Well, it's your job to be punchy. It's my job to try to listen and try to find some balance. Capital markets activity was up year over year in the first quarter. M&A activity for deals above $500 million, so the kind of M&A you and I talk about, was up in the first quarter year over year. Sponsor M&A was up in the first quarter year over year. I think it depends on where we go from here. If you look at the month of April, there's still been a reasonable amount of M&A activity. IPO activity is slower given the level of uncertainty. If the level of uncertainty grows from here, yes, you won't see the same amount of capital markets activity. But my own belief is things will settle down. We'll have a clearer policy perspective and some normalization of capital markets as we shift into 25 and 26. Even if we have a slower economy, or even far worse, we have a recession, ultimately, when the market adjusts to that and resets, people need to transact, they need to raise capital, they need liquidity for their investments. And so part of this is just a reset of expectations, and we're in the process of that happening.
I mean, given all of this, where do you see hiring and firing in what divisions and where geographically at Goldman's?
Well, I think this firm always, manages its headcount with a long-term perspective, and we will continue to do that. I think that in an environment like this where there's more uncertainty, we probably control our headcount by doing less hiring, not by, at the moment, based on what I see, doing more firing. But I do think one of the things that the labor force broadly will have to deal with when there's uncertainty with companies, and I'm hearing this from CEOs more broadly, CEOs tighten their belts. And when CEOs tighten their belts, they get focused on expenses. And so I think we're going to go through a period here in 2025 where expense management is going to be more in focus for CEOs running big businesses than capital investment. And if we get more certainty as companies head into their planning processes in the summer, that might change. But if we have the level of uncertainty we have now, that probably won't change in 2025.
David, thank you so much for joining us. That was David Solomon, Chief Executive Officer there of Goldman Sachs. Danny, with that, I'm going to send it back to you, of course, in New York, and we'll have plenty more throughout the day or here in Oslo, Norway.
Francine, thank you so much for that excellent and really wide-ranging conversation. Francine Lacqua speaking with David Solomon of Goldman Sachs. A plea really from the Goldman chief executive to have some certainty back into the tariff and policy negotiations, saying that he was hopeful that U.S.-China conversations and negotiations, that it was obvious that they were underway. Now, on that note of U.S.-China trade war, it does seem like a moment where China is digging in its heels. China's foreign minister warning that emerging market countries against caving into U.S. tariff threats. Speaking at a BRICS meeting in Brazil, he told the group to choose to remain silent, and compromising will, quote, only make the bully push his luck more. For more, Alan Wong, Bloomberg China economy and government editor, joins us now. Alan, there were also some headlines coming in recently from China basically saying for the pharmaceutical sector, look elsewhere beyond the U.S. to find resources. To what degree is China preparing for the long term to dig its heels in and not necessarily make deals with the U.S.?
That's right. There are two things happening at the same time. China is digging in and preparing for the protracted trade war, but at the same time it has insisted that it's open to trade talks, given certain conditions. And what those conditions are is that any trade negotiation must happen on the basis of equality and mutual respect. Whether the U.S. meets that bar right now or will do so in the near future remains to be seen. But one thing that we know for sure is that Wang Yi, the foreign minister, is standing firm and telling BRICS countries that they too should resist what Wang said that is bullying by the U.S. And it's in China's interest that other countries don't cut a deal at China's expense, obviously. And his speech signaled that Beijing is willing to continue the stalemate. And so the sort of uncertainty that Goldman Solomon talked about, I'm afraid, is going to continue for a bit.
Well, it was interesting. We heard from Treasury Secretary Scott Bessent yesterday speaking to the American media saying that there were conversations on all levels happening between the U.S. and Chinese officials. Alan, have we heard anything similar from the Chinese side? Do we understand to what degree the countries are actually talking?
Well, this time yesterday, China denied that there were any trade talks on any level of the government. So it's a bit of a he says, she says situation here. But going forward, I think it's a fast-moving situation, so we don't know if they will talk. I mean, President Trump said that President Xi Jinping called him, and based on the foreign ministry, they said that they hadn't heard anything like that. So it really is a situation where both sides are saying contradictory things.
Yeah, both of them seem to be saying it's your move, it's your turn to de-escalate. Alan, in the meantime, what is China doing beyond just the rhetoric of saying to the BRICS nations and emerging markets, let's come together? Beyond that, what is China doing to make sure that there is a limited impact to their economy as they continue to put up the tariff barriers?
There seems to be some move on China's part to grant exemptions to certain tariff exemptions to certain imports from the U.S. For example, certain industrial chemicals and maybe plane leases. So those are the categories that China may consider to be key to its own economy and the needs of domestic companies. So there are signs that China is moving to buffer those aspects of the economy.
Yeah, fair enough. And China also seeming willingly now to cooperate with Boeing. Alan, excellent work as always. It's always great to have you on. Bloomberg's Alan Wong. Coming up, more earnings, economic data on deck. We'll break down the calendar for you next on your Bloomberg Brief.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It's your Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day on this Tuesday. We're going to get more earnings before the bell, GM and JetBlue included. Plus JOLTS, that comes out at 10 a.m. Eastern. Visa and Starbucks, those earnings come out after the market close. Now some individual stock movers for you. Ford is rising the pre-market session with those concessions for auto tariffs being announced by Trump just by 1%. GM also rises. Same reason, it also has earnings before the bell, so maybe some tepidness to actually go in and buy before that. PayPal, they're also getting ready to report results. Those shares up 1.6 ahead of those figures. All right, that is it for Bloomberg Brief. Surveillance takes the reins from here. You're watching Bloomberg. DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit. Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
The market is just hoping that we've got the worst of the tariff story behind us.
The longer this goes on, the more uncertainty pervades, the less likely, the upside becomes a reality.
There's no longer uncertainty. It's not what we don't know, but unpredictability of how things behave, how things react.
I just caution people, things may have to go down a little bit more before they go up.
Things can get a little bit sloppy over the next couple of quarters.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday as the president closes in on 100 days. President Trump heading to Michigan with some relief for Detroit, on track to lift some levies on foreign auto parts. The pressure to do more rising as a flurry of polls show increasing discontent with the U.S. economy, leaving Secretary Bessent doubling down on the tax effort.
What you can see is that as we go into the tax negotiations of the final stages of the tax bill, we're going to see the president's campaign promises: no tax on tips, no tax on Social Security, no tax on overtime.
It's an aggressive timeline. The Treasury Secretary aiming for Independence Day.
July 4th, they can get this tax bill through and possibly change the narrative. I think it's really important, as you said at the top, there has been a shift in sentiment. It is no surprise that President Trump has spent most of the 100 days at Mar-a-Lago, at the White House. Now he is getting out on the road, going to the Rust Belt with some promises of some exemptions or some relief for auto manufacturers. At the same time, they have to shift the scene, given some of the sequencing and how it's been received.
Francine Lacqua just caught up with the Goldman CEO. The Goldman CEO, Mr. Solomon, turning around and saying this is an unhealthy level of uncertainty. And this is what we're seeing from UPS right now, not providing any updates to previously issued year outlook.
This is becoming increasingly common. You're seeing outlooks withdrawn, ranges of outlooks given, or potentially no credence being given to any outlooks that they have. UPS is one of the incredible rush of earnings that we're getting this week. 44 companies themselves are going to be reporting. GM later this morning to be reporting earnings at a pivotal time. How do they give guidance given the whipsaw that we've seen in tariff policy?
UPS saying they'll provide an update to the outlook in the first quarter earnings call. Looking at the headlines in front of me at the moment from UPS, as Lisa talked about it, GM's going to drop a little bit later. But better music coming out of Washington, Anne-Marie. More lines on tariff relief, additional push on tax cuts. It can't come quickly enough.
And this is why the market is so uncertain, because the situation still remains fluid with the number of these tariffs. You have a 25% levy on autos, but now what the administration is talking about is there's supposed to be another levy on auto parts. So thinking of giving a reprieve. And also, if you're already paying a tariff on the autos, maybe then we're not going to double tax you, and then you have to pay a tariff on the aluminum or steel. This is why the situation is so tricky. It's two-step forwards, Jonathan, at many times,
one step back.
Equity futures this morning just about positive. A 5-day run of gains on the S&P 500. Positive here by 0.2%. Coming up on the program, we'll catch up with Brian Nick of New Edge Wealth with stocks on a 5-day winning streak. Lee Klasko of Bloomberg Intelligence reacting to earnings from UPS. And Stephanie Roth of Wolf Research on headwinds for the labour market. We begin this hour with stocks higher as the White House signals tariff relief for autos. Brian Nick of New Edge Wealth writing, we are concerned this may be the eye of the hurricane as the tariffs are still in place and their real-world impact has yet to be felt. Brian joins us now for more. Brian, good morning. Good to see you.
Good to see you.
The first cracks in the data, are we seeing them already?
Yeah, we are. And we're seeing stocks being impacted in the areas where we're getting real-world data that's showing the impact of the tariffs. We're seeing fewer and fewer tankers, shippers coming from China to the U.S. We're seeing empty ports. We're seeing lower trucking volumes coming from the West Coast into the rest of the country. And the Dow Jones Trucking Index is the index that has not recovered at all from the Liberation Day swoon in the rest of the equity market. So the concern is less worried about uncertainty, more worried about certainty of reality being bad. And if the resolution of uncertainty is we're going to get these ripple effects through the economy, that's not good news.
Torsten Slock of Apollo's made the point that we'll see the drop-off in trade, trucking's next, retail layoffs come after that. Is that how you see this playing out? And what's the timeline for that sequence of things?
So the thing I'm going to be most interested in about the GDP report for the first quarter, even though it's very backward-looking, is inventory. So we want to see this about the earnings calls, too. What are the companies saying about inventories? Because how much restocking and sort of cautionary stocking there was in the first quarter is going to determine how long we can go, how long consumers can continue to go to stores, find things on the shelves. Is it going to be 1 month, 3 months, potentially longer because there was such a huge buildup in inventories in the first quarter in anticipation of exactly what we're seeing. But we're not optimistic that we're going to be into June and July without starting to see some broader ripple effects in either the labor market or in consumer spending, especially if people see prices going up and decide they're going to pull back.
To build on that with the idea of inventories, how are you looking at some of these earnings that are hardly guides? I mean, basically, you've got UPS saying macroeconomic uncertainty is too difficult to really start to game out with any kind of projection. You've seen a whole host of different companies, including the airlines, withdraw guidance entirely. What do you do with that?
Yeah, and look at the Dallas Fed survey yesterday. The comment section of the Dallas Fed, these people were euphoric after the election, and now they're saying, we have no idea what to do. You're giving us nothing. It's just tariffs all the time. We don't know how to plan. I would say, in terms of the guidance we're seeing, one of the things we like right now actually is technology. They seem to be coming through with, not necessarily positive guidance, but at least relatively stable compared to the rest of the market. Earnings have beaten more in that sector than in others. But if you're looking at the economy as a whole, how can consumers plan for these higher prices? We're going to start to see them on online retailers. They're going to start to show the tariff impact. I think the hope here is that this becomes a political problem before it becomes a severe economic problem or an earnings problem. And people start to see specific items that are high salience, but maybe not impactful to GDP or to corporate earnings, but they just start to see things going wrong in their daily lives in terms of what they can buy. And that ends up being a bigger political problem, and we get some resolution here.
Right now, there seems to be a pretty big distortion developing in markets where you have the front end of the U.S. yield curve pricing in a pretty negative situation with respect to growth, even as inflation expectations on the margins creep up, at least in the near term. Risk assets haven't felt it. We're close to where they were on Liberation Day. So how do you reconcile that? What will make some sort of convergence or divergence, ongoing divergence between the two?
I mean, Jonathan said the hard data. I don't think we're going to get a bad report this Friday for April. I don't think that was soon enough to see a deterioration. But we get one or two of these big tier one hard data reports, whether it's retail sales, consumer spending, maybe May or June payrolls. If that starts to look negative, we'll start to see a capitulation, I think, in equity markets, knowing that this is going to be sort of a more severe cyclical downturn. And that will be consistent with the idea that the Fed's going to be cutting rates. I'm not sure, certainly not for next week, and potentially not for June either. We're going to see enough bad news in the near term to get the Fed off the sidelines, maybe until July.
So when it comes to Washington, D.C. policy, we heard from the Treasury Secretary trying to move the conversation forward when it comes to taxes. Do you feel like then potentially you would become more bullish when you see the entire policy perspective?
You just need to know what the tax bill is going to have in it. If it's just a continuation of basically the rates that we've had in place with some other kind of sweeteners thrown in, potentially for short periods of time, because it's not clear how they're going to fit all this into the tax bill, especially if there's a reluctance to cut spending. And this is where the tariff issue feeds into the tax bill. If the tariff issue is causing political pain to people in Congress, people in the White House, it's going to be harder to get people to take tough votes on things like big spending cuts. And if you're not cutting spending, you can't cut taxes as much. either without increasing the deficit a lot. There may not be the votes for that. So the things I get nervous about with the tax bill is there's too much optimism baked in that these tax cuts are not going to be long-term enough because they can't actually find the money to extend them forever, let alone for, for 10 years. And also that by the time they're discussing this, July, August, and they're trying to pass this, we're going to be in more kind of, very difficult macro data territory. And the shape of the tax bill may change entirely. It may turn into a stimulus bill if they're still talking about this in August.
It could too, potentially for farmers, which we heard from Brooke Rollins over the weekend. When it comes to basically then tariffs, which you say they need to deal with this first, what is your base case on what the rates are going to be?
That we're status quo here. It doesn't look like we may be moving to some kind of deals for some of the more kind of friendly trading partners, and that may just mean that the tax rates don't go back up in 90 days to where they were on April 3rd, that we just stay with the 10%. But the big deal that needs to happen is the U.S. and China. The two sides don't even seem like they're talking at this point. So our base case is that these remain in place, perhaps unless and until there's enough political pain that the U.S. has to unilaterally come down. I think that's the most likely scenario, along with they just stay in place. And then a kind of a durable deal that lowers rates on both sides is probably our third base case.
It's hard to come up with a single base case right now, which is why you've got three at the moment on trade. And corporations in America have got to deal with the same thing. Lisa, looking through these earnings from UPS, can't provide an update. Seeing it from other companies choosing, though, to offer that clarity, even when there is none.
I was looking at Hilton earnings, which also just dropped, and this defies all of the narrative that we're hearing about consumers falling off the cliff. Their full-year adjusted earnings per share is actually above expectations. They increased their full-year forecast for adjusted EPS, seeing the upper range. That said, net income is coming in below expectations. So you look in this, it's really mixed, and you start to wonder how much of this is cost-cutting, how much of this is Tom Keene's favorite expression, adapting and adjusting, which is what you see from a lot of companies when they cut on the margins. You also see share buybacks. How much are we going to see this? Because ultimately, if these shares are at a discount and companies believe in themselves, how much do they continue to reiterate and double down on that?
A couple of things to unpack there. Let's start with the resilience of corporate America. Savita Subramanian of Bank of America will join us a little bit later this morning. And the argument she's made, Brian, is that maybe we're underestimating the resilience of corporate America, particularly the names on the S&P. What would you say?
I think that's completely valid. I mean, if you look at the balance sheets coming into this, the reason the companies might be buying back shares is they have cash on hand. Maybe they're not going to be doing the riskier things that they thought they'd be doing this year. Maybe not as much CapEx, maybe not as much hiring, but that means that you have more cash on hand to, raise your dividend, buy back stock, the things that can be sort of more temporary, but things that are friendly to shareholders. I think there's a validity there, and I think it's true on the consumer side too. We're coming into this in pretty good shape with the consumer. We fought off a recession in 2023 that looked like the same thing, with all the soft data looking like it was going to be terrible. Companies very cautious on guidance, and we ended up getting out of that okay too. So I think part of that is because consumers and corporations are both kind of flush right now.
Brian Nick of New Edge Wealth is going to be sticking with us. Equity futures on the S&P just about positive. We're higher here by 0.1% with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Hacker. So Yahara.
Hi, John. We start with UPS. Those shares are up 4.3% in the pre-market after the company reported first quarter earnings that beat analyst estimates. Still, it said it would not be providing updates to its previously issued yearly outlook due to macroeconomic uncertainty. We've heard that before. Shares of Deutsche Bank, meanwhile, rising in German, trading up 4% after the bank reported a record first quarter, getting a boost from market volatility. Revenue for fixed income and currencies jumped 17%. Deutsche Bank CEO said the results put the bank back on track to deliver on targets this year. And Spain's power system is back to normal, according to the grid operator. Spain and Portugal were hit by an unprecedented power outage around noon yesterday, bringing both countries to a standstill. Train passengers were stranded while millions were left without phone and internet access. The cause of the blackout is still unknown. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, looking to strike a trade deal.
When can we expect the first trade deal?
I think it could be as early as this week or next week. Vice President Vance was in India last week, and negotiations are coming along quite well with them.
That conversation up next, live from New York City this morning. Good morning. good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
What a run on equities. 5 days of gains on the S&P 500, the longest winning streak of the year so far. Equity futures on the S&P up another 0.2%. On the Nasdaq 100 up by a similar amount. Academy's Peter Chair. It's difficult to have conviction with so many moving parts in a market where 1% in stocks or 5% in bonds seems like a normal intraday move. It certainly feels that way, doesn't it? Really volatile stuff over the last 30 days or so. Under surveillance this morning, looking to strike a trade deal.
When can we expect the first trade deal?
I think it could be as early as this week or next week. Vice President Vance was in India last week, and negotiations are coming along quite well with them. As I've mentioned, some of our Asian trading partners have come with very, very good deals. We're evaluating those, and President Trump's going to have the final say on all of them.
So here's the latest this morning. The Trump administration sounding optimistic on trade talks, expecting deals to be announced in the coming days. The White House also signaled some tariff relief might be on its way for automakers. Joining us now is Tyler Kendall, live from Detroit. Tyler, welcome to the program. Walk us through what we can expect later this evening.
Yeah, hey, John. Well, a White House official tells us President Trump is set to ease some of the impacts from his auto tariffs. That includes preventing the so-called stacking of tariffs so that automakers don't have to pay levies on top of each other, including that 25% tariff on steel and aluminum imports that you mentioned. We're also expecting some modifications when it comes to auto part tariffs, not necessarily the rates, but that car makers could apply for some partial reimbursements here going forward. But we should make clear at the moment, we are not expecting the auto tariff rates themselves to actually be impacted. Of course, there's the 25% tariff currently in place on fully assembled foreign-made autos, and then we are expecting a 25% tariff on auto parts to go into effect on Saturday. But still, officials contend that these moves are meant to be a reprieve, meant to give manufacturers more time to reshore their production in places like Michigan, where I am, and where, of course, as you mentioned, President Trump will be later tonight. He's headed to Macomb County. It's about an hour from where I am in Detroit, and it's considered to be an auto hub, a hub of production, and home to many of the workers that this White House contends that his policies are intended to help, even as perhaps amid all the uncertainty, they could also face some of the biggest harms when it comes to this. In fact, a Macomb County official does tell me that the area is home to about 338 auto manufacturers that employs about 22,000 people in this area. So, John, it is really no coincidence why President Trump is expected to be here tonight as he marks 100 days in office.
Tyler, I'm sure we're also going to hear about the tax policies. We're going to hear from the Treasury Secretary as well later this morning. They're clearly trying, almost desperate, to move the conversation forward. What do we know right now between where the White House stands and Congress stands about how quickly they can get reconciliation done?
Well, Amory, the Treasury Secretary, said yesterday that he would like to see this ultimately done by July 4th. But then we heard from Senate Majority Leader John Thune, who called that an ambitious timeline, and that really the X date is going to serve as the date that really spurs Congress on when it comes to this. That has been set around, late summer, early fall. I did actually speak to one senior aide to Republican Senate leadership who told me that they are not expecting the Senate to move on this until likely August. So that gives us a little bit of firmer guidance or more of a timeline timeline when it comes to what lawmakers are actually aiming to accomplish. But still, House Speaker Mike Johnson contends he wants his conference to get this done by Memorial Day. Of course, both chambers have to agree here, work on their own separate legislation. But to be clear, all of these timelines at the moment seem to be pretty ambitious because there are a lot of disagreements between the two chambers, including on tax cuts, what's actually going to get through as they work with the Senate budget blueprint, which includes about $5.3 trillion in net tax cuts. And they want to see other priorities like no taxes on tips, overtime pay, Social Security. But at the end of the day, they're going to have to come up with some more pay-fors to get all of those goals accomplished.
Hey, Tyler, thank you. Appreciate the update. More from Tyler later on this morning. Tyler Kendall there. Aspirational, I think the Senate Majority Leader called it, aspirational, targeting Independence Day.
Aspirational is exactly what he called it when it comes to trying to hit this July 4th Independence Day timeline. It's going to be incredibly challenging, which is why, and Secretary Bessent has said this to me, it's pretty much why they're making sure that they're raising the debt ceiling in reconciliation, because Congress actually needs a hardcore deadline or really nothing gets done.
Brian Nick of New Edge Wealth is still with us. Brian, we talked about a base case. Let's go through some of this. No tax on tips, no tax on Social Security, no tax on overtime. What can we do down in Washington?
I was pretty skeptical that these were actually going to be in the bill, but it looks like they are going to move forward with them. The question is, how long are they going to be there for? I mean, they can do this for a year or 2 years or 4 years, but they probably can't do all of this for 10 years and still pay for it under all the rules. The one silver lining of the tariffs is it probably gives them enough revenue to push the X date back a bit. If the tariffs stay where they are and we're really collecting as much as we have been in the first couple of weeks here, the X date doesn't have to be in August. It could be potentially as late as October, which gives them a bit more breathing room. It sounds like congressional leadership doesn't necessarily want that. They would prefer to have everybody act over the summer and get this done. But we know from the 2017 experience, they kicked this all the way through to the end of the year. They pass it at the very, very last moment, which is what Congress is going to tend to do.
But the market wants to see it as soon as possible. Is the market, though, pricing in basically this is an end-of-the-year story?
I think the market's pricing in that they have to extend the current individual tax credit rates, and maybe we get some other sweeteners in the form of these no tax on tips, no tax on Social Security. But I don't think there's going to be any permanence in this bill. I think you'll see assuming the economic situation is softer in July and August than it is today, it's going to be harder to pass the things that are the pay-fors in the bill, like taking away some of the tax credits for energy, it's going to affect some of these congressional districts most acutely, taking away parts of the IRA, cutting potentially some of the Medicare reimbursement, the federal formula. That's going to be harder to do if the economy is weaker. And so I think the longer this goes, the more this is going to be sort of a pure tax cut and deficit increasing bill, and it's going to feel more like a stimulus bill.
You're getting into some of the back and forth we're going to see from a lot of different caucuses within the Republican Party, those that don't want Medicaid touched, those that actually want the IRA credits because their districts are using them. What do you think really does get cut when it comes to things like Medicaid? Can Republicans really sign up for that 18 months before a midterm election?
It's going to be very challenging. And the people have already wrote letters, the moderates have already written a letter saying we don't want to do this. They're going to find a way to try to cut this without saying they're cutting it, looks like. There's no way to get all these tax cuts through for even 5, 6, 7 years without also doing some of these spending cuts, and that's just where the money is. And you've had the president already on record saying we're not touching Social Security, we're not touching Medicare, and also occasionally we're not touching Medicaid. So there's no place to get the money. I think we'll probably see some of the federal reimbursement formulas, sort of the payment sharing, some of the eligibility potentially change as well. That seems to have sort of that baseline of popularity in the party. But like you said, they can't lose that many votes on either side of this.
You said that it'll feel like stimulus. It'll be straight up deficit spending. That's the more likely path. Why is that not making you optimistic in equities?
Because the way we get to that point is that things have to get worse, right? In order for all these Republicans that don't want to do deficit increasing tax cuts to agree to this, you have to have a worse economic situation in the interim so that you can have a bailout for some of the affected industries, potentially farming bailout, potentially just checks written to individuals who are being hit by the tariffs, and that you could easily see that by August or September if this is being debated.
I can hear the roar of bond traders with pitchforks getting up in arms as they hear about this, given all of the uncertainty around the potential deficit. Yesterday, the Treasury released its latest quarterly borrowing estimates, and they had a bit of a rounding error of more than $400 billion. That is how much bigger their quarterly borrowing estimate is for the second quarter of 2025 than initially forecast. How much is the Treasury running out of cash and needing to borrow more and more and more going to stress the market in a way that possibly puts a cap on how much of a stimulus that this actually can be, at least for equity markets?
I think one of the things, just given all the news around tariffs, one of the biggest whiplashes that people are missing is that this went from optimism on spending cuts to now, I don't think people are really talking about that anymore. I mean, it's not clear that we're seeing any significant spending reductions from the DOGE cuts. It's not clear that we're going to get significant spending reduction in this tax bill, assuming it comes in a couple of months when things are getting softer. The question, and we haven't seen a reduction in interest rates, despite the fact that the Fed cut at the short end 100 basis points last year. The 10-year is still basically where it was. So there's no room to find sort of good news for the Treasury in terms of the borrowing costs. I think the only thing you can look at is if there's more optimism about passing this and having the economy sort of reflated potentially in 2026, that's going to be better than the alternative, which is you get a recession and then the government has to spend a lot more money. We know, like, as big as the deficits are today, they would be even wider in a recession when you get all these automatic stabilizers kicking in. So if it's like we're not going to have a recession because we're stimulating the economy today, that might be good news for the bond markets.
That's actually the question I wanted to ask you. You talked about the incoming tariff revenue. What about the loss of revenue elsewhere, the loss of tax revenue elsewhere because of those tariffs? How does one offset the other?
Yeah, I think in total, if you're talking about sort of over the long term, the tariffs are not going to raise as much revenue as they offset from things like corporate profits taxes, individual income taxes. If incomes are going down, people are losing their jobs potentially. I think in the interim, though, as this money is coming in, you'll see it used. I don't think it's going to be earmarked in the legislation, but you'll see it used as an excuse to, okay, look, there's a lot. The Treasury has a lot more balances than the Fed. There's more cash on hand, so we don't have to worry about the debt ceiling quite as soon.
Lotfi Karui of Goldman Sachs sat in your seat just yesterday, and he made it clear from his standpoint, his opinion, that when we go into an economic downturn, bonds will rally, treasuries will perform. Do you share that confidence?
Yes, still share the confidence. Don't think we have a credit issue yet in the U.S., so at the end of the day, if things really do look bad, if we're seeing big negative payroll numbers, I think you will see the 10-year yield fall. It does seem like the hurdle to get there is a lot higher than it used to be. The fact that bonds are only up a couple of % year to date, with all that we've seen with the negative news in the equity markets, with the downward revisions we're seeing to GDP forecasts, seems like they're just plummeting every day. The economic consensus, the fact that we haven't seen the long end fall by more tells me that we're not in the same territory that we were 2008, 2015, or even 2024.
Brian Nick of New Edge. Good to see you, sir, as always. Brian Nick there of New Edge Wealth. The number one question I think that investment committees have been grappling with, Lisa, over the past few months.
Yeah, our Treasury is still a haven asset. And one thing that you noted was 5 straight days of U.S. equity gains. Well, guess what? We've also had 5 straight days of Treasury gains. And normally, okay, everything rallied, great. In this case, is it? Because ultimately it's either a pro-America or anti-America trade on. And that isn't necessarily supportive to this idea of that ballast.
Equity futures positive here by 0.2%. Up next on the program, looking for clarity where there is none. Lee Klasko of Bloomberg Intelligence as UPS backs away from full year guidance, and we're looking for the latest numbers from General Motors. All of that coming up next from New York. This is Bloomberg.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Earnings season in focus. UPS out with numbers just moments ago. No update to full-year guidance, given what they call macro uncertainty. The next numbers to drop from GM, we'll get to that in just a moment. Equity futures on the S&P positive by 0.25%. 5 straight days of gains for stocks and bonds, with 3 hours to go until the opening bell. With your morning movers, here's Danny Berger. Hey, Danny.
Hey, John, I wanted to show you what UPS is actually doing, because given what you just said, that they scrapped their guidance, you might think that they were down this morning. No, in fact, they're one of the biggest movers to the upside on the S&P 500 in the pre-market session, up 4.33%. Now, along with scrapping guidance, specifically citing macroeconomic uncertainty, they're also undergoing this project to slimming down. They also announced that they would eliminate some 20,000 positions in response to pulling back on some of the Amazon deliveries for 2025. Also, one of the biggest gainers pre-market for the S&P is the industrial giant Honeywell, that is up nearly 5%. Unlike UPS, they did give a full-year guidance, and it's something that perhaps the market is taking comfort in, because within their range, they have raised the midpoint of it. But the CEO there did point out, look, as we get later into the year, things will become less certain. You can also see that in the guidance, the top end, they still did trim down, but still those shares higher. So those are the two biggest gainers on the S&P pre-market. The biggest loser is NXP. This is the semiconductor company. It is down nearly 9% this morning. They've announced that their CEO is retiring, that he will be replaced, but Bloomberg Intelligence pointing out he's retiring at a young 56, which seems to indicate some structural issues at the company. They also said that life is getting harder for them because of tariffs, and they are still working through a COVID backlog. John.
Danny, thank you. Here comes another one. This from the Wall Street Journal and the New York Times. GM pulling profit guidance, citing what they call significant tariff impacts.
Yeah, the CFO, Paul Jacobson, coming out and saying we're not going to give any more forward guidance on tariffs until we have more clarity. He went on to say we don't want to put out a number from the company that is a guess amidst what the administration might do. So yet another one saying, look, in our honest assessment, how can we give you any honest assessment of something that is just profoundly unclear?
Rescheduling the call to Thursday, May 1st. That's the latest from GM this morning. The stock's slightly positive, up by 1.4%. We'll come back to this story in just a moment, but just to wrap things up so far this morning, no update from UBS, the full-year guidance. Why? Tariffs, what they call macro uncertainty, and a blunt assessment from GM this morning, pulling their guidance as well. Can't contemplate the impact of tariffs. I think we're all struggling with doing the same thing. On our radar this morning, some relief maybe for the autos. President Trump on track to lift levies on foreign auto parts and provide a reprieve from separate tariffs on steel and aluminum.
Well, this is exactly why GM is saying it's really difficult right now to say what it's going to look like for the rest of the year, because this is what they're thinking of doing today. We didn't know about this until 24 hours ago. So basically what the administration is saying is we're not going to hit you on multiple levels of the different levies that we have right now. So if you're paying an auto tariff, you're not going to have to pay the aluminum and steel tariff. And then potentially there's going to be on the margin some reprieve when it comes to auto parts. This is a huge welcome and sigh of relief for the likes of Ford, GM. The problem is they're still uncertain about if there's going to be even more relief when it comes to autos. And they are calling the administration almost every single day, trying to get clarity on this issue.
Bloomberg's Craig Trudell will be with us in just a moment to run through these numbers from GM and the lack of an update to guidance given the policy volatility we've seen over the past few weeks. China responding as well, reiterating the US trade talks are not underway and urging countries to not cave into US tariff threats. China's foreign minister saying he supports normal business cooperation between the two countries.
So it's kind of speaking out of both sides of the mouth. On one hand, you have Chinese authorities coming out and doubling down on a very nationalistic type of tone, saying, look, we're not going to cave, we're not going to give in to bullies. It's a very rah-rah type of speech. And then on the flip side, there is this sense that on the margins, China is willing to cooperate because the financial pain is significant. It speaks what we were talking about yesterday, and there's a Bloomberg story about it today, about how much Beijing has welcomed the groundswell of support that they've gotten from the local domestic audience, given the fact that they now can blame one person for all of their problems that have been in the making for a long time.
I think it's fair to say that Mark Carney has welcomed that as well. Canada's Liberal Party, led by Mark Carney, set to win for a fourth consecutive election. The party narrowly winning 43% of the national vote. Carney pledging to strengthen Canada's economic independence and stand up to President Trump.
This U-turn is pretty incredible when you think about the Liberal Party in Canada, given the fact where Pierre Poilievre was at the start of the year. There was this immense fatigue when it comes to three-term Trudeau administration. But then, of course, Donald Trump started to be antagonistic on Canada when it comes to trade, when it comes to things like making the 51st state. And then you saw this rallying cry behind Mark Carney, and then he was able to pull it out last night.
I remember back in 2016, shortly after the Brexit vote, the Prime Minister disappears, the Chancellor can't be found, there was one man left standing. Now, whatever you think about Governor Carney and how he handled Brexit at the time, the leadership that he provided in that moment, I can tell you there was no one else there. He was like the beacon of stability, the port in the storm. And that's been the pitch to voters in Canada over the last month, exactly because of the tariff volatility down in D.C.
To frame this, and I think you're exactly right, this is someone who ran the Bank of Canada, or headed the Bank of Canada during the financial crisis, who headed the Bank of England during Brexit, and now is saying to Canada, during this crisis of confidence with our neighbor, the United States, I will be your port in the storm, to sort of highlight your point. He always just seems to emerge when there's some sort of existential crisis.
He knows how to handle these moments. I was in the room with him back in June of 2016. Several other journalists were all called in shortly after the vote, and it was to calm people down, to soothe nerves. And I think he did a pretty decent job of just that.
Well, hopefully he will have the opportunity to do that. I will say he did get a groundswell of support, but not quite as much as people expected. He doesn't have the majority in the House of Commons. So it could be a little bit messy for him to have the same kind of ballast of support as he did when he was running some of the central banks.
We'll get you an update on that story in about 60 minutes from now. I want to get you an update on the earnings story as well. GM reporting earnings just moments ago. Craig Trudell joins us now for more. Craig, welcome to the program. I think we have to start with the guidance or lack thereof. What's your response to what you're seeing this morning?
Yeah, I don't think it's a huge shock to see the company back away from the numbers that it had given investors when, it's been, a matter of hours that the administration has changed yet again its approach to automotive tariffs. I do think that the relief that the administration announced last night will be helpful on an incremental basis, but it is still a matter of, saying we're not going to do, sort of the most out there thing of stacking tariffs on top of one another. We are still, however, going to hit, parts and car imports, and that is still going to be extremely disruptive. And so, you have the CEOs of companies in Detroit coming out and saying, thank you, Mr. President, for not doing the worst. But if you parse their statements closely, they're saying that these moves will mitigate the damage. It won't do away with them entirely. And so how do you sort of, offer guidance with any confidence, given that you don't know just how long these tariffs are going to stick around, and just how dug in this administration is, given the extent to which they've kind of taken one step forward, one step back over and over again.
So, Craig, lots of questions here for the operational side of the business, but also, I think, for the capital return program, the buyback over at GM as well. What does this mean for that, Craig?
I mean, that's been, sort of Mary Barra's calling card, right? Where this is a company that, hasn't done everything right. The strategy has been to try and, kind of replicate Tesla and get people excited about GM's electric vehicles. And for years, it was also to get them excited about self-driving and autonomy. I think the electric vehicle side is picking up momentum, but they had a significant step back on, the self-driving side and did away with Cruise, essentially absorbed that business. But all the while, the sort of old school business within GM of making big trucks and SUVs has done quite well. And, Bara has managed this company in a way that has allowed for them to do a lot of returning to shareholders. And to the extent that that can't continue this year because of the commands on the company's cash, dealing with tariffs and potentially making some investments that it might not have otherwise as a result of these levies, it may be a setback to some of the momentum that we've seen with GM in the Mary Barra era.
Quite clearly. Craig Trudell with the latest out of London from Bloomberg. Craig, thank you. The latest on GM, if you're just joining us. So the first quarter, adjusted EPS coming in at 278. The estimate was 272. The guidance from the company, pretty clear. The prior guidance can't be relied upon because they didn't include the impact from tariffs.
Yeah, and they also did they froze that share repurchase program, which had been the hallmark of Mary Barra's whole plan, was to try to, as we were just hearing from Craig Trudell, replicate what they saw over at Tesla. How can they justify using their free cash at a time where they say that they have no understanding of how the path forward is going to look like?
GM this morning down by about 4% in the pre-market. Another company to look at is UPS. Joining the list of companies halting guidance, the company saying it will not provide an update to its 2025 outlook despite delivering better than expected first quarter earnings. Lee Klasko of Bloomberg Intelligence joins us now for more. Lee, welcome to the program, sir. Let's just start with the numbers. Did you like what you had to see this morning?
Yeah, I mean, given all the noise of the economic uncertainty in the background, I think this morning's print by UPS was some good news for the company that's in the midst of a transformation. And that transformation is going to get, I guess, a little bit bumpy because of the uncertainty that's out there. And that's really why management is pulling their, decided not to give guidance going forward, which to us makes complete sense. We were actually surprised a lot of our companies have maintained their guidance during this uncertain time. And, I think overall, UPS had a pretty good print. The beat was really driven from our vantage point, from the volume side, especially as it relates on the domestic business. Domestic margins came in better, which is kind of telling us that maybe some of their cost controls that they're working through their networks are starting to pay off. The company is continuing to restructure itself to deal with the new realities of demand, even excluding all the U.S. tariff and de minimis noise. And some of that is, walking away from Amazon business, which accounted for about 12% of their revenue at one time. And they're just doing that because it's low margin business and they feel that they can fill their network with more profitable freight.
UPS used to be a real bellwether for the U.S. economy. It's gotten complicated by some of the rivalry with Amazon and some of the other competitive landscape issues. I am wondering how much of the volume that you saw increase is due to pulling forward of orders ahead of the tariffs, whether this is a one-time type of boost that will come at the expense of volumes later in the year.
I think it definitely had something to do with it, that pull forward effect. I mean, it's been telegraphed that tariffs are coming and some shippers, especially more sophisticated shippers, want to make sure that their inventory are positioned here in the United States before those tariffs go into effect. And I think we saw some of that. I'm not quite sure if that's 100% of what's driving the volume beat. But, it'll be interesting to see what management has to say during their earnings call later this morning about, what their customers are saying to them. But, given the fact that they are not providing guidance, I think their customers are just, sitting at the sidelines waiting to see how this plays out, this trade war plays out with the rest of the world on global freight demand.
Lee, when it comes to de minimis, which you mentioned earlier, how much of an impact is that going to have, closing of that loophole?
Yeah, they don't really give specific numbers on their volumes. We guess it's, low single digits of their volume. And that de minimis stuff, so what happened is the government's getting rid of the exemption for freight less than $800. Those shipments usually, when they come in, they get cleared through customs and they don't really have to pay a tariff. Now they're going to have to pay that tariff. And a lot of those volumes are from Chinese e-tailers like Temu or Shein coming into the United States. So those companies are going to have to change the way they do business. Either they're going to have to position that freight here in the U.S. Or face these tariffs. So that's definitely going to have an impact. And the growth that we've seen late last year and probably to some of it in the first quarter has been driven by a surge in that demand here from the U.S.
Hey, Lee, got to catch up. Thank you, sir. Lee Klasko there of Bloomberg Intelligence, the latest on UPS. Equity futures at the moment just rolling over, slightly negative now on the S&P 500 following these results out of corporate America in the last 40 minutes or so. Let's give an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Goldman Sachs CEO David Solomon sat down with Bloomberg's Francine Lacqua earlier and discussed the impact of President Trump's first 100 days in office.
I'd say 100 days in. We need another 100 days to kind of see where the policy directives are going and to try to have a better understanding of how what's talked about so far, particularly with respect to trade, is ultimately going to be put in place, how it's going to play out. But the policy actions to date have raised the level of uncertainty to a degree that I don't think is healthy.
Solomon also said he expects companies to announce layoffs due to uncertainty around policy. Meanwhile, GM shares are falling in the pre-market, down nearly 3%, despite reporting earnings that beat estimates. That's because the automaker is pulling its 2025 profit guidance and putting $4 billion in share buybacks on hold. GM saying President Trump's auto tariffs have clouded the outlook and its prior forecast can't be relied upon. And American Airlines ended discussions with JetBlue to revive a pact for the two airlines to team up. American's vice chair and strategy officer told staff that JetBlue was, quote, focused on different business priorities. The company also said it filed a lawsuit against JetBlue to recover money from the unwinding of their prior pact. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, counting you down to payrolls.
We're generally expecting that the labor market data is probably going to look okay through the May data. It's probably not really until sort of June, July, August timeframe that we really see, the impact of some of the uncertainty and the tariffs on the labor market.
The payrolls report just a few days away. Up next on the program, Stephanie Roth of Wolf Research from New York City. This is Bloomberg.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
There's a theme emerging this morning from General Motors. Prior guidance didn't include the impact from tariffs. No update to guidance from them because of that. Seen this elsewhere as well from UPS, not updating the outlook given the macroeconomic uncertainty. And just moments ago from Pfizer, guidance doesn't include the impact related to future tariffs. Equity futures right now softer by 1/3 on the Nasdaq 100. We're down by 0.4 on a Russell. A bit softer also negative by 1/3%. Under surveillance this morning, counting you down to payrolls.
The labor market's holding up pretty well. We're generally expecting that the labor market data is probably going to look okay through the May data. You know, we've been expecting that it probably will soften relative to March, but then it's probably not really until sort of June, July, August timeframe that we really see, you know, the impact of some of the uncertainty and the tariffs on the labor market.
So here's the latest this morning. Our survey here at Bloomberg showing economists looking for 134,000 jobs added and unemployment to hold steady in Friday's payrolls report. Stephanie Roth of Wolf has one of the lowest estimates on the street, writing, we're looking for 90,000 non-farm payrolls. Weather, seasonal factors and the calendar alone suggest a substantial headwind. Stephanie joins us now for more. Stephanie, good morning.
Good morning.
Is it too early to expect to see a hit from the policy volatility down in Washington?
No, I think we should start to see that companies probably pause on their hiring. If we don't know what the outlook is, a lot of companies are quite uncertain about where things are going. It makes sense that they're going to pause on hiring. And then from the comments that you just read, there's seasonal factors weighing on the print, calendar factors weighing on the print. It makes sense for it to be below 100.
Has been described as a random number generator at time. In the survey week, claims are okay. Does that make a difference to you?
No, because the seasonal stuff is not really an effect of firing. It's more just timing around the survey week compared to last month. There was bad weather. That doesn't mean that there was actual firing, so that shouldn't correlate with the claims data. This is more a function of this particular non-farm payrolls print.
Does it matter which jobs end up getting removed or maybe seeing a weak performance in this report, given the fact that there has been this ballast of healthcare, as well as a couple of other sectors, including the government, that have really driven things over the past couple of years?
Yeah, and I think that's something that we're going to see over the next couple of months is the parts of the labor market that were really strong should start to slow down, government in particular, healthcare as well, especially since grants are likely to be slowing down healthcare hiring. And then on top of that, you should start to see the cyclical parts of the economy slow down. That one I don't expect for this print necessarily. I think we should see a sort of more gradual slowdown from that perspective. But we should start to see construction, should see a headwind from some of the weather stuff. Healthcare, government should be a little bit softer in this print. And then in the next print, things like rail employment, stuff that's actually tied to the goods economy. That's probably less of a story for this print. It's probably more about the May payrolls print.
You know, this has been a really confusing moment. On one hand, a lot of people are predicting a lot of pain and potentially a real headwind to growth. On the other hand, you do have companies withdrawing guidance. You have others, like some of the travel companies, cruise liners, and hotels increasing their adjusted full-year forecast because they see people still traveling. People still want to go around. The consumer is still strong. How do you pair these two ideas and put them together in some sort of outlook?
I think it makes sense. Today, the economy is fine. There will be some significant headwinds in the next couple of months unless Trump pulls back the tariffs on China in particular in a big way. So if he doesn't do that in the next couple of weeks, we might be on a sort of unsustainable path towards recession. Base case is he probably pulls down the tariffs on China in particular fairly notably in the next couple of weeks. Otherwise, we might be looking at bare shelves and COVID-like environment, but it was a self-inflicted one.
Stephanie, what's fairly notable in terms of pulling the tariffs down? 60%? That still feels like to many people a trade embargo.
You need tariff rates to be below 55% roughly, all in. That includes the fentanyl tariffs, that includes the reciprocal tariffs. And then, by the way, you have to be cognizant that there are 301 tariffs from the last trade war as well, some of them up to 25%.
Right, so it's a massive cumulative rate. You said something earlier. You said you don't expect companies to be hiring. They're on pause. Do you expect them to be firing at this moment?
At this moment, probably not. There's just so much uncertainty. There was so much difficulty hiring in the past couple of years. It probably makes sense for them to just pause for a little while. Of course, there's going to be still some hiring to some extent. There's just a business needs, the economy is still growing. But to the extent that at the margin, if you're not sure you need the position, you might just kind of wait for the next couple months, see how things play out, and then make a decision about whether you actually want to hire that position.
Later on this morning, we get consumer confidence numbers, and within that, you're offered a read on attitudes to the labour market, how difficult or hard it might be to get a job. And I think this is really important on taking the temperature, not only for that, but also the potential for second-round effects when it comes to inflation and price hikes. Now, if I'm worried about getting a job, how likely is it that I'm going to get a pay rise anytime soon, or at least ask for one?
Probably less so. So you're probably going to start to see a little bit of a deceleration from a wage perspective. The one thing is, the immigration stuff actually has a different implication for the blue-collar worker at the lower end. So there's a bit of stuff happening kind of under the surface that is quite nuanced. So we might start to see an unusual tightening for the blue-collar worker, even though the white-collar worker might actually be having a little bit more difficulty finding a job.
So just for the record, ask for a pay raise, right? Okay.
Really?
Always.
Always.
Okay, so that's you're basically, so in sum, please. Rachel?
This can become self-fulfilling, don't you think? That people start to worry about these things, so they back off, they stop spending, and it takes on a life of its own.
Which is a reason why I think it's really salient that you mention these surveys and how people feel about their jobs, people staying longer. The quits rate later this morning when we get that JOLTS data is going to be key in terms of people's confidence, not just to ask for a raise, but to leave their jobs. And as we're talking about this, UPS announces plans to cut 20,000 jobs this year as a result of the Amazon tie-up. You're seeing this on the margins, cost-cutting coming more into the fore.
Where is consumer price tolerance right now, going into potentially higher prices?
Not very high. So the biggest driver of consumer inflation expectations is past inflation. So to the extent that consumers are worried about the inflation that we saw this time, they're quite worried about inflation that we're going to see in the future, in which case they're probably going to be pulling back on spending. They're going to be very attuned to the prices that they're seeing on the shelves. So this is very different than the last trade war for a number of reasons, magnitude of course, but also where we are coming from. And in 2018, we didn't have a period of inflation. People weren't really expecting inflation. They didn't really know what it felt like. This time, consumers are very, very different versus where we were.
Amazon has a different idea of how this might play out, right?
Amazon, I think, is going to get very political. The Trump administration is not going to like this. Punchbowl says that they're going to add what the tariff rate is on top of the cumulative price. So if you're a consumer and you see something's $5 and now it's 10, 7, whatever, you see the additional tariff input. That is going to, I think, really irk the administration.
Yeah, the politics of that is going to be interesting over the next few months or so, if that's how it plays out. Stephanie, it's good to see you, as always. Thanks for dropping by. Stephanie Roth there of Wolf Research. In the second hour of Bloomberg Surveillance, we'll catch up with Matt Stuckey of Northwestern Mutual, Rob Casey of Signum, Global Advisors, Colin Martin of Charles Schwab, and Mandeep Singh of Bloomberg Intelligence. 48 hours full of tech earnings. That kicks off tomorrow. Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country and how many people have another problem called illiteracy or illiteracy, which means they can read, but they don't choose to read.
It's a challenge with the digital age because they're reading on tablets, so we do count that as reading. If you have an ebook, you're reading the book, and I've been often asked if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets
with the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Overall, it's just been better than expected in terms of earnings.
The short term is going to be very challenging for a number of companies. So I think it is still going to be a really challenging quarter ahead.
If you assume we kind of muddle through this year, it's kind of reasonable to be where we are.
Overall, across the board, these companies are going to sustain their CapEx spending plans.
Short-term volatility that then can resolve itself. The concern is, of course, is if we cannot have some certainty in the markets.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, following 5 days of gains for stocks and bonds. Equity futures this morning negative by 0.1% on the S&P. On the Nasdaq 100, also softer, negative this morning by 0.12. In the bond market, Treasuries a little weaker, yields a bit higher across the curve by a single basis point. On the 10-year, up by close to 2 to 422.74. Going into a busy morning, 8:30 Eastern time, you'll hear from the Treasury Secretary in a press briefing from the White House. Look out for that a little bit later this morning. After that, some economic data, job openings and consumer confidence as we get a read and take the temperature on confidence in corporate America, and confidence is not that high.
You have UPS, you have General Motors, you have Pfizer coming out and basically saying, you're really expecting us to give any sort of guidance? No way. How can we? Because the macroeconomic uncertainty, the inability to forecast seems to be a real concern. You are getting guidance from elsewhere, but here lies the issue. There are pockets of such deep uncertainty that corporate executives like GM are postponing calls even with their investors because they're saying ultimately we don't really have a sense that things are moving that quickly.
The president heading to Michigan later on this evening to mark 100 days of his second term and offering some relief potentially to Detroit. That's in focus, plus doubling down on the tax cut effort in the nation's capital.
So he's going to be in Michigan. This is obviously the automotive hub of the United States. And at this moment, he's going to say, I hear you, automakers. I'm going to help you out. There's going to be some reprieve. You're not going to have to pay double taxation, double levies when it comes to the tariffs, even though we see that that's not helping at this moment. GM, Ford, they need to digest all this and get concrete affirmations on what this administration plans going forward. And then obviously, Jonathan, it is so clear from everything you hear in Washington, D.C., They are desperate to move the conversation forward to talk about taxes, and I'm sure it's what the Treasury Secretary is going to really want to lean into this morning when he briefs the press.
This word uncertainty has been overused over the last month or so. You always have to deal with uncertainty in the market. The difference with this kind of uncertainty is the following. At Goldman Sachs, as David Solomon put it well, it's unhealthy because it's leading people to do nothing. It's the wait-and-see economy, and we've all gone back to what Jim Zelter many months ago said over at Apollo, macro paralysis. It's the paralysis of this that is problematic.
There is a level of uncertainty that has to do with we don't know what's going to happen, but we can have a range of parameters to understand exactly what could happen given the rules of the game. Now the uncertainty is about the rules of the game at a time when potentially you could have a real upheaval of the global order. You're seeing a lot of companies come out and say, ultimately, we can't give you any more information. So what do investors do with that?
We can deal with the shock to the cycle. It's much difficult to understand a shock to the system, something we've repeated again and again on this program. Equity futures on the S&P 500, negative here by close to 0.1%, just a little bit softer. Coming up this hour, we'll catch up with Matt Stuckey of Northwestern Mutual as stocks post a 5-day winning streak. Rob Casey of Signum Global Advisors, with President Trump expected to ease some auto tariffs, and Mandeep Singh of Bloomberg Intelligence previewing earnings from big tech. We begin this hour with stock steady as the White House signals some tariff relief for automakers. Matt Stuckey of Northwestern Mutual writing, while peak uncertainty might be behind us in terms of a trade war, the reality of the highest tariff rates in a century remains. The impact on growth and inflation still could unfold. Matt joins us now for more. Matt, welcome to the program, sir. I think last time we spoke, you pointed to stability in the labor market. Will you be able to point to that at 8:31 on Friday?
You know, I think, Jonathan, we still will have, a fairly decent jobs report. We haven't really seen consumer spending really fall off quite yet. I think consumers are likely to respond in terms of pulling back spending as they see prices rise, and we still have yet to kind of see the full impact of tariffs impact pricing on everyday items that consumers are buying. And so kind of with that means that, the economy is still hanging in there in terms of the hard data today. It's just the future that is more concerning as we think 3 months out from now. When a lot of the price hikes start to really kick in. That we think is a little bit more messier as we think about the labor market, just a few months from today.
Matt, over the last 4 years throughout this cycle, we've consistently underestimated the resilience of the consumer. What's the starting point now for the consumer in America?
Well, I think the consumer right now is like a lot of business leaders looking at the forward outlook and having some concern. We're seeing that in confidence numbers that have really fallen off, both for the consumer as well as for businesses. But we've seen that before. The last couple of years have been marked by a real disconnect between soft data that shows some weakness in the economy, but hard data that stays resilient. And the last couple of years, despite a rapid rise in the Fed funds rate, despite high inflation, the economy has hung in there and avoided recession. We think, though, that this is a little bit different. Policy uncertainty is, on a 30-day moving average, has 5x'd from where we were in October. And that does introduce kind of higher risk of a lot of uncertainty spilling over to softness in the actual economy as we think over the next couple of months how this might unfold.
Really what exemplifies what you're talking about, Matt, is yesterday we got this Dallas manufacturing survey, which came out at the weakest level going back to May 2020. At a time when basically a lot of risk assets continued to rally. People shrugged it off and said, we're going to watch the hard data because the soft data has been so noisy. At what point do you listen to what corporate executives are telling you and saying, look, we don't feel good. You just have JetBlue cutting their full-year capital expenditure budget. There is a feeling the corporate executives are also not feeling well. Does that raise concern for you?
We've seen throughout history that, when exogenous shocks like this happen and uncertainty spikes, the first impact, as you mentioned, is in the survey data. We saw that, as you pointed out, with the Dallas Fed, but you also saw that with Richmond Fed as well as the Philadelphia Fed surveys. Typically, there's a 3 or 4 month lag, though, between survey data and the potential for that impacting hard data in terms of actual spending, CapEx, things of that nature that we can measure that flow into GDP, and that we're just in this window right now where we see the softness in the survey data, and it's going to be a couple of months until it actually potentially shows up in the hard data. The problem, though, is we don't know what's going to change from a policy perspective between now and then in terms of trade deals, in terms of de-escalation potential between the United States and China. Those are huge unknowns, and business leaders saying the same thing that we're thinking is we just don't know at this point.
You said that random sell-offs are not random. When you get a sell-off of more than 10%, that typically is driven by either significantly higher interest rates or an increasing jobless rate. You talked about how there's going to be lagging data. Do you think that the interest rate side of things will actually help the cause? That you could see interest rates fall, not rise, offsetting some of that potential pain that could come from a weakening labor market?
I think as you look, you referenced the sell-off. We've had 28 of those since 1960, and as you pointed out, there's a common cause behind a lot of them, and that's sharply higher rates, sharply higher unemployment, or some exogenous shock that causes one of the two to rise. We've seen peak to trough roughly a 20% sell-off, with retracing a lot of those losses in the last couple of weeks. I think what really kind of changes the discussion from correction to bear market is what happens with the labor market. And if you start to see material increase in the unemployment rate, despite the potential for rates to move lower, that's where I think the potential is for corrections to translate into outright bear markets. We'll see what happens. I think as we talked about earlier, the unemployment picture this upcoming Friday is still going to hang in there. So it's likely to be a hard data item that we see unfold and potentially move softer in the coming months.
If you're just tuning in, welcome to the program. Just got a note from Torsten Slok of Apollo. Check this out on the labor market. The survey week for the employment report was the week after Liberation Day tariffs were announced. The consensus expects 130K. There are significant risks the number is going to be lower, Lisa, perhaps even negative.
And so how would this market respond to a negative print? Not well. That's my sense, is probably not well, given exactly what Matt Stuckey is talking about, which is this idea that some sort of real hit to the employment market would be the true cause of a bear market.
Matt Stuckey of Northwestern Mutual. Thank you, Matt. Always good to catch up with you, sir. Anne-Marie, this is the pressure that's rising now for the president, captured in the polls as he heads to Michigan to mark 100 days.
You see it really in the polls. The last weekend we saw from CNN, NBC, Washington Post, some of the lowest ratings the president has received in the economy, when really it's these twin issues that he was elected on, the economy and immigration. When it comes to the economy, continuously in these polls, you see a number of consumers pushing back, American voters, on the tariff policy and the concern on what this could mean for inflation and the cost of everyday goods, something he promised to lower coming into office.
There's a huge difference between firing and not hiring. We're talking about not hiring here, not firing. And let's hope that we're not talking about firing later on this year. But when you see this kind of corporate guidance, Lisa, just to go through it, again, if you're just joining us, we've seen this repeatedly throughout this morning across a range of industries. JetBlue not reaffirming the prior full-year guidance. GM, prior guidance can't be relied upon. UPS not updating the outlook given macro uncertainty.
And you did see a number of these companies pull back plans to buy back their shares. Some of them reaffirmed them or even went for it. The fact, though, that they are concerned about preserving cash at the same time that they're talking about uncertainty gives you a sense of what they're girding for. Then you have the likes of UPS laying off 20,000 workers, and you have other companies looking to trim costs to maintain margins. That is code word for look around. Is that person really necessary? And that is maybe what you will end up seeing.
At the start of the year, there was a lot of excitement. There was this view that the administration would be pro-growth and pro-risk and good for equity markets and good for the broader economy. Might still turn out that way, but there are much more doubts, I would say, at this point than there were just 3-4 months ago. The tax plan is going to be a big feature of this conversation over the next several months. When you speak to the administration, when you spoke to the Treasury Secretary, he repeated again, don't just talk about tariffs, talk about the whole policy platform, and taxes are a big piece of that.
He said right now everyone is just focused on tariff, 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 but then they need to start focusing on tax, 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 deregulation, deregulation, deregulation. President Trump, the evening before his inauguration, said this is going to be the most extraordinary first 100 days in any presidency. I think many people would agree this has been quite extraordinary. The market, though, is desperate, and this administration, I think, as well, is desperate, seeing all the pushback in the polls as well from corporate America to get the tax bill underway. The issue is, right now, all this tax bill is doing is extending current policy Is there enough for the sweeteners that he promised on the campaign trail? Not sure.
5-day run against in the equity market this morning. We stall out just a little bit. We're negative by 0.1%. With an update on stories elsewhere, with your Bloomberg brief, here's Yahara Heckes. Hey, Yahara.
Hi, John. A flurry of earnings have come in, and we start with Pfizer reporting a miss on revenue for Q1, but reaffirming its 2025 guidance, adding it doesn't include impacts related to tariffs. The drug maker also saying it is cutting at least $1.2 billion from its spending after its obesity pill failed. The cuts are part of an effort to save $6 billion by the end of 2027. And you mentioned JetBlue before. It's reporting first quarter earnings that missed Wall Street estimates and saying it's not reaffirming its full year guidance. In a statement, the company saying, we expect softened demand for off-peak travel to continue into the second quarter, where the booking curve is more exposed to macro uncertainty and deteriorating consumer confidence. And Spain's power system is back to normal, according to the grid operator. Spain and Portugal were hit by an unprecedented power outage around noon yesterday, bringing both countries to a standstill. Train passengers were left stranded while millions were left without phone and internet access. The cause is still unknown. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, tax cuts.
We're going to see the president's campaign promises: no tax on tips, no tax on Social Security, no tax on overtime.
It's a lot of tax cuts. Rob Casey of Signum Global Advisors joins us next to discuss. Live from New York, this is Bloomberg.
Brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
This week, lots of earnings, lots of data, and very little clarity on the outlook. Equity futures negative by just 0.04%. JetBlue not reaffirming the previous full-year guidance. GM says prior guidance can't be relied upon. UPS not updating the outlook given macroeconomic uncertainty. And Pfizer, their guidance doesn't include the impact related to future tariffs. These guys are flying blind. On the NASDAQ, we're negative by 0.1%. The NASDAQ in focus later on in the week. Tomorrow, numbers from Meta and Microsoft. And then on Thursday, Apple and Amazon. Under surveillance this morning, tax cuts.
We're going to be having a tax meeting today, but what you can see is that as we go into the tax negotiations or the final stages of the tax bill, we're going to see the president's campaign promises: no tax on tips, no tax on Social Security, no tax on overtime.
Here's the latest this morning. Pressure rising for President Trump's tax cuts on Capitol Hill. A flurry of polls showing increasing discontent with the U.S. economy. Bloomberg's Tyler Kendall joins us live from Detroit. Tyler, we will see an address from the President of the United States later on this evening to mark 100 days of his second term. I want to understand from you whether we will get any clarity whatsoever on this tax bill.
Yeah, hey, John. Well, it's clear that the White House is trying to ramp up the pressure, and very likely President Trump will speak about it tonight. In fact, he actually told Michigan Republicans to stay home, not come to the speech, because he wants them in Washington instead to really get to work on this, as the White House wants to give some sort of relief to consumers amid the tariff fallout. We are getting the administration's requested timeline here. Treasury Secretary Scott Bessent saying that they would like to see the entire reconciliation package done by July 4th. It's something that Senate Majority Leader John Thune called, quote, aspirational, instead saying that the X date really would serve as that hard deadline for lawmakers, the potential date when the U.S. could default on its debt. We are expecting an updated X date number in the next week or two as the Treasury really gets in its finalized tax receipts for April. And I did speak to one senior Senate aide to Republican leadership who told me that they do not expect third chamber to complete work on this until August at the earliest, even as House Speaker Mike Johnson says that his chamber will get done its side of the legislation by Memorial Day. That would be considered to be a very big feat if it is accomplished, because we have to keep in mind, John, this really does have three big pillars in it. It's tax cuts, spending cuts, but then also, of course, lifting the debt ceiling, and all three are considered to be very contentious, and Republicans have very little room for error here because they chose to do this through reconciliation through a fast-track process, but it means they have to agree among themselves because, John, they will not be courting any Democratic votes to get this done.
Tyler, you're in Detroit. How much are the automakers breathing at least a little sigh of relief for some flexibility the administration is showing when it comes to auto tariffs?
Well, Anne-Marie, we did see automakers applaud this expected move from the administration when it comes to somewhat of a reprieve. We should make clear that we are not expecting the administration to change the actual auto tariffs that are in place. Of course, the 25% tariff on fully assembled foreign autos, and then the expected 25% tariff that will go into place for auto parts on Saturday. But it is considered to give these companies more breathing room to reshore production to places like Michigan, where I am today. And I'd also point out President Trump's going to be in Macomb, Michigan, Macomb County. Actually, we saw an auto worker from that area be at the White House in the Rose Garden next to President Trump on so-called Liberation Day. So really no coincidence that President Trump is focused in on this area, of course, one of those big production hubs, as he tries to float some relief to these automakers.
Tyler, thank you. Tyler Kendall of Bloomberg. More from Tyler throughout today on Bloomberg TV and on Bloomberg Radio. Let's extend the conversation. Here's a thought from Rob Casey of Signum Global Advisors, writing, expect continued turbulence as congressional Republicans move towards a final reconciliation package. Speaker Johnson's Memorial Day target is nearly impossible to meet at this stage, and we think even a July target is optimistic. Rob joins us now for more. Rob, good morning.
Morning.
What's the biggest point of tension that holds that up?
Well, I think the biggest point of tension is the fact that there are a million points of tension between Senate Republicans and House Republicans on the level of cuts, between Senate Republicans and House Republicans on the level of where the debt ceiling will land, and frankly, probably most of all, between Trump and House Republicans on just how many of these new tax policies will be included in the final bill.
What do you think actually gets over the finish line for the new policies?
Well, I mean, if we're thinking about no tax on tips, no tax on overtime, no tax on Social Security, in that order, least expensive to most expensive. So I think no tax on tips between 100 and 200 billion over the next decade, that probably fits in. But if we're talking about, at the far end, no tax on Social Security, $1.5 trillion over 10 years, I know President Trump continues to say, and we just heard from Scott Bessent, that all of it will be included. I think it's really hard to square that circle.
So that's what they want to add. What are they taking away? What's happening with SALT? What's happening with things like IRA provisions that some Republicans really want to keep because it's impacting their districts? Who wins out in this fight?
So on SALT, I think that there has to be some sort of relief for New York Republicans and California Republicans. We've heard that from them time and time again. They've said that even doubling the cap to 20,000 per person is not enough. I think we probably land somewhere around there, right? 20, 25, 30. On the IRA, like with a number of other sort of stimulative packages, the issue for Trump and Republicans is that we are now, hurtling towards recession, right? The economy needs a little bit of stimulus. And so I think that we're actually going to see less of the IRA pulled out, less of potentially chips pulled out than President Trump had signaled previously otherwise. But, I mean, there just aren't that many places to cut.
It's very challenging right now where they can cut. You made a point in your notes that Trump holds sway over his caucus. Given what we're seeing in polling, do you think that he's starting to dent that sway?
Well, I think he probably is starting to dent that sway internally, right? But the issue for congressional Republicans is that if they are going, if they're going to push back against Trump externally, publicly, then they are going to get primaried, especially if they do it this early. So I think for the time being, no. Congressional Republicans are in lockstep with Trump. I would say with the exception of New York and California Republicans who need SALT relief. I mean, it's a mortal challenge for them electorally. So, we talk about the House Freedom Caucus all the time. They're always the ones who like to jump ship and make the most noise when it comes to passing legislation. I actually think that in this case, it's Maliotakis, it's Lawler, it's maybe Stefanik. It's the New York and California Republicans who are generally in lockstep with Trump and relatively quiet, who may make the most noise this time around.
They're trying to change the narrative back to taxes and possibly even deregulation at the same time. The market's still very focused on trade. And you have a pretty bold prediction, which is that you expect the U.S. and China to really walk back a lot of the tension and see a much lower tariff rate. So did you get President Trump on the couch and kind of seek into his mind? What gives you that kind of conviction?
I wish. I mean, I would love a one-on-one with President Trump. I'm sure you all would as well. Well, no, I think there are sort of two levers that Trump can pull, right? There are the retaliatory tariffs on everybody, ex-China, that are set to come back into effect on July 8th, barring, bilateral agreements. And then there's the China level, and we keep hearing this back and forth between who's going to call who, right? It's like, high school dating. Is it going to be Trump or is it going to be she who calls first? And honestly, I would see through a lot of that noise because I think Trump is able to essentially walk back tariffs unilaterally, right? We saw it after Liberation Day. I think we could see it again where all he needs to say is, publish the truth that says we are on our way to negotiations, which will then be on their way to a deal. We believe China's going to come to the table. And in the meantime, we've caused a lot of harm to China's economy. So 145 is going to look like, 30 to 50 to 70 for the next however long. I think that's pretty easy for him to do.
There is this larger question, and I guess it's sort of implied here, which is how much is this administration paying attention to what markets and to what companies are saying and doing? I just asked Julian Emanuel the last time you saw this many companies pull guidance from the forward-looking guidance, and he said it's very rare, and probably the last time is the financial crisis. How much does that resonate in the White House?
Honestly, I think over the course of the past month, we're seeing that maybe it's resonating a little bit less than we might have expected, right? There was all of this discussion around what is the Trump put, where is the Trump put in the equity market? Frankly, I don't think it was found in the equity market, it was found in the bond market, and I'm just not sure they're focused company by company forward-looking guidance. I mean, it would be great, I think, if President Trump watched this show, as we all do every morning. I don't think he's watching this. I think he's watching Fox more than anything else.
I can confirm he tunes in sometimes, for what it's worth, Rob. But I can confirm also, based on reporting, that the wake-up call came from the retailers just last week. A week ago, the risk of empty shelves, and there is still a risk of empty shelves in the coming weeks.
There is this theory that there's going to be a moment like the egg crisis, where suddenly there's going to be one item that suddenly is triple the price, or their shelves are clear, or people are going to be lined up trying to get into national parks, Yellowstone or Grand Canyon or something, and running out of food from some of the grocery stores, that there's going to be some PR mishap that will really be the ultimate check. Either way, there is a clear tipping point. It just is unclear what exactly that is.
The warnings from corporate America and then unemployment. And let's hope the warnings from corporate America are enough before we get to unemployment.
That's right. Because for Trump, that's really, I think, what you would call the ultimate Trump put. It's the political pushback, what's coming from Americans. And you have to think, he does not want to see empty shelves before back to school. That is going to be incredibly challenging for this administration.
Rob Casey of Signum Global Advisors. Rob, thank you, sir. Appreciate it. A few months ago, the Liberal Party, led by, at the time, Justin Trudeau, 20 points behind the Conservatives, led by Pierre Poilievre. 2 months later, 3 months later, a big win for Mark Carney of the Liberal Party, and Pierre Poilievre loses his seat. What a massive change.
Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The scores look like this on the S&P 500. In 2025, down 6%, down 10% from all-time highs for April, down just 1.5% this month, and down just 2.5% since April 2nd. If you ask people to guess without looking, I'm not sure they're the numbers people would come up with. They would feel like this market was down a whole lot more than that. Equity futures stable this morning following 5 days of gains, 2 hours away from the cash open. With your morning movers is Danny Berger. Hey, Danny.
Hey, John. The cruise line operators have been so fascinating to listen to because they've defied any of the consumer gloom, and that continues. We just heard earnings from Royal Caribbean, a record quarter for them. They also said April bookings so far are ahead of expectations, and there's no reason to believe why 2025 wouldn't remain on track, defying the other gloom we've heard from companies. Those shares up 4%. Their guidance also surprising to the upside. Now, on the complete opposite end of the spectrum, we have GM. Those shares down over 2% this morning, scrapping their guidance for the year. At the same time, scrapping their $4 billion buyback, saying that they would update the market when they have more clarity. And just in a sign of how unsure things are, they were supposed to hold their earnings analyst call today. They're not even doing that. They're waiting and postponing until Thursday before they speak with the analyst community. The final bit of earnings to round things out with, we also heard from PayPal this morning. Shares down 2%. At first, their results look strong, beat expectations. Shares rose. The CEO said their turnaround remains on track. However, they did not update their guidance. Also said that macro uncertainty is going to play a part, and thus you get the fall in shares about 2%, John.
Danny, thank you. Thank you very much. More from Danny later this morning. Let's turn back to GM. On our radar this morning, General Motors, the latest company to pull earnings guidance. The automaker also putting $4 billion in share buybacks on hold, citing, guess what, tariff uncertainty. Danny's point on the call, I think, is an interesting one. They'll have their own reasons for this, but I think it works perfectly, and I'll tell you why. The call is going to take place after the address from the President of the United States, the address which might reveal some exemptions, some weakening of the tariffs around the autos, and I think that will provide the clarity they need to be able to talk to investors and analysts alike.
Right now, they are in PR mode with respect to President Trump. Mary Barra came out after those exemptions and said, we welcome this. We think that it's wonderful what the president is doing and are looking for something to bring manufacturing back to the United States. How much can they get further exemptions aside from just not paying aluminum and steel tariffs on top of everything else still remains to be a question.
That's why they can't guide. This is incredibly challenging. The situation remains very fluid in Washington, D.C. They were expecting to pay these auto part tariffs starting this weekend, and guess what? It sounds like the administration is going to say, we're going to evaporate those, especially if you're paying an aluminum tariff. We don't want you to be double taxed. The auto industry, though, has had a massive lobbying effort on this administration. I wonder, actually, if we see even more relief.
It's not just GM. We're seeing this across so many different industries this morning. Lisa, we've been through it so many times already. GM, UPS, Pfizer, JetBlue, the list goes on and on.
And it's really important to emphasize, and I want to go back to this, it is very rare for companies to withdraw guidance. This is not a usual occurrence. Even in 2020, it was too quickly moving, the COVID shock, to really engender this type of response from earnings. This is something that we probably haven't seen going back to the financial crisis. And it really raises questions about how to extrapolate out information and earnings in the market.
More earnings coming through this week, of course. Tech earnings very much in focus over Wednesday and Thursday. Tomorrow, Meta and Microsoft. Thursday, Apple and Amazon. Just a quick update on a story we mentioned briefly just then. President Trump is planning to offer some tariff relief for automakers. White House officials saying some levies would be lifted on foreign car parts, and imported autos would see a reprieve from separate steel and aluminum tariffs. Elsewhere, the Treasury Secretary, Scott Bessent, setting a goal of July 4th to pass the president's multi-trillion-dollar tax package. Trump putting increasing pressure on the GOP as the polling doesn't make for good reading over the past week.
No, they're desperate to move on from tariffs, talk about something else, tax cuts for Americans. That would poll definitely well, and certainly the market would welcome that. The issue is the Treasury Secretary is talking about July 4th, Independence Day in the United States, to get this bill done. And then right after that, Majority Thune comes out and says, ooh, that's aspirational, because they know within Congress that this is going to be incredibly challenging to get over the finish line. You have so many issues at play here. It's going to take a long time.
Policies in Washington totally reshaping elections taking place around the world, including Canada. Canada's Liberal Party projected to narrowly win a fourth consecutive election. Bloomberg's David Gurra joins us now from Ottawa for more. David, we were talking about it yesterday. This is not the result people were anticipating only a few months ago.
Yeah, so this was a late night that bled into an early morning as we watched the ups and downs of the vote tally and, of course, the resultant reaction in the Forex market, as well as folks reckoned with the fact that Mark Carney is going to have a mandate here as Prime Minister, a fourth term for the Liberals, but it's still unclear how big that mandate is going to be. 4 seats shy of having a majority, which would give him a lot of power to advance his legislative agenda going forward here. And you rightly bring up the fact that just a few months ago, this outcome would have been all but inconceivable. Justin Trudeau, in the tail end of his term as Prime Minister, the Liberals not doing well among the electorate broadly, a lot of dissatisfaction about the economy, but a couple of things changed it, and they're not unrelated here. The first, that Mark Carney won that Liberal leadership election, and people had a lot of faith in somebody who is a technocrat by career, somebody who ran 2 central banks and said that he was quite proudly not a politician and recognized the gravity of this moment. The moment is the second thing that I want to emphasize here, and that is Donald Trump's return to the White House and the messaging that we heard from him about the long-standing economic and trading relationship with the United States and Canada, and the security relationship as well. On top of that, the attacks that he made on this country's sovereignty. That was very resonant with the electorate in this country broadly. It was something that the Liberals capitalized on as they campaigned, and the Conservative Party as well. And so what voters were thinking about yesterday as they went to the polls across this country is, who did they want to represent them at a meeting in the White House between the Prime Minister and President Trump when that takes place? And Mark Carney said when he became Prime Minister just a few weeks ago, that conversation wasn't going to begin in earnest until the election that we had yesterday was finished. So in his remarks just a few hours ago, he again emphasized the fact that he's going to bring a strong message to the President of the United States, talk about that trade relationship, what's on the table and what's not. And that issue of sovereignty that I mentioned, it is not going to be on the table. He is emphatic that he doesn't think that President Trump has been joking about Canada becoming the 51st state, and this is a non-negotiable item for him. Canada will not negotiate on any terms of that going forward, John.
David, when it comes to the Conservative Party, they were ahead 20 points just a few months ago, and the leader of that party actually lost his seat. What is the future for Pierre Poilievre?
This is an extraordinary development. It became clear as the night wore on. He is proudly from the western part of this country, but his riding, his district is about 30 or 45 minutes from here in Ontario. He lost to the Liberal candidate. Now, that throws a lot into uncertainty. He could continue as the leader of that party, and he enjoys a lot of popularity in that party broadly. He's managed to unite it. Can't, of course, be the opposition leader in Parliament not having a seat. So, if you look at paths forward here, looking at history as a guide, the Conservative Party has ousted those who haven't held their seats in leadership. If he hangs on to it, there could be sort of a by-election in the months ahead. He could convince a Conservative member of Parliament to step aside and take that seat. But what I'll stress here, Anne-Marie, is that would take time. It would take time to call that election and have that election. And what we've learned over the last few months, over the first 100 days of Donald Trump's second term, is there's a great urgency to this moment. And any time waiting for something like that to happen is going to be a handicap, yes, to Pierre Poilievre, but to this party as well. And so we'll have to see what happens here in the coming days and weeks.
David, thank you for the update. David Gurra there of Bloomberg. North of the border, south of the border, policy in Washington has completely upended this election in ways that we didn't foresee only a few months ago. Threats and/or jokes to sovereignty, additional tariffs have completely shaken things up. And we've been saying over the past few months, I don't really understand it. Why the president had such little interest in the outcome of this election. Wouldn't it have made sense to have a North American powerhouse, a more pragmatic, conservative approach to energy? Wouldn't that have worked for both sides, both for Canada and the US under President Trump?
It seems that President Trump declared victory when it came to Canada when he ousted three-term Trudeau, who obviously there's a tremendous amount of friction between those two and that relationship. And it's almost like because he went too far in this maximalist aggressive approach, he made the Liberal Party great again. And Mark Carney swooped in, coming from out of nowhere basically, swooped in and won this, even though the Conservatives were 20 points ahead when Trump was inaugurated in January.
Unbelievable turnaround, a big shake-up to Canadian politics off the back of policies in Washington. Let's turn to a busy week of data ahead and a busy week for Washington as well. The Fed's next rate decision just a week away. Colin Martin of Charles Schwab writing, while soft data has been concerning, the hard data has held up well. If this week's data disappoints, the Fed won't necessarily react. Colin joins us now for more. Colin, good morning.
Good morning.
Torsten Slok, Apollo. Don't know if you saw this. I'm going to share it with you now. The survey week for employment this week was the week after Liberation Day tariffs were announced. He goes on to say the consensus expects 130K. There is significant risk the number is going to be lower, perhaps even negative. What's your reaction to that?
It'd be pretty disappointing. I mean, when we look at the labor market outlook, there's all these thoughts and concerns about what can happen as the tariffs are put in place over the next few months. And there isn't too much concern in the here and now, opposite, aside from what Slok just put out. I mean, I think the consensus estimate is 165,000, something like that. If we were to see a slowdown here in April, I don't think that would change the Fed's calculus for next week. We kind of heard that from a lot of Fed officials in terms of no move in May, maybe it gets pulled up to June. I think it'd be bad for the markets, though. If we got that negative reading this early, this quickly, I think that'd be a pretty bad outcome.
When you say the markets, you're talking risk assets in particular. And what we have seen so far is a real divergence between the front end of the yield curve, which has really signaled a great more pain than certainly risk assets, whether it's credit instruments or whether it's equity ones. Do you think that divergence needs to close to more weakness on the risk side of things? Or do you think that people are pricing in an overly large response by the Federal Reserve?
I don't think they are. If you look at the 10-year Treasury, for example, I mean, that's been hovering in that 4.2 to 4.5 range. I think a lot of that comes down to potential confidence, dollar concerns, things like that. If you look at the Fed funds futures market, they have been pricing in relatively aggressive cuts. We somewhat disagree with that. We don't think we're going to see that slow down as quickly as a 3 or 4 rate cut outcome suggests. But it does come down to the labor market. If we see that weakening, we think the Fed over time will react. We're seeing Powell kind of pivotal away a little bit. I think a week and a half ago, he mentioned maybe we'll focus on the inflation mandate more than the labor market mandate. That seems to be the minority right now based on concerns and comments we've heard from other Fed officials.
This is a fascinating moment where Lotfi Karui of Goldman Sachs yesterday came on the show and said that he actually prefers credit risk to sovereign risk right now. And it's talking about removing from some of the volatility that you're seeing in Treasury markets to really go with corporations that are telling you we have no clue, that are one after another saying we can't give you any forward guidance. Can you reconcile that? Do you agree with that?
Somewhat, but I guess it depends how much credit risk we're talking about. We're still a little bit cautious on, the very low-rated parts of the market. I mean, junk in general, we're worried that spreads can blow out if we get this prolonged trade war. Investment grade, we're still pretty comfortable taking that risk. So whether it's credit on the corporate side, whether it's municipal credit risk, we're okay there because the hard data leading up to now was generally okay. Corporations are in pretty solid footing, especially IG rated. We're looking at really strong balance sheets, plenty of liquid assets. If profits slow down, I think that might be more of a stock market issue. That's an earnings issue, not a balance sheet issue. And we think they have really strong balance sheets right now. Again, IG issuers, they've pushed back that maturity wall a little bit. So IG we're okay with, but we're not really taking low credit risk right now.
This is a really tough time to be an investor, I have to say. I can just begin to imagine. There's so many different themes that are kind of overlaid. You've got this question of credit versus sovereign risk, and then you've got a question of just international appetite for US dollar-denominated assets. And that has been one of the biggest shifts over the past few weeks, is that that's really been called into question. How much have you changed your allocation to shift away from US dollar-denominated assets, just to touch on the margins, to immunize yourself from that type of narrative that does seem to be becoming entrenched in certain pockets?
I could say we're talking about it a lot more with our clients than we were a few months ago and over the past few years. When we look at international markets at Schwab, it's not really a big aspect of what we look at. I think most U.S. investors from a bond standpoint are probably underallocated to international debt. With the dollar being as strong as it's been over the past few years, there hasn't been as much of a case because you have that yield disadvantage when you consider other global developed markets. If the outlook is for the dollar to weaken a little bit from here, then the case can be made to shift a little bit to international assets. We're not saying go nuts, we're not saying go overweight, but it probably makes sense, especially when you talk about the idea of a loss of confidence or sovereign risk. You don't hear about those concerns with some of the higher rated issuers in, say, Europe, for example. So I think it's a decent option, but really just for investors who are probably underallocated right now versus, hey, take all your money out of the U.S. and go into Europe, for example.
You said you're talking to your clients about this. Are they nervous about U.S. losing something like reserve status?
Yes. Full stop. I mean, that's over the past few weeks we've done.
Have you ever heard this before?
We get it a lot. It's a question that it always lingers, especially when you have the idea of rising debts, rising deficits. There's no shortage of concerns about the outlook for the dollar and how investors should be positioned. But over the past few weeks, especially since so-called Liberation Day, the client events and requests for communications have been, through the roof. No surprise. And that's a major concern. The question is, what's going on with Treasury, with foreigners potentially selling our debt? What's the outlook for the dollar? We try not to be too alarmist about it. We don't think the dollar is going to lose its reserve currency status overnight. I think there could be a risk over the long run. If the goal here by the Trump administration is to reduce those trade deficits, then maybe that means we have less of a capital account surplus, and it means foreigners over time don't need to hold as many dollars. It's a very long-term view, though. So we're trying not to be alarmist. Obviously, there's concerns out there, but we're not saying you need to get out of the dollar or dollar-denominated assets right now.
It's not something that happens overnight. It's something that happens gradually. And we have started to see this take place. The dollar's started to weaken. Gold started to appreciate. That's been a story for the last couple of years now. And some other people would also point to the steeper curves we've seen as well. Less of a willingness to hold the long bond, particularly in moments of stress in equity markets. You're not even seeing subtle signs of this starting to accumulate.
What do you mean by starting to accumulate? With foreign investors and nervousness about long-term debt?
Nervousness about holding U.S. assets, particularly at times of stress.
I don't know if it's so much a nervousness. I think it's just a gradual shift away. Hey, there's a lot going on right now, and if you're a foreign investor, and it seems like it might be private investors as opposed to central banks, obviously these are negative headlines if you're a foreigner. Just the idea of maybe I don't want to hold that asset right now. But John, you hit the nail on the head. It's a long-term potential shift. This takes years for something like this to happen, and it's not our outlook right now, mainly because where else can you go? I mean, the dollar is still the most held asset, the most traded asset, so it's not something that we're worried about right now.
And if you've been away for a while and came back and saw DXY at 99, you probably wouldn't freak out, that's for sure. Good to see you, Colin. Appreciate it, as always. Colin Martin there of Charles Schwab on the latest. The latest in the equity market, equity futures at the moment, just about unchanged. Nothing unchanged about some of the corporate earnings and guidance we've had so far this morning. More on that in just a moment. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahira Hackett. Say, Yahira.
Hi, John. Coca-Cola shares are up 1.2% in the pre-market after the beverage giant beat Wall Street expectations on first quarter profit. The figures show that price-conscious consumers continue to purchase the company's drinks despite worsening sentiment. Plus, in the earnings statement, Coca-Cola said it expects tariff impacts to be manageable. Meanwhile, UPS is planning to cut 20,000 jobs this year as it dramatically reduces shipments for its largest customer, Amazon. The company said it will close 73 leased and owned buildings by the end of June and may identify more facilities for closure. The announcement coming as UPS reported solid first quarter results, but pulled its 2025 guidance. And OpenAI now lets users shop for products within ChatGPT. Users can compare products and click a link within the platform to make a purchase on an external website. OpenAI said the company won't collect affiliate revenue for purchases made via its chatbot. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in the next hour. An update from HSBC. New price target on the S&P 500. Just dropping 5,600. Down from 6,700. That's a catch down from HSBC. Up next on the program, earnings from Big Tech.
Technology is the sector which is most vulnerable to the various tensions. We'd be a little bit skeptical at this point that there isn't further downside to go for these tech firms. They do sit in the eye of the storm with regards to tariffs.
The calendar absolutely stacked over the next 2 days for mega cap tech. We'll get a view from Mandeep Singh of Bloomberg Intelligence in just a moment. That's next. This is Bloomberg.
You missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power live every weekday.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
5-day winning streak on the S&P 500, the longest daily winning run going back to November. This morning we stalled just a touch. We're negative by not even 0.1% on the S&P, down by 0.13 on the Nasdaq 100. The Nasdaq in focus under surveillance this morning. Earnings from big tech.
Technology is the sector which is most vulnerable to the various tensions. Now, we are hearing from investors that they're looking to maybe dip their toe in the tech trade again, given the very big re-rating that we've already seen. But I guess that we'd be a little bit skeptical at this point that there isn't further downside to go for these tech firms. They do sit in the eye of the storm with regards to tariffs.
So here's the latest. Meta, Microsoft, Amazon and Apple delivering high-stakes earnings this week in a volatile trade environment. Bloomberg's Mandeep Singh joins us now for more. Mandeep, good morning.
Morning.
We've had Alphabet already. What did we learn from them about what's to come this week?
That companies with low China revenue exposure and low exposure on the cost side, the cost structure, will end up doing well. That's why they had a nice beat on the earnings despite the competitive pressure from ChatGPT. And look, they called out the de minimis rule, companies shipping their products directly from China. The end of that will have an impact on their ad revenue, but it's still manageable. So to me, Meta will be similar. Microsoft will have minimal impact. The big ones are the ones that have high revenue exposure, Apple, and the cost side is also exposed to China. Tesla, we already heard from them, but NVIDIA as well, they can't sell their H20s anymore. So that's where, the numbers are not easy anymore to beat, and you won't see any upward revisions. The catalysts are just missing.
That kind of being able to withstand any type of tariff volatility is also paired with a reaffirmation, at least from Alphabet, in their capital expenditures. How much do you expect that to be the story? That the loss of AI spend and maybe the over-exuberance, maybe it wasn't that over-exuberant, maybe we just lost a little bit too much faith in the story.
I mean, I go back to, 2022 when the end of the low interest rates came. These companies were very aggressive with regards to cutting their OPEX, the headcount reductions they had. So if they saw, things are really slowing down, they would rationalize the CapEx. It's bound to happen. The question is, Apple obviously is the one that's most exposed. They're not one of the biggest spenders on CapEx. Google is, and they reaffirmed their CapEx numbers for the whole year. I think Microsoft is going to do the same. So from that perspective, the big hyperscalers are still going with that CapEx. Clearly, if Apple says they have already announced $500 billion in investment here, if they're going big on CapEx this year within the US, that's going to be another huge tailwind for AI infrastructure. So it's not very clear if these companies are looking to pare back their CapEx, but we know back in 2022, they did rationalize the OPEX. So that's the framework. If they see a longer downturn, they will pare back on CapEx.
The Treasury Secretary said to me that the NASDAQ earlier this year, when it took a nosedive, had a Mag 7 problem, not a MAGA problem. But everything you're talking about is companies having to de-risk because of policy. How much are tech companies looking to Washington because of policies that they actually do have a MAGA problem?
I mean, look, these companies have over 50% of their revenues coming from international locations. So, the reason why they're so big is because, they have such big international exposure. And tariffs plays directly into that. I mean, whatever we kind of witnessed with the reciprocal tariffs and then the changing stuff, all that has an impact with regards to what happens to their international revenue. So in the end, these companies are pretty much exposed to the international revenue exposure.
Just quickly, how's Gemini doing?
Well, I like the Gemini Live, and the reason I say that is I can't use it on my iPhone yet, but if you have, an Android phone, the Live feature, you can pretty much interact with it like, a virtual assistant, and it's amazing, It doesn't waste any time in terms of answering a question.
Do you know what I've been doing with ChatGPT? Monitoring blood test results, then capturing a menu and asking it what I should eat. Just like that. It's amazing. It's fantastic. And sometimes when I'm sitting down for a meal, I can't choose. I'm really tired. And it's choosing for me. And it's choosing the right thing. Okay. It's brilliant.
All I can say is that reveals so much about you, John.
You should try it.
On so many levels.
You should try it.
Outsourcing your nutrition.
I bet you a lot of people at home, next time you go to a restaurant, snap a photo of the menu and ask you to choose and give it some requirements and see what happens. Mandeep, it's good to see you. Mandeep Singh of Bloomberg Intelligence. If you have health requirements, dietary stuff, don't blame me for that. Speak to your doctor, all right? From New York City this morning, good morning.
We're micro-investors. So as micro-investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. When we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. Now, in our existing companies, in our existing portfolio, the vast majority are services companies. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich, it's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself. but in our portfolio companies. We roll up this data every month. For example, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is
telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah. We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episodes this spring, only on Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
The market is just hoping that we've got the worst of the tariff story behind us.
The longer this goes on, the more uncertainty pervades, the less likely, the upside becomes a reality.
There's no longer uncertainty. It's not what we don't know, but unpredictability of how things behave or things react.
I just caution people, things may have to go down a little bit more before they go up.
Things can get a little bit sloppy over the next couple of quarters.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The opening bound 90 minutes away. Equity futures on the S&P 500 barely negative, down by not even 0.1% following 5 days of gains on the S&P 500. A 5-day winning run for stocks, a 5-day winning run for bonds. Yields lower over the previous 5 days. Yields now on a 10-year, 4.2274. And a man who will be happy with that is a man who will speak in about 30 minutes' time. The Treasury Secretary, Scott Bessent, in a press briefing from the White House at 8:30 Eastern Time, just before we get some data a little bit later.
Yeah, we're going to get some data later with respect to jobs and the job openings and people's confidence that they can quit their jobs. A question about whether they really welcome the 5-day rally in treasuries, given that it has been this sort of knee-jerk move in accompaniment with the stock market. Do you want to see a reversion back to that traditional inverted response between stocks and bonds? In other words, make sure it's not a dollar call before really breathing life into this idea that we're actually seeing some sort of sustainable rally.
Away from the equity market, I think pressure still building. Away from the bond market, I think pressure still building. It's coming from the lack of corporate guidance, the threat of cost cuts, the potential for higher unemployment, and empty shelves.
That's right, and potentially the Treasury Secretary is going to try to offer some guidance, or the reporters will be asking him for some guidance. I think he's going to strike an optimistic tone when it comes to trade deals potentially being done in this window of a 90-day reprieve with trading partners, barring China. That's the big question mark. And what did the Treasury Secretary say over the weekend? He wasn't sure if President Trump spoke to Xi Jinping. The status of those negotiations, that is what the market wants in terms of clarity.
This is what the market wants to hear throughout today. Deals exemptions and tax cuts. They want to hear that repeatedly by the president later on this evening in Michigan. They want to hear it from the Treasury Secretary in 28 minutes.
Yeah, take some of the pain outside of the out of the tariffs and then move towards some of the more constructive pro-growth policies. If he can't do that, there is a real question about how much momentum is going to shift away from him, both with polls, but also with respect to economic momentum. Right now, it seems like there is some sort of Trump put. It just really is unclear exactly where that is.
Stocks right now negative by about 0.1% on the S&P. Coming up this hour, we'll catch up with Savita Subramaniam of Bank of America with stocks on their longest winning streak since November. Daniel Rusker of Bernstein on the latest earnings from GM, and Kathy Boschantic of Nationwide Mutual. Looking ahead to this week's payrolls report, we begin this hour with stocks attempting to build on a 5-day winning streak. Savita Subramaniam of Bank of America writing, "The only thing to fear is fear itself. Folks are worried about a recession, so they are acting recessionary. Speed in achieving policy clarity is of the essence." Savita joins us now for more. Savita, good morning. It's good to see you.
Good morning. Great to see you.
A lot of cuts to outlooks. We're seeing suspensions of guidance repeatedly across the board from corporate America this morning. What does that mean for you and the team?
Yeah, well, I mean, it's not great. it's definitely not good. We're seeing the revision ratio, just a number of cuts to number of raises to earnings, approaching all-time lows. Guidance is being suspended. That's a hit. I mean, we saw the same thing during COVID, probably more so during COVID because there was a much higher level of uncertainty. And what we found was the companies that continued to guide actually traded at the widest premium to the non-guiders or the suspenders that we've seen. So I think right now people want transparency, investors want to know. So that's one thing we're watching. I think what's interesting is that in the last week we've heard more companies talk about mitigation tactics for tariffs than we did in prior weeks. So I think that what we're in right now is the environment where corporates are doing what they always do, which is adapt, figure out where they can, kind of change things around the edges. And on top of that, we're seeing kind of a deferral of big decisions. So it almost feels like we're in this phase where there's no hiring, but no firing. There's, no new capital committed to projects, but projects aren't necessarily being canceled. And I think that's both good and bad. I mean, this pause, the longer it lasts, the worse it gets for the economy. But at least we're not seeing just this sort of reactive firing, canceling, kind of a downdraft in activity.
This is important for the data that comes on Friday. Payrolls.
Exactly.
When you say adapt then, if they're not firing, how are they adapting? What are they doing?
So what they're doing is they're sort of shifting supply chain. They're thinking about more manufacturing in the U.S. I think that the idea that we've seen this movie before back in 2018, especially with respect to China, gives companies a little bit more confidence that they know how to negotiate this. So I think that's a positive. What's interesting, though, is that you're hearing more weakness around consumer and even in consumer staples. So if you think you can hide in the food stocks and the defense, not necessarily working this time, and I think that's also noteworthy. I will tell you, I mean, everything we're looking at really points us in one direction, which is large cap value. And I feel like it's almost this kind of unassailable theme in an environment where the risks are, potentially higher yields, and we can talk about that. Potentially higher inflation, because what we're seeing right now on the table from a policy standpoint is mostly inflationary. And in that environment, you really don't want to be in bonds, you want to be in dividends. Russell 1000 value companies have a much higher tether to non-discretionary spend, either services or goods. Think about it. I mean, if we're in an environment where we're, cutting back, we're still going to pay insurance, we're still going to pay utilities, heating, et cetera. So I think those types of areas of the market should hold up quite well. And the value index, the large cap value index, has kind of consistently outperformed the growth index this year. So I think that's where you really want to be to sort of cover yourself, as opposed to just going pure defensive, kind of the old school defense playbook.
Yeah, to your point, some of the consumer staples, Kraft Heinz came out and cited worsening consumer sentiment and cut their forecast. Evidently, Oscar Mayer sausages, as well as your Heinz ketchup, but not necessarily moving off the shelves as quickly as in the past. You said you wanted to talk about
hot dogs.
Yeah, well, I mean, maybe that's something else. Maybe that's John's hack in terms of healthcare.
ChatGPT,
exactly. Maybe if you check your blood and then you check that Oscar. Anyway, let's move on. You talk about yields. Let's go there. You have a very non-consensus call on what U.S. equity markets are implying about where Treasury yields could go. 7%, really?
7%. So this is the analysis. We said, okay, equities and the corporate sector is actually quite unlevered and unusually healthy when it comes to leverage, because all that leverage sits on government balance sheets. So if you look at the leverage ratio between corporates and the government, complete opposites. And if you apply the math, so what we found is that investors will pay a higher multiple if leverage risk is lower. If you apply that math to where bond yields are, where the US government is, it spits out yields of around 7%. It's a much higher level of return that investors need to see in an environment where leverage is so high.
This is following the logic that the math is the same for U.S. sovereign risk.
I mean, it's
as
back
in
of the
corporations.
envelope.
Well, it's back of the envelope, but this raises this real question, which is if there is a credit risk component to U.S. sovereign debt, how much does that impede the equity story in the United States, given that a lot of guests who come on this show say, once 10-year Treasury yields hit 5%, forget about it. You're going to see some losses in equities.
Yeah, I don't necessarily think so. I mean, let's say we're kind of becoming more like an emerging market. Sometimes emerging market equities do really well, especially when they're unlevered and there's potential for growth. And I think that's where we are today. So if you look past tariffs and you think about what the administration is trying to do, we're trying to get America manufacturing again. We're already seeing the seeds sown for that story over the last 4 to 8 years. So I think that the idea that stocks have to implode if yields hit 5% is completely false. In fact, we've looked at this a lot of different ways. I mean, think about it. Yields right now are not unusually high. 7% sounds really high, but it's, we've been there. We've been higher in the past, and stocks have done okay, especially dividend yielding stocks. So I think this is an environment where we have to kind of recalibrate to what's actually going on. The U.S. government debt levels are at, off the grid. We've never seen this before. We're seeing a closed economy. We're seeing signs of a closed economy. We're seeing signs of inflation. We want to see growth in the U.S. That's what the policymakers are trying to get. And all of that is likely to push up bond yields on the long end.
But right, the administration, though, is targeting lower yields. If it hits 7%, does that mean they failed?
I don't know if it's failing. I mean, I think it's just sort of, we're all anchoring to super low rates over the last 20, 30 years, and they've been falling the entire time. But think about where we are now. I mean, rate cycles last for decades. We were in a multi-decade period where interest rates were falling. So I just think we should sort of gear ourselves for the idea that interest rates rising even from here is not necessarily anathema for stocks. From a policy perspective, I mean, nobody's calling me about, if rates move higher, have we failed? But I think that the idea is if rates move higher, but growth is accompanying that rate move, that's not a failure. It's actually kind of a more normal boom time economy. And I just think we're so not used to that because we haven't seen that in such a long time.
Why they're high, though, is important. Is it going to be the boom time economy that takes rates higher, or is it going to be something else?
I think it's a whole bunch of things. The good case is positive growth. The bad case is sovereign risk. It's also a lack of demand for U.S. treasuries because the buyers, foreign buyers have left the building. The Fed used to buy treasuries. I mean, one could argue that if we get to 5% on rates, the Fed will step back in and start buying. But I think even there, we've got an environment where, again, going back over time, we're just all looking at the last 10 to 20 years, and we're thinking that 5% seems unsustainable. Companies aren't geared for it. Companies are actually very geared for a higher rate environment. They've paid down debt. They've locked in very low fixed rate obligations. Consumer balance sheets are pristine. I mean, for the most part, you're seeing some fraying around the edges, but when you think about what just happened, the government gave the private sector a whole bunch of money.
True.
Right? So what do you want to buy, the government or the private sector?
But when I hear you, Savita, I hear you talking about the potential for earnings. I don't hear you talking about the potential for what people will pay for those earnings. And when you talk about higher sovereign risk, when I start to think about that, when I start to think about what could happen to the sovereign, that makes me think that people won't be willing to pay for earnings in the same way they were, particularly foreign investors who have built up an incredible long on dollar assets over the last decade. What kind of multiple are you putting on that very optimistic outlook?
It's tricky because I think the S&P today is a very different animal than it's been historically. So saying a 15 multiple, which is the long-term average, you just slap that on and that's what you get. I don't think that's fair. I think that's overly punitive because when you look at the market today, it's, you know, higher margin industries with a lot of potential to become even higher when you think about old economy sectors that can use a lot of this automation and tools and, you know, little AI sprinkled in to get more asset light and, you know, kind of improve margins and improve earnings variability. So I think a multiple of 20 seems completely reasonable. In fact, we ran this analysis where we looked at the S&P 500 versus other global benchmarks. Granted, the S&P is trading in the stratosphere, everything else is super cheap. Now, if you adjust for sector mix, if you adjust for earnings volatility, leverage, consumer aspects, you actually come to a conclusion that the S&P isn't that expensive relative to these other benchmarks. So I think by just sort of painting this historical average, everything has to trade at the same level, I think we're sort of oversimplifying really important details about U.S. corporates.
A big dose of optimism this morning from Savita Subramaniam of Bank of America. Savita, thank you.
Thank you.
A lot to think about.
Yeah, optimism for who? Maybe for the equity investors, not for Scott Bessent. The idea of 7% yields would be a real problem for the federal deficit as well as expenditures, given that a fifth of all Treasury outstandings are in T-bills. That means that they will be at 7%.
And there's one man who owns that, right?
Yeah.
Or owns a lot of it, anyway. Equity futures on the S&P just about unchanged, with an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Hims and Hers shares are soaring 30% in the pre-market on reports that the telehealth company is partnering with Novo Nordisk to offer its weight loss drug Wegovy at a reduced price. The partnership aims to fill a gap in access to affordable weight loss treatments at a time when companies are no longer able to sell compounded versions and demand remains high. Meanwhile, UPS shares are also rising 1.4% in the pre-market after the company reported first quarter earnings that beat estimates. It also said it plans to cut 20,000 jobs this year as it reduces shipments for Amazon to focus on shipping higher yielding packages. Like others, UPS pulled its 2025 financial guidance due to macroeconomic uncertainty. And S&P Global Ratings says it's no longer considering cutting Boeing's debt to junk status. It says Boeing appears on track to recover from strike-driven production halts last year and persistent quality issues. S&P currently assigns Boeing a BBB- rating, one step above junk status. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara later on this morning. Up next on the programme, the morning calls. Plus, Daniel Rusker of Bernstein after GM joins a chorus of companies pulling full-year guidance from New York. This is Bloomberg. good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
The opening about 1 hour and 12 minutes away. Equity futures into that negative by 0.1%. That's some of the price action for you. Let's get to some morning calls. First up, UBS cutting its price target on Amazon to 253, anticipating tariff-driven demand destruction. The stock is up by 0.16%. Your second call from Morgan Stanley, raising its price target on Apple to 235, expecting earnings to beat expectations on strong product pull forward. The stock is positive by 0.06%. And your third and final call from RBC, reiterating its outperform rating on GM, saying it benefited from pre-buying ahead of tariffs. That stock is negative this morning by 1%. Let's stick with GM. Daniel Ruska of Bernstein reiterating his outperform rating or underperform rating on the stock, writing, quote, GM seems to have been unaware of the Trump administration's plans and/or timeline. This worries us immensely. Daniel joins us now for more. Daniel, good morning. Good to see you.
Good morning. Good seeing you.
What was it about the way this was released that was different to other quarters?
In the sequence, you clearly had a pre-press briefing, as is customary, yesterday afternoon. And after that, the Trump or administration's announcement saying there will be some sort of reprieve to tariffs followed. And then GM decided to not talk to investors this morning. So that's a pretty specific timeline. And it just shows that apparently GM had no knowledge that this would happen in terms of the tariff relief today or yesterday evening.
So we're all flying blind. What's your base case now? What's your working assumption for any of this?
I think if you look at it, and I'm surprised a little bit at the street and the valuation of the companies at this point, what Lutnick's announcement yesterday confirmed is that vehicle tariffs are going to stay in place, 25%. Parts tariffs are coming starting on May 3rd, and the addition is we're going to have some reprieve for people who manufacture in the U.S. The market has been discounting a couple of months of vehicle tariffs, but no parts tariffs. And so for us, this is still clearly from where the stocks are right now, a negative signal.
How much, though, do you get comfort from the fact that it appears, based on the timeline, and I realize this is so speculative and reading tea leaves and all of that, but that's where we are, that there is some room for negotiation and that they truly believe that at a time where President Trump is going to Detroit to really celebrate his 100 days in office?
Look, there definitely have been conversations going on. I'm pretty sure there still are conversations going on. What's worrying to me is that the ideas that have been floated over the past couple of weeks, kind of excluding some of the bigger components or the smaller components, expanding the U.S. content rule to mean it's actually U.S., Mexico, and Canada. And now we get kind of this new announcement. So I'm going to say if they do all of that, so if they limit the parts, if they expand the U.S. content to include Mexico and Canada, and if they give some reprieve, that will be good news. But you really have to do a broad-based relief to really give any upside to the stocks to where they are now.
After the announcement from the White House, the CEOs from Ford and General Motors came out and welcomed this and said that they welcome bringing jobs back to the United States, et cetera. You're smiling. They're trying to negotiate, have a PR move ahead of these negotiations. At what point will it be beneficial, if ever, for these companies, or is there no bull case at all in your mind if these tariffs, in some shape of how they are right now, continue?
So look, I think one, you have to stipulate that yes, these tariffs will incrementally move manufacturing to the U.S. Not in big parts. I don't think anybody will shut down factories in Mexico and move, but incrementally there will be more manufacturing coming in. I think the bull case some people are hoping for is that external OEMs, so OEMs from China like Mitsubishi, for example, who don't make a single car in the US, that they pull back from the US market. And that is maybe where we have a different view. If you're Mitsubishi, US is a third, maybe half of your earnings. You've built 30 years of supplier, parts networks, dealerships in the US. Are you not going to sell a single car in the US the coming years? The answer is most likely no. You cannot leave the market. And so while we're moving incremental production to the US, we will not see market exits. And so there really is two things. One, yes, more production in the US means higher prices for cars. More cost for the OEMs means higher prices for cars, and higher prices for cars means lower demand.
What about the upside to all the tariff negotiations? The fact that maybe American autos for the first time can really make a push in Japan if they're going to potentially loosen up some of their safety issues that they have. This is something I know the administration is really trying to get over the finish line. Is there an upside to American companies outside of America?
The tariffs to import cars into Japan are zero from the US. Yes, there are some different homologation requirements to make cars safe in Japan. For example, also the Tesla Cybertruck wouldn't be road legal in Europe. It has too many sharp corners. Yes, possibly, but I don't think there is a significant upside. If you put these cars side by side, manufacturing in the US is just expensive. The cars are, I'm going to say, on par to not that great compared to the content in those other markets. It's really about the innovation and the capabilities of US companies, and I do not think that tariffs really help that.
When I spoke to the president a few weeks ago on Air Force One, I was traveling with him in the press pool. He had said that day, I got off the phone with an auto executive, wouldn't say who it was. There are conversations on every level, a lot of conversations as well with the Chief of Staff, Susie Wiles. Is there a sense that you think the autos really know what the administration wants to see for a massive reprieve?
I don't have any more information than you at that point, so it's kind of guessing at that and saying the actions of the administration have been very incoherent when looking at it from an autos perspective. If I am an autos expert and I look at what is happening, it does not make any sense to me. There are a million different ways to do this. This is probably one of the worst ways. And so putting more reprieves into it, that's great, but really putting cost on cars will make prices go up, will weigh on the US consumer, and will lower volumes. And I think that is the bigger portion that people shouldn't lose sight of, that whatever this is, it's more cost on cars, that's higher prices, that's lower volumes.
You mentioned Tesla. It's not a company that falls under your coverage at the moment, but perhaps we can speak about it in general terms. I remember a note that came from you that Tesla wins, Detroit bleeds. Is that still the case? Is that still your assessment?
Yes, because Tesla manufactures all of its cars in the US, and even their parts that they use to manufacture the cars are overwhelmingly domestic. And so, I mean, if I'm the administration, I think the policy goal to say, look, we want to be the US content, want to have that as high as possible in those cars, definitely. I think a big question on Tesla is where all the batteries are coming from, and what about the China and South Korea tariffs, and how does that factor in? But they do have domestic battery capabilities. But yes, still Tesla is least exposed to the tariff headwind among all the OEMs.
Daniel, appreciate your time. Thanks for dropping by. Daniel Ruska there of Bernstein on the tariff situation. We're all looking for clarity. Maybe we'll get it in just a moment. We're 5 minutes away from a press briefing at the White House where we're set to hear from the Treasury Secretary Scott Bessent alongside the Press Secretary Caroline Levitt.
Absolutely. This is going to be one of the key questions, especially when it comes to where they are with these trade negotiations and the reciprocal tariffs and the sectoral tariffs. Remember, this is just autos. We're still waiting for pharma tariffs to come down the pipe and semiconductor.
And all the tax cuts, Lisa, that are still to come later this year. Yeah. Independence Day, July 4th.
Yeah, how much can people look to the sweeteners? That candy, remember we ate our vegetables first, which, by the way, you should always eat first and then last too, because they're great. But, you know, when are we going to get the stuff that, you know, maybe your algorithm won't like?
It's a pretty aggressive timeline, let's put it that way. Up next on the program, a press briefing with the Treasury Secretary Scott Bessent, plus reaction from Kathy Bostjancic of Nationwide. From New York, this is Bloomberg.
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
The opening bell about 60 minutes away and seconds away from a press briefing at the White House with the Treasury Secretary alongside the Press Secretary. When the Treasury Secretary starts to speak, Scott Besson will take some of those comments for you right here now live on Bloomberg TV. Equity futures on the S&P negative by 0.1%. On the Nasdaq 100, we're down by 0.2%. Let's get you prepared for the opening bell with your morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. One of the biggest movers this morning was UPS, but it started to ease back on some of the gains. It's up now less than 1%, scrapping its full-year guidance, specifically citing macro uncertainty. It's also undergoing a 20,000 cut of employees and try to right-size as they're no longer taking as many Amazon shipments. Also on the move this conversation, we're just having a conversation about this, is GM. The car maker this morning also scrapping their full-year guidance, saying that they would try to update the market once they have more certainty. Shares are down by 1.33%, also getting rid of their $4 billion buyback. Also postponing their analyst call. It will no longer happen today. It will indeed now happen on Thursday. Finally, away from earnings, Hims, the telehealth medicine company, surging in the pre-market trade, up some 30%. Novo Nordisk announced that it's going to be working with telehealth providers, specifically Hims and Hers is one of them, also Ro, also LiveMD, in order to supply them with Wegovy and cheaper options for consumers. Of these telehealth medicines had been selling compounds. The FDA has basically told them to stop because the shortages have ended, so that sending shares much higher this morning, John.
Danny, thank you. Three of the names to look for going into the opening bell a little bit later. Lots of earnings coming up over the next 48 hours or so. You'll hear from Big Tech on Wednesday and on Thursday. Some economic data later this morning as well, and some data just crossing the Bloomberg. With the latest, here's Mike McKee. Good morning, Mike.
Good morning, John. You want to pull ahead effect to the president's tariffs? You got it in the March trade report. March trade gap widens to a record $162 billion. The forecast was for $145 billion. Now, most of this came in consumer goods. Imports of consumer goods up 27.5% on the month. That's a crazy number. Imports overall were up by 5%. Exports were up by 1.2%, and most of that was cars, as they tried to get cars off the lots and out to customers overseas before the tariffs begin. So that is a major number that will put downward pressure on first quarter GDP. Along with this, we get the wholesale inventories report. They were up 0.5%. Retail inventories, though, fell 0.1%. Now, this is a conundrum for economists because there should be an offset in inventories to all of these imports. But even though we got 27% more imports of consumer goods, retail inventories fell. And nobody quite knows what's going on with that, but it'll be interesting to see how it all plays out tomorrow in GDP.
Mike McKee, thank you, sir, with the latest. More data coming later. Job openings, as Mike pointed out. You'll get payrolls later in the week. Consumer confidence coming later this morning, too, so look out for that as well. In a few seconds' time, we should have a press briefing with the Treasury Secretary, so when that room starts to fill out and the Treasury Secretary walks into the briefing room, we'll take that for you in just a moment. Also looking ahead to more data on Friday, as we say. This is the take from Kathy Bostjanczyk of Nationwide, writing, "We think the economy added just 120,000 jobs in April. Kathy joins us now to discuss. Kathy, welcome to the program. 120. Are we at risk of something much, much lower?
Well, good morning, John. Well, yeah, I do think the risks are on the downside, but it's a bit early to look for the real negative numbers in payroll, or the hit from the government layoffs and the hit to healthcare and even the cyclical sectors. I think that's going to be a few months from now, but we certainly have seen businesses just pull in their hiring reins, and given that we do see churn in the labor market every month, the fact that you're just seeing companies paralyzed, right, and not hiring, that does impart a downward bias to the number.
Kathy, are there specifics that you're looking for within, like under the hood of the headline number that's going to be important to see?
Yeah, no, absolutely. One of the main engines of growth in payrolls has really been the healthcare and social assistance sector. Those sectors are very much related and dependent on federal government activity and support. So we think those are areas that will start to see, some softening, and then that means overall non-farm payrolls, start to weaken. Really, if you looked at like kind of what we would call the core cyclical sector, we had already seen the labor market losing some steam, but overall healthcare, education, and even the government sector was boosting the overall headline number.
Kathy, we're going to get a host of other data before that, including the JOLTS information, which includes the quits rate. We'll get some more consumer confidence, as John was just mentioning. I'm just wondering, from your vantage point, as you look forward, how you reconcile the gap that we have seen between the soft data and the hard data. Do you agree with some of the earlier guests on the show who said it's probably a 4 to 6 month lag before you see a similar type of deterioration in the hard data?
Yeah, I would agree with that. I mean, maybe I'd say a little shorter, 3 to 6 months, but by and large, the movement in the soft data has been so pronounced. You really have be careful of shrugging that off. Sometimes it can be a little bit misleading, especially the confidence numbers. But when you spoke about the Conference Board Consumer Confidence data, what I'm going to zero in on is all the labor market readings, and particularly I want to see the expectations for more jobs, or jobs are fewer out there, and looking at the labor differential. That I think is meaningful, and also consumers' expectations about income going forward. Usually that survey shows is very like an American attitude, oh, future incomes will be up. What we have seen is some breakdown on that, and people becoming a little more pessimistic about future income. That can obviously influence current consumer spending.
But at the moment, we do see consumers also front-loading, wanting to get ahead of the tariffs. What does this mean for spending at the second half of the year, Kathy?
So the data are very skewed by the tariffs. You were talking about, Mike was talking about the import data. Yes, import is going to drag on GDP, but consumption is going to keep it elevated more than it otherwise would be. So it's very skewed. But that pulling forward means there's just a lot less consumption in the second half of the year, regardless of what happens on the tariff front. Like, even if they're resolved, if you bought an auto or a big ticket item, you're not going to be buying one in the second half of the year. So that's certainly going to be a negative for consumer spending and GDP growth in the second half of the year.
John has brought up this point a lot. If you're going out and you're spending on big ticket items, say a car or some sort of SUV, are you actually nervous about losing your job?
Well, that's a great question. I would say no. I think that, by and large, those are people who are just trying to get ahead of the price increase. I think if you're worried about losing your job, you probably hold on to your current car and just run it as long as you can, or look to the used car market, which that's also going to feel upward pressure, right? And prices, we saw that during COVID. So I think that's a really good point. And even in, our outlook, and I would say the vast majority of others I've seen, it's going to either be a borderline recession, or if we get a recession at this point, most of us thinking mild, that means the unemployment rate goes up to 5%. That's still overall historically pretty good labor market, but it's this uncertainty that is really, I think, killing the economy right now.
Kathy, as we've seen, the chairman of the Federal Reserve has chosen to prioritize anchoring inflation expectations. I just wonder, from your perspective, how you imagine that might shape his approach to next week's meeting.
Yeah, he is going to have to walk a tightrope as many times he does, especially during the press conference. But I don't think he'll back away from that. I know some others have been a little more dovish, right? Some Fed officials, but I think he'll maintain this idea that, inflation expectations high. The worst outcome for them is it becomes embedded and becomes more persistent. One of the things I worry about is the rollout of the tariffs. Like, we're still waiting to see if there's going to be additional sectoral tariffs. The longer that process gets elongated, the more inflation shock can be persistent, right? I'd almost rather have all the tariffs at once. I mean, it's not good for the economy, but in terms of inflation, it is really hard to gauge then what's, transitory versus persistent.
Kathy, what's your take on some of the pressure that's come from the president on the chairman of the Federal Reserve? How does that reshape the optics of them trying to ease sometime soon?
I think Chairman Powell would say he ignores that, and they're apolitical, and they're only looking at the data. And I think, by and large, that is the case. I just worry a little bit about the optics for market and investors, how they interpret that. And it could be that, they ease for the right reasons, but the market second guesses that. And that would be bad, right? And then you could have long-term interest rates rising while short-term interest rates are lower because of inflation expectations rising, or an extra term premium embedded on the long end.
Kathy, got to leave it there. Kathy Borchancic there of Nationwide. Over at the White House, that press briefing just starting with the Press Secretary Caroline Leavitt, with the Treasury Secretary Scott Bessent standing by. Lisa, those comments are about to begin. The focus is going to be on tariff relief, exemptions, deals, and then we start to make a bigger push on taxes.
When can they get to the pro-growth agenda at a time where people are focused? And can he give some sort of reliable guide in how they are going to get this through before or by July 4th, Independence Day, given all of the dissent that we're seeing in Congress?
Happy first 100 days is what Caroline Leavitt says as she takes the podium. Secretary Bessent today needs to first do two things. One, show that optimism, getting trade deals done with these partners. He's talking about India, he's talking about South Korea. Second, try to push the conversation forward when it comes to taxes. But can this actually get done on the timeline he wants? The Senate Majority Leader, who has to deliver the votes in the Senate, thinks it's aspirational.
Called it aspirational just yesterday. Independence Day, July 4th is the target for all of that. How does he answer the question about where talks are between China and the United States, and whether those talks are actually taking place?
Well, he did comment on that over the weekend by not commenting on it and saying that he was not in the room with respect to that call. Nonetheless, it is imperative for him to give some sense of just how that progress is going. He did say that deals were imminent. With who? And how significant would those deals be to ratchet back some of the concerns that we're hearing from corporate America?
When it comes to China, the issue, of course, is who's going to properly blink first. I don't mean exemptions. I don't mean some olive branches, but maybe some gracious language that the president has said about Xi Jinping. Actually, someone coming out and saying we're lowering 145% tariffs to, say, 50 or 60%. And until we get that, can you really have an area for negotiation? Remember, China's waiting for the president to make a point person. Every time I ask the administration, they say there is a point person. It's called Donald Trump.
Look how difficult it is right now for corporate America. General Motors, a perfect example of that, coming out this morning and basically offering very little guidance because they can't, and pushing back their call because they have to. Because later on today, we're expecting some kind of news about exemptions for auto parts for these companies to function without higher costs. And they can't offer any clarity on the future without getting that detail.
And there was a shift where they removed any clarity after hearing about those potential exemptions. GM is not alone when it comes to withdrawing guidance. Just this morning, we also had JetBlue withdrawing their guidance, Pfizer, UPS. It's not just the auto manufacturers. At what point will their pleas have the same sort of power that maybe the Walmart and Targets of the world did just last week?
And Daniel made a great point. This is a reprieve on parts of the tariffs. This Saturday, we're supposed to have the auto parts 25% take hold. What the administration is saying, well, also if you're paying aluminum or you're paying steel tariffs, you don't have to be doubled up. We're not going to double tax you. But since April, there has been a 25% tariff on autos writ large. And this is why the auto industry is struggling and also having a full court press lobbying effort down in Washington to try to get some sort of reprieve. But they want something bigger than what we're seeing right now out of the White House.
You made a good point moments ago, the potential to open markets more elsewhere. How great is that potential in places like Japan?
Well, it's something that's definitely on the agenda, and that's happening with these conversations. What the U.S. wants to see is them to have a more relaxed approach when it comes to some of these safety precautions, safety procedures for U.S. autos to get into the Japanese market. They say it's one of the most protectionist places for U.S. autos to actually sell vehicles. If that's part of a trade deal, that would be something welcome for sure by Detroit.
At the same time, how much does it push companies to really manufacture more locally? We saw actually Coca-Cola come out this morning and reaffirmed guidance and talked about exceeding profitability because they produce a lot of their goods locally. In other words, will it have exactly the effect that people are looking for if the walls are so great that people are just looking to really domesticize all production?
The risk is it takes too much time, and you're already seeing the cracks emerge. The trade between China and the United States breaking down. The view from Torsten Slock of Apollo is that transport and trucking breaks down next, excuse the pun. And after that, the job losses begin. The empty shelves start to appear. This is what he had to say about payrolls on Friday. Payrolls on Friday, the estimate is 130K for the month of April. Let's hope it is around 130K. He says the risk, significant risk, is that it's lower or negative, because the survey week was the week after so-called Liberation Day, that point of maximum uncertainty.
And when you heard about people actually withdrawing financing from venture capital, withdrawing financing for potential projects in the face of what they projected out, it does raise a question: how does this market respond to that? At what point is the lever of Fed rate cuts really not effective anymore? If what this market is really not necessarily pricing in is full-blown recession, is that what starts to get priced in if you do see a truly negative number?
And then what does the Treasury's, the Fed do, the Fed chair do? Jonathan, you brought up a great point just now with Kathy. The fact that the president's put so much pressure on the Federal Reserve, does it make their job harder? Because does it almost look political that they're now placating to the President of the United States, who is jawboning at Jay Powell whenever possible to lower interest rates?
They end up digging in. Look, we talked a lot about the so-called Trump put. The strike price was a whole lot lower than people thought it was only a few months ago. But the pressure comes from multiple places. Here's two. It comes from the polls and it comes from employment. If you start to see rising unemployment, you start to see it because of the policies announced in the last few months, that's the question. How much of that kind of pain are you willing to tolerate if one starts to infect the other? Employment starts to break down and it starts to hit the polls even more.
Which is the reason why it's interesting to look at each individual Congress member at town halls, at how they're responding to potentially pushing back against the president at a time when you've really seen him be the key whip, right, for a lot of congressional votes. It just raises this question about the breaking point at a time when it's not the stock market, maybe it's the bond market, but the bond market might not be in play if we're really truly pricing in weakness.
Caroline Levitt just said that the president is America's businessman in chief. Well, this is what the American people have to say. On Sunday, CNN poll says 39% of Americans approve of how Trump has steered the economy. And then when you look at the NBC poll, they talked about how unpopular, deeply unpopular the tariffs have been. 39% of respondents agree with the rollout. And you keep seeing this in the polls, and this is going to be a massive pushback on this White House and what they're trying to do.
Remember how bullish people were and why. They were bullish, this administration, because they believed they'd be pro-risk, pro-growth. Yes, you'd accept some tariffs, but the fuller platform would include some tax cuts. We've had to wait longer for that conversation to start than we thought it would only a few months ago.
And part of the problem with this is the sequencing of the tariffs first, which some people said was likely given the fact that that was something that the president could do unilaterally, has led to less agreement among Congress members to get through some of the tax cuts passed. And all of a sudden, there's a question of how much further they have to go with cutting taxes in order to offset maybe some of the drag that you've seen from the tariffs.
Stepping up to the podium, following comments from the Press Secretary, Caroline Levitt, we can take a listen to some of the questions and some of the answers from the Treasury Secretary, Scott Bessent, speaking at the White House.
The administration is pursuing. So my question is, what is the White House's ultimate objective here? Do you want to have long-term tariff revenue or deals that might reduce those tariffs?
I think it's a combination of both. So we're going to take in long-term tariff revenue. We put a process in place. We have 18 important trading relationships. We will be speaking to all of those partners, or at least 17 of them, over the next few weeks. Many of them have already come to Washington. What President Trump is referring to is the ability for tariff revenue to give income tax relief. And I think there's a very good chance that we will see this in the upcoming tax bill. The president campaigned on no tax on tips, no tax on Social Security, no tax on overtime, and the restoring interest deductibility for autos, for American-made autos. So tariff income could be used for tax relief on all those immediately.
So you think that there is a role for significant tariff revenue in U.S. fiscal policy?
I think that it is something that got put away a long time ago, and I think that tariffs will bring back American manufacturing and generate substantial revenues.
On manufacturing, we've seen some pretty grisly surveys this month from the Philly Fed, which saw the biggest drop since May of 2020, and the Dallas Fed, similar plunging outlook, poor shipping orders. What are American manufacturers not understanding about your push for onshoring in the U.S.?
Well, I think I was in the investment business 35 years, and I learned to ignore the survey data and look at the actual data, and the actual data has been quite good. The job data is good. Americans keep spending, and as Caroline said, we have these incredible commitments to bring manufacturing back on shore with record investment by domestic corporations and foreigners who want to come into the U.S.
Thank you so much, Caroline. Thank you, Mr. Secretary. The Chinese continue to say that the U.S. and China are not engaged in any consultation or negotiation on tariffs. You recently said you've talked to your counterpart, but more about, quote, traditional things like financial stability. So can you clarify, is the administration talking to Beijing specifically about tariffs or not?
Well, we're not going to talk about who's talking to whom, but I think that, over time we will see that the Chinese tariffs are unsustainable for China. I've seen some very large numbers over the past few days that show if these numbers stay on, Chinese could lose 10 million jobs very quickly, and even if there is a drop in the tariffs, that they could lose 5 million jobs. So remember that we are the deficit country. They sell almost 5 times more goods to us than we sell to them. So the onus will be on them to take off these tariffs. They're unsustainable for them.
And they are saying you guys are not talking about it. So is that true?
Look, they have a different form of government. They're playing to a different audience. So I'm not going to get into the nitty-gritty, again, of who's talking to whom. But as I said, I believe for the Chinese, these tariffs are unsustainable.
And very quickly, 2 days ago, you said you didn't know if President Trump had spoken to Xi Jinping. Do you know now?
Again, I would say Caroline and I have a lot of jobs around the White House. Running the switchboard isn't one of them.
Bloomberg, go ahead. Secretary Bissett, thank you so much for being here this morning. You've talked about the importance of giving investors certainty when it comes to the market, yet the Trump administration is continuing to negotiate several complex trade deals in a very sort of compressed time frame. When do you expect you'll be able to give the market some certainty around those deals? Do you have a deadline? Is it the 90-day pause? What are we looking at here?
Good question. And I think one thing that has been a little disconcerting for the markets is, President Trump creates what I would call strategic uncertainty in the negotiations. So he is more concerned about getting the best possible trade deals for the American people. We had 4 years of bad deals for decades of unfair trading, and we are going to unwind those and make them fair. What we are doing is we've created a process. I think the aperture of uncertainty will be narrowing, and as we start moving forward announcing deals, then there will be certainty. But certainty is not necessarily a good thing in negotiating.
Mr. Secretary, last night there were reports on the administration sort of walking back a little bit on the auto tariffs. Can you sort of just elaborate on that decision there and what we can expect going forward, and why sort of the shift in those auto tariffs?
Well, President Trump has had meetings with both domestic and foreign auto producers, and he's committed to bringing back auto production to the U.S. So we want to give the automakers a path to do that quickly, efficiently, and create as many jobs as possible.
Jasmine. Thank you so much, Caroline. Thank you, Secretary. Back on China, does the administration anticipate supply chain shocks or supply shocks coming now that cargo shipments from China are significantly down? And if so, are there plans in the process of how to address that?
I wouldn't think that we would have supply chain shocks, and I think retailers, they have managed their inventory in front of this. You know, I speak to dozens of companies, sometimes daily, but definitely weekly, and you know, they know that President Trump is committed to fair trade and have planned accordingly.
And then second question, can you outline the timeline for when you think some of these deals, particularly with your Asian countries like India, Japan, South Korea, you may have an announcement?
I'm glad you brought up our Asian trading partners and allies. They have been the most forthcoming in terms of doing the deals. As I mentioned, Vice President Vance was in India last week. I think that he and Modi made some very good progress, so I could see some announcements on India. I could see the contours of a deal with the Republic of Korea coming together, and then we've had substantial talks with the Japanese.
Andrea.
Secretary Bessent, just continuing on the path of the sort of like progress. You said yesterday, I think, that it was could happen as early as this week or possibly next week. Can you give us a bit of a timetable? And then I wanted to ask about South Korea specifically. They've said that they probably won't be able to make a comprehensive deal until early July because of their elections. Japan also has elections. And to what extent are domestic factors complicating your efforts? Canada just had an election. You know, are you seeing that you might have to think about delaying the 90 days?
Well, I would actually take the opposite tack, that I think from our talks that these governments actually want to have the framework of a trade deal done before they go into elections to show that they have successfully negotiated with the United States. So we are finding that they are actually much more keen to come to the table, get this done, and then go home and campaign on it.
Sean?
I'm sorry, did you have a comment on whether something could happen this week or next week? For a deal. So, you know, you said yesterday.
Again, I think that we are very close on India. And in India, you know, just a little inside baseball, India, in a funny way, is easier to negotiate with than many other countries because they have very high tariffs and lots of tariffs. So it's much easier to confront the direct tariffs when as we go through these unfair trade deals that have been put in over decades, that the non-tariff trade barriers can be much more insidious and also harder to detect. So a country like India, which has the posted and ready tariffs, it's much easier to negotiate with them. So, you know, I think the India negotiations are moving well.
Sean, go ahead.
Hi, Mr. Secretary. So it was reported this morning that Amazon will soon display a little number next to the price of each product that shows how much the Trump tariffs are adding to the cost of each product. So isn't that a perfect crystal clear demonstration that it's the American consumer and not China who is going to have to pay for these policies?
I will take this since I just got off the phone with the president about Amazon's announcement. This is a hostile and political act by Amazon. Why didn't Amazon do this when the Biden administration hiked inflation to the highest level in 40 years? And I would also add that it's not a surprise because, as Reuters recently wrote, Amazon has partnered with a Chinese propaganda arm. So this is another reason why Americans should buy American. It's another reason why we are onshoring critical supply chains here at home to shore up our own critical supply chain and boost our own manufacturing here.
Is Jeff Bezos still a Trump supporter?
order?
Look, I will not speak to the president's relationships with Jeff Bezos, but I will tell you that this is certainly a hostile and political action by Amazon. And Secretary, if you have anything to add.
Yeah, I would also add that the bringing down the terrible Biden inflation has been a priority for the first 100 days of the Trump administration, and President Trump has done a great job of leading that since January 20th. Interest rates, mortgage rates are down, gasoline and energy prices are down. We're expecting the further decreases, and as Caroline said, the big tax on consumers that goes unnoticed is deregulation or regulation, and we are deregulating and bringing that down. So, from a household income point of view, we would expect real purchasing increases. We've seen them over the first 100 days, and we would expect that to accelerate. We are doing peace deals, trade deals, tax deals, and deregulating. And the deregulation is a longer lead time, but I think by the third and fourth quarters, that's really going to kick in.
Thank you, Caroline. A question for you and Secretary Bessent. We talk a lot about volatility and uncertainty in the marketplace, and the president has stated all along that he's more concerned about mainstream America, the American worker. You just talked about deregulation and this entire fair trade and reciprocals. What is your message to the American people in terms of letting them get through this disturbance and the outcome being greater and a greater good for the American worker, the American people, the American families?
I would say trust in President Trump. There's a reason he was reelected to this office. It's because of the historic success of his economic formula in the first term. And as I laid out at the beginning of the briefing, and the Secretary has talked about, and the President talks about every day, there's a proven formula that works. Massive deregulation, energy independence, and tax cuts, which are coming. And the Secretary is working very hard on that with our counterparts on Capitol Hill. If you want to talk about that, that's a huge deal to put more money back into the pockets of hardworking Americans. As for the fair trade deals the President is trying to negotiate, he's not just righting the wrong of the mess that he inherited from the past 4 years of the Biden administration. This is a mess that has been created for the past 4 decades, that has sold out the middle class, that has moved jobs overseas. You think about our heartland, middle America, what towns used to look like, what they look like today. President Trump wants to restore the golden age, and it's a process to do that, and that process is underway, but he's put together a fantastic trade team. Secretary Bessent, Secretary Lutnick, Jamieson Greer, all working incredibly hard on this effort 24/7, but tax cuts are coming, and that's key. And Mr. Secretary, why don't you talk a little bit about that?
Yeah, so it's really a three-legged stool in the economic policy. It's trade, it's tax, and it's deregulation. So we are in the midst of addressing, as Caroline said, these long-term trade imbalances. The tax bill is going much better than I would have thought when I took office on January 28th, and that's through President Trump's leadership. That Speaker Johnson, Leader Thune are united. Speaker Johnson, we had a very good meeting yesterday with somebody called the Big Six, NEC Director Kevin Hassett, myself, Speaker Johnson, Leader Thune, Committee Chairman Jason Smith, and Senator Crapo. And the tax bill is moving forward. It is going to give permanence to the 2017 Tax Cuts and Job Act, which will, back to the question on certainty, it will give American business certainty, it will give American people certainty, and then President Trump is also adding the things for working Americans that is talked about earlier: no tax on tips, no tax on overtime, no tax on Social Security, making auto payments deductible. So that will substantially address the affordability crisis. And the other thing that I would note, and back to data, is that the Vanguard, one of the largest money management firms in America, said that over the past 100 days, 97% of Americans haven't done a trade, and in fact, individual investors have held tight while institutional investors have panicked. So individual investors trust, investors trust President Trump.
Megan, in the back.
Thank you you both. Can you detail for us exactly what we should expect as far as relief on the auto tariffs front? And then further, Mr. Secretary, should we expect other industries to also get relief the way we've now seen for auto and tech as well?
I'm not going to go into the details of the auto tariff relief, but I can tell you that it will go substantially toward reshoring American auto manufacturing. And again, the goal here is to bring back the high quality industrial jobs to the U.S. President Trump is interested in the jobs of the future, not the jobs of the past. You know, we don't need to necessarily have a booming textile industry like where I grew up again, but we do want to have precision manufacturing and bring that back. And you know, another important, very important function of this that does not get talked about enough is national security. President Trump, his overriding concern and belief is that economic security is national security is economic security. And we saw during COVID that our supply chains got cut off. And we need to bring back a lot of those supply chains, whether it's in semiconductors, medicines, the steel, and we have to onshore those. So it's a combination of making trade free and fair and remedying this gaping national security hole that he was left with.
I would just add, Megan, the president will sign the executive order on auto tariffs later today, and we will release it as we always do. Go ahead.
Secretary, any updates on the negotiation with the European Union, and is it hard to negotiate with the European Union? Do you have any updates on the negotiation with the European Union?
I'm more involved in the Asian negotiations. My observation would be, goes all the way back to Henry Kissinger's statement, when I call Europe, who do I call? So we're negotiating with a lot of different interests. Some of the European countries have put on an unfair digital service tax on our big internet provider. You know, France and Italy, other countries, Germany and Poland don't have that. So we want to see that unfair tax of one of America's great industries removed. So it's going to be a give and take. So they have some internal matters to decide before they can engage in an external negotiation.
Edward.
Thanks, Caroline. Mr. Secretary, so contacts I have in the business community say that they're basically frozen for long-term investment because of the uncertainty around tariffs. How long do you think President Trump has to make a deal before there's damage to the economy?
Look, I think that what we're seeing is that business leaders, they've gone into a pause, and I think we're going to give them great certainty on this tax bill. And I think over the next couple of weeks, as I said, we have 18 important trading relationships. We'll put China to the side. 17 are in motion. And then, as I said yesterday, I think there's a very good chance we're going to get this tax bill done. And the tax bill is going to be very powerful for domestic U.S. investment. So what we are going to do, one of the most powerful parts of President Trump's 2017 tax bill was full expensing of equipment. We are going to make that, as President Trump said in his speech to Congress, that will be retroactive to January 20th. The other thing that we are looking to add is full expensing for factories. So bring your factory back. You can fully expense the equipment and the building. We will couple that with deregulation, cheap energy, and regulatory certainty, and that will continue to make the U.S. the greatest destination for domestic and foreign investment.
And the president, well, if I could follow, just the president said that world leaders would like to meet with him in Rome, in Vatican City, about trade. Other than President Zelensky, who did the president meet with, and about trade, and when could we get some of those deals?
The president met with President Zelensky, which we talked about, and the president continues to be engaged with his fellow leaders around the world in the European Union. You've seen many of them visit the White House. I want to harp on, in closing, the point the secretary just made. On the campaign trail, the president promised the American public that he was going to make America the best country in the world to do business again. The lowest taxes, lowest regulation, lowest energy costs of anywhere in the world. And if you do business in the United States, you won't pay a tariff, you won't pay a price. That's not just good for companies around the world, but it's good for the American worker. That's what this team is focused so hard on every day. We have work to do. The golden age of America is underway. But as I pointed out in the beginning, there's a lot of reason for the American consumer, the American CEO, the American small business owner to be confident and optimistic about this president and where we're headed. So you will hear more from the president himself later this evening. He is traveling to Michigan, as you all know. He'll make a stop at the Air Force Base with Governor Whitmer, and then we will head to a rally tonight where you'll hear more from him directly. So we'll see you in Michigan. Thank you, guys.
Thank you.
All right, Treasury Secretary Scott Bessent at the White House being slightly overshadowed by White House Press Secretary Caroline Leavitt. This is Open Interest. I'm Matt Miller alongside Shonali Bassick and Katie Greifeld.
Let's take a look at what markets were doing during that press conference. You have S&P 500 futures at their lows right now. Bessent said that he won't comment on who was talking to who when it comes to China. He did say that the U.S. has had substantial talks with Japan, that they're very close to a trade deal on India, but we have to talk about Amazon here. This was really interesting. Punchbowl reporting overnight that Amazon will soon display the added cost of U.S. tariffs on individual products. Again, that is according to Punchbowl. You can see shares are down about 2% right now because Caroline Leavitt said that this was a hostile and political act by Amazon. Shonali.
Yeah, very interesting and targeted comment, of course, by the press secretary. We're going to bring in Bloomberg's Tyler Kendall. She is in Michigan. This is where President Trump will hold a 100-day rally tonight. But first, let's talk a little bit more about the direct reaction. Of course, they talked about tariffs, they talked about taxes, and they talked about Amazon specifically. What does this say about the White House's reaction to companies around the push-pull with these tariffs? Prices are going up. Amazon might start to sit here and tell you just by how much. The follow-up question, Tyler, was, isn't Jeff Bezos still close to the president? What is Amazon's story saying about how the rest of corporate America might have to handle inflation?
Yeah, hey, Shonali. Well, the White House is very defensive of its policies, particularly as big box retailers came to the White House last week and urged the president to pull back on his tariffs because we could potentially see empty shelves in the coming weeks. And we've heard that from across the sectors, including the autos particularly, saying that they might have to hike prices for consumers as soon as next month, May, which is just in a matter of days. It is clear that this White House has been feeling the pressure from these companies, but they also don't want to let up on their tariff policies that they say they are staking their economic agenda on. Now, when it comes to those automakers, since I am here in Michigan, Caroline Leavitt did confirm our Bloomberg News reporting that President Trump is expected to sign an executive order that could offer some reprieve to automakers. Now, a White House official does tell us that this is expected to reduce or prevent the stacking of levies that automakers often face. So while we are not expecting the actual rates that automakers' auto tariffs are in place, that 25% tariff on foreign autos, as well as a 25% tariff on auto parts expected to come in on Saturday. Very likely automakers now will not have to pay those other tariffs that could get stacked on top, like steel and aluminum. And we're also expecting automakers to actually be able to get a partial reimbursement back when it comes to auto parts. So clearly the administration trying to thread the needle here, at least offer some sort of reprieve. As Treasury Secretary Scott Bessent there didn't give us much details exactly, but did say that this is a focus on reshoring manufacturing in the United States.
Yeah, I think it's interesting, especially, Tyler, after we got all those really bad polling numbers out. To be fair, from outlets that are not necessarily super Trump-friendly, CNN, NBC, and others, but bad polling numbers, and now the White House is making it clear they really don't want consumers to see how much tariffs are adding to the prices of goods that we all need. That's why they say it would be a hostile and political act for Amazon to show consumers that information. They also don't want that to happen with cars, right? Because if you stack tariffs 25% on 25% on more for parts, you're going to see auto prices rise by maybe more than half.
Right, exactly. And it's also, I think it's fair to say, this is also part of why we're starting to see the administration really focus in now on its tax plan, since the White House is really banking on getting that through as soon as possible to get more cash into consumers' pockets and quickly. You had the Treasury Secretary there saying that they think that tariff revenue could actually help to offset some of the bigger tax priorities. We should also note it's unclear how exactly that would happen, considering that the tariffs aren't codified by Congress. They're not going to be in the Congressional Budget Office scoring, which could kind of complicate the math here. But Treasury Secretary Bessent yesterday came out saying that they actually want to see reconciliation done by July 4th. That is considered to be a very ambitious timeline. Senate Majority Leader John Thune said that it was aspirational. Instead, they're really looking towards that X date as the hard deadline for lawmakers to get the reconciliation package through. I did speak to one senior aide to Senate Republican leadership who told me that the chamber really isn't expecting to complete any work on this till actually August. So the administration, though, really pressuring lawmakers. I can tell you actually one other thing, that President Trump told Michigan Republicans who were supposed to be here tonight not to come, to stay in Washington, because that is the sense of urgency this White House is pushing lawmakers to get through their tax agenda as they deal with the fallout from consumers and retailers alike when it comes to their tariff plans.
Certainly a sign of the times there. Bloomberg's Tyler Kendall reporting from Michigan. Looking forward to your coverage all day long. But let's keep the conversation on autos going, because GM suspended earnings guidance and froze plans to buy back $4 billion in shares due to uncertainty around tariffs. Bloomberg's David Welch is our Detroit bureau chief. He joins us now. So that's just part of it, David. They also postponed their earnings call from today to May 1st because they simply don't have enough clarity right now. And I guess it remains to be seen whether they'll get that clarity by the start of May.
That's right. They're looking for some kind of detail. I think last night they were preparing their earnings, the press release, the numbers, everything like that. And there were news reports breaking into the evening that Trump was going to give some sort of relief on auto tariffs. There's still no detail out there, or at least not a lot of it, on what that is. So it's tough for GM to affirm, not affirm, or even update their guidance. So they suspended that. They had a $6 billion share buyback that they had announced in February. $2 billion of that is already funded. That was the accelerated plan that's supposed to be completed in the second quarter. So the money was actually sent to the banks. That's going to be done. The other $4 billion that didn't have any kind of end date on it, it could theoretically even stretch into next year. But that's what's being sort of indefinitely held until they have clarity on tariffs, what that means for profits, what that means for cash flow. And, I think GM's like a lot of companies right now where they don't know how to plan the business because they don't know about all the devils and the details of the trade policies.
It's not just American companies, it's European companies as well. Matt knows I really want a Porsche. And maybe it might be more difficult to buy one, but they actually cut their profit outlook because of these tariffs. What to make of the international car industry right now based on what they've said?
Look, it doesn't make sense to have one small Porsche plant in every market where you do business, right? Because, even though people really like these expensive sports cars, you just don't sell enough of them to have a big plant in America, another plant in China or South America or wherever. So you have to do a lot of exporting if you're a niche car company like that. And I think what they're saying is they're not sure what tariffs, whether they pass along some of the cost to consumers or eat some of it, what it's going to do to their business. So, yeah, it's going to weigh on Porsche's profits one way or the other, whether it lowers sales or it lowers their margin on the vehicles that they sell. There's a theory that if you've got $100,000 for a Porsche, you also have $125,000, but people who can afford those cars didn't get that wealthy by giving their money away. So, everybody is price sensitive to some degree.
If you are getting a Porsche for $100,000, then you're not getting a 911, which means it's probably not made in Stuttgart. David Welch, very good point. People forget, used cars, great choice. David Welch out of Detroit, where he is our bureau chief and wrote the book, literally, on Mary Barra and General Motors. Now, UPS is among the big earnings movers today. Another one that pulled its guidance. Let's get the details from Bloomberg's Red Brown. So, Red, this is one of many companies this morning that have said we can't give guidance, we're flying blind.
Yeah, I mean, it's to kind of what David is speaking to there. It's really difficult to plan, make a business plan when you don't know how things are going to look within a week, right? So let alone months out towards the end of the quarter. So even UPS with so many, tentacles stretched so far across the economy, getting so much real-time data, can't really plan out what they think the rest of the quarter is going to be. Rest of the year is going to be. We are getting some of their second quarter guidance coming through right now. So the company's saying they expect to get $21 billion in the second quarter, estimates calling for around $21.1 billion. So still right in line with what the expectations were, but still the rest of the year is still kind of a big question mark.
They also have plans to cut 20,000 jobs this year, UPS. That is due to reduced shipments from Amazon. So that was
by
really
more than
interesting
half.
as well.
That plan announced earlier, but by more than half, they want to cut shipments for Amazon.
They're also going to close dozens of facilities. But let's keep the theme going, flying blind, not literally when it comes to JetBlue, but they did pull their guidance.
Yeah, they did, and kind of, I guess, probably expected with them. Delta, American Airlines, Southwest all either withdrew or declined to reaffirm their outlooks this quarter already. So, JetBlue is already a company that's struggling. Another one of these companies going in the midst of a turnaround while the economy is struggling. And then, again, demand is just not necessarily there for air travel.
But maybe sea travel. You see Royal Caribbean hiking their outlook. Something I realized just a couple weeks ago, there was a great Wall Street Journal story about Coke versus Pepsi. Coke actually not making their concentrate out in Ireland and therefore maybe benefiting. Are we seeing that in their outlook right now?
Coke makes it obviously here, top secret in Atlanta. That makes sense because it's an American company, right? Pepsi. The weird thing is that Pepsi makes their formula in Ireland.
Right. And it used to be an advantage, but maybe not today.
Yeah, no, it's interesting because it's like, these companies that are so multinational, some people were worried about them being more exposed to the tariffs, right? If you're shipping things in from all over the country, potentially it seems obvious. But for Coca-Cola, it seems like they had a really strong quarter. It seems like people are still buying their sodas. So yeah, sales did fall slightly from last year, but the company has really strong pricing. Price mix was up 5% in the quarter, 9% in the quarter before that. So the company still is able to charge higher prices for their sodas.
When it's addictive, it's pretty easy. Your pricing strength is increased when what you sell is addictive, right?
Yeah, absolutely. People like sugar. People like soda. Red Brown, we appreciate your roundup as always. Matt, you brought up this point. You take a look at the year-to-date chart of Coca-Cola versus Pepsi. It's pretty astounding. You have Coke up 16% on a total return basis. You take a look at Pepsi, down 11%.
Look at that. Joe pulled up the chart on the
Talk about a pair
He's so
trade.
fast. And Joe, by the way, if you look at that, if you look at it over 1 year or over 2 years, it's equally bad. Pepsi has really underperformed Coca-Cola.
You know what's up 36% on the year? Celsius, out with the new cherry cola flavor. Just saying, if you want to talk about addictions, I've got one.
Let's also take a quick check on the overall market right now because we're sitting at session lows when it comes to futures. The S&P 500 down 0.5% right now. We know a lot of that pain is coming through with big tech, with Amazon, hostile act, as the press secretary of the White House said. We'll continue to follow these markets up next. This is Open Interest.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Let's turn to healthcare now, because Hims & Hers Health is absolutely flying right now after announcing a partnership with Novo Nordisk. Novo will be offering its popular weight loss drug Wegovy through Hims and other pharmacy platforms at a reduced price. Let's talk about it now with Bloomberg's Madison Moeller, who reported on this. And Madison, I get why this is great news for Hims, but why does this make sense for Novo to go this route?
Yeah, so this makes sense, especially right now, because we are coming up on the end of the compounding era of weight loss drugs, which we've talked about on the show. You know, during widespread supply shortages last year, these compounding pharmacies sort of teamed up with telehealth companies to sell cheaper knockoff versions of blockbuster products like Wegovy and Zepbound through these telehealth platforms. And we're coming up on the end of that because the drug makers can now supply enough of their drugs to satisfy demand for the market. That means the FDA is going to start cracking down on some of this compounding, potentially leaving hundreds of thousands of patients that have come to rely on these cheaper drugs without access to medicines. So Novo, I spoke with them, and they, have been looking at this and making sure that they are there to step in when patients are eventually cut off from the drugs. They rolled out this cheaper option for Wegovy last month, and now they're expanding that to partner with these telehealth companies that have sold these compounded drugs in order to potentially reach more patients.
Madison, it is much cheaper, right? It's less than half of the cost of otherwise getting Wegovy in America, but it still costs like a car payment. And if you look in other countries, admittedly, this is data from 2023, but you can get this stuff for $100, even less in some places a month. These companies have always told us it's because of the middlemen that their prices are so high in America. But does this really pull back the curtain on that argument?
A little bit. I mean, this does show, because what they're doing, you're right, that this direct-to-patient or direct-to-consumer option is cutting out the middlemen in some cases. And so we're seeing a reduced price that maybe lines up a bit more with some of the discounts and rebates that insurance companies are getting on the list price of the medications. That being said, it's still, even at this reduced cost, a lot higher than it is in other countries. And that's something that lawmakers like Bernie Sanders really called attention to last year. The CEO of Novo Nordisk testified at a Senate hearing about the prices of his company's drugs. That's something we've also actually seen President Donald Trump call out this year, the fact that Americans pay much higher prices for medications than elsewhere in the world. So that is something that there's been a lot of focus on, and Novo has tried to reduce that price and that criticism by bringing down the cost of their medications, but it still doesn't line up to what other patients in other countries are paying.
Madison, we only got about a minute left here, but I want you to talk to me about Pfizer, because the results kind of left for wanting. They did not give details on tariff impacts. Others have, and they also have, of course, that failed obesity drug experiment. How do you think about their path moving forward?
Yeah, I mean, that is something I think people have been asking for a long time. We've seen Starboard get involved in Pfizer, and there's a lot of questions about what will be their next big hit. People were looking at obesity to be that next thing for Pfizer, and that really hasn't panned out. I mean, we've seen other companies, it's really been a challenge to develop an obesity pill specifically. That's somewhere where Lilly has been excelling, but it's been a bit harder for other companies like Pfizer. And there's really a question still of what is going to be the next big hit after COVID for them, which we've been saying for, almost 2 years now. But when it comes to tariff impacts, we are seeing some uncertainty in the healthcare space.
Yeah, some big questions over Pfizer's pipeline. Bloomberg's Madison Mueller, appreciate your time. Now, coming up, less than 5 minutes to go until the opening bells. We'll walk you through all of the action with Anastasia Amoroso. This is Open Interest.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes out in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. It looked like we would have maybe a positive day because we could get a reprieve on auto tariffs, but you can see futures down 0.5% because Caroline Leavitt at the White House said that showing consumers information about tariffs leading to price hikes is hostile and political. Here's the opening bell on the New York Stock Exchange. Jim Cramer ringing the opening bell, a fantastic and unique human being who has been hosting Mad Money, an iconic show for 20 years. Great to see him there at the NYSE. And down at the NASDAQ market site, you can see the funny hats. That's because this is Churchill Downs. They wear these hats for the Kentucky Derby, right, which is coming up this weekend, like the most exciting 20 seconds in sports. And Churchill Downs has been down big, off 33% year to date. Hopefully they put in the right bets on Saturday. Katie?
All right, let's take a look at some specific names to watch because we're in the heart of earnings season, and we heard from UPS this morning that it plans to cut 20,000 jobs, also to close dozens of facilities. That's as Amazon package volume plummets. It did not update its outlook, and it's certainly not alone in that, Shanali.
Yeah, I am looking here at General Motors, one of those that did not update its outlook. In fact, they've suspended guidance, and they're freezing share buybacks as well. That's on tariff fears. GM also moved the earnings call to Thursday as the White House weighs auto tariff relief. It's down 2.12% at the market open, Matt.
As we've been talking about, apparently plans to show consumers how tariffs contribute to higher costs on each product, if they do. This according to a report by Punchbowl. But the White House press secretary, Caroline Leavitt, said that is a hostile and political act. And at that point, if you look at the futures chart, they just come dropping down. So the market did not like that reply from the White House. However, we have been in an uptrend lately, and JP Morgan's trading desk has turned tactically bullish on U.S. equities. The team says that the de-escalation trade, which is what we're going to see out of Michigan and President Trump today, has room to run as low liquidity and light positioning likely push markets higher. We are joined by iCapital Chief Investment Strategist Anastasia Amoroso. And Anastasia, great to have you here. Thanks so much for joining us. What do you think about this? Okay, a little bit of a blip because Caroline Leavitt buried Amazon, but otherwise, the Trump White House has been de-escalating on tariffs, and they're expected to continue tonight. Do you like this market?
Look, it's a puts and takes market, and obviously, got some positive news flow that we are seemingly de-escalating the tariffs that were highly escalated around April 2nd. So that's a positive, and I think that can continue. But at the same time, the markets have to grapple with what is happening on the ground right now. And what is happening is the shipping volumes, for example, are tanking, and you have the potential for layoffs. And I think we'll see that in the numbers this week. And clearly, there's a lot of supply chain uncertainty and repositioning that's taking place. So the market has to absorb all of that. But net, I would say, Matt, that if you zoom out from the day-to-day or the intraday market volatility, I do think you have a more constructive setup right now where technicals have corrected, and at the same time where I do think we've seen peak tariffs, and there's likely a path lower from here. We've heard it once again from Secretary Bessent this morning that China's tariffs are unsustainable, and they truly are. And when you think about the economy that's been built, in a way that supply chains are so globalized, you can't just unravel that all at once. So I think we have to roll some of that back. And at the same time, we're likely to have deals with South Korea and Japan and all of that. Maybe it's not going to dominate the news flow every single day, but I think that's the direction of travel. So my point is the end game is not where we are today, but it's something else and something better.
Well, Anastasia, let's talk a little bit more about this specific moment and how you use it, because Matt mentioned the uptrend. We've seen the S&P 500 post 5 straight days of gains, which maybe it didn't feel that way. You have JP Morgan on one side turning tactically bullish, but you have Goldman Sachs on the other side saying that they're actually turning or remain tactically defensive. They're using this sort of relaxing that we're seeing across asset volatility to add to hedges, to reload on some of those defensive stances. And I wonder if that's the move here.
Yeah. The way I think about it is, what's the time horizon for the money that you have at hand? And also, are you fully invested or do you have cash to deploy? So if the time horizon is short term and you're fully invested, yes, I do think that playing defense in the portfolio makes sense. And also, we've liked private credit to continue to, because you can get paid while you wait out this volatility. So that's for the existing portfolios, and still prioritizing things like staples and utilities and real estate, and actually anything that benefits from potentially lower rates. So that's the current stance, the short-term stance. But if you do have long-term capital to deploy, if you have cash on the sidelines, these are not moments, but these are periods of adjustments that you should use as an opportunity to add to long-term risk. So if the time horizon is 2 years, 3 years, 5 years or more, absolutely, it's not often that we get a 15% drawdown, an opportunity to deploy that cash. So for that pool of money, I would be looking to take more risk. It's just that I wouldn't expect a quick payoff on that in the next couple of months.
Yeah, speaking of quick decisions versus long-term potential pain, you had that Amazon reaction. We've been talking about it all morning since it happened, but then in the last couple of days, talking about Shein and Temu raising prices, particularly on U.S. goods. I want to point out also that the trade deficit this morning was a record. It was $162 billion. It was worse than anybody expected, more than all analysts surveyed by Bloomberg. Consumer goods being imported was a big part of that, front-running those tariffs. What does this mean in terms of the inflation situation heading into the rest of the year? Our own Anna Wong makes this great point that this is the time that retailers want to prepare for the holiday season and the rest of the year and back to school, but it's a tough time, and it could be through the end of the year.
And I think prepare they did. That's exactly what the playbook for a lot of retailers, a lot of companies has been. They've been fast-tracking a lot of those imports. If they're importing cost of goods sold, clearly they've been doing that in anticipation of the tariffs. So this is actually pretty good news, I would say, for the margins of those companies and also for the wallets of the consumers. This is why, for example, you look at some of the early reads on inflation in April, we're not seeing a huge pickup in prices because I think a lot of what's on the shelves today so far has been previously imported. And it's interesting, Shonali, the Dallas index that came out yesterday, exactly, something like 55% of the respondents said that they're going to increase prices, but the rest actually did not say that. And they're either going to use existing inventory or maybe they're going to onshore some production, although that was about 6% of those respondents. And then some others said that they're going to use inventory that they previously had or some existing production capacity. So the point is, you have the situation that we're expecting the core PC print this Wednesday to come out at 2.6% year over year. And you might actually see that inflation trend lower in the next, month or so. And if you couple that with labor market weakness, which I think we will start to see, that's the license to cut rates for the Fed.
And I mean, I think we're pricing in like 5 rate cuts.
Almost 4 through the end of the year.
Almost 4, Shonali says. And I believe her.
3.7.
Still, that's a full percent, right? So is that good news, or does this market say, oh, that's because unemployment's going to climb to 5%? That's bad news.
No, look, I think it is good news, and it is warranted, especially if you take all the political back and forth aside. If you look at the data itself, if you have inflation at 2.6% and the potential for it to trend lower, if you have the unemployment rate that weakens a little bit, if you have consumer confidence that's really near record lows and business confidence has plummeted as well, and by the way, you look at financial conditions, they've tightened significantly since the start of the year. So if you were just looking at that setup and that picture, what would you do as a Fed? You would likely cut interest rates. So I think the markets would welcome that. And if we do have to go through the trade and tariff uncertainty, if we can cushion that with rate cuts, which, by the way, that's what eventually happened in 2019 as well. And that's what ultimately turned the market back around.
Well, maybe we'll get some clarity from the Fed on that May 7th meeting. I don't think anyone is quite expecting that, though. Anastasia, it's great to see you. That is Anastasia Amoroso of iCapital. Meanwhile, let's take a look at some of the stocks moving underneath the surface right now, right after the opening bell. We'll do that with Isabel Lee.
Hey, Katie, we're looking at Hilton. So the company's boosting its adjusted EPS for the full year while lowering its net income guidance as the travel outlook wanes. So as we know, hotel companies as well as airlines really face a lot of uncertainties in the face of rising tariffs. You have the shares kind of flat now, aging 0.8%. We have the Hilton CEO saying that travelers are in a, quote, wait-and-see mode. The company did beat expectations for the first quarter, but that's before tariffs roiled the markets. Up next, we're looking at Royal Caribbean. So this is a different story. The company raised its profit outlook for the year. You see the stock there edging slightly higher by 0.6% as cruise demand continues to defy the increasingly dire travel situation. We have the company saying that bookings grew in April from last year and that cancellation levels are normal. The company also still sees full-year capex of about $5 billion. And last, we have JetBlue. So it's back to the gloom for us. And you see the stock there dropping by as much as 3%. So JetBlue Airways just becomes really the latest company to pull its full-year financial outlook following in the footsteps of Delta Airlines and others. So JetBlue focuses largely on domestic travel, which is mostly affected by the waning demand because of the trade war. The company said unit revenue, which is a measure of fares and demand, could fall as much as 7.5% this quarter. So that's not such a great look. Back to you guys.
Isabel, we thank you so very much. That is Bloomberg's Isabel Lee. Now Now, coming up, UPS announcing a plan to cut 20,000 jobs due to reduced Amazon shipments. We're going to take a look at the company's first quarter report next with Citi's Ari Rosa. This is Bloomberg Open Interest.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
All right, it's time now for Top Call. Some of the analyst action in focus this morning. And first up, Netflix upgraded to a strong buy over at CFRA. The analyst says that the streaming giant's recent results reinforce the view that Netflix has a unique competitive position, down a little bit today. Next up, this is a fun one. Hims and Hers cut to a hold over at TD Cowen, saying that shares could be range-bound with weight loss drugs no longer in a shortage. But that was before Novo announced a partnership with Hims to sell Wegovy. Not range-bound right now. Hims up about 26%. Maybe we'll get an update. Finally, ConocoPhillips cut to neutral over at Bank of America. Analysts say that Diamondback Energy has an edge over Conoco. Remember, the oil giant reports earnings on May 8th, Matt.
All right, May 8th, we will look forward to then for, we'll get Alex Steele on the program on May 8th. One stock on the move today is UPS. It is rising after announcing it'll be cutting, no, now it's down. It was rising. It was a little bit up, now it's a little bit down. They announced they'll be cutting 20,000 jobs in an effort to improve profitability. The Street likes that. It also beat first quarter revenue estimates. The Street likes that. But it said it can no longer tell us what's going to happen for the full year. It pulled its forecast, and the Street does not like that kind of uncertainty. Joining us now is Ari Rosa, Senior City Transportation Analyst. He has a buy rating on the stock with a target of $123. And Ari, I guess I want to ask how firmly you can stick to that target if not even UPS knows how this year is going to turn out.
Yeah, hey Matt, thank you for having me on. So it's a great question. Look, right now there are a lot of moving pieces, obviously, in the global economy. No one's really sure, and as you pointed out, UPS pulled its guidance, right? So that obviously makes it harder for us, and we kind of, we're shooting in the dark a little bit in terms of developing forecasts. Their earnings call actually just ended about 15 minutes ago, so we're going to go back to the drawing board and kind of try to adjust our estimates as best we can. And as I mentioned, we're kind of shooting in the dark a little bit. That said, look, the stock has been very beaten up. It trades at one of its cheapest valuations in a long time, close to a 7% dividend yield, which is near its highest in history. And one of the things that's really notable, the company did $1 billion buyback this quarter, which is significantly higher than what they do traditionally. And so they're kind of indicating to you that the stock is cheap. So we feel very comfortable with our buy rating. In terms of where the actual price target settles out, it's a little harder to say because, again, there are a lot of moving pieces. But I do think that UPS stock is quite cheap at these levels, and quite a lot of bad news is being discounted into shares.
Fair enough. I mean, the dividend yield and the buyback alone should also be good news in addition to some of the measures they're taking. But to speak to the uncertainty just a little bit more, how wide is your range of outcomes for this company, given the pressures around tariffs, given the pressures consumers might feel with inflation and what they might end up getting delivered? Do you have a set of outcomes from worst to best?
Yeah, absolutely. So it's a great question. As we think about the historical range, and we kind of try to develop our price targets based on obviously just a P target and then an earnings number. In terms of earnings, it's a lot harder to say where that might go. And again, there's variability around that. What we saw is in 2024, UPS actually had its worst operating margins in a decade. And so the stock had already been under quite a lot of pressure. We've already seen, idiosyncratic challenges, Amazon cutting down their business with them. We've seen their union got some pretty significant concessions when they renegotiated their contract about 2 years ago. And so there have been already a lot of pressures on UPS, and that's the reason the stock has been kind of soft over the last year or 2 years. But at the same time, in terms of valuation, the PE ratio now trades at a substantial discount to the broader market. And we don't think there's a lot of downside risk to that multiple. And so really then it becomes a question of what is the earnings number, not only for 2025, but what does really a more normalized earnings number look like? And look, we don't think that global trade is going to cease. We think there's going to be some sort of, I don't want to say benign resolution to the tariff, to tariff discussions, but it seems really hard to reverse these things that have been put in place over decades, right? It's not about one administration. It's not about, one country even, right? It's really about global supply chains are deeply integrated, and UPS plays an essential role in that. And again, that's the reason that we feel comfortable with our buy rating. It's the short-term call is tough. The longer-term call we feel a lot more comfortable on.
Does that hold for the entire transportation landscape? Because I'm taking a look through your notes. You write you prefer rails over trucks right now. So in that very integrated supply chain that you're describing, I mean, are some factors, some sectors of it poised a little bit better here?
Yeah, so the reason we prefer rails is, frankly, they're just better businesses, right? The rails have extremely diversified end market exposure, high barriers to entry, I would say almost impossible barriers to entry, really attractive margins. They generate a lot of free cash flow. Whereas truckers, it's low barriers to entry. It's extremely competitive marketplace right now, especially because really since the pandemic, you've had this excess capacity that hasn't been worked through. And that's put a lot of pressure on rates. It's put a lot of pressure on margins. And the net result is trucking stocks have been quite beaten up. So if you're looking for safety, rails all day, I think, are the place to be. If you're looking for that higher beta trade where you might see surprise upside, especially, frankly, if we get a little bit more of a downturn in the economy, you could see some of these marginal carriers start to exit the market, and that actually could be very supportive for rates over the medium term, which could in turn help trucker earnings. But definitely rails are kind of the safer, higher quality play in the in transports, at least right now.
Ari, we thank you so much for your analysis. That is Ari Rosa of Citigroup. Now coming up, Amazon shares are lower after the White House press secretary had this to say about plans for transparent pricing on tariff products.
I just got off the phone with the president about Amazon's announcement. This is a hostile and political act by Amazon. It's another reason why we are onshoring critical supply chains here at home to shore up our own critical supply chain and boost our own manufacturing.
Your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Bloomberg surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a check on what's going on in stocks. And we're looking at a little bit of negativity here, but not too much. You can see we're only off by 0.04% on the broader benchmark S&P 500. The NASDAQ is down 0.1%, probably because Amazon has a bigger weighting there. And it really is all about Amazon. I'll get to that in just a second. But you can see Tesla is also off and General Motors is down. We're hoping to get a reprieve for car makers and car parts today as President Trump goes to Michigan. Hims and Hers is absolutely soaring because they're going to offer Wegovy for the low price of $499 a month. So either you get a car or you get skinny. UPS is down but 0.6%, and Amazon, really the big news of the day after this company's attempt at transparency, giving consumers information on pricing, was attacked by White House Press Secretary Caroline Leavitt. Katie?
All right, let's talk about that with our Caroline Hyde. So this was according to Punchbowl reporting that Amazon would start showing these after tariff prices. Obviously, that has landed them in the crosshairs of this administration.
Yeah, no announcement. Amazon has not in any way confirmed that this is exactly what they were considering, but the Punchbowl report that is based on a person familiar is citing that they would indeed make it very transparent as to how much more expensive your goods are going to be. In fact, today Amazon wanted you probably talking about the Prime Day that's coming in July that they made an announcement on. They probably wanted you talking about the luxury store they're doing with Saks online, but no, we're now all focusing on whether or not they will really do what Caroline Leavitt is calling a hostile act, because that transparency is really going to make it very clear to consumers how much more expensive their goods are becoming. Now, remember, according to Bloomberg Intelligence, about 70% of all goods sold on Amazon come from China, whether that's largely through their third-party vendors, which of course are going to be looking to pass on some of those costs, or indeed Amazon itself, which has been trying to renegotiate if they've had deals coming due. We've heard from Andy Jassy doing interviews on other networks saying, look, we are going to renegotiate if that contract has come due. We're going to try and protect the consumer. And of course, that means, sorry, supplier, you're probably going to have to suck up some of this margin hit as well as us.
Yeah, your SPLC function on the terminal will show you just how much that consumer alone matters, 50% of the revenue, and of course, earnings after market on Thursday. But the follow-up question to Levitt was about Jeff Bezos' relationship with the president. What can you say of that, and can they essentially be told by the White House, bullied even, to turn this decision around? Of course, as you said, Amazon did not announce this. This was reported earlier by Punchbowl.
Bezos is the founder, but he's not running the business. Andy Jassy is running the business. Andy Jassy is the guy who's been on the phone to the White House and railing up to all of the new administration when we sat down with Andy Jassy earlier this year. So it's really up to him. Of course, the founder owns a lot of stock. Of course, the founder has, I'm sure, a lot of credence with Andy Jassy, who used to work for Jeff Bezos before he took the helm. So that's going to be notable. But as it stands, it's an independent company that's going to be running things as it sees fit.
Right, looks like Bezos does have a pretty big stake.
I would imagine so.
And a lot of sway.
He owns about a tenth of the company. We'll see if the president and Carolyn Levitt can scare him out of showing consumers how pricing works. Carolyn Hyde, thank you very much for joining us. Coming up in the next hour, B of A's Jill Carey Hall, then Rebecca Minkoff talks tariffs' impact on the fashion industry.
Why is Baltimore so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come. While we've invested in the convention center, the reason we focused on housing and getting rid of the vacant housing, the reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. Shares of Amazon are falling after the White House blasted the company today over a new tariff disclosure plan. Correspondent Michael Wallace has new developments.
Amazon will reportedly begin showing how much Trump's tariffs add to the price of each product.
This is a hostile and political act by Amazon.
White House Press Secretary Caroline Leavitt.
Amazon has partnered with a Chinese propaganda arm.
Treasury Secretary Scott Bessent acknowledged the tariff whiplash has created uncertainty for business owners and the stock market, but
certainty is not necessarily a good thing in negotiating.
He expects new trade deals with India and South Korea soon. Michael Wallace, CBS News.
UPS is preparing for what it expects to be fewer Amazon shipments because of new tariffs by cutting 20,000 jobs globally. Employees totaled 490,000 last year. Amazon is the delivery company's biggest customer. General Motors says it beat Wall Street estimates in the first quarter, but it's reassessing expectations for the rest of the year because of Trump tariffs. The car maker's chief financial officer, Paul Jacobson.
We're telling folks not to rely on the prior guidance, and we'll update when we have more information around tariffs.
The Supreme Court hears the case of an Atlanta woman today after FBI agents broke her door down, raided her house, and arrested her boyfriend, all by mistake. Legal analyst Thane Rosenbaum.
The family sued the federal government and the FBI agents, alleging Fourth Amendment violations. But two lower courts ruled that the agents were entitled to qualified immunity owing to the Supremacy Clause.
CBS Morning's Tony DeCopel went to the U.S.-Mexico border to speak exclusively with Homeland Security Secretary Kristi Noem, whose purse was stolen at a restaurant in Washington, D.C. Two suspects are in custody. Noem says both were in the country illegally.
People live in communities that have been going through this for many, many years. So the more that we can bring these people in and have them face consequences and get them out of our country, the safer America will be.
Tens of thousands of unionized county workers went on strike in Los Angeles last night. It's disrupting public services from healthcare and social work to libraries and parks. County Supervisor Chair Catherine Barger accuses the union of not bargaining in good faith.
I understand the cost of living has gone up and that the workers want to see more in their paychecks. But at the same time, we have a fiscal responsibility to make sure that when we write a check, you can cash it.
Workers are expected to end their strike tomorrow night. The Dow is up 184 points. S&P ahead 1. This is CBS News. A new reason to lay off junk food.
Ultra-processed foods like bread, cakes, and fast food are fine as an occasional convenience, but researchers say consuming large amounts increases your risk of an early death. In fact, each 10% extra intake of foods high in fat, salt, sugar, artificial sweeteners, and other additives increases your risk of dying before 75 by 3%. And the study in the American Journal of Preventive Medicine says ultra-processed foods are implicated in 1 out of 7 premature deaths in the U.S. Vicki Barker, CBS News.
Danish drug maker Novo Nordisk is rushing to cash in on a new market for its weight loss drug Wegovy. Now that it's no longer in short supply and compounding pharmacies have been restricted from making cheaper versions, the company says it'll offer its injectable through telehealth providers Hims & Hers and LifeMD. Shares of Hims & Hers are soaring on the news, and Novo Nordisk stock is also up. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast Live, and that's where you'll find us. Busy day coming up. We had some economic data came out today. So some consumer confidence came out a little bit weaker than expected. We'll break that down coming up. We're also going to check in with Nathan Dean, Bloomberg Intelligence Senior Policy Analyst on Trump's first 100 days. We have a lot of policy decisions coming up here. We got to get some legislation passed for this government funding and the tax bill. So he's going to be in studio. We'll break that down. David Welch, Bloomberg Detroit Bureau Chief. General Motors pulling their guidance, postponing their earnings date. Folks, that rarely happens. And it just shows you that they are scrambling to try to figure out what is the impact on their business from tariffs. They still don't know. Lee Klasko, Bloomberg Intelligence Transports Analyst, going to talk to us about UPS. They came in with some disappointing numbers there for the deliverer. So we got a lot coming up here on the earnings front and on the economic front. We'll get it all in there for you. Let's start off with Lisa Mateo and a Bloomberg Business.
And this Bloomberg Business Flash brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks, ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more to ibkr.com/around the clock. All right, like you said, more economic data out today. We have the JOLTS job openings for March. Expectation was for 7.5 million. Came in lighter at 7.19 million. And the Conference Board, consumer confidence for April. Survey was for 88. Came in a bit weaker at 86. Early this morning, wholesale inventories. Expectation was for a rise of 0.6%, came in up 0.5%. Then retail inventories, though, fell. The survey was for a rise of 0.4%, came in with a drop of 0.1%. To the markets we go, where stocks are starting to advance after more companies, though, pull their earnings outlooks for 2025 due to the impact of the trade war. Talking about companies like General Motors and JetBlue. General Motors down 2%. We have JetBlue off about 3%. UPS backed away from its 2025 financial guidance. The other news, it expects to cut 20,000 jobs this year, close dozens of facilities. It's been reducing shipments from Amazon. That's the reason for that. Its shares are down about 0.8%. So we have the NASDAQ up about 0.3%. The Dow up 0.5%. The S&P 500 up 0.2%. The two-year yield at 3.67%, down 1 basis point. The yield on the 10-year, 4.19%. That's down about 1 basis point. And the Bloomberg Dollar Spot Index up about 0.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa. Alex Steele here alongside Paul Sweeney. All right, let's get back to that consumer conference data here. So for April, coming in at 86, a little lighter than estimate, and a pretty decent decline from the month before. Joining us now is Stephanie Gouchard, senior economist at the Conference Board, on this data. Stephanie, walk us through your takeaway on this.
So yes, the index declined 7.9 points. It's now the lowest reading since March 2020, so since the beginning of the pandemic. And what's really driving the index down is consumers' expectations. I mean, the assessment of the present situation was a bit down by relatively stable, but the expectation index really fell by a lot. And the three components of that expectation index are in negative territory, which means that people are expecting business conditions to deteriorate. They're expecting the labor market to deteriorate. And very importantly, they are now also expecting their income to deteriorate in the next 6 months, which means that, the worry that they have been expressing recently about the economy, about the labor market, now they feel much more personal, and they feel like this is going to affect them personally in terms of income.
Real quickly, Stephanie, the job market, how does that impact consumer confidence?
So it impacts in two ways. It plays in the assessment of the current situation, and so far so good. The labor market has been weakening a little bit recently, but we haven't seen a massive increase in layoff or a massive increase in unemployment. So that component is quite stable. The other way it's affecting the index is via their expectations, and this is where we see a real decline.
All right, Stephanie, thank you so much. We appreciate it. Stephanie Gouchard, senior economist with the Conference Board. Again, the U.S. consumer confidence fell in April to an almost 5-year low on growing pessimism about prospects for the economy. Market drivers today brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor-to-staff ratio. Small firm attentives, big advisor impact. Go to commonwealth.com to learn about their consultative support and technology. So again, we've got the stock market moving higher here. The S&P is up 10 points, the Dow's up 188 points. Let's see where the action is under the hood with some of the markets. On stocks on the move today. We're joined by Bloomberg's Norma Linda. Norma, what are you looking at?
Well, there's a couple names I'm keeping in mind. I'm keeping eyes on Amazon. This is actually a big name that people are keeping an eye on this morning, and that's because the White House is saying that Amazon is, quote unquote, being hostile for saying that it's going to actually report how much tariffs are being calculated into the prices. So when people go on Amazon, they're going to see a product that they're going to purchase, and it's also going to additionally show how much of the cost for that product is due to tariffs. They're saying, Caroline Leavitt, she's the White House press secretary, she told reporters today that this is a hostile and political act by Amazon. So we are seeing Amazon shares a touch lower this morning, but I'm also keeping an eye on Honeywell. Now, this is one of the bigger gainers in the S&P 500 today by a percentage basis, and this is after the company lifted its earnings outlook, and it said that it's going to be shaking off the impact of tariffs. I mean, this is a really big deal for the sector when we think about aerospace and defense companies and just the broader uncertainty about how tariffs are really going to play a part in some of these firms. But the fact that they were able to raise their full guidance for their EPS, and also saying that it'll offset about $500 million in tariff exposure with their price changes and other actions, they're hoping to protect their bottom line. So, of course, this is great news for investors here.
Yep. Also, the company is planning to split into 3 separate companies, and that multi-pronged approach also helping to offset the tariff impact. We're wrapping it up here with Hims & Hers Health.
Yes, Hims & Hers, keeping an eye there. We have the stock surging. It's up about as much as 33% today. This is after a deal to sell Novo Nordisk's Wegovy at a bargain price. We know that Hims & Hers is really great for finding prices at a decent level in terms of a lot of these weight loss drugs. But the fact that they're going to be having Novo Nordisk saying that it will sell, that it was popular weight loss Wegovy, it's going to be a really good thing for the stock. And as we see, it is benefiting off of that. And if you look at Hims & Hers on a year-to-date scale, up about 49% so far this year. So great news for the stock.
All right, Nora, thanks a lot. Really appreciate it. Norma Linda joining us from Bloomberg News. For more conversations like this, listen to our Stock Movers podcast. Subscribe for 5-minute episodes and the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcasts. All right, in studio, this is a treat. This must mean something.
I know, it's big. Something's happening. Somebody's buying somebody a free meal today. That's what I'm guessing.
That's what I'm thinking. Nathan Dean, Bloomberg Intelligence senior policy analyst, joins us now. We have 100 days for President Trump. He's celebrating with a rally in Detroit and hitting the road. What does that signify to you?
Well, you know, I think what we're thinking about is what's going to be the next bigger thing for the markets, because obviously we've talked a lot about tariffs, but just this morning, Treasury Secretary Scott Bessent was talking about deregulation. So what we're doing is we're telling our clients that's probably the next biggest prong for the next 100 days, because there was a lot of sentiment coming into the election about deregulation, but there's no magic wand. You can't just say, poof, you know, deregulate.
There's no executive order for that?
Well, there are executive orders, but they're somewhat limited in what they can do. So you need to go through this rulemaking process, and you needed agency leaders to be put in place. Those agency leaders are now being confirmed by the Senate. And so in the next 100 days, we think the proposals, if you will, for a lot of the industries we cover, namely energy, technology, and financial services, these proposals are going to come out in the next 100 days. So he wasn't wrong when he said deregulation is coming.
So I was at an event last week in Oklahoma City, and the Interior Secretary said that they're going to change permitting days to 17 days. And actually maybe 14. Either way, that's nuts, from like multiple years. And if you include environmental permits, it'll just be a little over 20 days. And he said he can do that because President Trump declared a national energy emergency. Is it that simple?
It is for the energy sector. So out of the sectors that we cover, if you're in the energy space, you have to pay a little bit more attention to these executive orders like you were talking about, Paul. So when the Secretary of the Interior says they can cut these permitting times down, he can. But it doesn't work like that when it comes to financial services. So there's a lot of financial services investors who are like bank deregulation, think of cuts to capital requirements. That has to go through something called the Administrative Procedures Act. Long story short is it takes about a year.
All right, one of the other growth agendas I think that President Trump and his administration came into office supporting or proposing was just a continuation of the tax cuts, the 2017 tax cuts. Where are we with that whole legislation?
Yeah, so the House wants it wrapped up by Memorial Day. Speaker Johnson says he wants it done by Memorial Day. Treasury Secretary Scott Bessent said July 4th is the date that we're going to do it. We're telling our clients that we think it's going to come before the August recess, but the deadline you need to pay attention to is the deadline of the debt ceiling. And whenever that X date is, Treasury says they're going to have a new X date later this week, early next week. Our chief rate strategist, Ira Jersey, has it around late July. That X date is the date that the reconciliation bill most likely will get done, because if not, then they're going to have to do something else to raise the debt ceiling.
Do you feel that July 4th for passing a budget, et cetera, is that realistic?
I think it's feasible but difficult. So I think more likely than not, it's going to come in late July or before the August recess.
But was it one of those things where like you do July 4th and you don't let anyone leave because everyone wants to go away for holiday celebrations, but they make them stay? Is that the idea?
Yeah, and I think even if they don't get it done by August, they'll keep them around and say, look, you're just going to have to be in the 100-degree heat.
I'm a big July 4th guy. That would be good incentive for me if I were a lawmaker. So how are we paying for all this stuff? Because he's talking about more tax cuts, and it's in the trillions of dollars, and how do we pay for that?
Yeah, so there's really 4 pillars to this. The first one is you can increase the deficit, and this is what we think is the most likely outcome. The other 3 pillars are cutting Medicaid, SNAP benefits, the Inflation Reduction Act. And just because it's much easier to kick the can on the deficit and to vote for a deficit increase than it is to cut Medicaid or cut the food, the program formerly known as food stamps, we think that Congress, more likely than not, is going to say, let's take the deficit route and we'll just borrow today to spend for more later.
I mean, isn't that what we've been doing forever? So how is this one different?
Well, it's not, because Congress, at the end of the day, they think 1 to 2 year terms. They don't have to do with a 10-year treasury or anything like that. They think before the next election. And when Elon Musk comes in and says, look, I want to cut and get us back our fiscal house in order, majority of the payments that go out from the U.S. government are mandatory spending, Social Security, Medicaid, Medicare, and you need Congress to deal with that. And it's the third rail politics, because if you vote to say that I'm going to cut Medicaid or if I'm going to cut Social Security, then more likely than not, you may be out of office come the next election.
That's politics.
Yeah.
All right. Nathan Dean, thank you so much. We appreciate it. Nathan Dean, Senior Policy Analyst, Bloomberg Intelligence. Nobody does it better. And he works with us. He's on our team, so that's cool. And he was in our Bloomberg Interactive Broker studio today, so we appreciate that. Markets slightly higher here. The S&P's up 4 points. The Dow's up 130. And NASDAQ's up 20 points here. Again, some of the consumer confidence data coming in weaker than expected, and a 5-year low, actually. So, again, some of this uncertainty starting to creep into the hard data. We'll have more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. The S&P 500 looking for a 6th day of gains. This is ahead of more earnings. We have 44 companies in the S&P 500 reporting today, so let's get to some of them. Let's start with Honeywell. First quarter profit beat estimates, raised its full-year guidance for earnings per share, and is expecting to offset $500 million in tariff exposure with price changes and other options. And that has shares higher. Their shares up nearly 5%. Coca-Cola posted quarterly profit beat expectations. The company also said it expects tariffs impacts to be, quote, manageable. It also maintained its guidance for sales growth and profit. Its shares are a little changed right now. Kraft Heinz trimming its annual sales and profit outlook. Its shares are a little changed. And PayPal left its full-year forecast earnings unchanged, even after reporting a stronger than expected first quarter than analysts were expecting. PayPal is a little changed right now. Things are starting to change. That's two stocks now. We'll go to the NASDAQ, down about 0.1%, 21 points. S&P 500 down 0.1%, 6 points. And the Dow up about 0.1%, 77 points. So little movement in stocks this morning. We go to the Bloomberg Dollar Spot Index, up about 0.1%. The 2-year yield, 3.67%. That's down 2 basis points. The yield on the 10-year, 4.18%, and that's down 2 basis points. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from our interactive broker studio right here in Midtown Manhattan. Breaking news for you. This is according to the Washington Post. Amazon says that the plan to show tariff costs in a breakdown when you buy something is not a consideration. That was subject, of course, of the White House press conference that happened earlier today with Treasury Secretary and the White House spokesperson.
It's according to the Washington Post.
According to the Washington Post, yep. Amazon says that the plan to show tariff costs is not a consideration. We'll follow that as the news crosses. All right, let's get to earnings and go to GM. So regardless of the quarter, they pulled their guidance and moved their earnings call to Thursday. They also froze their share buyback, all on issues surrounding tariffs. David Welsh is Bloomberg Detroit bureau chief to recap some of those earnings. David, why did they push their call 48 hours? What are they going to learn in those 2 days?
As they were preparing last night for today's earnings call, there were reports coming out from us and others that the Trump administration would relax some of the auto tariffs, but there's no detail in there. There's some out there that they won't stack metals tariffs on top of auto tariffs, for example, and there could be some relief on parts, but until automakers look at the details and see exactly what they're going to have to pay and what they won't be paying, it's hard for them to forecast earnings and sales. And look, they have all kinds of ways to try to plan for tariffs, mitigate them, and also model out the impact on the business. And they can't do any of that until they know exactly what it's going to say. So I think what GM did is they looked at this and they just said, hey, the guidance that they had given out did not count really for any kind of major tariff scheme here, despite the fact that Trump had campaigned on it and said he was going to levy them. They gave guidance that had nothing to do with those tariffs. I think probably the tariffs are bigger than GM thought, much more aggressive than GM thought. So they've withdrawn the guidance, and they had a $6 billion share buyback. 2 of it's already funded and will be done in the second quarter. The other $4 billion is on hold, again, until they can understand what the tariffs will mean for their profits and their cash flow. So this is all about finding out what the details are and then trying to model and plan the business going forward, and they just don't feel they can do it right now.
What are GM and some of the other auto manufacturers doing now, David, in terms of, are they making any changes to production, to sales incentives, or is it just business as usual as they try to figure out what's going on?
There are small changes here and there. It's really difficult to change production or change your parts. I mean, you can't do that overnight. You can't. It can take a year to do that, let alone, we've been at this for a couple of months. But one thing General Motors has done, so they have 4 pickup truck plants. It's their highest volume vehicle, the Chevrolet Silverado and GMC Sierra. 2 of the plants are in the U.S., one's in Canada, one's in Mexico. Of course, those vehicles coming from Canada and Mexico are subject to tariffs, at least on the parts, the non-U.S. parts inside them, and that's pretty substantial. So what GM has done there is they've jacked up production at their Fort Wayne, Indiana plant to get more pickups out of there. They've just increased one. They were already running 3 shifts, but they've increased the line speed, so they're working it faster to get more vehicles out. It'll add about 50,000 trucks a year, and you know, that's one way to offset tariff production of trucks and sell American-made vehicles. And you're seeing stuff like that. You know, I think some companies may be slowing production of some vehicles that have tariffs on them because they either can't pass the cost on to consumers, or it's no longer as profitable to sell so many of them. So you may be seeing some of that stuff, but a lot of it's been business as usual. But you're seeing some small moves like GM has made.
Well, really interested to hear that call on Thursday. David, thanks so much. David Welsh, Bloomberg Detroit Bureau Chief, joining us there. So for the broader markets, the question is, where are those IPOs? Where's all the M&A? What happens to private markets? We heard that report, was it over the weekend, that Harvard wants to be offloading, was it Harvard or Yale? To offload their private equity slots because they really need the liquidity. Joining us now is Ted Swimmer, Head of Capital Markets and Advisory at Citizens Bank. Ted, what's your world like right now? Like, what are the concerns? What are the positives?
Well, good morning, Alex, and good morning, Paul. Things have certainly slowed over the last couple of months from an M&A perspective. As we entered the year, we thought with lower regulation, potential upbeats in earnings, that we were going to get off to a really good start in M&A, and it started out that way. There was a lot of really good activity going on, but since Liberation Day, we've certainly seen things slow down a little bit. It's hard to find a buyer and a seller who can agree on what the next 6 months, a year, 2 years look like, and therefore get concerned about whether they should ink a deal or not. After saying that, it is still very orderly out there. We're still seeing a fair amount of conversations going on. Our pipelines at Citizens have never been bigger, so there still feels like a lot of activity, a lot of discussions going on. It just feels like at the moment it's hard to get to an actual final contract on a deal. But it does not feel like the world, the ground is crumbling. It still feels like there's activity. We saw a couple of deals get announced last week. So it's not the end of the world, but it's still not as busy as we'd hoped it would be.
Ted, I know at Citizens Bank, you guys target, and a lot of your clients are middle-sized businesses, and a lot of folks are saying, you know, the mid to smaller companies, they might feel the tariff impact more than the larger companies, the Amazons of the world, the IBMs of the world. Are you hearing that from your clients, that, boy, we're a little bit more, this is going to be an issue?
It's certainly industry specific as we talk about it. I mean, we're in the data center space, and they're not all that concerned about tariffs, but certainly those who can work with China. We have customers who have drawn on their lines to try to build up inventory pre-tariff effect. So we've seen some higher loan utilization as a result of that. So yes, we're seeing and feeling some of that, but it's really very industry specific on who's having that impact and who isn't.
So what do you make of where the private markets are going to go? I just was mentioning how Yale wants to offload some of their private equity stake in order to get some funding and get liquidity. What are you hearing on that end?
This is a good market for private capital, especially on the loan side. With the banks backing up a little bit on being able to give certainty on underwriting positions. We're seeing some private capital reverse trends that we saw in the first quarter when the syndicated market was going more banks. Now private capital has a little bit more certainty on their deals, so we're seeing that. That impacts the leveraged loan market. On the offset, it gives banks a lot of ability to lend to the direct lenders, lend to the private capital, do equity issuances, do bond issuances as those markets come back. So it works in both ways, but we're seeing private capital have a really good opportunity to put some loans to work on deals that are a more difficult time getting done in the syndicated market right now. So there's some good and some bad, I think, with everything, with what's going on in the market right now.
You know, from my Wall Street days, I remember being taught early on that M&A activity in large part is based upon confidence and certainty. The more a C-suite and a board feels about their business, more confident they feel about the trends in the industry, the more aggressive they can be in terms of making a big capital commitment or making a big M&A trade. That doesn't seem like the environment we're in today.
Again, it's industry specific. So I would agree with you, Paul, in certain areas where tariffs or policy may have an impact. It seems like the M&A processes are being delayed a little bit till there's more certainty around what's going on. In other places, We feel very good about people needing to transact. What's different about what's going on here than we've seen in a lot of other markets is the loan market, the bond market are acting orderly. We're not seeing a time where there's not execution of deals. We've seen people go to the bond market today. We're seeing them go. We saw them go last week. So we're not in a frozen period of time. And so if you're in an industry where it's not going to be impacted by tariffs, we're still seeing not robust M&A flow by any stretch of the imagination, but we're certainly not seeing a shutdown of the market altogether.
What do you think brings back the animal spirits? Like, what specifically would we need to see? And I know everyone's going to say clarity on tariffs, but in theory, like, what is that your clients are like, press the go button?
I won't say what you just said not to say, which is clarity on tariffs.
I mean, everyone would like that, but something more concrete.
But I think
maybe.
as more of this goes on, look, there's still a lot of money sitting on the sidelines looking to make acquisitions, looking to expand businesses. I think corporates have a decent, I mean, we saw Global Payments last week make a very nice acquisition. So we're seeing some of that still go on in today's market. I think we will continue to see those non-tariff related businesses continue to make acquisitions. The headlines are M&A is down, and that is factually correct, but it is still, we are still seeing and feeling conversations going on in a lot of different industries, which I don't think it's going to take a lot to bring those deals to completion and continue to build some momentum into the M&A markets. I think there are going to be certain industries we won't see things happen for 6 months to a year or maybe longer. But I don't know that that's going to impact the whole M&A market like it did during COVID, or it did in 2023 right after the banks filed, or it did certainly in the Great Recession. I think we're in a different market and we're feeling different things right now. Again, we've seen transactions get announced even last week during all the noise that was going on.
How about the IPO market? Let's look at one, StubHub. You guys are named a co-manager on that deal. That seems like a deal that would walk out the door. Talk to us about StubHub as just emblematic of what's happening in the IPO market.
I think you need, in the IPO market, to really take off. That's where you really need confidence and you need consistency. There are a couple insurance deals that we hope to get announced shortly that we think would be another area that we could see the IPO market start to pick up. But it's still very tough to test the markets right now, with the fear that something in the middle of your issuance day would hurt create the stock. So there's a lot there on the sidelines. There's a lot there ready to go. StubHub is a good example of something that could go. I have no idea.
They've been maybe going, could be going for how long now?
Yeah. Again, but there are industries that are not going to be impacted like this that I think you will see, as soon as there's a little more stability in the market, test the markets and bring the markets out.
All right, Ted, really appreciate it. Thank you for coming in. Also great to see you. Ted Swimmer, Head of Capital Markets and Advisory at Citizens Bank, joining us in capital markets, IPO, private, all the good stuff. So I guess that's kind of the point, and we see it with the equity market too. It doesn't take a lot to move the needle anymore to the upside.
Yeah, and we saw just a little stabilization in the bond market, and then we had a lot of corporate issuance over the last 3 or 4 days, and people saying, all right, maybe this isn't the best of times, but it's a lot better than it was a few weeks ago, so let's hit the window. We saw a lot of issuers, including some tech names.
Yeah, come out. They got to do it. All right, coming up, we'll break down UPS halting its full year guidance, also laying off 20,000 workers. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got stocks advancing this ahead of another lineup of earnings reports today. We'll start with the Nasdaq up 0.1%, 27 points. The Dow up 0.4%, 166 points, and the S&P 500 up 0.1% or 8 points. The two-year yield at 3.66%. That's down 2 basis points. The yield on the 10-year 4.18%, and that's down 2 basis points. Heading to commodities, we have COMEX gold down about 0.6%, $3,327 an ounce. We have Brent crude down more than 2.5% at $64 a barrel. WTI crude, $60 a barrel. The Bloomberg Dollar Spot Index up about 0.1%. Want to jump back into earnings? We have Pfizer. The big news here is that it's cutting at least another $1.2 billion from its spending. Remember, that obesity pill failed, so it's looking for the next best thing. Demand for its COVID shot and pill have been falling too. But shares this morning, they are higher. They're up more than 1.5%. Now, we have two different sides of the travel industry. You have Hilton lowering its earnings forecast for 2025, growing uncertainty about the economy, kind of weighing on travel, but its shares are actually higher, up about 0.5%. What is booming is the cruise industry. Royal Caribbean raised its profit outlook, took record bookings in the first quarter, but its shares started to take a turn for the worse. They're down about 2%, and that's also pulling down shares of Carnival Cruise Line down more than 2%, and Norwegian Cruise Lines down nearly 2%. They both report tomorrow. After the close, we move on to Booking Holdings, also Mondelez, Visa, and Starbucks. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We cover all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. And want to focus on one of them, UPS. That stock is flat, but the company is cutting about 20,000 jobs this year in a pullback from Amazon. The company also talking about the macro uncertainty as well as it backed away from its financial guidance for this year. Lee Klaskow is Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst, and he joins us now. Lee, just break down for me what is UPS specific, like the Amazon stuff, which we kind of knew was coming, versus what is the macro specific?
If I had to break it out, I would probably say 95% of the, I guess, somewhat disappointing 2Q outlook is really being driven by the macro and not UPS. I mean, UPS, in our view, is and has been doing the things to kind of restructure its network to deal with the realities of their business and how much it's changed over the last couple of years. And they're also focusing a lot more on revenue quality. So that would mean trying to win more share of small to mid-size shippers. Also, you noted they're kind of gliding down, if you will, their exposure to Amazon, to some of their businesses. That just doesn't make sense. I mean, they're still going to do returns for Amazon, which is a good business for UPS from a margin financial standpoint.
Hey, Lee, what kind of visibility does UPS have on their revenue stream? Like, how much is contracted versus how much is just me walking up to a store and, shipping a package across the country?
That's a great question, Paul. I think the reality is that they have somewhat a decent visibility into their business a couple weeks out. I think that's really about it. That's just really because it's their customers are really driven by economic activity, and it's really tough to kind of really gauge those volumes, especially in the current environment, given the uncertainty driven by tariffs, which is why earnings expectations for the second quarter will probably start moving lower as sell-side analysts adjust their models.
But in theory, if we put aside the macro for a second, I appreciate you said 2/3 of it is macro. But the Amazon stuff is a good thing for them long term, right? Even though there's near-term pain, like those are lower margin packages that they don't want to do anymore. They're going to focus on higher margin packages that could wind up being much more stable and profitable, right?
Yeah, and I actually, said 95%, so it was a little more focused on us thinking that the majority of the shortfall in the 2Q is really the macro. But yeah, to your point, they are really they're really focusing on revenue quality. They mentioned on the call that some of their business out of Amazon's fulfillment centers just really wasn't profitable for them. So it obviously doesn't make sense to take that business. And if they're able to create capacity by getting rid of some of this business and filling it with what they call SMB, small to mid-sized businesses, that's just going to be a good thing for us margins overall, and it'll allow them to generate the kind of returns that they can reinvest in their network. Because while they're doing a lot of investing in now in automation, and they're closing some facilities just to be a little more nimble than they were in the past, they're still going to continue to have to make those investments because technology continues to change, and those benefits will need to be driven by those investments.
Lee, a lot of companies are saying, they're not necessarily seeing the impacts of tariffs now, but they certainly expect to in the coming weeks and months. You cover everything in shipping: rails, trucks, the ocean shippers, the air freight guys. You cover it all. Are you seeing it now? Because I've actually seen some reporting over the weekend that maybe fewer ships are sailing from China to the U.S. Are you seeing it anywhere in your space?
Yeah, we are. And to your point, bookings from China to the U.S. are down 30 to 40%, depending on which press reports you read. Some of that is obviously there was a pull forward effect in our view before the tariffs were going into place, so people were rushing to get stuff out. So we don't know really where that's going to lie. Shippers are going to they're going to take the stance where they're going to be like they're going to sit back and wait to see what happens. Some are continue to do business as usual, and they're just going to try to push off the costs associated with tariffs to customers, which obviously will be inflationary, or a mix of the two. So really, it'll be interesting to see how things progress. And at the end of the day, we might wake up tomorrow morning, there's no tariffs, right? So who the heck knows?
Yeah, but still, I mean, you have to wonder, though, how fast then the shipping industry can re-rate. Like, if there's like one ship hanging out at the LA port, all of a sudden tariffs go away, what does that wind up looking like?
Yeah, shipping companies can do a number of things to manage their capacity during ups and downs time. They can do blank sailings, which really just means they don't go to a port, they skip a port. They can operate slower, which actually is good because it can save them on fuel. And in a worst case scenario, they can just take the ships out of the water because that can be costly. And also, a lot of them, they lease their capacity from other companies. So, once those leases come up, they can just return the ship to the owner of that ship.
Haley, I know you cover rail and truck companies that do a lot of business across the Mexican border. What are you seeing there these days? Or what are they telling you?
Again, there's a lot of uncertainty. They saw a kind of a surge in demand ahead of the tariffs. There is a lot of exemptions in tariffs between the U.S. and Mexico and the U.S. and Canada. So, they are not as punitive as they are with China. So, that might be more of an inflationary aspect versus a stopping of flowing of freight. But the problem is that, if some of the supply chains get mucked up from the tariffs on China, that could impact manufacturing in Mexico and manufacturing in Canada, which will therefore, impact cross-border volumes overall. So there's kind of a wait and see approach here. I know that's not what people want to hear. They want certainty. But given the more protectionist policies out of Washington and how they can change on a dime, it's really hard to get that certainty. So hopefully in the coming weeks, we'll get some better definitive outlook on where these tariffs are heading.
It's funny. I don't even know what certainty would be anymore.
Yeah.
I mean, if the line seems to be it's negotiation, so how do you get clarity in a negotiation? You can't. It's just the end game.
Right. You just have to. So I think what the answer is just get some agreements with some of the big trading partners.
Right. Like you get one or two, even if it's like a memo of understanding, like at least it's a framework. All right, Lee, thanks a lot. Really appreciate it. Lee Glasgow, Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst on UPS earnings. Natasha Kaneva, she runs the commodity research arm over at JP Morgan, said that there's no Trump put. when it comes to energy. He wants those lower prices, ... Can he get them? So what does that mean for oil producers? We're going to have more of my conversation from some of the top CEOs in the industry from the Ham Institute for American Energy over at Oklahoma State. I was there last week. Devin, coming right up. This is Bloomberg.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Hey everybody, I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio, broadcasting to you live from our interactive broker studio right here in Midtown Manhattan. So last week, I attended Powering AI Global Leadership Summit at the Ham Institute for American Energy at Oklahoma State University, and there were some of the biggest names in the energy space there. And one of them is Clay Gasper. He is the new CEO of Devon Energy. He took the helm in March, and he recently announced a very large business optimization plan, basically trying to raise some money, increasing their free cash flow by about $1 billion to improve their margins. Here's part of that conversation.
We're excited about this business optimization plan with the change in CEO. We're really trying to take full advantage of this opportunity. My belief is there's always another gear to grab, and I think really focusing the company on something like free cash flow and the durability of that free cash flow really excites the organization, and we're finding lots of opportunity there. We have a goal for $1 billion by year-end 26, and we feel really good about being able to achieve it.
Where are the areas where you feel like you have the most control and can really wring out more efficiencies?
On the release we did a few days ago, we set out 4 categories, but one of them is reorganizing around the gas processing and transportation fee structure. And so what we're going to do is reach out to our counterparties, renegotiate some of these opportunities. We're seeing a real material drop in cost for us and benefits we're able to accrue to them as well.
Oh, that's nice. And then also, is it just sort of back of the office also, just sort of moving operations around and becoming more efficient as well?
So excited about AI. We're here at the AI conference. I think one of the things that really excites us is how do we apply technology to our business with a renewed focus. One of the changes we made organizationally was promoting our Chief Technology Officer to the Executive Committee. And part of his charge is think about all of the things that we're here to solve through a technology lens. And so I think a byproduct could be some reorganization, efficiency, how do we apply that technology, but it's more about the focus on the free cash flow and not necessarily starting with an organizational change in mind.
Now, you're not 2 months yet into this role, right? So this is a really big change, and you're just taking the seat. It's been a crazy couple months also as a backdrop for where you sit. Why did this kind of plan make sense now in this environment?
It's a great question, and some people have said, wow, you really timed this well with all of this chaos in the market. And I said, well, obviously we started much earlier than this current set of issues that we're facing. But I think, you know, the tariffs and the environment that we're in, this is a perfect example of why we need to be exceptionally good at these things that we're talking about. The durability and the sustainability of our organization, you know, we ride a roller coaster. That's what we've signed up to be part of. And to make sure that we never know when or how deep these roller coaster dips are going to be, but when they come, that we're really, really ready for it, starting with our financial footing, our operational savviness, the portfolio, and then most important, having a really strong organization that can make the most out of the opportunity.
So based on that, when we see volatility in oil prices like this, volatility is never great. It's hard to make business decisions. It's hard to know where to invest money, et cetera. How does this optimization plan help offset that?
Well, it's interesting. We are in a very dynamic part of the oil
That's
business.
a nice way of saying
dynamic, yes. You know, currently about $62 front month. Interestingly, we run our mid-cycle pricing at 65, so it's not a very far disconnect from where we think about how we're doing our business. The volatility, as you pointed out, can be a real headwind, though. When we see a lot of just movement in the market, it causes a little bit of pause. Not as much internally, but certainly with our investors, with our counterparties, all of the partners that we do this symbiotic business with. You know, that angst can cause a little bit of headwind in us ultimately accomplishing what we're trying to accomplish.
So is it fair to say that you don't want to be growing? You want to just optimize what you have? Is that my takeaway then from this?
I think in this mid-cycle price deck, we're committed as a business case to a 0 to 5% growth, which is a low, kind of moderate growth. We've been closer to that 0, call it 0 to 2%. And that's more about the macro, thinking about, is the world demanding more of our product? The way we see it now, the world is very adequately supplied. We contribute to it. We need to make sure that we maintain our ability to continue that productive volume that we have. But we don't see a need to really push more onto the market that doesn't really feel like it's demanding it.
That doesn't really feel like pumping a lot of oil at $50. That was Clay Gasperry's CEO of Devon Energy. Now, yes, they already announced this sort of optimization plan before any of the issues of the tariffs, but it just goes to reflect oil in the low 60s. You can talk positive, but that's really rough if you're a producer.
And where would they like it to be? Is it in that 70s, 80s?
So Harold Hamm told me about a month ago 80.
80.
And then at this conference, he told me 75.
Okay.
So, and the White House told me, 50 continuously. And then at this conference last week, Christopher Wright said 65. So maybe we're going to somehow meet in the middle. But either way, I mean, if lower prices are sort of where you need it to be, and that's why the industry is moving towards deregulation. Now they're singing that tune because maybe that will wind up helping, even though oil prices at the margin are still low.
Right. And what about transportation in the pipelines? It's still almost impossible to build a pipeline today.
Well, they're trying to change it.
Okay.
I mean, they're trying to get fast-track permitting. If you have a national emergency, Secretary of Interior Doug Berman said that lets him do stuff. So it's the EPA and it's the Interior. Those are the two departments that are going to really define that for FERC.
So do we have declared a national energy emergency?
President Trump has.
Okay.
So he says because of that, they can lower permitting rules ASAP. And even with environmental permitting rules, all of them can be below 30 days. Cheering when he said this.
Here's some real important news on the energy and gas front.
Landman 2, season 2.
Landman has been cleared, approved
Renewed,
for season 2.
Uh-huh.
So that's big.
That is big.
Just letting you know.
I wonder if they're going to do some pipeline stuff on
Yes,
that. Anyway, all right. For our listeners in the U.S., here is a reminder. You can listen to us via satellite radio on Sirius XM, channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM, channel 121 is presented by Ship Station. Stay tuned for the latest market news and industry research. The second hour of Bloomberg Intelligence starts right now. Now you're looking at a market relatively calm on this Tuesday. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Tuesday, everybody. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We have a great second hour lined up for you. We're going to hear from Goldman Sachs CEO David Solomon. He spoke exclusively to Bloomberg News over in Europe. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist, will be joining us. It's sort of your bond and your Fed and your jobs preview. Ben Miller is co-founder and CEO at Fundrise. We're going to get the state of the commercial real estate market. And David Gura, correspondent for Bloomberg, will be joining us. He's the host of the Big Take podcast, talking about Canada and the election outcome there. And finally, Poonam Goyal is senior U.S. e-commerce and retail analyst. She'll be joining us from Bloomberg Intelligence, and Elliot Stein of Bloomberg Intelligence as well. They have a great tariff impact matrix thing. That's what I'm going to call it. It's the thing, and they're going to help break it down for us. It shows you where all the tariffs are and how they impact different industries. It's a nice place to put it all together. Yeah, because I sure can't do that. So we have a great hour lined up for you, but let's kick it all off for you right now with the Bloomberg Business Flash. For that, we go to Charlie Pellet.
All right, hi, thank you very much. And here's what's going on. Best level of the morning right now on the S&P 500 index, up 19 now, up by about 0.4%. We got the Dow Industrials up 279. That is a gain of 0.7%, while the NASDAQ Composite Index right now up 54. That's an advance of just about 0.3%. Whole lot more on the markets coming up in just a moment. Your 10-year 4.18%, the 2-year 3.66%, spot gold down 1%, 33.12 the ounce, and West Texas Intermediate crude down 2.2%, WTI 60.70 a barrel, Bitcoin just above $95,000, up now by about 0.6%. Consumer confidence, as measured by the Conference Board, fell in April to an almost 5-year low on growing pessimism about prospects for the economy and labor market due to tariffs. Stephanie Guichard is a senior economist at the Conference Board, and she was a guest right here on Bloomberg Intelligence.
What's really driving the index down is consumers' expectations. I mean, the assessment of the present situation was a bit down by relatively stable, but the expectation index really fell by a lot.
Stephanie Guichard of the Conference Board, interviewed right here on Bloomberg Intelligence. A major change in that Amazon story. The stock right now down 0.5%. Amazon says it never planned to widely display the cost of President Trump's tariffs on products after the White House blasted the reported move. Again, recapping, U.S. stocks are trading higher with the S&P right now up 19, up there by 0.4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Alex Steele and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast Live, and that's where you'll find us. As Charlie was just reporting, stocks generally moving higher. Let's take a look at some stocks on the move today. We're joined by Bloomberg's Denitsa Sakova. Denitsa, what are you looking at?
Let's start with Amazon. Obviously, there has been a big turnaround story, but we just saw UBS cutting the target of Amazon to $253 from $272. It maintains the buy rating. What has been happening today brought the stock down as much as 2%, but it's still underwater. Of course, Amazon says it was never under consideration to display the cost of tariffs on products. What we saw earlier today is reporting that this was indeed the case. And the White House press secretary said that this is a hostile act. And obviously there is a lot of volatility with the stock. And we saw retailers like Shein, we saw Temu, we saw a lot of discussions of how are they going to display those prices. And that is really an important thing for consumers. We saw that the questions at the press conference was like, does that mean that consumers will indeed pay more? So a lot of pressure there. The stock is still down for today, but of course, a lot of the earlier losses are reversed.
Yeah, and you mentioned Raymond James downgrading the stock head earnings,
yeah,
right? So
UBS, downgrading.
Yeah, so just like a double whammy there.
Yeah.
Shopify, what's going on here?
Yeah, with Spotify, shares stumbled as much as 8% in earlier trading. Some of that losses have reversed. The streaming company reported operating profit that missed estimate. That said, the report wasn't bad. We saw a big gain in subscriber, which was way more than analysts expected, and the company predicted. The subscribers reached 268 million, which is a 12% increase.
That's amazing.
Yeah, it's really good. We know the company has been pushing into audiobooks, podcasts, even video content to compete with YouTube. But of course, that has come at a price. We know that they raised their subscriber fee to $12 a month, but that has been helping. The stock is up 25% year to date, despite the pressure we have seen today. Still a very strong year after 2 years of more than 100 gains.
All right, anything else?
We have UPS. The stock is down today. We're seeing some pressure. Even in earlier trading, we saw some gains. The company expects to cut 20,000 jobs this year as it dramatically reduces shipments. Again, we were talking about a lot of pressure from the administration. The industry is grappling with new challenges. Of course, the tariffs. They have really complicated the cross-border shipments. And UPS is a very good gauge of how things are changing. UPS aims to cut expenses, improve profitability, and the network reconfiguration is expected to generate about $4 billion in cost savings. So that's definitely some relief. The stock has stumbled about 23% year to date. So the small gain today is a little bit of relief.
All right, Denitsa, thanks a lot. Denitsa Sakova joining us there. For more conversations like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcasts. All right, some two headlines crossing here. Russian President Vladimir Putin said to demand control of 4 Ukraine regions at U.S. talks, Paul. So you have Putin demanding control of 4 Ukraine regions at U.S. talks.
At least they're talking. That's kind of how I view this point.
Also, want to point out here that ransomware hack is now said to be the cause of a Marks and Spencer outage. It was hit with Dragon Force malware, shutting down key systems. You keep hearing that. Cybersecurity is the #1 issue.
Right. Absolutely. It's going to be a growth business.
Exactly, right? Okay, let's get more from some of the top newsmakers. Earlier today, Bloomberg's Francine Lacroix spoke exclusively to Goldman Sachs CEO David Solomon at the Norwegian Wealth Fund's annual summit conference in Oslo. When asked about the recent market volatility since Trump's inauguration, he says we need another 100 days before we have a better understanding of the policy direction.
We're 100 days in, and I would say there are a handful of policy initiatives that are being put forward. Some of them certainly are very, very interesting and intriguing to the market. But what's been put forward on trade so far has raised the level of uncertainty very significantly. And so I'd say 100 days in, we need another 100 days to kind of see where the policy directives are going and to try to have a better understanding of how what's talked about so far, particularly with respect to trade, is ultimately going to be put in place, how it's going to play out. But the policy actions to date have raised the level of uncertainty to a degree that I don't think is healthy for investment and growth. And I think it's going to be important that we get more clarity on the direction of travel from here.
What, for the markets? So if you look at markets, there's been a sell-off, a pretty dramatic sell-off in U.S. assets. It's somewhat come back, but has it been too drastic?
Well, it's not just for the markets. You know, first and foremost, it's for businesses, it's for individuals. When there's a high level of uncertainty, people tighten their belt. They invest less, they spend less, and all those things slow down growth. And so, you know, one of the things that has happened over the course of the first 100 days is that the perspective on forward growth has been decreased. And so when you decrease, that perspective on forward growth, that changes investors' perspective of equity values. So what we've seen is a relatively orderly kind of repricing of equity assets. And what's unusual in the context of this repricing is generally when you have that kind of equity market stress, people run to treasuries or safe haven, but here we're seeing a slightly different rotation because of the nature of the policy. We've seen a weakening of the dollar, at the margin, and so that's been different than I think what people expected.
Well, are treasuries still a safe haven?
I think U.S. Treasuries absolutely are a safe haven, but you can reprice a safe haven asset as people's preferences shift slightly. I think at the margin, we've had for a long period of time a trend of capital flows into U.S. assets. And, at the margin, people are looking at their portfolio constructions and saying, given the uncertainty that's been raised in the U.S., do we want to rebalance that a little bit? And I'd say the rebalancing so far has been at the margin. Investors can rebalance their portfolio in two different ways. If you're over here in Europe and you have a European investor, they can sell U.S. assets, but also if the relationship between the dollar and the euro changes, that rebalances their portfolio weighting too. And so we've seen that over the course of the last few weeks.
All right, that was Goldman Sachs CEO David Solomon speaking with Bloomberg Television anchor Francine Lacroix at the Norwegian Wealth Fund's annual investment conference in Oslo. So very interesting comments from Mr. Solomon. Let's get back to this Treasury market. I'm looking at the 10-year Treasury. It's up 30 seconds, pushing the yield down about 3 basis points, 4.17 on your 10-year. The 2-year, 3.66. So rates coming down. Let's see what the rates markets are telling us. We had some economic data today. The consumer confidence came in weaker than expected. The weakest in 5 years since back in March of 2020. So some big moves there on the eco front. Ira Jersey joins us, chief U.S. interest rate strategist for Bloomberg Intelligence, safely ensconced in the offices down in Princeton, New Jersey. Ira, what did you make of some of the economic data we got today, including the JOLTS data? And we got a bunch today. How do you think the market's reacting to it?
Yeah, not fantastic by any stretch of the imagination, but the JOLTS data wasn't terrible, really. But the confidence data is certainly, concerning for the forward outlook. The thing that we've seen, Paul, and we've been talking about this for a long time, and you continue to see it in the data we received today, is that the hard data, so things like JOLTS, is okay, not great. But then you see the confidence data, the survey-based data, seems really bad. So the fear here is that when do consumers and businesses and others actually pull back from the economic activity that they've been doing, and does that push us into a recession or at least a deep slowdown sometime later this year, causing the Federal Reserve to cut rates? And that's why you're seeing this little bit of bull steepening today, where you have short-term rates going down faster than longer-term rates.
I'm looking at 4.17 on the 10-year. We're below that 200-day moving average. Where's the next stop here?
Yeah, 410 to 413 is a very important range for the 10-year yield. Below that, you're probably looking down at below 4% as the next stopping point. Importantly, and I think that one of the things that you've seen over the past couple of weeks, and I think it's something that will continue to be the case, is that I think the beta of the long end is going to be lower than the beta of the front end. What do I mean by that? Well, if 2-year yields continue to rally, say another 15, 20 basis points, then you might only see the 10-year rally another 5 to 10. So you have a situation where the yield curve could bull steepen as the market gets more and more convinced that the Federal Reserve is going to cut interest rates, and you can get a pretty significant steepening of the curve. And quite frankly, that's something that we had expected all year from the beginning of the year. We've gotten some steepening, but it's really been from both ends. So this twist idea of steepening, and that's because of the the angst we had in the long end that we talked about last week.
So Congress is back in session. Supposedly they're going to start talking about and working on a tax bill, a budget, all this kind of stuff, and that naturally leads to discussions about deficits and the national debt. But I don't know. A lot of people just tell me, Ira, as long as people show up at our Treasury auctions, don't worry about it. How are our Treasury auctions doing?
Well, there's 3 pieces to what you just said. So we can take them in reverse order. So last week we had Treasury auctions, and they were a bit weaker. I'd say kind of middle of the road in terms of overall demand. Not absolutely atrocious, but also not particularly good. And so people did show up to those. Tomorrow morning we actually find out how the government's going to fund over the next 3 to 6 months that the continued deficits that you just mentioned. And that's at 8:30 tomorrow morning, where we get what's called the Treasury quarterly refunding announcement. And they'll tell us how many T-bills are going to issue, how many, and what the size of those coupon auctions are going to be in order to refund all of the maturing debt as well as fund new debt, which I don't suspect that there'll be any noise really tomorrow about that. It'll be more interesting from a forward basis. There is a concern that you're going to need higher yields than you might think in order to attract buyers. But here's the good thing, Paul. Everyone else's yields are going down faster than our yields are. So if you're a Taiwanese investor or a European investor, or, well, maybe not so much a UK investor, their yields are about the same as ours. But if you go to a lot of those other jurisdictions, you might actually find the U.S. has continued to be the high yielder. So therefore, you still might have significant incremental demand as long as hedging costs aren't too onerous.
That's so interesting. On the flip side, though, you can make the argument that, say, Germany, for example, is going to be spending a lot more fiscally than the U.S. Therefore, they'll have higher borrowing needs, which potentially mean higher yields. You see the opposite, though?
Well, for now, because the European Central Bank seems to be a lot more dovish than the U.S. And, you know, I was actually talking with Hugh Worthington, who's our European strategist, this morning. And one of the things that he mentioned was because of the tariffs, it's very possible that a lot of Asian and goods producers might wind up dumping their goods into Europe, and that could actually lower their inflationary outlook. So that means that they could have even lower interest rates, even with Germany issuing a lot more debt than they were before. You know, ultimately, that debt that Germany is, that's probably a yield curve steepener, but you could still have Germany with much lower rates, you know, several hundred basis points lower than U.S. Treasury yields.
When do you think the Fed will cut? And is that a given that they will?
Well, it's not necessarily a given, but I think it's more than likely. So our view has been, and I still subscribe to this, is that they're probably, in my view, not going to cut in June unless the data is absolutely atrocious the next month and a half. But it's more likely that they wait until they have to cut, and then when they cut pretty aggressively. So we're looking right now. We have penciled in kind of a November start. So they go November, December, January, and March next year. That's another 100 basis points. We go to exactly where we're currently priced. We just, instead of getting there, 25 basis points a quarter, we get there over the matter of just 3 or 4 months.
Do we think that the jobs data this week will help lead us there in any way?
It always has the potential to.
It's always laughing.
Yeah, well, it's it's the non-farm payroll data that we're getting for April. Like, we had all this market volatility in April, but it's not like people started to lay off a lot of people this month just because we wound up getting a lot of headlines. So these things take time to develop, which is one of the reasons I suspect that the data is not going to show that we have a big slowdown in the job market until the second half of the year, and that's why I think the Fed will be a little bit reluctant to see what happens with the tariffs, how inflation is going to develop, and you still have some of the survey data still showing that consumers think that inflation is going to be pretty high, and if that's the case, then the Fed is going to worry about inflation expectations becoming unanchored, and that's what you're probably going to hear from Jay Powell next week.
All right, Ira, thank you so much. Really appreciate that. Ira Jersey, Chief U.S. Interest Rate Strategist, Bloomberg Intelligence. Coming up, we're going to check in with Ben Miller, co-founder and CEO of Fund Rise, on the state of commercial real estate. Then we're going to check in with David Gurr, correspondent for Bloomberg and host of the Big Take podcast. He's been up in Canada the past few days covering the election of Mr. Carney. Good news is Mr. Carney won for him, so it's good news for him, but not much of an edge there. So look at the latest reporting. That's coming up.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. We got the S&P 500 index holding on to gains, extending its advance into a sixth consecutive day. Right now, the S&P 500 index higher by 4. We're off session highs, but still up 0.1%. The Dow up 193, now up 0.5%, while NASDAQ is lower by 7, a drop there of just under 0.1%. The 10-year yield 4.17%, with the 2-year currently yielding 3.66%. Spot gold down 1%, 33.10 the ounce, and West Texas Intermediate crude down 1.6%, 61.04 for a barrel of WTI. Bitcoin up $300 at $94,801, higher by 0.3%. General Motors shares lower by 2.2%. GM withdrawing its earning guidance for 2025 and putting $4 billion in share buybacks on hold because of uncertainty around U.S. tariffs. And economic bellwether UPS expects to cut about 20,000 jobs this year and close dozens of facilities. UPS up 0.1%, rival FedEx down 0.9%. And just getting word that Wells Fargo has announced a new $40 billion stock buyback program, sending its shares higher. Wells Fargo up now by 1.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pellet, thank you so much for that. We appreciate it. Alex Steele and Paul Sweeney live here in our Bloomberg Interactive Broker studio, and we are streaming live on YouTube. So head over to youtube.com and search Bloomberg Podcast Live. That's where you'll find us. If you listen to this program, you know Alex and I really like to stay on top of the commercial real estate business. Certainly one of the businesses that was impacted dramatically by COVID, and is now long recovery here, now in the midst of higher interest rates. Today, we're going to check in with Ben Miller, CEO of Fund Rise, joining us from Washington, D.C. via Zoom. Ben, I think when you look at the stock market, the bond market, the commodity markets, you know, the common word is probably just uncertainty out there, volatility out there. How about the commercial real estate market? What's the last 3 months been in that space?
The irony for real estate is bad news is good news, because interest rates have been higher for longer for the last few years. That's been weighing on real estate, especially commercial real estate. And so anything that brings down rates is going to be a boon for commercial real estate owners. And so uncertainty, tariffs, recession, those are all great words for real estate industry.
So that driven primarily by lower rates, I get that. Where do you think the best opportunities are here in commercial real estate?
Well, so the functional effect of tariffs is that it makes existing assets worth more. So my analogy is always, if I had 1,000 cars on my lot, if I was a car dealer, and I had 1,000 cars on my lot, and I put a 50% tariffs on all new cars, right? All those existing cars, all the car inventory on my lots across the country would be worth more because the price just went up. And so all the existing inventory of apartments and other assets are going to be worth a lot more with tariffs. And so it's a tax on flow, and it's a gift to stock, if you know what I mean.
But what about the volatility? So rates are one thing, stock is another, but the volatility and uncertainty, how does that affect sentiment in your market?
Yeah, I mean, real estate is a much slower moving asset. It doesn't trade very often. People don't renew their leases very often. So it's much more, it has much more insulation from volatility. I mean, because you can't really trade it, that volatility doesn't matter as much as it does for stocks or bonds.
Ben, if the uncertainty, not necessarily the tariffs per se, but if the uncertainty pushes or slows this economy dramatically, maybe even pushes it into a recession, that can't be good for real estate.
Well, it depends on the kind of real estate you mean. So office, which has already been hit by work from home, is very pro-cyclical. So people only expand office space and new leases when the economy's hot. If the economy's cold, office is going to get hit again. I think office could go from bad to worse. But consumer staples like food, groceries, housing, you got to live somewhere, you got to eat something. Those actually end up doing pretty well in a recession. And so multifamily housing, I think, will really outperform, and low rates matter a lot more than the economy. And so if rates come down, like I think they will, it's going to be a win for most commercial real estate.
Yeah, and then in terms of construction and new building and materials, like either that's going to get a lot more expensive, or as we were talking about, that's going to get a lot tighter, which then if you own already those buildings, that's better, right? What are you seeing right now currently?
Right. I mean, there was a absolute housing boom in 2021, 2022, because rates were so low and the demand was so high. And so we just are working our way through, I think, the largest supply of new housing in decades. So that hit the market last year. It'll be sort of done by the end of this year, and then we'll kind of fall off a cliff, and we'll end up with no new construction, high rates, expensive construction costs, tariffs, uncertainty, bank lending still pretty tight. I think we'll see sort of the end of new construction for maybe this decade, and that's great for owners and maybe bad for renters.
Ben, talk to us about Florida. It's been a market that really just goes up and down. It's had such a multi-year growth spurt coming out of the pandemic. What's the state of the Florida, I don't know, the apartment market, any of that kind of stuff?
Yeah, I mean, Florida got hit by climate change too. I mean, it was a really big hit on insurance costs. It caused a lot of owners to have second thoughts. The short-term effect of a lot of new supply in the market and insurance costs hit Texas too. Texas had a lot of challenges. So those two markets have sort of the most growth and had the most negatives. And in the short term, I think Florida really doesn't look as good as some of the other parts of the Sun Belt, like North Carolina, South Carolina, Georgia. But in the more medium term, Florida and Texas just get so much more population growth than any other state. I mean, between the two of them, they get over 1 million people a year moving there. And that over that 3 to 5 year period between migration and population growth, I think that Florida and Texas will be just fine. But in the short term, it's not that pretty.
All right, well, we appreciate the update. Let's keep talking and see kind of how this all evolves. Ben Miller, co-founder and CEO at Fundrise, on the state of commercial real estate, the largest direct-to-consumer alternative asset manager in the U.S. Over 2 million active users, over $3 billion in lots of assets like real estate, private equity, and private credit. Thank you very much. All right, let's head to Canada now. You have Mark Carney's edge slips as Canada's election comes to a hectic end. He won, yet by a very, very, very thin margin. David Gurr, correspondent for Bloomberg, host of Big Take podcast. I should say that his party won, but walk us through the results, what we know.
Yeah, an incredibly close race. So Mark Carney emerges here with a mandate, but it is not a majority mandate, which is what he and his party wanted. So what that means, in effect, is in the coming days, he's going to have to figure out how he's going to work with other political parties in this country to pass his ambitious legislative agenda, so much of which centers on the economic predicament this country is in, and of course the trade war this country's engaged with the U.S. on. And so what Mark Carney said over the course of this campaign is he intends to win that trade war. He intends to go to Washington, present himself in a meeting with President Trump as somebody who's not going to back down on Canada's position in that trade war. That's what we're going to be watching for here in the coming days, when in fact that meeting takes place. Again, it's something that he promised would happen in short order. We'll see if that's in days or weeks. But two things sort of upended the course of this race over the last couple of months. The first of which, of course, is Mark Carney becoming the leader of the Liberal Party. The second of which was Donald Trump returning to the White House in Washington and attacking this country really on two fronts. One on the side of trade and the economy, the other, of course, on the country's sovereignty. And Mark Carney has said from the get-go here, he never found those remarks from President Trump about Canada becoming the 51st state as any kind of a joke. He took it seriously, and that is something he said over and over again, Alex and Paul, is not negotiable.
So talk to us about conservatism in Canada. Is it as vibrant as it is in the United States, as it is in some European countries like Germany? Is it to the point where anybody in Canada would be okay with being referred to as a 51st state?
That is definitely not the case, but you bring up a really interesting question. That is, where does the Conservative Party in this country go from here? So Pierre Poilievre, the leader of the Conservative Party, who is in effect running against Mark Carney, actually lost his seat last night in a district just about 30 or 45 minutes from where I'm standing. So that kind of throws things up in the air in terms of, will he continue to lead the Conservative Party? Is there going to be a situation in which he can kind of convince somebody else in the party who was elected to step down so that he could run in a by-election for that seat? that's all up in the air here. And you ask just kind of about the breed of conservatism that we see here. Pierre Poilievre is somebody who has been compared in terms of political style to Donald Trump, the President of the United States. If there's Make America Great Again in the United States, there's Make Canada Great Again here in Canada, as sort of headlined by Pierre Poilievre. So they had an amazing showing yesterday by all kind of historical records. They did extremely well, yet they still didn't best the Liberals, and that's really extraordinary. Again, when you look at kind of the not so long ago history, just a few months ago, before Mark Carney entered this race, the Conservatives had a 20-plus point lead over the Liberal Party, and that was squandered here over the last few months. So there'll be a lot of soul-searching, Paul and Alex, within the party about what went wrong and what the party can do differently going forward.
So here's an insanely unfair question, considering that you're a reporter. So, you know, take this with a grain of salt. But if President Trump had not come aggressively after Canada, either in terms of tariffs or, more importantly, making it a 51st state, would this election have been different? Were there other issues that got kind of sidelined at this point?
I think no doubt. The fact that Donald Trump talked about Canada as much as he did and made those threats was something that Mark Carney, who is a career technocrat, he headed the Bank of Canada and the Bank of England, for a time served as the chair of Bloomberg Inc.'s board and Brookfield Asset Management. This gave him an opening to present himself as kind of a foil to Donald Trump, to be a foil to that kind of breed of populism that we've seen in the President of the United States. And it really changed the polling, it changed Canadians' engagement with this election. So yes, as that soul searching takes place among the Conservative Party, I think there's also an awareness of the fact that this is a very unique circumstance and that Canadians, as a result of what Donald Trump said and did, really kind of galvanized the electorate here in Canada in a way that they might not have 3, 4, 5 months ago.
David, you've been up in Ottawa for a few days now. What's the feeling of the person on the street here? Because as it relates to the relationship with the U.S., because I don't think I've ever come across anybody in my life that has anything negative to say about Canada. But, you know, so I'm just not sure how President's comments, how reflective they are of U.S. folks. But how do the people in Canada feel?
Just as Mark Carney didn't find the comments from the president about the 51st state as a joke, nobody with whom I've spoken has found them funny as well. So they've taken it as a real serious threat also. And there is a sense as you talk to people here, as I have over the last few days, of just kind of bewilderment, why the circumstances are the way they are. They listen to President Trump, they listen to that rhetoric, and they wonder sort of how they got here in light of what you're talking about, Paul, which is this is an allyship. This is a partnership that's existed for a couple centuries now, a very happy and important allyship of two nations. And to see it kind of changed fundamentally in the way that it has been over the last few months has really astounded people here. And again, going back to what the Prime Minister has said, folks here were surprised by that rhetoric to begin with, but they've moved past that, as Mark Carney says, and now they have to kind of plot a new path forward. That's going to take place in those negotiations in the White House, but also in just the way that the Liberal Party government here under Mark Carney is looking at the world and kind of rethinking relationships with other countries. And we've seen that over his rather short prime ministership so far. He's made trips to Europe, of course, and to England as well. He's trying to find new outlets for Canadian products and sort of new arrangements, new relationships for Canada to engage in as the U.S. kind of falls to the side.
All right, David, really great reporting. Thank you so very much. David Gura, he's the host of Bloomberg Big Take podcast, also a correspondent for Bloomberg News. All right, coming up, we're going to break down what the tariff impact is on individual companies and sectors. Poonam Goyal, Elliot Stein, both of Bloomberg Intelligence, did all the work for us so we don't have to. We get to give it to you. So stay tuned for that. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg, and this Bloomberg Business Flash is brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control of their growth with advisor-centric support and future-ready technologies. Grow on your own terms with a partner dedicated to your success. Go to Commonwealth.com to learn how. Stocks are higher, extending gains into a sixth consecutive session. Bond yields fell after weak economic data this morning, bolstered speculation that the Fed will cut rates to prevent a recession. The S&P holding on to a 7-point gain at 55.36, up 0.1%. The Dow up 213, up 0.5. Nasdaq higher by 10, up by about 0.1%. 10-year at 4.17%, with the 2-year 3.66%. Gold down $35 the ounce, 33.08, down 1.1%. West Texas Intermediate crude oil up 2.2%, 60.72 a barrel. Sizing up President Trump's first 100 days, Goldman Sachs CEO David Solomon says investors are craving certainty.
If the level of uncertainty grows from here, yes, you won't see the same amount of capital markets activity. But my own belief is things will settle down. We'll have a clearer policy perspective and some normalization of capital markets as we shift into 25 and 26.
Goldman Sachs CEO David Solomon speaking with Bloomberg's Francine Lacroix in Europe. Royal Caribbean Cruises is raising its profit outlook for the year as cruise demand continues to defy the increasingly dire situation of the wider travel market. Royal Caribbean shares, though, down 1.3%. Rival Carnival Corp down 1.7%. Norwegian down by 1.2%. Elsewhere in the travel industry, JetBlue Airways, the latest U.S. carrier to pull its full-year financial outlook. Shares of JetBlue, they're up today by 2.2%. Recapping, S&P higher by 12, up 0.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Alex Steele and Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio, and we are streaming live on YouTube. So head over to youtube.com and search Bloomberg Podcast Live. Uncertainty, that is the word you hear out of the mouths of so many people in the marketplace, whether it's the CEOs, traders, economists. People just don't know how the trade policy is going to impact economies and companies and their operations. Tough to put numbers on it, but that's what our good friends at Bloomberg Intelligence are doing. They're putting numbers to the risk here, and we want to get to that right away. Poonam Goyal, Senior U.S. Retail Analyst, joins us here via Zoom, and Elliot Stein, Bloomberg Intelligence Litigation Analyst, joins us here in the Bloomberg Interactive Broker Studio. Elliot, let's start with you. What is the tariff impact matrix that you guys have come up with?
Yeah, so thanks, Paul. So the BI tariffs matrix is a matrix that we launched just yesterday. It's available on the Bloomberg terminal at BI space tariffs go. And like you said, BI analysts for weeks have been putting numbers on what tariffs mean for their companies. And this is all distilled in the BI tariffs matrix. You go to the matrix, it lists 200 companies, and we're continuing to add more companies across 20 different industries. And it shows you what their blended tariff rate would be based on their exposure to different countries where they're getting goods for their sales in the US and what the tariff rates are on those countries. And then from there, our analysts have calculated how much the cost of goods will increase for all these companies' sales into the US, how much their profit will take a hit as a result, and how much they would have to increase prices both in the US and globally to offset the impact of the tariffs.
That's amazing. That's incredible. Honestly, this is why Bloomberg Intelligence is so awesome. And we'll get to retail with Poonam in just a second. But Elliot, when you were putting this together from all the different sectors, what stood out to you? What did you learn the most?
So, it's really interesting. So we also published a note on this yesterday, and in that note, there's a piece from Anurag Rana and the tech team. And, I like to filter by the blended tariff rate and see which companies are paying more tariffs as a result. And if you look at Apple, because they have such a high exposure to China, their blended tariff rate is still 20%. But a company like Dell has a much more diversified supply chain. And so their blended tariff rate is much lower, roughly, I think, maybe 4 or 8%. I forget the exact number. And so as a result, the amount that both these companies would have to increase their prices to offset tariffs varies quite dramatically, with Apple being close to 9% and Dell being close to 2%.
So Poonam, on the retail side of the business, how much more do you think consumers are going to have to pay at the store for stuff?
Sure. So if we assume that the entire cost is passed to the consumer, on average across the 39 retailers we analyzed here in the U.S., it's a low double-digit increase. That said, we do expect some mitigation efforts to take place, so we do expect that to moderate to probably mid to high single digits, worst case scenario.
That sounds bad. Is that bad?
Price increases are bad, right? Because they influence demand, and that means that consumers could pull back in where and how they choose to spend. So ideally, we would like to see no price increases, low single digit at best, which we think is manageable. But if it's beyond that, there could be a pullback in demand, especially for discretionary items, right? Things that you can kind of hold off on, you can trade down for. So it is negative. If things worsen and if China tensions don't come down from here.
Are there certain product lines or certain categories, Poonam, that are more at risk? I just think, I remember seeing a story on sneakers, and it seems like all the sneakers come from China. In that part
Well,
of the
they
world.
actually come mostly from Vietnam. So as long as the Vietnam tariff rates stay at 10%, which we'll know in early July if that's the case or not, I think that headwind is largely manageable. In fact, for the athleisure companies like Nike, Adidas, we've estimated that the tariff rate currently should only be around 10%. And that's because that's the current levy on the other countries outside of China. These companies have diversified a lot since the last round of tariffs, where they've actually moved out of China into the neighboring countries. And as long as the tariff is low there, we think it's manageable. If tariffs do increase in early July from the 10%, it's a bigger risk to these athleisure companies. Paul, you asked about where the impact is greater is across the 39 companies that we've analyzed. I think you have to look at the toy makers, you have to look at the dollar stores, and even some of the specialty apparel stores where they are more heavily exposed to China, in some cases largely exposed to China, and there the tariff rate is greater than 50%, and the exposure is much higher, so a much bigger impact.
Yeah, if you search by U.S. price hike and do, a top down, like Mattel, 31% estimated price increase, Five Below, 39%, Dollar Tree, 27%.
I don't think those people are going to like.
I mean,
the people who
that's
shop at Dollar Tree, I don't think they're going to
that's
like that.
really rough. I could do this forever. H&M, 20%. Target, where'd you go? Target looking at 20%. Elliot, are we going to see lawsuits, legal issues in relation to this?
Yeah, we already are. And just going back to the Matrix for a sec. So we didn't mention yet, but you can click below the Matrix and to the left of the Matrix as well, because there are interactive calculators for all these companies where you can play around with some of the different assumptions, put in your own numbers, and get the output as a result. But in terms of lawsuits, yeah, we've seen multiple lawsuits being filed. My colleague Holly Fromm covers them, but I've been tracking them as well because they're interesting. We've seen companies lawsuits from importers as well as blue states like California and Oregon. They're filed in courts all around the country, but they're probably all on their way to being consolidated to a court here in New York called the Court of International Trade, which deals with lawsuits over tariffs. And there are two main claims in these cases. One is that the government is exceeding its statutory authority under IEEPA, which is the statute it's using, the Emergency Powers Act. And then the second one is that even if it does have the power under IEEPA to implement these tariffs, Congress delegated its authority to the president improperly. These are issues of first impression. We've never seen a president use IEEPA for tariffs before. And at the end of the day, we think it's a close call, but we think the administration will win these lawsuits and the tariffs will stick.
Poonam, 10 seconds, Amazon in this thing about, putting the tariffs into price?
Yeah, they denied it. So I think they will have to raise prices to the consumer, especially the third-party sellers, but I don't think they'll show it. Not on the main Amazon website, at least.
Yep, got it. Okay, Poonam Goyal, Elliot Stein, Bloomberg Intelligence. Great work on this tariff import matrix.
All right, coming up, we are going to get some of my exclusive interviews from Oklahoma City. Coming up next, Continental Resources CEO is now a private company. He can really talk about the impact of those lower oil prices. This is Bloomberg.
listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, happy Tuesday, everybody. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance right here from our interactive broker studio in Midtown Manhattan. So last week I went to Oklahoma City. I attended the Powering AI Global Leadership Summit at the Ham Institute for American Energy at Oklahoma State University. I spoke to some of the biggest names in the energy space. During the summit, I sat down with Doug Lawler. I get to talk to him like once a year. He's president and CEO of Continental. It's now a private company. This is the company that Harold Ham founded. And we discussed the recent plunge in oil prices and his concerns around $60 a barrel. You're the oil guy and you can talk about it. What do you do at $62 oil? Are you worried?
Alex, I'm not too worried. It creates a lot of stress in our systems as we think about our investment plans. We don't think about investing today. We think about a long-term horizon. But we have to be thoughtful because, as you know, we're drilling wells today, opportunities today that are very competitive, and we're drilling into a lower price environment. So we need to be really thoughtful about that. Moderating capital investment programs, thinking about our investments here in the next 6 months, the next 1 year, 2 years. We're very thoughtful about it. We know that the oil opportunities that we're going to continue to see stable investment opportunities here in the U.S. for a while. So it's not too concerning, but it's you start getting below $60, it starts creating a little bit different paradigm.
So what happens in a $50 oil world? Like, is that the place where you shut down rigs? Is that the place where you just pause investment decisions? Like, walk me through the psychology.
It is. So in a $50 world, as you're aware, the United States, we have these creaming curves that we'll call it, that basically on a cost of supply per barrel basis, essentially gives us a profitability metric to look at what we'll invest. When you start getting in that $50 window or in that $50 to $60 window, really, you have to really start questioning whether or not you'll continue to invest at the current pace. As you know, shale investments are not immediate investments. You just can't immediately shut it down, rather. You're going to have programs where you get on a pad where you'll drill 1, 2, 3, 4 wells. And once you start that process, if you interrupt it, it can compromise your long-term delivery or your long-term ultimate recovery. So, we have to be thoughtful about that as well. And as we mobilize capital, when you see $50 to $60, we will start pulling back activity. We'll start adjusting that capital investment program for the next 6 to 18 months.
What sort of efficiencies can you guys still wring out of technology to help manage lower prices? Like, I remember when 2-mile laterals was a big deal, and then it was 3, and then it was 4. Like, what other stuff can you guys do?
Yeah, well, we'll continue to look at our direct operations, how we can be more efficient in our drilling and completion, pressure pumping, stimulation type of investments. And we're seeing good improvements there. The industry, like you said, with drilling longer laterals, we continue to improve there and see more efficiencies. There's more opportunity for that, I really believe. But then what we also need to do is, when these lower price environments, look at the overall supply chain, and the cost structure has to come down. We have to continue to look for ways to squeeze costs out of our investments in order for it to be competitive. If we're not successful with that, if we're not successful with technology, then that just puts more pressure, Alex, on future pricing, that you'll see a whipsaw effect in an increase in price.
That was Doug Lawler, now CEO of Continental Resources. It's now private, so they don't have to disclose their earnings in the same kind of way that they did before. And he has a lot of experience with being crunched. He used to head up Chesapeake after Aubrey McClendon was pushed out of that company and had to deal with so much debt and low natural gas prices. So he's kind of used to navigating that environment. And you take a look at the curve, it's a bizarre looking curve. I mean, you're seeing a lot of the curve signals demand right now, then demand kind of falling off a cliff in the beginning of 2026, and then it rebounds. So as long as you have that forward curve somewhere like above 60, he'd like it to be 65, over the next year or two, they feel relatively confident in drilling.
Where is the industry on new projects these days?
It's tough. With these prices, it's still tough. You're going to see a lot of supply come online now, like in offshore, but not because they feel really great about this current environment, but because that CapEx came a while ago when it was a better environment. So you're going to get that supply. To sanction, say, a new offshore A project at this time with this uncertainty, no, it's going to be really tough.
Do they pull back on their activity? Like, if I'm not going to drill 24 hours a day, I'll do it just whatever, something less than that.
I mean, they can. So if you're looking at onshore, if you have a land lease, sometimes you have to drill, even if you don't want to. So that's a bummer.
Yep.
If oil prices are low, but they can do many things. That they can definitely drill wells, but not complete them. So you kind of wait, and then it's sort of, you had this backlog. So when oil prices improve, you can kind of just press a button, and then all of a sudden the wells come online and you get the oil. It's not that simple, but you get my point.
The companies have been, from what I understand, talking to you and analysts, pretty good about, listening to their shareholders, listening to their bondholders, not going crazy on some of their new projects when times were good.
So the smaller guys, that's where you're really going to see it, and the independent and the small mom and pops. So that's where we're really going to see the stressors, and they don't have the kind of financial flexibility or diversity that, like, say, a Chevron or Conoco will have. Speaking of, we get Chevron and Exxon earnings on Friday, so that's going to be quite interesting. And we'll have Chevron Mike Wirth speaking to us on Friday, so we'll be able to discuss all that with him.
Good, excellent. On top of it, I'm psyched. I know what's going on.
He does. So when is the second season of Landman coming?
I don't know. They just announced that it got greenlit, so they got to film it, and so maybe not 6, 9, 12 months.
So he's waiting. He's waiting for
I'm
it.
patient.
Okay, fair enough. All right, let's take a look at the market. Nothing really happening here. We're seeing a little bit of upside, but from what I keep reading from analyst notes, that might be a short covering. You look at weak breadth, though, and this is not a macro fundamental upside for the S&P. The VIX, though, relatively calm. Big tech you got tomorrow, and you got Thursday. Going to be a big line in the sand for that sector. All right, coming up next, Balance of Power with Joe Matthew after this global news update. Happy Tuesday.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Steve Kathan. The White House says President Trump will sign an order today easing tariffs on the auto industry. Treasury Secretary Scott Bessent on the current tariff strategy with other countries.
What we are doing is we've created a process. I think the aperture of uncertainty will be narrowing. And as we start moving forward, announcing deals, then there will be certainty. But certainty is not necessarily a good thing in negotiating.
Hours after the White House blasted Amazon for a reported plan to list costs added to products because of tariffs, the company says it was considered for certain low-cost products, but will not happen. CBS's Robert Costa says today marks 100 days of the second Trump term.
We have seen through all of his actions, whether it's his sweeping policy on immigration and deportations to his standoff with other countries on trade. This is not the Trump of 2017 just getting adjusted to running the federal government. This is someone who now feels like he is in command of not only the federal government, but he's taking on U.S. allies, U.S. adversaries across the board.
A private report on consumer confidence says it fell for the 5th straight month to the lowest level in 5 years amid concern about tariffs. UPS has announced a plan to slash 20,000 jobs, as we hear from CBS's Michael Wallace.
UPS is cutting costs after agreeing to slash the number of packages it will deliver for Amazon by more than half. Amazon accounted for about 12% of UPS's revenue. UPS says the cut should save it $3.5 billion this year.
Well, CBS's Ian Lee is in Chatham, Illinois, where 3 children and an 18-year-old were killed yesterday when police say a woman's car slammed into a building where an after-school program was in session.
She is not currently in custody, and that is probably along the lines of police saying they don't believe this was a targeted attack, looking more at this was possibly an accident. They are also saying that the toxicology report hasn't come back.
Homeland Security Secretary Kristi Noem tells CBS News the man accused of swiping her purse at a D.C. restaurant with Secret Service nearby is a career criminal.
We were with a big family and 4 kids under the age of 4. I had it right between my feet. But he was professional in how he took it. And, we're just glad that now that he's in custody because of so many other crimes he's committed.
The 49-year-old man faces a string of federal charges. Wall Street, right now the Dow is up 220 points. This is CBS News. high-level meetings going on at the Vatican ahead of next week's conclave to select a new pope.
Just like the film Conclave,
Sede vacante,
or translated from the Latin,
the throne of the Holy See is vacant.
The process of choosing the next pope has already begun, with cardinals meeting regularly, behind closed doors, of course, to discuss what qualities and priorities the next pontiff should have, and to deliver speeches laying out their own vision for the church. No one's calling them campaign speeches, but that's essentially what they are. Vicki Barker, CBS News, London.
The U.S. Navy says it lost a $70 million F-18 fighter jet after it rolled off the Harry S. Truman aircraft carrier in the Red Sea. Officials say the aircraft was being towed when the crew somehow lost control. The carrier has been involved in launching attacks against Houthi rebels in Yemen. Steve Kathan, CBS News.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
And on the 100th day, he went to Michigan. Welcome to the fastest show in politics as President Trump marks the big milestone with a big rally in the suburbs of Detroit this evening with an offering for the big three. We meet the moment today with Republican strategist Alex Conant at Firehouse Strategies with Bloomberg Politics contributors Jeannie Shanzano and Rick Davis, providing analysis throughout the hour. Consumer sentiment sinks to the lowest level in almost 5 years. It's not a good look, and we'll dig into the data coming up with Bloomberg economics editor Molly Smith with us in Washington. So let's get to it. We start, as always, on Wall Street. Watching the markets for us in New York is Charlie Pellet. How's it look, Charlie?
Right now, we are looking higher across the board with the Dow, the S&P, NASDAQ, all very much in the green. Joe Matthew, happy Tuesday. Happy for the bulls with the S&P advancing today by 17 points, up 0.3%. We've got just one more session left before the end of a wild month. The Dow up 257, up 0.6%. NASDAQ up 40, a gain there of 0.2%, and should mention that the S&P 500 is extending its advance into a sixth straight day. The Bloomberg Mag 7 Index, ahead of key tech earnings, up by 0.1%. The 10-year, 4.17%. The 2-year, 3.65%. Gold is retreating by 0.9%, 33.15 the ounce. And West Texas Intermediate crude now down 2.3%, 60.65 a barrel on WTI. So stocks are higher right now. Ethan Harris is the former head of global economics research at BofA Securities. And on surveillance this morning, he said Treasury Secretary Scott Bessent deserves credit for lowering the temperature on tariffs.
I do think that he's gotten the ear of the president, pointed out that the way we're heading, you're going to have a really bad equity market going forward. And he's, I think, the architect of the recent softening of rhetoric. So he's helping, and because he comes from a more moderate background than a lot of the other advisors.
And you can hear more of the conversation with Ethan Harris on the Surveillance podcast. You can download it wherever you get your podcasts. The economic bellwether UPS is expected to cut 20,000 jobs this year and close dozens of facilities as it dramatically reduces shipments for e-commerce giant Amazon. UPS down now by 0.2%. Rival FedEx also lower today. Right now we've got FedEx down by 0.9%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, thank you, sir. And welcome to the Tuesday edition of Balance of Power here on Bloomberg Radio, satellite radio channel 121, and on YouTube, where you can dial us up right now. If you haven't already, search Bloomberg Business News Live. Just let it roll all day while you're working or whatever you're doing here. It's the full Bloomberg radio experience with visuals, if you dare, throughout the day. And we've got a lot to cover here as we mark 100 days. This is all anybody's talking about, beyond, of course, the markets and the economic data that are inextricably tied to the Trump administration. It's going to play out like this. He leaves the bubble pretty soon, actually, around 2 o'clock in the afternoon. We'll head over to Joint Base Andrews, and then it's off to the Midwest, to the promised land of Michigan. And he's not going straight to the big rally. We're going to get a big campaign-style rally tonight. You know, we're all staying up late for this special coverage right here on Bloomberg. But he's starting at Selfridge Air National Guard Base. If you were with us yesterday, you might have heard Congressman Bill Izinga talking about that. There's been an ask in Michigan for more jets. That's why the governor was in the Oval Office a couple of weeks ago. Updated jets. They're going to be talking likely about a major investment at Selfridge. And then it's on to the grand event in Macomb County at the Community College Sports Expo Center. They tell us 6 o'clock p.m. What they're billing as the 100th day in office achievement speech. Are we going to get the big one? We get like a Kid Rock concert here? What's going to be involved? I'm waiting to hear more about the choreography because that's going to feel a lot like the campaign. Maybe we'll get a flyover since he's actually the president now, with, of course, a lot of the conversation around promises made, promises kept, right? Just billed as an achievement speech. Of course, one of the big promises was tariffs. Another promise was lower prices. And they keep bumping into each other. We talk about it every day around here. They even pulled out the Treasury Secretary for an early morning briefing. By the way, they've done this twice. You're allowed to chuckle at White House correspondents who have to get up extra early now every morning for the 8:30 a.m. press briefing. Used to be around 2 in the afternoon. Special guest today, the Treasury Secretary, there to answer the big questions on tariffs. When will the trade deals emerge? But more specifically, listen to this exchange. Are we actually talking to China? Because we keep hearing from the White House that we are. Donald Trump even said on the Daily, Beijing says we've never engaged the White House on tariffs. Here's the latest from this morning.
I'm not going to get into the nitty-gritty, again, of who's talking to whom. But as I said, I believe for the Chinese, these tariffs are unsustainable.
And very quickly, 2 days ago, you said you didn't know if President Trump had spoken to Xi Jinping. Do you know now?
Again, I would say Caroline and I have a lot of jobs around the White House. Running the switchboard ain't one of them.
Running the switchboard ain't one of them. So we still have no idea who's on the phone with whom, or anyone for that matter, with the idea of maybe some other countries arriving at deals first. Japan, maybe India would be the big one. But as we wait, it's not helping with confidence on the corporate level or on the consumer level as we bump into the headline this morning. Consumer confidence slumps to an almost 5-year low. We can talk about abstract politics all day long, but if your job is to be Bloomberg economics editor like Molly Smith, you have to deal with fact, data. You know, Bloomberg, she's with us right now, having survived another 8:30 a.m. call, not for a briefing, but for a data dump. You have no mercy on these White House correspondents. Have to be in the briefing room at 8:30. You do it every day.
We've got other things to do. We've been doing this every day.
Well,
confidence actually dropped at 10, so that was a little later.
That's true.
But we had
enough.
something else at 8:30.
You did. I know you're an early bird here, and I want to start on confidence here, because if you look back 5 years, what was that, May of 2020?
Dark times.
What was going on right around that time?
Really dark.
So we just went back to the pandemic in terms of confidence?
That's where the level's at right now. Wow. And this was the 5th straight monthly decline, and that's the longest stretch since 2008. Another time period that probably rings
boy, oh boy.
A really sad bell.
These superlatives are stacking up. So what are consumers saying in this survey?
It's, really just a continuation of this tariff-induced anxiety about how this is going to be raising prices on a number of consumer goods, how prospects for what somebody anticipates their financial situation is going to look like are deteriorating markedly, anticipated odds of a recession, wage prospects, just all of these things about how secure you feel in your financial situation have just really weakened dramatically.
We talk a lot about soft data versus hard data. The data are supposed to capture what consumers are doing. We kind of look, as we're wonks at Bloomberg, we kind of assume everyone's walking around looking at GDP, and consumers say, well, geez, maybe I shouldn't buy this. But it's sort of a chicken and egg thing here, right? Where is the consumer when it comes to talk of a recession? Is that kitchen table talk, or is that for people like us?
No, I think this is very real. And that's where, people talk about this so-called vibe session in this idea of the soft data being just so much worse than what the hard data indicates. And that's why when we do actually get the first look at GDP tomorrow, it's going to be so interesting to see how much of this actually comes through in the hard data, because GDP
some economists are, I think the median estimate right now is penciling in what would be a very, very small increase. Would be a huge slowdown from the previous quarter, and a lot of that coming from, one, a big drop-off in consumer spending, and the bigger one is trade. And all of this so far being that there's been so much import activity to get ahead of these tariffs. And we saw that with the 8:30 data this morning. That was the advanced trades report showing that the goods deficit widened to another record in March. So the import activity has just been rampant, and that's really going to just subtract the most from GDP tomorrow.
We're seeing this as well in the form of fewer container ships off the port of LA, right? So what are we in for tomorrow when GDP comes out? This will be our broadest measure we've had.
Yeah,
since it's mattered, since Liberation Day.
Exactly. So this is for the government's initial estimate of first quarter GDP. And there are a lot of economists who are penciling in a contraction. You know, we haven't had that since 2022.
Wow.
And that would be really dramatic. Again, a lot of it coming from the trade side. So if you are of the camp that maybe imports are going to normalize after this big rush in the first quarter to get ahead of tariffs, then you might be a little bit more sanguine on the outlook for the current quarter for trade and GDP. But it's really hard to tell right now because there's still so much of this up in the air. As you just heard, Bessent can't even tell us who's talking to who right now. So who the heck knows if there's still going to be more of this front-running activity until we really know where the tariff rates are going to settle.
Yeah, so the idea of front-running and the pull forward that we're seeing right now in anticipation of tariffs, does that guarantee a downturn in the back half of the year?
I don't know if I would say...
How do you sustain that?
I mean, I don't know if I would say guarantee a downturn. I think what the biggest thing for our economy is consumer spending, and that's what drives our economic activity more so than what trade does. And I think a lot of economists would also tell you in looking at how to determine when a recession is actually happening, you have to look at the consumer and you have to look at the job market. And trade is, I guess it's more of an exogenous factor compared to those other two.
Well, we're about to look at the job market on Friday. This is the other big one that we have coming. I keep asking you every month, when do the federal worker layoffs start showing up? What are you expecting on Friday?
So I mean, you know, we keep thinking that like we're going to keep getting these like big, you know, more of a moderation in job growth, which has generally been the theme. I mean, except for the fact that the March payrolls report was such a blowout in a good way, you know, that there was such strong job growth. But it looks like that level would drop off pretty materially in April.
This month?
I don't know if I would, I mean, I think that implies that it's really like bad, but like the median estimate right now for payrolls growth is somewhere in like the 115,000 area. That's not bad. That's not a bad number. And the unemployment rate's still holding at 4.2%. Also not bad. But there's, I mean, I always like to look at the range of estimates for the payrolls report and how wide the band can be. I mean, sometimes we're looking at a span of like 150,000 from the high to the low. So that median, of course, is who knows where the actual number will lie.
It's interesting what you said to us, though, is we get a contraction in GDP tomorrow. First time since the non-recession, remember, it was two quarters, but it wasn't a recession during the Biden administration. A lot of people think this is the beginning of one. When does that become consensus, or that's not a baseline expectation right now, is it?
I mean, I think right now
we're in one now.
That we're in one now?
Yeah.
I don't know if I would say that. No, I think because again, like there's the idea of what you kind of just alluded to, what we'd call a technical recession of these back-to-back quarters of negative GDP, which could very well be a trade story. But when you look at actual recession, jobs, spending, that's not really,
and I learned a lot about that a couple of years ago when we met the technical definition, and Molly Smith taught me otherwise. It takes a lot more to call it a recession. Great to have you in Washington. Bloomberg economics editor Molly Smith with us on the fastest show in politics. Stay here live from Washington, only on Bloomberg.
on Wall Street. We do check markets all day long here at Bloomberg. We've got stocks higher with the S&P 500 index extending its advance into a 6th straight day. The S&P right now higher by 16, up by about 0.3%. The Dow up 269, up 0.7%. And the Nasdaq Composite Index up 24, up by about 0.1%. The 10-year 4.17% with the 2-year that's currently yielding 3.64%. Gold is down $28 the ounce, $33.15, down 0.9%. And West Texas Intermediate crude down 2.3%, $60.60 a barrel on WTI. Bitcoin back above 95,000, 95,065 now, up by about 0.6%. Amazon says it never planned to widely display the cost of President Trump's tariffs on products after the White House blasted the reported move. We got more on the topic coming up in just a moment right here on Balance of Power. Amazon shares today, they're lower. Amazon does report earnings this week. Amazon down now by 0.4%. Recapping stocks higher. S&P right now up by 0.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
Okay, Charlie, thank you so much. Live from New York, Charlie Pellet, the voice of Wall Street and the New York subway. Ride the train if you want to know what I mean when you say that. The most recognizable voice. We were talking about this the other day in the newsroom. Arguably, the most recognizable voice in New York City. Think about that. Waking up every day as Charlie Pellet. I'm Joe Matthew in Washington, where we don't have a subway, we have a metro. Sometimes it works, much like the apparatus on both ends of Pennsylvania Avenue. We're going to be talking more about reconciliation, the drive to mark up some bills this week, and of course what's happening on the other end. That's the big story today. 100 days. How do you feel having experienced it? As we turn to the anatomy of a retraction, this has been an interesting element today. Having started at 8:30 this morning with another early morning call in the White House briefing room, the press secretary and the Treasury secretary today talking about trade, tariffs, you know, the economic agenda on 100 days. This is a big part of what we're going to hear about this evening from President Trump. But this whole idea of Amazon, you heard about this by now, I'm sure, listing tariff prices. You know when you go to the restaurant, they've got the calorie count on the menu, makes you not want to buy anything there. You order that if it's 1,000 calories. Amazon had an idea to break it out in terms of tariffs. How come my new Fruit of the Loom are so expensive, you ask? And there'd be a little item on there, right, like a service charge, and it would break out the tariffs. Didn't play well at the White House. We all woke up to this story today. The Amazon was considering this. The press secretary, Caroline Leavitt, was asked about it. Here's what she said.
I just got off the phone with the president about Amazon's announcement. This is a hostile and political act by Amazon. It's another reason why we are onshoring critical supply chains here at home to shore up our own critical supply chain and boost our own manufacturing.
Yikes. Called it a hostile and political act by Amazon. Fast forward to noon, statement from the company. That was never under consideration. Amazon says the team that runs our ultra-low-cost Amazon Hall store considered the idea of listing import charges, never approved, and was never going to happen. If you're with us on YouTube, you see the response. Rapid response from Amazon. The stock's been lower, and it's where we start our conversation with a noted Republican strategist who's been through the ringer in multiple campaigns, survived the first Trump administration, and is with us right now at the desk. Alex Conan, partner at Firehouse Strategies, was at one time, in a different life, 2008, a spokesman for the Republican National Committee. Also helped to run Marco Rubio's presidential campaign. It's great to see you. Thank you for coming back on Bloomberg.
Good to be with you, Jeff.
So someone like yourself working at Firehouse gets a phone call from Amazon and says, Alex, we need help. What do we do here? A reversal like this is remarkable, and it tells us a lot about the influence this administration has over corporate America, doesn't it?
I don't think any business wants to get in a fight with the White House right now, but I think every business in America is also recognizes the reality that tariffs are going to drive prices up.
Sure.
As we saw in the last administration, inflation is the worst thing that can happen to a president. It's something that voters see everywhere. Every time they're going to fill up the tank, buy eggs, go online, to go shopping. When they see prices going up, they get angry. And so, look, Biden didn't survive it. Carter didn't survive it. I think Trump and the Republicans are very sensitive that these tariffs are going to make prices go up. That's why you saw the White House so quick to attack this report.
Right.
Like they don't want prices to go up, but they really don't want corporate America or any businesses to to blame the president directly on why the prices are going up.
Well, so here you are, it's 100 days, and you need to write an achievement speech, as it's being called, for President Trump. We just spoke to Molly Smith, our economics editor, who's pointed to hard data. We're going to see potentially a contraction in GDP tomorrow. You see all the analyst notes. The odds are rising on a recession. We're seeing some creep when it comes to inflation. The bond market's been freaking out a little bit. How do you craft a cohesive message that says we did good in the last 100 days on the economy?
Yeah, look, I can't recall a situation where there's such a disconnect between the mood inside the West Wing and the mood on Main Street, on Wall Street, with the electorate as a whole. If you look at the polls that came out over the weekend, they're really bad for the president, and they're trending badly. Yeah. And they're bad because people are losing faith in his ability to handle the economy, which has always been the bedrock of Donald Trump's support since 2015, since 2016. They might not like what he tweets, they might not like some of his personal behavior, but they trust him to handle the economy. If he loses that, he's in real trouble, and that's what we're seeing in the polls. But the mood inside the White House is, look, 100 days in, we're delivering on everything that we promised, everything that the president said he was going to do, he's doing. We got our cabinet confirmed. You know, there's only one nominee, Matt Gaetz, who didn't make it through. The rest were confirmed, for better or worse. Yeah, sure. You know, some of them have had some trouble since then. But the executive orders, he's done more of those than any president in history. His tax reform is moving ahead in Congress. So I think that they feel very, very good about kind of the first 100 days. I think the president is going to be in a really good mood at his rally tonight. But I think the fact that he's doing the rally tonight and that he's doing all the interviews around 100 days is also a reflection that there are voices inside the West Wing. While the mood is good, they can see the storm clouds coming. They recognize he needs to get out there more, sell his agenda. But if the economy's in the tank, a couple rallies isn't going to fix the numbers.
I can hear what he's going to say on the border tonight, right? We've locked it down. This is the most secure border in American history. When it comes to the economy, though, is the message just hang on? Well, give me a little more time. And how much time does he have?
Look, I think, he's going to blame Biden. Right?
Okay, Biden's economy.
Yeah, look, he's going to say, look, the economy was, and the reason he won is because people didn't like the economy, right? Like, people not liking the economy is not a new phenomenon. That's right. People haven't liked the economy is why he won. He's going to blame Trump. He's going to say, or he's going to blame Biden. He's going to say, look, I inherited the worst economy ever. We're doing X, Y, and Z to fix it, including tariffs, and he's going to try to sell his tariffs. Yeah. But at the end of the day, inflation is not something you can spin away. People are going to get upset about that. Falling stock market, people get upset about that. Recessions, if people start losing their jobs, look, they're going to blame Trump. And this is not I'm a communicator, and I love to say, this is not a communications problem. This is going to be an economic problem. Wow. If the trends that we're seeing, that Molly was just talking about, if that actually comes to fruition, Republicans are going to have a real political problem on their hands.
Has there been a communications problem when you have Howard Lutnick on one network, Scott Bessent on another, then the president's doing an hour and a half in the Oval, and everyone's saying something a little bit different about tariffs, about whether we've talked to China, about whether we're going to have exemptions? There has been some confusion in the message. If you were in the communications office, how would you true this up?
Look, I think there's been, to say there's confusion on the tariffs is, I think, is an understatement. There's been no communication strategy on the tariffs. You're right. You have Howard Lutnick out there saying, we are going to do tariffs because we're going to raise all this revenue to balance the budget. Right. You've had other people out there saying, we're going to do tariffs to get great trade deals so we can do even more trading. You've had other people saying, we're going to do tariffs so that we can increase the cost of imports and force people to bring those jobs back to the U.S. so, we can get more factories, more manufacturing in the U.S. All three of those things cannot be true at the same time, right? You can't have great trade deals and raise a bunch of new tariffs. And so I think the fact that, and at the same time, you're asking the American people to make great sacrifices. You're asking them to pay more for the things that they buy every day. which is going to be unpopular. If you're going to ask the American people to make a great sacrifice, you have to have a really clear rationale for that, and we haven't heard that from the White House.
What do you do optically tonight? How do you make this different? We're so used to seeing Trump rallies.
Yeah.
Do you have a big opening act here? Is there a flyover? You know he's going to be calling people up on the stage, right? Alex, come here. I love you, Alex. Come talk to the people for a minute. Is this a stem winder like we saw in 2024?
I would assume so. I mean, look, I think Trump's current team has survived because they let Trump be Trump. And if it's up to Trump, he's going to do what he did at the Republican National Convention. Look, he gave the longest acceptance speech ever at the RNC. He gave the longest ever State of the Union speech a couple of weeks ago. Tonight's speech is going to be long.
Yeah, okay. Cancel the dinner plans, James. We're going for the long haul here. We're very excited for another late one. Will there be news becomes a question, and does it matter? Does he need to make news tonight? There's talk about some relief that he might offer in the form of auto tariffs, for instance. You go to Michigan, do you have to bring something with you?
Maybe. I mean, look, that's just right. Like, I'm out of the prediction business when it comes to Donald. When it comes to Donald Trump, like, who knows what he's going to do, what he's going to say. You know, at the end of the day, look, I think we should all expect some sort of tariff walk back over the next 30 days. You see what importers are saying. You see what the Port of Los Angeles is saying. You see what retailers are expecting. This, if all this comes to fruition, Memorial Day is going to be rough. Politically, the economy is going to be rough. And so I would expect over the next 30 days to continue to see the sort of tariff walkbacks that we've seen over the last 3 weeks. And maybe he lays out or hints at some of that tonight.
So lawmakers marching in parades and doing town halls, if they do them,
I mean,
at least Republican lawmakers over Memorial Day weekend are going to get an earful.
Look, if the tariffs go into effect, as he said, and they're allowed to go into effect over the next couple of weeks, you're going to see an economic response to that. It's going to be very negative, and these things lag, right? First, first you see fewer imports. Then, look, if container ships are not coming into the Port of Los Angeles, then you don't need the truck drivers to drive those goods to the stores. If the stores don't have things to sell, you don't need people working hourly. If there's nothing to buy, prices are going to go up. People are going to get frustrated. This is all very foreseeable. I think you guys on Bloomberg are talking about it every single day. I think people inside the White House recognize this is coming, which is why you have seen the steady walking back of the tariffs. I would expect to continue to see that. If you don't see that, then there is going to be, I think, real economic headwinds this summer, and the White House is going to face the political penalty for
you hear lines about empty shelves, and so that's a horrifying thought for any administration. In our remaining moment, then, you're a political strategist. If you're a Democrat right now, are you writing the menu for the midterms?
Look, it turns out James Carville was right? Like, all Democrats needed to do was go into hiding. The president's poll numbers are not down because Democrats have figured out, effective messaging. To the contrary, I think the messaging we've seen from the Democrats is pretty lousy. But they're in the opposition, right? And so they're going to benefit in the midterm. Look, if the economy's in the tank and Trump is unpopular, the Democrats are going to have a good midterms, just like Republicans did 4 years ago.
Fascinating. I'm really glad to have you back in the fold here. Alex Conant, thank you so much. Firehouse Strategies, big thanks to Maddie and your team for putting us back in touch. Let's keep this conversation going because this is not one that's going to go away anytime soon. A voice of experience here in Washington, Republican strategist Alex Conant, many thanks here on Balance of Power. I'm Joe Matthew in Washington. Glad you're with us here on Bloomberg Radio, on the satellite, and on YouTube. We'll assemble our panel next. Rick Davis and Jeannie Shanzano are on the way in. Only here on Bloomberg.
Wall Street, we do check markets all day long. Here at Bloomberg, we have got the Dow, the S&P, and NASDAQ all advancing. One more session left before the end of a wild month. The S&P extending its advance into a sixth straight day. Up now by 13 points, up by about 0.2%. Dow Industrials up 240, higher by 0.6%. NASDAQ right now up 26. That is a gain of 0.1%. 10-year yield at 4.16% with a 2-year 3.64%. Gold at $33.24 the ounce, lower now by 0.6%. West Texas Intermediate crude down 2.8%, $60.33 a barrel, and Bitcoin up 0.8%, 95,281 right now on Bitcoin. Earnings news: Royal Caribbean Cruises has raised its profit outlook for the year as cruise demand continues to defy the increasingly dire situation of the wider travel market. RCL Royal Caribbean down 1.4%, rival Carnival Corp down 1.7%, and Norwegian Cruise Line Holdings down now by 1.8%. JetBlue is the latest American carrier to pull its full-year financial outlook as President Trump's trade war erodes demand for travel. And we've got Hilton Worldwide Holdings lowering its earnings forecast for 2025 as growing uncertainty about the U.S. economy weighs on future travel demand. Meta Platforms is out with a new standalone AI app in a bid to compete with other popular chatbots like OpenAI's ChatGPT. Right now, Meta Platforms up by 0.6%. Meta reports tomorrow. Again, recapping, S&P higher now by 0.3%. Balance of power continues right now, and back we go to Washington once again. Your host, here he is, Joe Matthew.
All right, Charlie, thank you so much. From World Headquarters in New York, the great Charlie Pellet watching Wall Street. He'll keep us safe, and we'll check back with Charlie a little bit later on this hour to see how stocks are faring in the Tuesday trade. Of course, so many questions about trade, and I mean that with regard to our relations, our trade relations with other countries. Not a lot of clarity coming out of that briefing this morning as the White House marks 100 days with a briefing at 8:30 a.m. with the press secretary and the Treasury secretary. They took a lot of questions, but we really don't know much more than we did yesterday. The promise of deals, we've heard a lot about them, soon to be announced. We're on the verge of some, on the bubble, whether it's Japan, South Korea, or maybe even India. When it comes to China, a lot more confusion. The Treasury Secretary would not answer questions today. Direct questions and repeated questions by White House reporters about whether the administration is in fact engaging or has engaged with China on tariffs. We've heard their daily calls. We've heard there have been some calls. Beijing says there have been no calls. The Treasury Secretary says he's got more important things to do than run the switchboard. Doesn't sound like a deal is about to emerge there, and that's why Wall Street continues to guess its way through this whole process. And of course, it's trade that tipped the scales in Canada. You watched the election yesterday. David Gura up there for us will join us next hour from Ottawa. It's not often, everyone from the U.S. dispatches a reporter to Canada for their elections, but this was a different one. And yes, Mark Carney won over the Conservatives. The victory was pretty narrow, more narrow than some had thought. But remember, before we got into the whole 51st state Governor Trudeau deal, erased the arbitrary line, all the language that we've heard from Donald Trump about actually taking over Canada, followed by tariffs on Canada, completely reversed the course of this race that may well have been won by the Conservatives in any other world. Ask Justin Trudeau. Now, Mark Carney did speak to supporters after winning the race. Here's what he said.
Our old relationship with the United States, a relationship based on steadily increasing integration, is over. The system of open global trade, anchored by the United States, a system that Canada has relied on since the Second World War, a system that, while not perfect, has helped deliver prosperity for a country for decades, is over.
We are never, ever getting back together. Also singing Taylor Swift, the Conservative candidate, Pierre Poilievre. Did I say it right? Cece said it better than me. Poilievre. I have to work on this. If you listen to the language they're both using, you might, if you closed your eyes or maybe if you just read them, You might wonder who was doing the talking because their message was pretty identical. Listen.
Conservatives will work with the Prime Minister and all parties with the common goal of defending Canada's interests and getting a new trade deal that puts these tariffs behind us while protecting our sovereignty and the Canadian people.
Boy, Donald Trump bringing Canadians together, making Canada great again. We assemble our political panel. Rick Davis is here, partner at Stone Court Capital, our Republican strategist, and Jeannie Shanzano, senior democracy fellow with the Center for the Study of the Presidency and Congress, our Democratic analyst. Great to see both of you here. What do you think about this, Jeannie? Mark Carney has Donald Trump to thank for victory. Is that true?
I think that is true. And Joe, I'm secretly happy, not only because Carney's a liberal, but because I too cannot, well, you did a good job. I shouldn't say I too.
I tried. It took me a couple of tries.
I can't do it. But, you know, what a comeback. You know, we usually look to our neighbors to the north for some kind of sanity from the craziness of American politics. And of course, it has just gotten infested all the way up there because this election was all about somebody not on the ballot named Donald Trump. And I don't imagine a world in which we've seen the sort of huge comeback that the liberals had, 22 points in just a few months in the absence of Donald Trump. And why Donald Trump was calling it the 51st state, why he insisted on calling Trudeau governor, the tariffs and more. It remains a mystery as to what the policy reasons were, but he certainly helped Carney get this big election and helped usher in a fourth term for the Liberals up in Canada.
Boy, if you're Justin Trudeau, Rick, are you wishing you just hung on a little longer here? Because the earth shifted under everyone's feet in Canada. At the same time, Conservatives did better than a lot of people expected, and I wonder how you're reading these results.
Yeah, look, you have a macro cycle that favored the Conservatives and have for quite some time, even before Donald Trump got elected. Trudeau, after having served over a decade, was sort of, you know, the whipping boy for the success of the Conservatives. Trudeau is a smart political operative. He figured out that he was the problem and the impediment to the Liberals gaining power again. And I thought quite notably took himself out, creating an opening for someone like Mark Carney, who is the most conservative liberal I've ever seen in my entire life. And so it doesn't surprise me that Pierre Poilievre would start echoing exactly what the Liberals' campaign slogan was. I mean, Liberals were all about making Canada strong, and Poilievre was all about making Canada first. Guess who came in first? So I think now you see the unified approach to Canadian government, which will be to oppose Donald Trump's tariff sanctions, his border sanctions, and all the things that have created so much pressure with the Canadian-U.S. relations.
Yeah. What's the play for the White House here then? Jeannie, if anything different, you know, they got a bit of a reprieve when the reciprocal tariffs were announced on Liberation Day, and the president continues to explore different ideas here with Canada. Will the Mark Carney regime help to end the tariffs on both sides of the border?
Yeah, it's hard to tell right now. Of course, it's going to depend a lot on whether he is able to form a government, a majority governing structure, or whether he has to rely on smaller parties up there in the House of Commons. What he's going to be able to do, because let's not forget, putting aside the Trump of it all, Canada has a lot of frustrated citizens up there. Everything from the economy to issues revolving around housing prices to equity issues. I mean, the list is long. And before Trump, that's partly why they wanted to throw the Liberals out. You know, to Rick's point, Carney is a much more conservative liberal than we usually see, a former central banker, a first-time politician who had the campaign commercial of the year with Mike Myers. But putting all that aside, that was a good one. This was all, though, about Trump. And, you know, we're seeing it in other parts of the world as well. We have an election coming up in Australia in just a couple weeks, and there is some concern that the same sort of idea is happening in Australia. The Conservatives, who were set to have a pretty good showing in a few weeks, may not have that good showing. And in this case, we're not seeing Trump, try to claim Australia as a 51st state, but it seems to be a reaction to what the U.S. has done under the Trump administration in the last few months. We have to wait and see. But this could be sort of a chain reaction in some of our allies and former allies around the world.
Yeah, that's an interesting prospect, Jeannie. It's interesting, Rick, that we have this example right on our border. It's right in front of our faces with what's going on in Canada. But are there lessons learned here for the Trump administration when it comes to other trading partners we haven't even begun to engage with yet?
Well, I think the biggest one, and this is really critical to U.S. global leadership, is what's happening in China, because there is reporting that Xi's party is benefiting by national surges politically to his side to defend China from, Trump tariffs, Trump, geopolitical pressure. And so here we are, our approach is actually strengthening our primary strategic opponent in the world. And so, look, as much as we like to talk about the Canadians, I mean, that's really like talking about your cousins. You have fights, but you're still family. China is a different story. And so the idea that somehow what Trump is doing is strengthening the China hand politically in China is exactly the opposite of what our geopolitical pressure should be all about.
Yeah, this is pretty wild. The public sentiment story, the wave of patriotism in China, Jeannie, is something that we're reporting on here on Bloomberg. And this is people from a wave of different backgrounds here. When you're talking about consumers, manufacturers, the elite, they want to back up Xi, as Rick just mentioned, in the face of this onslaught from Donald Trump. Does that sound like a recipe for concessions?
It does not. And again, we are seeing this around the world with both our closest allies and our competitors for decades, like China. And, a lot of the game being played today in the United States is, what's the most consequential thing Donald Trump has done in the first 100 days? And it's so hard to choose because so much has happened. But there is a school of thought that says the most consequential thing he has done is to reorder our alliances around the world. And we're talking about Canada. Look at Europe. Look at J.D. Vance going over there in the Munich Security Conference in February and March. Look at Europe saying, you know what, we can't rely on the United States anymore for economic security. Canada now, the stark comments by both the challenger and the winner yesterday in terms of we need to stand on our own. What Rick was mentioning about in China, there's no coming back from any of this. And so I think there is a case to be made on this 100th day that the most important thing Donald Trump has done, or consequential, would be to reorder the world order for the first time since World War II, both security and economic. And there is going to be a stark fallout for Americans as a result of that. And you read some of these pieces he's interviewed in, whether it's Time or The Atlantic, he is sticking to his guns on all of this, as are the J.D. Vances of the world. So this is a stark reminder of that yesterday in Canada, but they are certainly not alone.
Yeah. So what does President Trump say about this tonight in the big rally in Michigan? Rick, right? He's going to be surrounded by guys in hard hats, different factions who voted for him. He'll have the sort of campaign mood behind him, and he can talk about how America's been getting ripped off the way he did on the campaign trail. But how does he sell the confusion over tariffs that's causing a lot of these people who are going to be in that crowd tonight to pull back on spending and make different decisions in their lives?
I don't think he's going to do anything tonight that he hasn't already been doing, and that is those general prescriptions for how these tariffs are going to make America rich. And there's no real connection between how he's going to do that and what the reality is. I mean, Alex Conant, right before our segment, said it right, which is, when you have 3 or 4 different rationales around selling of tariffs, no one of them is going to actually solve the problems that are addressed by the others. And so, he's not going to do anything tonight to sort of clear up the confusion about what's happening. I do think he's going to try and start the slow walk back of tariffs, we're going to be bringing these things down, and we're going to make it all better again.
Amazing. We're going to find out together, by the way. That speech set to begin 6 p.m. Eastern Time in Michigan. Rick Davis and Jeannie Shanzano stay with us. We have a lot more on this 100th day and our second hour to get to. Kaylee Lyons will join the conversation, and we'll welcome our global television audience to the fastest show in politics. Thanks for being with us, only on Bloomberg.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
The president heads for the Rust Belt to mark 100 days. Welcome to the Tuesday edition of Balance of Power. As Donald Trump stages a big rally in the suburbs of Detroit tonight, I'm Joe Matthew alongside Kaylee Lyons in Washington. We thank you for being with us. Kaylee, he's going to be showing up, we understand, with an offering to the big three automakers.
Yeah, a revision to the auto tariff regime, essentially changing the 25% tariff on auto part imports, which was set to go into effect next week, making sure these car makers can claim an offset based off the value of a vehicle, 3.75%. Frankly, Joe, this seems a little bit complicated, but the White House is saying that this is in response to the concern from these companies. And you saw that concern evident in GM today, had to pull its guidance because of the uncertainty around the tariff impact.
It is interesting timing to be rolling into Detroit as GM puts up earnings, and we look across the border with what happened in Canada yesterday. It's a curious moment. We are going to bring live coverage of that rally. It's expected to be a campaign-style rally, as I mentioned, on the suburbs of Detroit, 6 p.m. Eastern Time. Bloomberg's Tyler Kendall is already there. She'll have a live report for us straight ahead.
And we're going to get the perspective from the other side of the aisle. It's just what we have experienced in the last 100 days. As President Trump is likely to argue tonight, things are going great. Promises made, promises kept. But the Democratic governor of Kansas will join us this hour for her take on whether or not these policies are moving the country in the right direction.
Voices from the heartland today on the show from Washington.
Indeed, but we're not just in Washington. We're in New York as well. At least Charlie Pellet is. That's where he monitors the markets for us here on Bloomberg TV and radio. Charlie, how are we looking on this Tuesday?
Right now we are looking lower, and that is a big reversal from our last update. Kaylee Lines with the S&P 500 index just dipping into the red, down by 2 points now. Little changed, yes, but giving up earlier gains. We've got the Dow up 114 now, up by about 0.3%. And NASDAQ, the composite index, lower by 36, down 0.2%. The NASDAQ 100 index also down 0.2%. The Russell 2000 index of small cap shares up by about 0.1%. Our Mag 7 index ahead of key tech earnings, lower by 0.4%. The 10-year right now 4.16%, with the 2-year 3.64%. Gold down $15 the ounce, 33.28, down 0.5%. West Texas Intermediate crude down 2.7%, 60.35 a barrel, and Bitcoin right now up by about 0.4%, 94,875 on Bitcoin. GM shares are lower by 2%. General Motors withdrawing its earnings guidance for 2025, also putting $4 billion in share buybacks on hold because of uncertainties surrounding tariffs. Honeywell International raising its full-year guidance for earnings per share, expecting to offset $500 million in tariff exposure with price changes and other actions. Honeywell up by 4.6%. Business of sports. Sources tell Bloomberg former New York Giants quarterback Eli Manning is putting together an investment group to bid for a piece of the NFL team. Manning led the team to its last Super Bowl victory in 2012. Again, recapping, little change for the U.S. equity market right now, giving up earlier gains. S&P right now down by 0.5 point. Balance of power continues right now, and back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet with a look at trading about 3.5 hours since the opening bell rang at 9:30 a.m. Eastern Time. And we're seeing a new trend here in Washington this week, which is a pre-opening bell briefing here in Washington from the White House press secretary Caroline Leavitt. 2 mornings in a row, 8:30 a.m. Eastern Time is when these have been called, and she's been joined by other officials in the administration. Yesterday was Tom Homan, who of course is the border czar. Today, it was the Treasury Secretary Scott Bessent. As tariffs, as always, remain in focus, specifically tariff negotiations with trading partners, and the ongoing question as to whether or not those negotiations are even happening with China at the moment. This was the Treasury Secretary earlier.
I'm not going to get into the nitty-gritty again of who's talking to whom, but as I said, I believe for the Chinese, these tariffs are unsustainable.
And very quickly, 2 days ago, you said you didn't know if President Trump had spoken to Xi Jinping. Do you know now?
Again, I would say Caroline and I have a lot of jobs around the White House. Running the switchboard isn't one of them.
Running the switchboard isn't one of them. Maybe Tyler can help us with the switchboard. She's made her way to Michigan, where President Trump is going to be speaking later in what's being billed as an achievement speech marking 100 days. Bloomberg's Tyler Kendall in Warren, Michigan. It's at a community college. Tyler, set the stage for us.
Yeah, hey, Jim. So Warren, Michigan, we're in Macomb County. You can probably hear the crowd behind me. We're going to show you what the scene already looks like. For our radio listeners, you can see people are already starting to line up here as President Trump is expected to take the stage at 6 p.m. Eastern. This is an auto industry hub. In fact, a county official tells me the area has 338 vehicle manufacturers and employs about 22,000 people. And it comes as President Trump is expected to sign those executive orders on Air Force One on his way over here to Michigan that you've been talking about that could give some reprieve to automakers. That includes preventing the stacking of levies for automakers so that they wouldn't be subject to that 25% tariff on steel and aluminum, for example. It also would potentially modify how we see auto parts tariffs end up being tariffed by allowing companies that make the fully assembled vehicles in the United States to get an offset of up to 3.75% of the MSRP value for the next year. Now, administration officials, and we should be clear, this is not changing the actual 25% tariff rate that automakers are facing, but administration officials say that this should give them at least a little bit of a boost, a little bit of a reprieve to reshore manufacturing to places like Michigan. Here's what the Treasury Secretary had to say about it earlier today.
I can tell you that it will go substantially toward reshoring American auto manufacturing. And again, the goal here is to bring back the high quality industrial jobs to the U.S.
I was on a press call earlier today with senior commerce officials who told us reporters that ultimately it really was the talks with the big three automakers that made the difference here, that ultimately spurred the administration to make these changes, because the White House says that they have gotten commitments from these companies to reshore production, and they just needed a little more time.
Well, and Tyler, obviously no surprise that this is likely to feature heavily in the president's speech tonight, given where he is speaking, and we can already hear the excitement of the crowd that is gathering hours early. What are his other primary messages going to be tonight for those who are assembled to see him?
Well, the administration really is focusing on the two prongs of its economic approach today, with Scott Bessent this morning touting progress when it comes to tariff negotiations, although we have yet to see any more concrete details about exactly where those stand. And then the other priority is that they are pushing, that they are moving very fast to get his tax agenda through. In fact, President Trump told Michigan Republicans not to come here tonight because he wants them to stay in Washington to get done the reconciliation package. We heard from the Treasury Secretary yesterday that they would like to see the entire package done by July 4th. It's something that Senate Majority Leader John Thune said was an aspirational goal. Instead, we're really thinking that that X date is going to be the hard deadline for lawmakers. But it is clear that this White House is pushing to get more cash into consumers' pockets quickly, try to turn the attention there as they deal with the fallout when it comes to the tariffs from retailers and consumers alike.
All right, Bloomberg's Tyler Kendall live in Warren, Michigan, where it is already loud. I can't imagine what it's going to be like this evening when President Trump speaks at 6 p.m. Eastern time. Thank you so much, Tyler, and for a kind of taste as to what we might be able to get from President Trump tonight. Beyond what we just heard from Tyler, let's hear from the president himself, some of the highlights of his first 100 days in office.
The golden age of America begins right now. I will sign a historic executive order instituting reciprocal tariffs. My fellow Americans, this is Liberation Day. China, 67%. They're sending fentanyl to Mexico and Canada. You're not in a good position. You don't have the cards right now. One of the most important initiatives is DOGE.
We're going to be cutting taxes, and it's possible we'll do a complete tax cut.
I have a great relationship with President Xi. I hope it's going to stay that way. We are finally going to be able to make America great again, greater than ever before.
Words from the Republican president of the United States. And we want to get the other side now from a Democratic leader of a state, the state of Kansas specifically. Its governor, the chair of the Democratic Governors Association, mind you, Laura Kelly, is joining us now here on Bloomberg TV and radio. Governor, thank you very much for being with us here on Balance of Power. I would imagine it will be several times tonight. We might hear some iteration of promises made, promises kept by President Trump, and hear those words from his lips. He argues, Governor, that what we have seen over the last 100 days is him fulfilling the desire of the voters who elected him. Is he fundamentally wrong about that?
I don't know if I would say he is wrong. I mean, certainly in his mind, he feels like he said he was going to do all of these things, and he's doing all of them. And there are actually some of the things that he proposed doing that I think everybody would agree could be very good things. You know, certainly we're all cognizant of the fact that we had an issue at our border and that needs to be cleaned up. I would agree. I think, though, we can't leave it just at cleaning up the border and deporting people who may or may not be criminals. I think it needs to go further than that to deal with the entire immigration issue and come up with, finally, a comprehensive immigration reform package that works for our states. Every state I know is facing workforce shortages, and by deporting potential workers, we are not working towards resolution of that. We really need the administration and Congress to sit down and finally come up with a real solution that would resolve the border issue, but also resolve our workforce issue.
Governor Kelly, we're lucky to talk to a lot of elected officials on this program, but it's always different when you speak to an executive. Governors and mayors simply have a different reality than a lot of elected officials here in Washington who play the partisan game and do a lot of talking. You have to deal with things like balancing budgets, making sure services are delivered, making sure roads are paved, actual things that impact constituents' lives. And so I'm curious what your pragmatic view is of this waiting period, this sort of limbo that we're in right now, and how much time President Trump actually has to set the record straight and deliver a clear message on tariffs. You're talking to voters every day about this. Is that window about to close?
Well, I think we're past time. I think the first 100 days of this administration has just sown chaos and uncertainty all across the country. And all across issues and industries. The tariff issue is obviously the one that's most prominent and clearly creating issues for our economies in our states. In my state alone, we have worked so hard over the last 6 years and been very successful in growing our economy, in bringing in new and different industries into our state, creating 75,000 jobs, bringing in $22 billion worth of new capital investment, which is huge for a state like Kansas. All of what we've been doing is getting put up in the air as the companies that we have recruited, the companies that are here, are dealing with all of this chaos and uncertainty on the tariff issue, and they don't know where to go or what will work as they move forward. So everybody's getting to a standstill kind of position, which is not good for the companies, and it's certainly not good for our states. So, while I recognize that every new administration has the right and responsibility to put into place policies and procedures that they think are necessary to move the country in a way that they think appropriate, but doing it in this way where it's just willy-nilly, one thing one day, another thing the next day, isn't helpful. Not to move their agenda forward, but certainly not to help our states stay on a path.
Well, and your state specifically, Governor, has more than 50,000 farms, and I wonder what you're hearing from farmers specifically about the impact of tariffs on them and whether they're going to need to count on subsidies from either the state government or the federal government to offset the impact.
Well, we have two major industries here in the state of Kansas. Aviation is one of them, and as has been in the paper, there are lots of issues going on with the aviation industry as a result of these tariffs and these sort of international battles that are going on right now. But certainly in agriculture here in Kansas, but then across the country, the tariffs create absolute havoc and real concern for our farmers. I was the very first, it may be the only Democratic governor who signed on to the USMCA, the trade deal that the Trump administration put together in his first administration. dealing with our relationship with Canada, Mexico, and the United States. I signed on to that because I thought it was in the best interest of Kansas, and now that's all being thrown out. Nothing's really replacing it. But what has happened is that our relationship, particularly with our two biggest trade partners, Canada and Mexico, are in a shambles. Our farmers very much depend upon the potash that they get from Canada to fertilize their fields. A lot of our produce and stuff, which we can't grow here, is brought in from Mexico. Our exports, for instance, when the USAID was sort of shut down, moments after he took office, we had, I don't know how many millions of pounds of milo that was sitting in silos here in the state of Kansas. Their only customer was the USDA. They were growing this specifically for them to use. So my farmers are stuck with this stuff, and the market has been completely shut down. So there are a lot of problems, and we absolutely have got to come to some resolution very quickly. And they don't want, a handout. They got that the first time around. Remember that tariffs were put in place in the first Trump administration, and they did backfill that with cash. The farmers don't want that. That's a Band-Aid that doesn't do anything for them going forward. And I think their biggest fear with what's going on right now is that not only are they not able to sell their product right now or export their products right, but that they will ultimately lose their markets. That countries aren't going to wait forever. They're going to go find somebody else who can supply what Kansas farmers have been supplying. So it is a huge concern, and one that I hope this administration will wake up to and finally deal with, because
Governor Kelly, we only have 1 minute left. I want to give you an opportunity to pre-butt what we're going to hear this evening. Donald Trump carried your state by more than 16 points in 2024. What's your message to voters on this 100th day of the Trump administration?
Well, there's not a lot to say to voters right now. We don't have an election. Midterms aren't until 26. Another presidential election is not until 28. But I would say to all citizens that they need to make a lot of noise about how this is really impacting them and their lives. And they need to make that noise so that their congressional representatives hear them. Because what's happening right now is impacting people all across this country, whether they're talking about what they're thinking about doing with Medicaid, what's happening with tariffs, and what's happening in our higher education system. Lots and lots. They need to get loud.
We're glad you could be with us. Laura Kelly, the governor of Kansas, chair of the Democratic Governors Association.
Wall Street. We do check markets all day long here at Bloomberg. 6 in a row for the S&P 500 index. Stocks are pushing higher as investors digest today's economic data, and some industry giants are pushing their earnings outlook amid trade uncertainty. We have got the pausing their outlook, I should say. We got the S&P up 16 right now, up by about 0.3%. S&P 500 index at 55.45. The Dow Industrial is up 232 now, up by about 0.6%. And NASDAQ higher by 31 for the NASDAQ Composite Index, again right now of 0.2%. 10-year 4.17% with the 2-year 3.65%. Spot gold down $21 the ounce, down 0.7%. The precious metal now at 33.22 the ounce. Crude oil 60.55 a barrel, down 2.5%. And Bitcoin up $700, up 0.7%. 95,207 right now on Bitcoin. Amazon says it never planned to widely display the cost of President Trump's tariffs on products after the White House blasted the reported move. Amazon shares, they are trading lower today, down by about 0.6%. Economic bellwether UPS expects to cut 20,000 jobs this year and close dozens of facilities. Amazon down now by 0.7%. Rival FedEx lower by 1.3%. Sources tell Bloomberg former New York Giants quarterback Eli Manning is putting together an investment group to bid for a piece of the NFL team. Recapping, stocks higher. S&P right now up 15, up 0.3%. Balance of power continues now. And back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet with a look at trading on this Tuesday. Thank you so much. Not just any Tuesday, of course, the day in which President Trump is marking 100 days back in the White House. And of course, over the last 100 days, we've seen a lot of action emanating from the executive branch, from President Trump himself, the signing of hundreds of executive orders or memoranda, the implementation of tariffs and the like, things that he hasn't really needed Congress to go with him on, and Congress hasn't really expressed much interest in countering him on that. But the problem, Joe, is for the next portion of the president's agenda, the next 100 days, he's going to need Congress.
That's true.
To get a lot of what he would like to achieve across the finish line.
Well, if you think about it broadly, too, I mean, that's when trade deals would need to be announced, right? That the 90-day period would be wrapped up. We have to deal with Trump tax cuts, and we could get an X-date this week that lands a debt ceiling in the early summer. So, yeah, the second 100 days could be really interesting here. And it's where we start our conversation with our panel. As we round the first 100, Rick Davis and Jeannie Shanzano are here, Bloomberg Politics contributors. Rick is partner at Stone Court Capital. Jeannie is Senior Democracy Fellow with the Center for the Study of the Presidency and Congress. So happy 100 days, everybody. Rick, how much does President Trump have to show for the first 100 days, but also how much news does he need to make? Because there is an expectation he's going to make an announcement, no mystery that he's in the suburbs of Detroit here, to make an announcement on auto tariffs that we just heard from the White House. The auto industry will be happy with the announcement, some relief on tariffs that will prevent them from being stacked on top of each other here. Rick, does he need to bring the goods to Michigan?
Yeah, first of all, I'm not sure it's a happy 100 days. I mean, it's a pretty sober 100 days. You know, what everybody thought was going to be open season on, you know, investments and mergers and IOPs and, you know, less government regulation and more entrepreneurship has turned into exactly the opposite. Real serious questions about global trade, attacking the Fed's independence. I mean, this has had a real salutary effect on the economy, and S&P down 8%, worse than any president since Gerald Ford in his first 100 days. And we know what was going on back then. So the reality is that I think today he's got a chance to try and start peeling some of that back. Obviously, they are forecasting release of some of these tariffs on parts for car manufacturers. Good start. You kind of scratch your head and go, okay, well, why did we do that to begin with? Why? I mean, like, you know, these are parts that all go into automobiles that are going to be made in the U.S. ultimately anyway. Why did we put tariffs on them to begin with? And so I think there's going to be a lot of that head scratching, because hopefully this is the beginning of a whole series of things, including, as you point out, deals that we're making with other countries that will lower the reciprocity tariffs reciprocal tariffs that were already put on. Well, if we're going to cut those deals, why didn't we just reach out and say, hey, we're going to cut a new deal with you before we put these reciprocal tariffs on? I honestly don't really get the strategy, and it's not working with the American public, but tonight maybe we see the claw back on some of that.
Well, and I wonder how much tonight will focus not just on tariffs, Jeannie, but the other kind of domestically oriented efforts that the president has undertaken, in part with Elon Musk at his side, like the dramatic reduction in the federal government, the complete dismantling of agencies like USAID or the CFPB, arguably. How much, Jeannie, is his 100 days actually marked by something that could be, if not a permanent change to the federal bureaucracy, something that would take years to unwind even once he leaves office, or rather than unwinding, perhaps rebuilding?
Yeah, much of what he's done can take a long time. Things he's done via EO, we usually say, well, a new president could walk that back. But that's harder in those areas you're talking about, Kaylee, like the cuts in DOGE. How do you bring a workforce back if you want to do that? How do you rebuild departments? I mean, just take USAID as an example. That's going to be a big, big challenge. And, as I look at what the president is facing, he certainly is not going to want to focus on the economy tonight, because the economy, according to every poll you look at, is in disarray. So he's going to want to talk about things like immigration and DOGE, but he's not incredibly popular on that either. And so this is going to be difficult. Karl Rove got on Fox News and said the president has a huge problem, and that is, number one, his support as it pertains to the economy, both short-term and long-term, has all but plummeted and is in very bad shape. And Karl Rove, as we know, is no liberal. So how do you walk back from that? Very tough. And then I look at the Atlantic interview where the reporters asked him point blank, is there any red line, any sign of the U.S. economy plummeting where you would say, okay, enough is enough and I'm going to walk back from my commitment to tariffs? And he said, no, there's no red line. I've been committed to this for 30 years. Nothing could change my mind. So that is a very sobering reality as we look out there. And so I think it leaves him with a real challenge tonight.
Well, Rick, Democrats are counting the ways here. The top Democrats on the House and Senate Appropriations Committee are out with a letter here. They've even created a tracker to determine the billions of dollars in funding allocated by Congress that has been blocked or withheld by this administration. This is $430 billion, according to Rosa DeLauro and Senator Patty Murray. $430 billion for medical research, disaster relief, aid to farmers. I could go on here. It's almost like they're taking a page out of Elon Musk. Remember the wall of receipts? We now have a tracker to determine the money that's not being spent. Is this the type of strategy that works?
Yeah, I think it's important to realize there are kind of like three buckets that everybody's talking about. There's that DOGE bucket that went from we're going to cut $2 trillion out of the budget to now we're going to cut $150 billion, right? And these are cuts. These are things that will likely not come back. Then there's this $430 billion, which are things they're authorized to spend the money on. They're just not spending it. Those checks aren't going out. The funds aren't made available to the programs that have been authorized by Congress to do. And that's what Congress is tracking, saying, hey, this stuff is supposed to be done. There's a third bucket that Russ Vought's about to send to Congress, which is $9 billion of rescissions. That means here's money you gave us. We're giving it back. We're not going to spend that money. And so, like, there is a massive reduction in spending by the federal government going on, none of which we can really track effectively right now. And by the way, we talk as if the first 100 days is at the end of the administration. We have 3 years and 400 days left to this administration, and we're just getting started. So I think you can anticipate this fight continuing for a long time.
Well, it certainly is incredible to consider the more than 1,300 days that we still have left. But of course, the president may be thinking about a kind of more immediate deadline here, Jeannie, as he wants to make sure he can get a maximum amount done with control of both chambers of Congress. Right now, Republicans have control. That could change after the midterms next year, which is why they're trying to force through this budget reconciliation package with his tax cuts included as quickly as possible. The Treasury Secretary says now July 4th is really the target to get this done. It had previously been touted by the Speaker of the House as something that would be accomplished, at least in that chamber, by Memorial Day, knowing that the debt ceiling could be a factor in here as well. Is this really going to be something that can be completed by the August recess, given the difficulty of some of the subject matter that Republicans are going to have to tackle in the coming weeks?
Yeah, they really want to just ruin your summer, Kaylee. Forget about the beach. You're going to be working either Memorial Day, July 4th. It's going to be tough either way. I think in an odd way, the fact that the debt ceiling, they may come up to it, may light a fire under them. But either way, there is going to be a lot of inter-party squabbling on these issues because we've got these small groups of Republicans who are committed, and they, unlike Donald Trump when it comes to tariffs, they do have a red line that they won't go over. I mean, we were just talking about clawbacks, and you've even got a group of Republicans in Congress who say, we don't want clawbacks of the IRA. Quite frankly, we like those investments that Joe Biden made. Then you've got the other deficit hawks. And then, of course, you've got the folks on SALT, which, is one of my personal favorites. Then, you've also got folks who are saying, we're going to draw a red line as it pertains to something else. And so these groups are going to have to come together and figure this out. And it's going to be hard to do in a short period of time. And of course, Donald Trump is running some right smack dab into a Madisonian government. It's all about divided power. Everything he's done this first 100 days has been unilateral executive power. Now he's got to deal with this other branch he's been able to run over for some time. But if they look at the same polls Karl Rove is looking at, they may decide it's not in their interest, and they indeed could lose their seats if they go along with what the president is proposing. So I think July 4th is ambitious, but Scott Bessent's a smart guy. Maybe he knows something I don't, but I think it's an ambitious timeline.
Does that unilateral approach, Rick, that Jeannie describes, the playbook for the next 100 days?
Yeah, I don't think so. Look, I mean, even though Donald Trump did a lot of things through executive order, which he'll continue to do throughout his presidency, all he has to do is pick up the front page of any newspaper and say, I'm going to issue an executive order on that today. That seems to be his MO. But remember, Congress gave him his cabinet. There were hearings, there were the votes in the House, in the Senate to confirm every member of his administration's cabinet, and the members had lots of opportunity there to hang people up and make it, quote, worth their while on a policy basis. But they didn't do it, and now they're all rallying around, the big, beautiful reconciliation bill, and I have no doubt that's what will become law.
All right, Rick Davis and Jeannie Shanzano, our political panel, thank you so much joining us as we mark 100 days in office for President Trump and look ahead to his big speech in Michigan tonight, again slated for 6 p.m. Eastern time. We'll have full coverage of that for you, but there's still more ahead here on the early edition of Balance of Power. This is Bloomberg TV and Radio.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got U.S. stocks trading at very close to session highs right now. The S&P's up 24 at 55.53 for the S&P 500 index. That is an advance of 0.4%. The Dow up 292 points, now up 0.7%. Nasdaq up 51. That is a gain of 0.3%. While the Bloomberg Mag 7 index ahead of all those tech earnings this week. Big tech earnings up by 0.1%. The 10-year 4.16%. The 2-year is currently yielding 3.65%. Spot gold is down $18 the ounce now, down 0.6%. 33.24 the ounce for the precious metal. West Texas Intermediate crude down 2.5%. 60.47 a barrel on WTI. Bitcoin is up 0.8%. Bitcoin now at 95,224. Pfizer is cutting at least another $1.2 billion from its spending while the company searches for its next big hit after the failure of its obesity pill. Pfizer shares, they're up right now by 4%. Hims and Hers Health is surging after Novo Nordisk said it would sell its popular weight loss drug Wegovy for a reduced price on several telehealth platforms. Hims and Hers up now by 26%. Novo Nordisk up by 4%. Eli Lilly up by 1.3%. And sources tell Bloomberg former New York Giants quarterback Eli Manning is putting together an investment group to bid for a piece of the NFL team. Manning led the team to its last Super Bowl victory in 2012. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And Balance of Power continues right now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
Many thanks, Charlie Pellet, watching Wall Street for us every day here on the fastest show in politics. Thank you for being with us on the Tuesday edition here on Bloomberg TV and radio. Find us on YouTube as well. Search Bloomberg Business News Live. With uncertainty being the key word at the IMF spring meetings last week here in Washington, certainly when it came to tariffs. And we're expecting to hear a little bit more on tariffs from President Trump when he speaks at the big rally in Michigan later, marking 100 days. Kaylee, it's entirely likely that that uncertainty around tariffs will be featured prominently in the next 100 days for this president, because we're talking about a lot of the potential for a lot of trade deals that could take months, if not years. The idea of a trade deal with China, 2 to 3 years, according to Scott Bessent. Maybe there's some lower hanging fruit between now and then.
Yeah, they're looking at Asian countries in particular, Japan, South Korea, India, getting the primary focus right now. But we also heard from the Treasury Secretary when he joined the White House Press Secretary Caroline Leavitt at the briefing this morning, specifically about trade conversations with the European Union and what the holdups are.
My observation would be, goes all the way back to Henry Kissinger's statement, when I call Europe, who do I call? So we're negotiating with a lot of different interests. Some of the European countries have put on an unfair digital service tax on our big internet provider. France and Italy, other countries, Germany and Poland, don't have that.
I'm not sure who the Treasury Secretary would call, Joe. I do know who we're not calling, but having live from our world headquarters in New York, and that is Josef Stichela. He is Commissioner for International Partnerships at the European Commission, joining us now on Bloomberg TV and radio. Commissioner, thank you for your time. You're, of course, in New York now, in part attending the Bloomberg NEF Summit. You also are meeting with private businesses after being here in Washington last week for the IMF World Bank spring meetings. And I wonder, based off the conversations you're having here while in the United States, if you're confident that some of these issues between the EU and the U.S. will be bridgeable in short order.
I'm confident that finally we will turn to common sense, because basically this instability is not a good message for business, because business is always looking for safe havens, for predictability, for stability. And this is something we want to offer, to remain the reliable, stable and predictable partner. And I have a good feeling that we will solve the issues to a mutual interest.
Well, Commissioner, I'm curious your thoughts on what the Treasury Secretary said this morning, that the European Union has some internal matters to work out. He specifically pointed to the tax on digital services. Is that an accurate read on the current state of affairs inside the EU?
tariffs are basically the bad things. I think for business it's better to build bridges and gateways rather than walls and obstacles. And based on our analysis, basically the tariffs, if will be implemented and if there will be escalation, will basically decrease the GDP growth in both parts of Atlantic, in Europe, but maybe even more in US. And I think that the biggest hit will be on the world trade. Based on our analysis, you know, the world trade can drop by 2% plus already this year and even more, like a 3% plus next year. And of course, the more vulnerable countries, the weakest countries will basically get the biggest hit. And this is something we have to avoid. We have to rather focus on bring basically the stability back. So we are negotiating. There are tangible offers from our side, like I do not want now to comment on details, and then finally I believe that we will find a solution to a mutual benefit, as I already mentioned.
Well, even if a solution can be found, obviously the fact that these negotiations have to happen at all, Commissioner, is evidence of the U.S. taking a bit more of an inward tilt, isolationist, if you will, protectionism perhaps comes along with that. And I wonder if you see that as opening an opportunity for Europe to fill the void that could be left by the U.S., not just when it comes to markets for trade, but also leaders in investment or in development finance throughout the world, as the U.S. seems to be turning away from those things as well.
I think that the investments in development are basically the base for global stability. And we very much regret the decision of the U.S. administration basically to decrease the involvement. Of course, this is an opportunity. This is opportunity for Europe, but what is, I think, even worse, this is also opportunity for our economic and political competitors or even rivals. So we should not leave space in other continents for more Russia or more China. And as I already said, Europe has been by far the biggest provider of development assistance with more than 90 billion. This is 42%. This is by far above our share on the global GDP. We will remain to be a predictable state partner. We stick to our commitments, and of course, we want to use this opportunity selectively to basically even increase our presence and our visibility. However, I have to be very honest with you, the gap is too big to be closed just by European Union and the member states.
Okay, so let's just have you finish that thought, Commissioner. Is the vacuum being created by the U.S. or potentially being created? Will that be filled by China?
It is one of the scenarios which can happen, and I don't think that this is the good scenario for basically democratic world. I think, you know, we have been for decades the main partners protecting democracy, protecting rule-based order, basically contributing to the world stability and providing the development assistance. And basically we still have our responsibilities in this area.
Well, and the public sector is one thing, Commissioner, but what about the private sector? As I understand, that's what you're focusing specifically a lot of your energy on this week.
This is of the utmost importance because basically with the current gap on sustainable development, the goals, which is more than 4 trillion, we will never ever be able to close the gap just with the public spending. So basically to create conditions on the partner country side, basically to create more investment friendly environment, to create e-governance principles, to basically help to implement more friendly tax environment, and on our side, basically to come with a de-risking, with a blending schemes is one of the ways how how to close the gap. And this is basically what we want to do with the global gateway strategy, to team up with private capital in sustainable development, sustainable energy production, sustainable electrification, sustainable industrialization, connectivity, to allow simply to invest in the job creation and in the value chains on spot, and to allow also these countries to access to the world markets by creating transport corridors.
Speaking for the European Commission, Josef Siegele, Commissioner for International Partnerships, with us from World Headquarters in New York. Thanks for joining us today on Bloomberg. Of course, we're a day after the big election in Canada. And as we try to unpack everything that happened and the remarkable changes that we saw politically in the weeks leading up to this contest, Mark Carney, indeed, the victor here, and more specifically, his Liberal Party. He spoke after the votes were counted.
Our old relationship with the United States, a relationship based on steadily increasing integration, is over. The system of open global trade, anchored by the United States, a system that Canada has relied on since the Second World War, a system that, while not perfect, has helped deliver prosperity for a country for decades, is over.
Let's bring you live to Ottawa right now, where Bloomberg's David Gura is still on the scene, having spent a couple of days covering this contest. David, I'm sitting here in Washington and supposed to ask you about the role that Donald Trump played in all of this. The fact is, you can't avoid it.
You can't avoid it. We learned from Radio Canada a few moments ago that the two leaders are scheduled to speak this afternoon, so we'll have to get a readout of that in short order. But the big open question now is, when are these two leaders going to meet? If you go back to what Mark Carney said over and over again on the campaign trail, he was eager to go to the White House and sit across from Donald Trump and make the Canadian position known. Of course, Donald Trump has infused himself into this election in two ways. The first, of course, is on the issue of trade and security. The second is on the issue of sovereignty. And as you heard there from Mark Carney, the Prime Minister, he's really couching this in historical terms. What he said last night in that victory speech is this is no longer a surprise to Canadians. They were surprised at first, but they've moved beyond that now, and they have to plot a way forward. And you look at the way that Prime Minister Mark Carney has approached the job since he assumed it a couple of weeks ago. He's taken trips to Europe and to the United Kingdom. He's had calls with all manner of foreign leaders. He's trying to find new allies with whom Canada can work going forward here. He's trying to find new ways for this economy to work internally, looking at the ways that these provinces can trade with each other more than they have in the past. He's clearly turning the page here. And again, Joe, the thing that we're waiting for is some indication of when these two leaders are going to meet. When that happens, Mark Carney says he's going to be forceful in his messaging about trade and the economy. He's also going to be forceful that sovereignty is not something that's negotiable for this country.
How much, David, will he be constrained, though, by the parliament that he has to work with? As we consider that this election system is a bit different than ours, the number of seats actually matters. Is that going to hinder Carney as he tries to counter the U.S. and do all of the things you were just mentioning?
This will be fascinating to watch. He has a mandate, but he doesn't have a majority in Parliament, and he narrowly got one. He didn't get it. So he's going to have to work with these other political parties, some of whom have issues of their own. The NDP, for instance, saw its leader resign after a poor showing in the polls yesterday. So it'll be interesting to watch somebody who's an avowed and proud technocrat, somebody who was a central bank governor for most of his career, now approach the politics of the job and have to assemble that coalition, assemble those agreements to make those pieces of legislation get through Parliament here. Again, just fascinating to watch that unfold, and that's definitely high on the agenda here over the next few days.
All right, David Gura, Bloomberg correspondent, live in Ottawa, where clearly, as we can hear on Bloomberg Radio and see on Bloomberg TV, the weather seems to be not as ideal as it was when David was reporting for us on Election Day, but we appreciate it all the same. And of course, I'm not sure the extent to which, although we very likely could hear about it given the proximity and the issue of the auto sector, Joe, we'll hear from President Trump about the election results in Kearney when he takes the stage in Michigan tonight, knowing that auto specifically and the transit of parts across Canada's borders, Mexico's borders is an issue as he visits Macomb County, which is an automaking stronghold.
That's for sure. He's going to be in the suburbs of Detroit talking about auto tariffs and a bit of relief that will apparently exempt automakers from dealing with tariffs stacked on top of other tariffs. Thinking of aluminum, for instance, on top of reciprocal. He's going to try to iron this out. We're getting headlines as well from the Commerce Secretary saying that he's got a trade deal pending approval right now. He's not naming that country. We've heard a lot about South Korea or other Asian partners, as well as India, though, and it could be one of those.
Yeah, and perhaps the president will have something to say on that further this evening. We'll, of course, have special coverage of that. As long as the president's talking, we'll be on the air here on Bloomberg TV and radio. It begins, though, at 5 p.m. Eastern with the late edition of Balance of Power.
We'll see you back then. And we'll be here for the duration, as Kayleigh mentioned, throughout that rally. So join us a bit later today, right here on Balance of Power on Bloomberg TV and radio.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
It is a Bloomberg Business Week. A very good afternoon, everybody. Live on Bloomberg TV, radio, YouTube, and Bloomberg Originals. I'm Tim Stenivek. Emily Grafeo of the Bloomberg News Cross Asset team is in for Carol Masser this afternoon. Emily, welcome. Good to have you. How are you?
Doing well. Markets are higher, at least for today. So
yeah, it's interesting. They're seeming to kind of look past this weak consumer confidence and labor data to send the S&P 500 toward its best 6 days, going all the way back to March of 2022. It's up more than 7.5% just in that little bit of time. We're going to have more from Charlie Pellet in just a minute. And on that consumer confidence data, we're going to be hearing from Mike McKee, too, in just a minute. Also, following everything out of Washington, D.C. and out of Michigan, where President Trump is headed, the latest on auto tariffs as the president makes his way to the heart of the U.S. auto industry to mark his first 100 days in office.
And what's going on with Amazon and those tariffs? Matt Day will clear it up for us. And that government work is costing him as Elon nears the end of his 130-day Doge stint. He's $113 billion down, Tim.
All that and more coming up over the next hour right here on Bloomberg Business Week Daily. First up, though, a check of the day's trade and top business stories. Here he is. Hey, Charlie Pellet.
Well, hello there, and here's what's going on. The Dow, the S&P, NASDAQ all pushing higher right now, with the S&P up 36, up by about 0.7%, on track for its 6th day of gains. The S&P now at 55.65. Dow Industrials up 364 now, up by about 0.9%. We got NASDAQ up 103 for the NASDAQ Composite Index. That is a gain now of just about 0.6%. The Bloomberg Mag 7 Index ahead of all those tech earnings this week, up by about 0.4%. The 10-year, 4.17%. The 2-year, 3.65%. Gold now down 0.9%, 33.14 the ounce. West Texas Intermediate crude down 2.4%, 60.59 a barrel. And Bitcoin now up 0.9%, 95,360 on Bitcoin. General Motors is withdrawing its earnings guidance for 2025 and putting $4 billion in share buybacks on hold due to uncertainty around U.S. tariffs. General Motors shares today, right now, we do have GM trading lower by 1%. Again, recapping, stocks higher, S&P trying to make it 6 in a row, up 37, up 0.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Do appreciate it. Let's talk cars, because President Donald Trump is scheduled to sign an executive order easing the impact of auto tariffs, preventing duties on foreign-made vehicles from stacking on top of other levies and lessening charges on parts from overseas used to make vehicles here in the U.S. U.S. automakers did gain as details of the tariff relief came into view, though they've since given back some of those gains, bouncing around a little bit right now. Also, General Motors pulling earnings guidance for 2025 and putting $4 billion in share buybacks on hold. This is until it has more clarity on the impact of U.S. tariffs. So, yes, a lot to get to, and we got a great group of folks joining us now. Keith Naughton is Bloomberg News auto reporter. Mario Parker is Bloomberg News managing editor for U.S. economy and government. Keith is in Detroit. Mario is in Washington, D.C. Keith, I do want to start with you. The auto tariff story is obviously a very interesting one. It's one that you're keeping a close eye on. What is the latest update and details that we have from the White House as to what actually will be removed? And a reminder that President Trump did impose these in the first place.
Right. So what we had was auto parts tariffs that were coming, Tim, this Saturday, May the 3rd. And President Trump has given sort of a partial reprieve on those. The tariffs will go forward on auto parts, but then companies can apply for a reimbursement, essentially, an offset, which starts at a certain level immediately and then goes down the following year and then goes away the year after that. So the idea is to encourage the movement of production to the United States, but to give the companies time to get that done. He's also providing some relief on what's known as tariff stacking. You might recall there's also a 25% tariff on aluminum and steel, and cars use a lot of aluminum and steel. Well, now, if you're an automaker, you don't have to pay that tariff too. You just pay the 25% tariff on import cars. You don't stack the aluminum and steel tariff on top of that.
What is offset? Like, you use this term offset. How does that work, and how is it measured, and what exactly is that?
Yeah, so it's complicated. I actually need to look at my screen to give you the correct numbers, Tim, but it starts at 3.75% worth of your U.S. built car you can apply for reimbursement on after you've paid that 25% part tariff. That goes down to 2.5% in the second year and nothing in the third year. So you get some reimbursement. I think we're still trying to gain clarity on what that actually means in dollars and cents, but the companies are responding positively. So I think it's significant.
Mario, can you talk a little bit about just where we are now in the process of Trump raising tariffs? I mean, how much relief is this causing for the automakers, and how expected was this for the industry after all of the headlines that we've gotten out of this presidential administration?
Has welcomed it. The CEOs of the big three issued statements on the heels of the announcement being reported, the reduction or the relief, if you will, being reported, lauding the administration for the move. We know that behind the scenes, of course, obviously automakers were lobbying the administration for quite some time. President Trump has said this several times over the last several weeks, that he was, he hinted, if you will, telegraphed that he would give some type of off-ramp or some type of relief to automakers with the promise that they'll onshore more manufacturing going forward. Now, that's from the White House, at least, that he said that that's the reason. He said things like they need more time, et cetera. So on the balance, this seems to be positive for the big three U.S. automakers based off the statements that we've gotten. And for the White House, they get to both claim a victory, saying that there could be onshoring of manufacturing later on, but also that he's been in some ways benevolent with the tariffs.
I think one thing that is interesting to me is that we're getting some news about foreign automakers as well that do business here in the U.S., Keith. And the reason I bring this up is because the president has touted companies such as Hyundai coming to the U.S. to make vehicles. But if my understanding of this is correct, these foreign companies that are manufacturing vehicles in the U.S., which I think is what the president's goal is, they could also be hit?
Well, I mean, you know, the one thing to keep in mind is that foreign manufacturers have been building cars in this country for over 40 years. Your Toyota is coming from Kentucky, your Subaru is coming from Indiana, your Honda is coming from Ohio. The biggest importer of cars to the United States is General Motors, America's #1 automaker. They import more cars to the United States than Toyota, Mercedes, any other company. So the notion that, you know, it's a zero-sum game, that cars that come into the United States are foreign. Well, those cars have names like Chevrolet and Dodge on them. So they're not foreign. They're U.S. brands. They're built outside of the United States.
But at the same time, there are companies like BMW and Mercedes that look foreign to American consumers, but those cars are built, some of those vehicles are built here in the U.S., Keith.
Absolutely. Alabama, Mississippi, throughout the South, Volkswagen, you name it, just about anybody. Hyundai has said they're going to double their U.S. production. Hyundai Kia is one of the biggest importers. After GM, it goes Toyota, then Hyundai Kia. So they're going to double their production, investing $21 billion in the United States. President Trump is looking for more announcements like that.
Okay, well, speaking of announcements, Mario, the president is set to deliver remarks tonight from Michigan, the heart of the U.S. auto industry. The messaging here, I think there are outside analysts who would argue that he's essentially going back on what he's imposed or what his administration has already talked about. What's his messaging around this going to be later?
Well, his messaging will be that he's done all of these things in his first 100 days to benefit the blue-collar worker, even as polls show that the president is losing support and the confidence of Americans, both specifically on his economic plan, as they've been rattled by the tariff rollout. He's going to tout, I mean, he's going to Michigan to announce what we're talking about right here with the some of the tariff relief, and again, to characterize it as saying that he's there for those working class voters. And one thing that is striking is that we haven't seen, this is the president's first real rally since he's won the election. So we see the White House starting to get him back out there in order both to sell the tariffs, to pivot toward this reconciliation package, this tax bill that he's billed as the second prong of his economic relief to Americans, and then also to interact with voters again and try to raise his standing and his political capital.
Keith, we got some news from General Motors earlier today that they're pulling their earnings guidance for this year. It's a theme we've seen across industries, but for autos specifically, how have the tariffs thus far affected this industry, and is today's change going to kind of change the future of that at all?
Well, the automakers are certainly hoping that this relief will make the future less dire. They were very, very concerned that full tariffs on parts would really break the bank. But it is already affecting things. What has happened is there's been this rush to dealerships as consumers head out and try and get cars before the tariff prices hit, which are expected to come this summer. So there's this big surge. March sales were up 11%. They're running high again this month. There was this big surge in sales that is expected to then taper off when the tariff prices hit this summer.
Hey guys, gonna have to leave it there. Thanks to both of you for joining us. That's Keith Naughton, Bloomberg News auto reporter, Mario Parker, Bloomberg News managing editor for U.S. economy and government. As I mentioned, the president making his way to Michigan to mark his first 100 days. The backdrop to that visit is a consumer that's feeling a little bit less confident. U.S. consumer confidence fell in April to an almost 5-year low. This on growing pessimism about prospects for the economy and the labor market due to tariffs. Michael McKee is Bloomberg News economic and policy correspondent. He joins us here in the Bloomberg Business Week studio. Mike, I'm going to get to the consumer confidence numbers from the conference board in just a minute, but first I want to just pick up on some comments that we heard from the Commerce Secretary, Howard Lutnick, earlier on CNBC. He said that a trade deal is pending approval. We don't know the details, who that would be with, but there's also some confusion about who actually can make a trade deal. Just clear that up for us.
Well, it depends on what you're talking about. If you're talking about an agreement to continue negotiating, sure, they can do that. Agreement in principle that if we cut our tariffs, you'll cut your tariffs. But any kind of detailed trade agreement is going to have to be ratified by the Senate, any kind of treaty. So I doubt that in the last week or so they've gotten that far on anything. So this will just be sort of public relations and sort of maybe a step forward, but not real progress.
So should we think about that in the context of a big deal with China that ostensibly could get done during this administration? It would have to be approved by the Senate?
Well, it depends on the kind of agreement that they make. There is something called an executive agreement, which the President Trump made with China in the first term that you didn't have to have it ratified, basically, but it was just a series of promises. It wasn't a treaty that would be enforceable. And of course, as we know, the Chinese did not live up to their promises.
We got a lot of economic data today. We still have more coming up later this week with payrolls, but I want to start with consumer confidence, because we know that sometimes what consumers say they are feeling is not exactly what they're actually doing. There was a recent Fed study about this. But what did you make of the data out today from the conference board? Decreasing, consumer confidence decreasing for the 5th straight month, the longest stretch going back to 2008. Is it all due to tariffs?
It's pretty much all due to tariffs and the kind of surrounding confusion and chaos in the administration. The interesting thing is that current conditions didn't really move all that much, went down just a little bit, but expectations for the future really cratered down to the lowest since 2011. People are hearing that the import taxes are going to go up, and they're hearing that we might have a recession, and they're hearing that we might see unemployment rise, and so they're getting worried about it. But as you pointed out, the Fed has always said we watch what they do, not what they say, and they just came out with a study last week saying that what they say doesn't really match up well with what they do. People have been complaining since the end of the pandemic that they feel lousy about the economy, but not only are they spending more, but they're buying more things. So they haven't cut back on their spending because of that. Now, we haven't had a recession since then, so maybe what the consumers' confidence numbers are telling us now is going to turn out to be different. But you have to take with a little grain of salt in terms of trying to predict the future.
Okay, well, speaking of data, we did get some data today that showed that U.S. merchandise trade deficit unexpectedly widened in March. This to a record. Companies continued importing goods to get ahead of tariffs. What did this data tell you?
Well, this is one where you can predict the future because we get the GDP numbers tomorrow, and this is probably going to put us into a contraction. The deficit was so wide, and it's largely because people were trying to front-run tariffs. The biggest increase in imports was in consumer goods, up 27%. Biggest increase in exports for the U.S. was in automobiles as people tried to get them out the door before tariffs made them too expensive. So you could really see the tariff impact. Now, because it's so wide and imports subtract from GDP. Most analysts think that we're going to probably now, they've plugged in the numbers to their spreadsheets. They think we're going to see some sort of contraction. You get different numbers from different people, but the Atlanta Fed GDP now, which everybody follows, is looking at about a 1.5% contraction in the first quarter.
The cross-asset team on Friday did a whole story about alternative data and how Torsten Slok from Apollo, he was one economist, but we had other people that we interviewed, investors, economists, looking at things like TSA, checkpoint data, amount of people driving for Uber, shipping data was one point. I'm wondering if in your side of the world of economics, you're looking at alternative data to kind of discern some signal about the economy that maybe the more hard data, more traditional data isn't telling us yet?
We look at all kinds of data, and this has been going on for a very long time. It really kind of ramped up during the pandemic when the government was mostly shut and we weren't getting complete data sets from the government, and everybody started looking at things like open table. Are people going out to eat?
Or the subway turnstile.
The subway turnstile.
Info, which you can get on the terminal.
Yeah, all kinds of things that people call alternative data. Now, there are alternative data sources being used by the government, the BLS for prices, and in retail sales, they get data from private providers, and they work that in. ADP's numbers go to the Fed, and they massage those to put into whatever they're doing. So it's not something that's particularly new. The thing that is getting a lot of publicity these days is the shipping numbers. The folks from the Port of Los Angeles have been out talking about how there's no ships coming in, et cetera, and a lot of people are worried by that, and they think that we're going to possibly see some empty shelves. So that's gotten some traction. But it's not a completely new thing. Although I heard the Fed is asking for your credit card statements.
Yeah, I had to book a bunch of flights. I have weddings coming up. I was telling Mike McKee.
All right, so you're contributing to the economy.
Yes.
Mike, before we let you go, 10 seconds on JOLTS.
JOLT's kind of meaningless right now at this point. We know that we still have more job openings than we had prior to the pandemic, but nobody's hiring. So do they really count as job openings? It's not something the Fed is going to be particularly concerned with at this point.
All right, Michael McKee, Bloomberg News economic and policy correspondent. Stocks higher, the S&P up by more than 0.7%. Up next, Amazon and tariffs. Matt Day is going to clear it up for us. That's next on Bloomberg Business Week Daily.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ. They're all advancing right now, very close to session highs on the S&P 500 index, up 32 right now at 55.60 on the S&P. That is a gain of about 0.6%. Dow Jones Industrial Average up 313 on the Dow, higher by 0.8%. The NASDAQ Composite Index up 0.6% right now. NASDAQ up 97. We've got the 10-year yielding 4.16%. With a 2-year, 3.65%. Spot gold down $28 the ounce, down 0.8%, 33.16 the ounce. West Texas Intermediate crude down 2.5%, 60.48 on WTI. And Bitcoin up 0.8%, 95,283 on Bitcoin. Amazon says it never planned to widely display the cost of President Trump's tariffs on products after the White House blasted the reported move. We got a whole lot more on the controversy coming up in just a moment. Amazon, though, on an update for the rest of the market. Amazon down 0.2%. Economic bellwether UPS expects to cut 20,000 jobs this year and close dozens of facilities as it dramatically reduces shipments for e-commerce giant Amazon.com. UPS down 0.1%, rival FedEx down 0.9%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Do appreciate it. Well, Amazon said today that it will not display the cost of U.S. tariffs on products after the White House blasted the reported move and President Trump called Jeff Bezos to complain. The White House earlier Tuesday seized on a brief Punchbowl News report that Amazon would, quote, soon begin displaying the cost of U.S. tariffs on individual products next to the total listed price. White House Press Secretary Caroline Leavitt blasting the purported plans.
I just got off the phone with the president about Amazon's announcement. This is a hostile and political act by Amazon. It's another reason why we are onshoring critical supply chains here at home to shore up our own critical supply chain and boost our own manufacturing.
That was White House Press Secretary Caroline Leavitt earlier today. Matt Day joins us. He's Bloomberg News technology reporter. He covers Amazon. He's out there in Seattle. Matt, clear this up for us. What's going on here?
So Amazon says there's nothing to see here. What they say is they do have a program that kind of like Temu will ship parcels cross-border from China and Hong Kong.
This is Amazon Haul.
Amazon Haul, that's right. This is kind of a little-known service compared to their retail site. They launched it last year. So what Amazon says is they were considering for a time, putting import duty notices on those products, right? Those products, today are exempt from duties. That's a loophole that the Trump administration is planning to close as soon as this week. Temu has already, shown customers and shoppers, some version of what the import duties would be. They were considering doing that. The report out this morning from Punchbowl that you referenced earlier didn't make that distinction, and that's what the White House was responding to. Amazon comes back to us today and says, listen, we were never thinking about anything for our wide retail site. They also say they're not going to implement this for Haul either.
So, Matt, Amazon's response, was it directly because they were, responding to the White House, or does your reporting show that they really weren't ever planning on doing this?
It's not clear to us how far along these talks were. I mean, it is worth noting again that, people have been throwing around screenshots on Temu for a couple of weeks now, showing that for folks getting things cross-border after the de minimis loophole, as they call it, gets closed, they were showing them duties. So it would make a whole lot of sense for Amazon to be considering something like this. We don't know how close it was to rolling out. And to take Amazon at their word, this was not something most shoppers would have seen. It wouldn't have been on their main retail site.
Well, what could shoppers... Sorry, go ahead, Matt.
It definitely looks like they were responding to the White House. Once the before Seattle was awake this morning, the press secretary, accused them of a hostile and political act. So they've definitely had to pick up the microphone on this one.
Yeah, maybe gets the attention of a certain Jeff Bezos who spends time in Florida these days. Matt, I'm wondering specifically about the de minimis tax and what consumers might see as a result of these tariffs going into effect. Our prices on Amazon for stuff that we buy that is imported, how much are those prices going to go up?
It really depends. So Amazon, they buy things and they get things to consumers in a whole lot of ways, right? In addition to the direct, Temu-style shipments, they're also a classic big old retailer. They buy in bulk, just like Target or Walmart or Home Depot might. They import things themselves. Some things their sellers import. So it is all a big mess. We reported that Amazon, in some cases, has asked some of its vendors in China to do the importing themselves, right? Which seems sort of a first sort of negotiating tactic to maybe pressure them into eating some of this cost. But we just don't know what the bottom line is going to be for consumers. There's a lot of estimates out there.
When we were speaking earlier with Mike McKee, Emily, you brought up this idea of looking at container shipments and ships that are going into the U.S. Matt, at this point, are we starting to hear of concerns with regard to empty, quote unquote shelves, empty storefronts on Amazon as a result of a slowdown in shipments from China?
Nothing specific to Amazon, kind of beyond those broad reports we've all seen about, hey, container sailings are way, way down from, this point a year ago. I think that's probably still too early for an Amazon-specific story, given that, we haven't seen the calendar roll into May, which is really when the first glimpses of this might appear. It's worth noting, too, that Amazon hasn't said a whole lot about tariffs one way or the other. They really don't want to stick their neck out on this. And so that's part of why today was so interesting, is that they're in the conversation whether they want to be or not.
Matt, I'm sure the folks at Amazon today were hoping that we'd all be talking about something else Amazon related, and that's Project Kuiper. It's their first batch of production satellites that reached low Earth orbit, and it's a step in the company's effort to establish a broadcasting internet connectivity from space. It sounds a lot like SpaceX. Is it a viable competitor to SpaceX?
A lot of people are hoping so. A lot of businesses have dreams that it's not just going to be Elon Musk's Starlink with an internet from space outfit. A lot of government entities as well have banked on Kuiper, Amazon's satellite offering coming online at some point. So this is much delayed, but it's welcome news for the folks at Amazon who are plugging away on this. They got plans to launch something like 3,000 more satellites here in the next few years.
How far ahead of Amazon is SpaceX right now with Starlink? And also, I'm curious about who actually did the launch here, because Starlink has its SpaceX satellites, which can do the launching. Bezos, of course, has Blue Origin, but who got these satellites into orbit?
So these ones were sent by United Launch Alliance, a workhorse Boeing Lockheed joint venture that accounts for a ton of U.S. government business. But you're right, because SpaceX has its own sort of captive launch arm that is the most successful rocket launch outfit in the world right now. They've been able to get out to a huge lead with their Starlink constellation. They've got more than 7,000 satellites, I think it is, in orbit. Amazon's sitting on 27, so they got a whole lot of catching up to do just before they're in the same conversation as Starlink.
And I know that retail customers, like individuals, households...
Like Carol Masser.
Carol Massel's using Starlink?
She's got Starlink.
So is this project supposed to also gear towards just regular, everyday people getting internet connectivity from space from Amazon?
It will, yeah. They plan to offer a regular consumer business. It's going to vary market to market. In some places, you'll be working with a cellular service provider probably, and others they're going to sell direct to consumers. We don't know a ton about the business plan, but they've already kind of showed off the little terminals you can put on your garage or on top of your house.
All right, Matt Day, going to leave it there. Thanks for clearing all of this up for us. We do appreciate it. Matt Day covers Amazon. He's out there in Seattle. He's Bloomberg News technology reporter. Let's shift gears a little bit and talk sports and sports business, because former New York Giants quarterback Eli Manning is putting together an investment group to bid for a piece of the NFL team. That's according to people with knowledge of the matter. Randall Williams is part of the team with The Scoop. He's U.S. sports business reporter. He joins us here in the Bloomberg Business Week studio. Randall, Eli wants a piece of the Giants. What do we know?
Exactly that. I mean, he's putting together a group. He's long expressed interest. He said it on CNBC earlier this year. He's told me privately. He said it publicly. If there was one team that Eli was going to own, it's going to be the team that he plays for.
How much money is this worth? Like, what? Give us a sense of the numbers that we're talking here.
So I think we don't know right now, but if you look at the previous two transactions, or two of the three transactions that the NFL had, the Philadelphia Eagles are valued at 8.3. Philadelphia